I said, shall we ask her? She's had a baby a month back, but maybe she's ready. And she did take it when she was asked. But the bias that carries that she's just had a baby a month back, how is she going to move cross-border? That's her problem to sort out. The choice is for her to make and her family to make. And I think it's important we start asking and sponsoring the women talent more consciously.
I think you're absolutely right about that. I think a lot of the behavior is self-limiting. Women hold themselves back, but equally organizations also tend to hold back, assuming that it is something that a woman may not want to do or may not be able to do, and so on and so forth. And as you pointed out, just ask the question, give the woman the choice to say yes or no. And I think that is the least that you can do for somebody who works with you.
Let me add something to that, Shriram. So not just ask, also make the environment conducive for that lady, give her and her ecosystem that coaching and enable how she can make it do, rather than, obviously it's difficult to do, but how can she make it do is also the organization's responsibility.
What is the one question that you've been asked over and over again in the many decades that you've been around in the financial services sector that you still wonder, I'm still being asked that question?
Can you manage family and work together? I'm surprised. It's been 30 years and I still hear the same question, not for myself, but I hear the girls being asked the same question even today. And it's very disappointing.
It is very disappointing. None of the men are being asked that question. How are you going to manage family and work? And if you are going to ask the women that question, you better ask the men that question as well. Ritu, many, many thanks for joining us. Swati, thank you for being here with us. You started up in 2013. You've had marquee investors come on board at Cash Karo. Again, you know, a lot of people say women lack ambition, women lack aspiration. I mean, we have enough examples in this room and enough data to say that that's not the case. What have been some of the biggest deterrents in your journey so far, but also, you know, where have you got your tailwind from?
I think the first tailwind actually came from Ambala, which is where I grew up. And when I grew up, the most I wanted to do was actually, no offense to Delhi, but to go and study at St. Stephen's because, and you know, which is like, I was going to say that, look at the, you know, which is great. But, you know, like I didn't know beyond Delhi is what I'm saying. Like I didn't know anything being in Ambala from like beyond Delhi. And my grandfather used to say that, he used to tell my mom that you will not marry her at the age of 21, which is what may have happened with you. She is going to study. So he had that thing. So my dad came across this advertisement for Singapore scholarship after class 10, and he said, you topped Haryana, why don't you apply for it? And I said, Papa, what are the chances that a girl from Ambala will come in the top 25 people, you know, across guys and girls across India? And then I looked at myself. This is what women do all the time. We always discount ourselves first before the world discounts us. Yes, exactly. So I applied for that. I got that. Then I got a scholarship to London School of Economics. Then I worked at Goldman Sachs in London for 5 years, started our business, moved to India, raised money. But I think the first tailwind came from actually my friends and family, my aunties and uncle from Ambala, who actually, when they saw that Singapore scholarship, 20 people got together. 16 saal ki ladki ko Singapore jana chahiye ki nahi? And they said, oh, jana chahiye. And I also made a case. I said, if I don't go, how will ever your kids go? You need some role models. And after that, a lot of kids have gone abroad to study. So tailwinds come when you let girls have ambition, when you don't tell them ki kya zarurat hai. शादी तो करनी है. That's what people say. पढ़ लिख के क्या होगा? MBA करके क्या होगा? You'll get a good husband, as if that's the goal of life. So tailwind comes when people encourage you to think beyond that. That husband is not your goal.
I mean, it could also be part of your goal. It cannot and should not be the only goal that you aspire for. But you know, in the last 10 plus years of building Cash Karo, you know, what have been some of the biggest hurdles that you've had to face, especially when and we hear so much about the fact that it's always very hard for women founders to raise money and so on and so forth. What advice would you give to female founders who are looking at raising capital today, who are looking at starting up today, who are also looking at scaling up today?
Well, we've raised 250 crores in funding so far, and our Series A was Kalari Capital. And at that time also, Vani and I were the only two females in that entire room. And after that, Mr. Ratan Tata came on board as an investor. And when we met him, we had that 20-minute conversation. And what changed that conversation was me asking Mr. Tata that, you know, instead of pitching here on the side, because he was sitting and having his lunch, I was like, there'll be no eye contact, no relationship. How will he ever invest? I said, sir, do you mind if we sit across across from you and have a conversation, just those same 20 minutes. He said, yeah, do that. But because it was a chat, he liked us, he liked the business, and he invested. So I think every time I forced myself to ask the question and to not doubt myself, write myself off before it had even happened, it paid off. And then Series B was Korea Investment Partners, where I was pitching to a room of 30 Korean men, because that was what investment committee of KIP was like. And I didn't think many of them even understood English. So I was looking at the graph saying, look at the shape, look at the shape, right? And but that's fine. I think what happens is you grow through it. And even my Series C was 130 crores. And I was actually going to have a kidney transplant 3 months after that Series C round. So I had it in my mind कि मुझे तो दोनों करना है, because I am going to do both. My hemoglobin was 5.5. My kidney function was 3 to 4%. And I was sitting across as if, yeah, so what? Because actually, so what? Things do go wrong in life. I was always glad that my problem is one I know. Things happen out of the blue. So health and everything is actually a mental game. Can you make yourself mentally strong enough? Can you make yourself mentally such that, I even disclosed it to the investor before they wrote the term sheet. And I said, this is going to happen in 3 months. And it was an all-male investor, and they said, it's okay, we know you'll bounce back. And I did. Within 2 weeks, I was back home, working from home, and it was fine. So yeah, thank you. And I think, so therefore, it's not as much about men or women. I think we also have to remember that investors are in it to make money. So if they're sitting across from somebody who they think can deliver, who has a business that is, in our case, we have precedents of success abroad. Why can't we do it in India? It's a much bigger market. So I think it's all about how you communicate that vision, and if you demonstrate that you have the confidence. And I think to do that, to get there, the advice I would give to women also is that there are some shifts that we need to make in ourselves to show up for good. Stop pre-apologizing. Stop over-explaining. Take a compliment. Take interest in money. Don't think that my father or my husband or someone's going to manage all that. We are earning it, but we are not investing it. We are saving also, but we are not investing, because we think that part to someone else will manage. But the minute you start asking those questions, which you think that, oh, ab tak to usko ye pata hi hona chahiye, that's when you actually take control of your finances. And I think financial independence and financial literacy is very important for every woman, because if you want to get out of a situation in life where you want to get out, you can only do it if you have a choice. It could be a bad marriage, it could be a bad job, it could be a really hurtful boss, or whatever it is that is killing your vibe or your soul. You can only do it if you are financially independent.
Well, can I just say that you're absolutely brilliant, Swati. Take that compliment with all the love that we're giving it to you with. But thank you so much.
Hello and welcome to India Business Hour. I'm Ashmit Kumar. Here are the headlines that we're tracking this evening. Sun Pharma acquires US-based Organon with an enterprise value of $11.75 billion. This is among the largest foreign acquisitions by an Indian company. The Lal Street waves a thumbs up to the deal, which will double Sun Pharma's annual revenue to more than $12 billion. Iran's foreign minister arrives in Moscow for talks with Russia's President Putin as he steps up diplomatic efforts to end the war with the US. President Trump says Iran's leaders can call us to negotiate after cancelling a planned visit by his envoys to Islamabad. Crude oil prices remain elevated as the Strait of Hormuz is choked for shipping. Israeli attacks kill 14 people in Lebanon in what is the deadliest day since the ceasefire agreement. The Lal Street snaps a 3-day losing streak. Nifty ends above 24,000. All sectoral indices close in the green. Pharma and IT stocks lead the gains. Mid-caps outperform. Rupee is above 94 against the dollar despite marginal gains. Government considers 5,000 crore rupees in emergency credit to airlines impacted by the war in West Asia. more than 15,000 flights cancelled in the last 2 months, leading to potential losses of nearly 6,000 crore rupees. Indian Airlines are currently operating at only 25% of their scheduled flights to the Gulf region. The war in West Asia has also led to a spike in fertilizer prices. The cost of urea has nearly doubled. Sources say government's fertilizer subsidy bill could rise 20% and cross 2 lakh crore rupees. Reserve Bank issues final rules for asset classification and provisioning by banks under the new expected credit loss mechanism. The rules will take effect from April of next year. A sweltering heat wave scorches large parts of the country. More than 90% of the world's hottest cities are now in India. Weather department warns conditions could worsen over the next few days. The 31-year-old gunman who fired shots at the White House Correspondents' Dinner set to appear in court. Officials say the gunman was targeting President Trump and administration officials. The gunman appears to have acted alone and had a shotgun, handgun and knives. The high-voltage campaign for West Bengal draws to a close. Election Commission tightens security around 142 constituencies that will vote on Wednesday. Union government holds a high-level meeting with states to crack down on counterfeit goods to finalize a roadmap for nationwide enforcement. Adulterated food and spurious medicines emerge as a national challenge with more than 24 seizures in just the last 3 months. Auto rickshaw and taxi driver unions across Maharashtra up in arms after state government plan.
US President Donald Trump is reportedly unhappy with an Iranian proposal because it does not address Iran's nuclear program. Meanwhile, Iran condemns the US seizure of Iranian-linked tankers as piracy and armed robbery. It was a subdued session on Wall Street overnight. The Dow ends with losses while the S&P 500 and the Nasdaq close at record highs. Markets in Asia have opened lower as investors assess the latest US-Iran signals. The GIFT Nifty for now is indicating a lower start for our own markets. Brent climbs towards the $109 a barrel mark as markets assess the likelihood of a lasting ceasefire and the potential reopening of the Strait of Hormuz. Meanwhile, gold prices are holding within a narrow range as investors assess renewed diplomatic efforts to resolve the US-Iran conflict. The war in West Asia has also led to a spike in fertilizer prices. The cost of urea has nearly doubled. Sources tell CNBC TV 18 that the government's fertilizer subsidy bill could rise by 20% and cross the 2 lakh crore rupee mark. And in key earnings today, Maruti is expected to report fourth quarter numbers later today. A steady quarter is expected with double-digit revenue growth seen on healthy volumes. Also watch out for numbers from Eternal, who is likely to report a 5% uptick in revenue on a sequential basis. A very important trading session lies ahead for our markets, not only for the earnings front, but it's also the monthly expiry of the Nifty contracts. Good morning. You're watching Power Breakfast right here on CNBC TV 18 in the Mumbai News Center. I'm Hormuz Fatakia. Let's first start with how the Asian markets have begun trading this morning, and it is a mixed picture. The Hang Seng was slightly above the flat line yesterday. It's slightly below the flat line today. So no significant moves on the Hang Seng or the Shanghai Composite in either of the first two sessions of the new week. The Nikkei is underperforming today, down around 0.5%, but the outperformance continues from South Korea. The Kospi is up 1.5% and has now overtaken the UK to become the 8th biggest market in the world, has the South Korean market, considering its outperformance last year and of course the continued outperformance this year as well in 2026. So a new high for the Kospi and 1.5% higher in today's session as well. The rest of the markets, though, across Asia are subdued, are trading slightly below the flat line as we speak, and that's showing off on the GIFT Nifty as well. It's the monthly expiry today, so you'd expect some degree of volatility on that front as well. The implied open currently is suggesting a gap down start of 100 points. Remember, we were up 200 yesterday, so if this holds, we might just give up 50% of what we gained in yesterday's trading session. Now on to updates from West Asia. A US official says President Donald Trump is unhappy with an Iranian proposal because it does not address Iran's nuclear program. This comes after Trump discussed the proposal with his top national security aides. Meanwhile, Iran's Foreign Minister Abbas Araghchi has met Russian President Vladimir Putin in St. Petersburg and said that Tehran is considering a US request to restart talks. Meanwhile, dozens of countries gathered at the United Nations have warned that instability in the Strait of Hormuz is continuing to disrupt global trade and energy supplies. UN Secretary General Antonio Guterres has appealed for freedom of navigation in the critical waterway, saying that a prolonged disruption risks could trigger a global food emergency.
I appeal to the parties: open the strait, let ships pass, no tolls, no discrimination, let trade resume, let the global economy breathe. Prolonged disruption risks triggering a global food emergency, pushing millions, especially in Africa and South Asia, into hunger and poverty.
And based on all of these developments, oil prices are continuing to inch higher. Brent was 2% higher overnight, and they have opened higher in early Asia trading as well. Manisha Gupta is here with all the updates from the commodities market. Manisha, good morning. Oil, well, nearing 110 now.
Oh, absolutely, yes. Overnight was 3% of gains, and we are just inches away from $110 a barrel for the Brent prices there, and just inches away for $100 a barrel for the U.S. crude oil prices as well. So even as we do understand that there is a new proposal from Iran to U.S., but U.S. in its tweets and statements has expressed skepticism on Iran proposal. And with the U.S.-Iran war now in its 9th week, the markets seem to be building up long positions when it comes to crude there, with expectations that we are heading higher if the status quo continues. There are various reports suggesting that by the end of May or mid-May for some of them, we could be inching towards $120 to $135 a barrel if the things continue to be as they are right now. We have seen stronger gains come in also for the metal prices, whether it's copper, aluminum, Tin is trading at a 1-month high as well. So many of these metal prices continue to be at multi-month or multi-year highs. And the latest thing, Hormuz clearly has been the agriculture prices. So whether it is about soybean, rubber, cotton, wheat, corn, drought concerns, El Nino concerns, fertilizer prices on the higher side, and then, of course, the West Asia conflict seems to be increasing inflation for many of these agricultural commodities also.
So, tough times for a lot of these commodities. Manisha, thank you for that update there. Oil prices, the key monitorable for our own markets, of course. Take a short break and set you up for today's trading session on the other side. Stay tuned. Welcome back. Let's get you prepped for today's trading session. Our research team is here with the trade setup, the stocks that should be on your radar, and of course the setup on the F&O side of things as well. Firstly, Vivek joins in to get all the market cues that we need to watch out for today. Vivek, good morning. What are you watching out for?
Good morning, Hormaz. Quite a lot on the plate today, given the fact that we are in the thick, in the middle for very heavy earnings season. Well, first, as you mentioned, overnight cues largely mixed. U.S. markets ended mixed, almost near the flat line, and Dow Jones actually managed to end with minor cuts. Oil prices, however, continue to edge higher. Brent now hovering around $108.5 to $109 per barrel. Now, coming to Asian markets today, Asian markets all indicating mixed, mostly negative cues what we're getting as far as Asian markets are concerned, and GIFT Nifty 2 indicating a gap down start. In terms of yesterday's markets, remember yesterday India managed to go ahead and snap a 3-day losing streak, and the clear outperformance yesterday came in from the pharma pack, especially Sun Pharma, and in the mid-cap space it was Cohen's Life Sciences hitting the upper circuit. MobiKwik too, one of the top performers in yesterday's trading session. In terms of what is it that we'll be watching out for in terms of earnings reaction, remember, keep an eye out for AU Small Finance Bank, good numbers, City Union Bank. Earnings today, Maruti, the top number that analysts on the street will be watching out for, Eternal as well as Bandhan Bank. On the other hand, keep an eye out on the entire PSU banking basket. The ECL norms have been notified by RBI. Looks like a slight negative read across the PSU banking universe especially.
Keep an eye out on these PSU banks today. That will be the big monitorable. Vivek, thank you for those updates there. Over to Upasna now, who will list out the long list of stocks that should be on your radar today. Upasna, good morning.
Good morning. First up, let me start with Coal India. Overall good set of numbers. Revenue up 6%. Margin has seen an uptick of 12 basis points. PAT up 12%. And Jeffries has also retained a buy with a target price of 500 per share. City Union Bank, good quarter overall, and the asset quality is also positive. NII has seen an uptick of 31%. Deposits also grew 23% on year-on-year basis. And companies' GNPAs have also fallen to 1.9%. Bajaj Housing Finance is the next one. The company says it's a strong quarter with good growth and even asset quality has improved. NII has seen an uptick of 15% on year-on-year basis and a downtick of 2% sequentially, and disbursement for the bank stood strong at 17,506 crore with an uptick of 23% on year-on-year basis. Piramal Finance, overall good quarter with strong growth, NII up 41%. NIMs have also improved to 6.5% in Q4 with an uptick of 23 basis points sequentially, and overall GNPAs have come down to 2.3%. Phoenix Mills, overall a good quarter for the company. Net profit up 50%, revenue up 21%. Margins have also expanded from 55% to 60% on year-on-year basis. Jindal Stainless Steel also in focus as government extends quality control orders exemption for stainless steel with onboard date up to October 2026. Railtel in focus on the back of that order boost. It has received LOA worth 145 crore from Eastern Coalfields. And lastly, coming to Bajaj, Balaji Amines, the company has said that the global ammonia supply chain is improving, allowing a gradual restart to the production of ammonia-based products. Hence, this stock will also be on our radar.
Upasana, thank you for those updates there. Lastly, Sudarshan joins in with cues from the F&O space. Sudarshan, good morning. The monthly expiry today, the bulls would be hoping that the 24,000 mark is still defended. But what's the F&O data indicating?
Good morning, Hormuz, but it's not so good morning as far as the commentary related to state of Hormuz is concerned. But talking about our data for the market, especially F&O data, things have improved in the last 24 hours. And why I'm saying so, yesterday, we have seen that major put writing in the range of 24,000 to 24,200. Even the action from the FI side have indicated towards positive things. First, FI's sell positions in the cash market has come down drastically. And second, FIs have added long positions in the derivative market after selling for 3 consecutive days. Also, 24,100 will become an important level because it's important for both call writers as well as the put writers. Now talking about the FIs in the derivative market, in the index futures, they have sold and selling figure was just 320 crore. But in the stock futures, they have bought more than rupees 1,400 crore. And also they have added long positions of more than 1,600 contracts. Their long exposure remains around 19%. On the short side, the addition was just 3,500 contracts and the exposure is 81%. Put writing, the reason I've told you, look at the put call ratio. It has increased to 0.99 versus previous day's level of 0.78. So it indicates you the put writing, and that's the reason 24,000 and 24,100 put options were active, where we have seen a sharp drop in the premium, while on the call side, 24,100 premium has risen. So support for Nifty, 23,700. That's your 20 DMA, and resistance will be your 50 DMA of 24,250. One stock remains the band, that is SAIL. Some of the stocks that will be in focus because of the earnings. Small Finance Bank, it was a very strong set of earnings. Supreme Industry, earnings were good, but the commentary was mixed, so there might be a negative reaction in this. And Varun Beverages, strong earnings and strong commentary, so we can see further upside.
Possibly lost count of the name puns now, Sudarshan. Thank you for that update there on the F&O side of things. And just before we move on, pull up Brent again. It's up now above 109. We started off the day just around about the 108.50 mark. It's now at 109.30 as we speak. So a percent higher again on Brent. NYMEX 2 nearing that 97.5 a barrel. Now moving on to action from Wall Street, the S&P 500 and the Nasdaq closed at fresh record highs on Monday, but gains were limited and because of the stalled Iran peace talks and rising tensions in the Strait of Hormuz that lifted oil prices and capped the gains. The Dow, however, ended in the red. CNBC's Deirdre Bosa gets us a wrap of all the action on Wall Street.
U.S. markets were mixed across the major indexes on Monday trading, with the S&P and the Nasdaq both hitting all-time highs again. The Dow fell 63 points, the S&P 500 was up 9, and the tech-heavy Nasdaq gained 51 points. Jury selection began Monday in the landmark legal battle between Elon Musk and OpenAI CEO Sam Altman. Musk, who co-founded OpenAI, sued the company, fellow co-founder Altman, and OpenAI president Greg Brockman, alleging they abandoned a commitment to keep the AI startup as a nonprofit. OpenAI calls the lawsuit baseless. The trial will be divided into two phases: a liability phase to determine if wrongdoing occurred, then a remedies phase to determine damages and next steps. A group, meanwhile, of budget airlines, including Frontier and Avelo, are asking the White House for more than $2 billion in aid in return for stakes in the companies. According to the Wall Street Journal, they calculated that amount by estimating how much more they would spend on jet fuel this year. The proposal is separate from a possible government investment to rescue bankrupt Spirit Airlines. That's what's happening here in the U.S. Back to you in Mumbai.
Now, here's some opinion from Jeremy Siegel and Roger Ferguson on the Fed leadership as the U.S. Justice Department has ended its investigation into Fed Chair Jerome Powell.
I don't think the drama surrounding Jay Powell is over. I understand that Tillis will let Warsh go, but I haven't read anything that says that Powell accepts what Trump has done, stopping the investigation from the Justice Department, whether that's sufficient for him to leave his position. And that's very important. We all know that he won't be chairman, and that's okay. But we know he has 2 more years that he could serve if he wants. And at that last meeting, he seemed to make it clear, unless I am exonerated, completely exonerated, I will stay on as board member.
Obviously, no one really knows. He'll tell us maybe this week. But frankly, in the world of, complete, total exoneration, put this behind us, I'm not sure that the move of this investigation from Justice Department someplace else really fully checks the box of putting this behind us. It's important that it not be a criminal investigation, obviously.
Right.
But I'm not sure that if I were sitting in his seat or his advisors that I would say, let's blow the all clear whistle on this and move forward.
And that is the view coming in on Jerome Powell. But of course, Jerome Powell and company will be in focus tomorrow because of the big Fed decision and what could possibly be his last policy as Fed chair. Take a short break. On the other side, we get you all the expectations from Maruti, who's reporting numbers later today. Stay tuned. Welcome back. Onto the big result of the day. Maruti Suzuki is going to be reporting numbers later today. Let's go across to Sudarshan to tell us what the street is working with. Sudarshan.
The biggest automaker of the country, Maruti Suzuki, is going to report its earnings for Q4 FY26, and it's going to kickstart the earnings for the auto sector. And we are expecting a steady set of earnings as far as Maruti Suzuki is concerned. So on the revenue front, it's going to be supported by the double-digit volume growth that company has seen despite capacity constraints, and volume growth YOY was up almost 12%. As far as the realization is concerned, that will also be boosted by the increased mix of the export segment, and because of that, realization too will improve by almost 12% YOY and 1% on a sequential basis. But one concern that will be for the entire auto sector, that is rising commodity costs, and that will have an impact on the margin. Now talking about the headline numbers, we can see both not only profit, even revenue and EBITDA can see a double-digit improvement. As far as the profit is concerned, it might improve by 12%. Revenue can increase by almost 26%. And EBITDA too can see a jump of 44%. And we can see margin expanding to as high as 12% versus 10.5% in the same quarter last year. Volumes up 12% YOY, 1% on a sequential basis. Realization too 12% up YOY and 1% on a sequential basis. But this time, more than the earnings, what would be important for the entire auto sector is the commodity, because there's a sharp increase in the commodity cost over the last few months. So except Maruti, majority of the companies have already announced price hike. So we'll see what time Maruti announces price hike. Second, central government recently released the draft emission, CAFE emission norm draft, and also Delhi government had released the EV policy draft. So what exactly does Maruti management talk about? So commentary more important than what company releases in the earnings.
A most important factor to watch out for today. Sudarshan, thank you for that update there. Now, the government has flagged that fertilizer prices have taken a sharp hit due to the West Asia crisis. The fertilizer department has said that urea prices have nearly doubled since the start of the conflict. Sapna Das brings in more details. Sapna, take us through what the government has said.
Well, these are estimates being given by the Department of Fertilizers. So overall, they expect the FY27 fertilizer bill to be higher, or rather the subsidy bill to be higher by at least 20% at the current international fertilizer prices. The Department of Fertilizers is on record saying that the urea prices have doubled since the West Asia crisis started. The natural gas prices have also doubled. The price of other fertilizers also in the international markets have gone up. And India has been doing some, heavy imports, especially in terms of the urea imports as far as they are concerned. There's also the ongoing Kharif season, for which the availability is in plenty, but the demand is going to peak somewhere around June 15 and all of that. So government wants to be just prepared and to be on the safer side. But the cost implication is something that they have already factoring in, the Department of Fertilizer, and they have also said very clearly that they are in constant communication with the Department of Expenditure in the Finance Ministry. So additionalities have already been sought, and we are now given to understand that the fertilizer bill for FY27 is going to be around 20% higher at the current prices, which means basically with a budget estimate of around 1.70 lakh odd crore, you can expect the fertilizer subsidy to cross around 2 lakh odd crores at the current prices. The rest, of course, for the Rabi season, we'll have to wait and watch and see. That's quite some distance away, so we'll have to see how the situation pans out. But definitely the cost impact is coming in, especially, a large part of the India's, fertilizer imports are now coming from the non-Hormuz route. So the transit is also taking additional time, around 40 odd days, and that's also adding to the costs additionally.
Sapna, thank you for that update there. We take your leave on this edition of Power Breakfast, but just as we do that, a quick programming reminder. We step back from the noise of quarterly results and ask a far bigger question. Is one of India's most defining economic engines, the IT services sector, at an inflection point? Catch sector experts on our special market forum, The Tech Trade. Today, 4:30 p.m. onwards, we invite you to be a part of this conversation, where you can send in your queries on the email ID on your screens, and the first 50 entries stand a chance to receive an invite to join us in the studios.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Nigel and Rima. Guys, good morning.
Hi, morning.
Hi, good morning. Tuesday morning looks like holding pattern for US markets, but at record levels. GIFT Nifty slightly down, but we've got the Nifty monthly expiry and a lot of earnings to track.
Well, that's right. It's been actually a very, very good series. So let's see whether or not the bulls can end it with a bit of a flourish. For the time being, I think the GIFT Nifty is suggesting a bit of a subdued start, but it's been a very, very good month of April after getting slammed in March.
You know, it's been a good month for us. It's been an outstanding month if you look at technology stocks. It's almost like it's 1999-2000.com, era. If you look at an index of semiconductor stocks in the US, it is blown out. It's 40% higher in April, right? And these are large companies that we're talking about. So, yeah, I mean, it is. April has not been bad, despite, of course, the war continuing, etc. By the way, I think today is the 1 month anniversary, or the what is it? The war started 28th of February, right?
So
it's 2 months. 2 month anniversary.
2 months.
Who would have thought it would have lasted 2 months, right?
Yeah, 2 month anniversary of the anniversary is the wrong word. It's like a happy occasion, but basically it crossed the 2 month mark with regards to the conflict going on. All right, well, let's just quickly take it from the top. I want to just start with a few things which perhaps act as kind of triggers, right, as we look ahead. April has been consequential. May looks pretty action-packed as well. Elections will wind down. 29th is the last day of polling tomorrow. Post-elections, question is, will we see fuel price increases? All indications are that perhaps you will, but small staggered, nothing very large. 4th of May is the state election results. Markets very focused on what happens in Bengal. Will Didi, will her vote share and the number of seats she had, she was at 214. How will that change? 15 years anti-incumbency, right? I mean, it's part of democracy, but will it really mean that she kind of gives way to the BJP in a meaningful fashion? And that's, I think, more than anything else, that's what the market's focused on, at least in the next 1 week or so. And then you've got, during sometime in mid-May, US Secretary of State Marco Rubio, who's going to visit India. And the only reason I'm mentioning that is because it's kind of not on the radar anymore at all. Remember, the Indian trade delegation was in the US and they just returned after almost a 2-week-long trip. So could we see some movement on the trade deal between, maybe a framework agreement or whatever before the US Secretary of State, Mr. Rubio, is in India? So just leaving it out there, and if that is the case, I mean, it could be pretty important for especially stocks which have been beaten down because of the lack of an agreement, because of high tariffs, etc. So that's the short bit. Now, the here and now, Brent oil prices are $107, $108 a barrel this morning. We're actually 109 now, so 1% higher. This is the contract. This is the near month contract. I mean, the front month is now trading at about 102, 103, so which is also creeped up, by the way, but there's some difference. US equities, which they closed higher but small. I mean, NASDAQ was up about 0.2% or so. But technology stocks have done so phenomenally well that it is just crazy. As I was saying, that index of semiconductor stocks in the US having absolute blowout April, 40% on large semiconductor stocks in the US in 1 month. I mean, that reeks of what we used to see back in the day, 99, 2000 kind of phases. In terms of the actual negotiation, Iran, US, etc., remember, same time yesterday we had reported that Axios, the news organization, had said that Iran had offered US a deal to reopen the strait, but by postponing the talks around the nuclear enrichment, nuclear weapon, etc. And we got a response to the story by the White House press secretary, who said that Trump had discussed the proposal from Iran with his national security team, but that the US maintained red lines on any deal to end the war
including preventing Iran from obtaining a nuclear weapon, basically saying that they're not budging. Trump has, of course, gone to town in the US and social media everywhere that, the primary objective is that Iran will not have a nuclear weapon. So it's kind of going to be hard to walk back from that position, but we'll see. In terms of cues ahead in the US, it's going to be large cap earnings. So Google, Microsoft, Amazon, Meta all report numbers on Wednesday. Apple will report on Thursday. So it's a pretty earnings-heavy session when we come back on Thursday morning, especially after all the numbers Wednesday evening here. And just to tie in the levels, after Friday, the market sold off big time. Yesterday, the market recovered. But the important point is we didn't break below the 23,900 odd levels, which is the support that we had highlighted, which is where we left off on Friday. And we're at about 24,100 now. So most likely, I think we head back once again to the nth time to the 24,300 level. And then if that is taken out to the 24,685 levels, that is the neckline, which has moved higher. On the downside, if 23,900 breaks, you're basically looking at about 23,550, which is a swing low, which is the lower end of the full gap area that the Nifty came up from. So those are levels, 24,300 immediately on the upside. And of course, 24,900, 23,900, which the market has respected. GIFT Nifty gives you a quick sense of where we are starting. We'll pick it up from there. 120 odd points lower is the indicative open. Nigel has walked across with the FNOQs. Nigel, take it away.
Well, the GIFT Nifty is suggesting a bit of a start on the back foot, but this has been a very, very good series for the bulls, and they'll want to end it with a high, because for this series itself, the Nifty has bounced up close to around 8%. It's been a solid showing in April 2026 so far. The problem is Brent crude prices continue to remain elevated, and dollar index as well is holding on. It's been rather firm in the last couple of trading sessions at around 98.5 odd. So it appears our markets have focusing on the political developments at the center, in the last few days. And it also appears that they're sniffing a strong showing from the ruling BJP in the state elections. That appears to be the case. In the next few days, markets will be looking at that because we'll get the state election results in the next week or so. The other positives yesterday, though, were that the India VIX, that cooled off. It was heading towards the 20-odd mark. That cooled off close to 7%. So that's good. The advanced decline ratio as well, firmly in favor of the number of stocks that are advancing. And you like that. The breadth of the market is good. Individual stocks as well did very, very well. So though the Nifty ended higher, you'll be happier with regard to the broader markets. And that's been the big outperformer, not just in this month, but from the outbreak of the war as well. You have the mid and the small caps that have done very, very well. In terms of flows, the DIs, they put in the big money yesterday. They've returned back to their buying base. Close to 4,000 crores is what they put in. And the FI selling came down drastically. You want them to be more or less flattish, or you can take a sell number of 1,000, 1,500 crores or thereabouts. But that, 7,000 crore of net sell number, that's what bears on our markets. For yesterday, the institutions were net buyers. Looking at positioning, the FIs, they went ahead. They added some short positions, in yesterday's trading session. More shorts than longs. The short positioning holds at around 81%. But on stock futures, they added more longs than shorts. Remember, they have been net long on stock futures itself. Moving to the options data then, in yesterday's trade, the call writers, they had to run for cover. So all those calls that were written earlier, they packed their bags. 60,000 contracts were unwound, but there were signs of some put writing in yesterday's trading session. So looking at the options data, I'll give you the levels. Now, in yesterday's trade, yesterday's low at around the 23,930 or thereabouts, that becomes the first level of support that you're looking at. That's yesterday's low. Important that we don't breach this mark. You're looking at 23,900 ballpark out there. If that breaches, then all eyes on the 20 DMA. But till this range holds out, you'll be expecting the markets maybe to continue that move to around that 25,000 odd mark. On the upside, the first level of resistance comes in at around the 50 DMA. So expiry day, volatility will pick up, particularly in the final hour of trade. But that 150-point dip, some of the bulls will be tempted to get in there and hope that the expiry plays out the way the series has played out as well.
Thank you very much for that. And we've got three major central bank decisions in rapid succession. Today, BOJ just awaiting that decision. But on Wednesday, we've got the FOMC decision. ECB meets on Thursday, while none are expected to change the rates, but all are important given the Middle East backdrop. Robert Subramaniam, head of global macro research in Nomura, Singapore, is now joining in. Thank you very much for joining in. Rob, today is FOMC day one. Powell's last meeting as the chair begins today. Now, you've titled your note, Central Banks' Bark Will Be Bigger Than Their Bite. Share your views with us, and what's the expectation from the various central banks this week and through the course of the year?
Yeah, thanks very much. So I think central banks around the world, you have many officials sounding more hawkish, so they're barking louder. And I think that makes a lot of sense because they want to give a perception to markets that they are ready to raise rates if they start to see second round effects from the headline spikes in CPI. So I mean, start to see inflation expectations going up, start to see wage demands picking up. Then you'll start to see inflation feeding into the core inflation. And that's what central banks want not to happen. So they'll be barking, but I don't think they're going to be biting in the sense of hiking rates at this early stage. I think it's more wait and see, but it makes a lot of sense for them to sound a bit hawkish and to warn that they are ready to raise rates if they start to see those second round effects. But this week we have a bunch of meetings, the Fed, BOJ, Bank of Canada, ECB, Bank of England. We have them all on hold.
So you believe they're unlikely, just talking about the Fed, for instance, unlikely to raise rates. But what about the argument that they hold steady through 2026? Because crude prices are up 50% from the time this war started. Gas prices have crossed $4 a gallon. So at some point, inflation is going to start hurting. You're calling out for 2 rate cuts in 2026. Why not a steady? Why not no rate cuts?
Yes, it's a good question. So our view is that for the US economy, out of all the major economies, it's probably the most insulated from this energy shock. Yes, gas prices are rising in the US, but broadly speaking, the US is a pretty large net energy exporter. So we don't think it's that exposed. But the biggest reason why we have cuts is because of the change in the Fed chair, likely to happen in June now, with Kevin Warsh likely to take over the helm. Our view is that he has a view that the AI boom is going to be a significant productivity boost to the economy and disinflationary, and he wants to start to position monetary policy ahead of that. And so we think that that means there will be rate cuts by the Fed. We have rate cuts in September and December. So not straight away when he gets in as chair. It will take a little bit of time to settle in, but we think those are the arguments for rate cuts. And probably in the second half of the year, our assumption is that oil prices will kind of be stabilizing. And so the kind of inflation pulse, the month-on-month readings, will start to ease off as well, which provides some further ammunition for Kevin Warsh to kind of make the view that there's room to cut rates.
Rob, hi, morning, Prashant here. You know, as long as there is, I guess President Trump will say whatever it needs to be said to keep energy from spiking. I mean, just throw in the hope, expectation that maybe a deal is possible, just possible, only if, right? And that keeps markets excited and hopeful. But the point is, physical oil markets have got to clear, right? I mean, and if I was looking at physical prices in Asia, Dubai, etc., $117, $118, whereas paper prices are $108, $109, right? And physical prices are lower than where they were, which was the high which we hit, 145-ish. So is there a readjustment which needs to take place there, or the market's already readjusted? I'm saying readjustment higher for physical prices if this continues.
Yeah, you're exactly right. The physical or spot market for the oil price has a high premium relative to the financial prices for, like, the futures prices for oil. And I think there is definitely shrinking supply out there. I think a lot of the floating storage of oil is being used up. Strategic reserves are being used up. And so I think, Prashant, it's all to do with timing. If this Strait of Hormuz stays closed for, many more weeks, it's quite possible that this supply-demand imbalance that I think you're really seeing still in the physical market more than in the futures market will start to dawn on the energy market, and you'll start to see the futures prices starting to rise and that gap closing. So I think it is a matter of timing. I think for the futures market, there is hope still that a deal can be struck and that the Strait of Hormuz can be open, but I think we are running out of time. So I think what you allude to is a significant risk that if we continue as we're going with no resolution, it's quite possible that we do get a renewed spike in the futures oil markets.
Hi, Rob. Morning and good to see you, Ben. Let's come back to India then. You know, one after the other, we have been getting news flow, right? First, it was the tariffs. Then we had that AI factor that played out. And then, in fact, now the war. That said, how do you read India's current economic situation? You know, as you mentioned in the past, the regulators were doing a good job. The government as well was trying to protect us from those higher tariffs. But at current reckoning, how do you see the Indian economy shaping up? And also in terms of RBI action, with Brent crude prices at elevated levels, there's only so much they can do, right? Rate cuts out of the window?
So I think last time I was on this show, I talked quite positively about India's backdrop, and I still believe so in terms of, India's had started with a Goldilocks economy here with, strong growth and low underlying inflation, and it has created some fiscal space and monetary policy, I think, has gained credibility. So all those things have been good. So it went into these shocks. And then, as you say, it's a triple shock now, right? It was tariffs, then it was the software, and now it's oil. Triple shock is starting to wear on the economy. So, Q1 GDP growth for this year was 7.3, we think. It's probably going to slow further. Q2, Q3 will probably be around 6.5% or so. So there is some effect. Clearly, the longer that oil prices stay high and energy prices overall stay high, the bigger the impact on India's economy, the bigger the strain on the fiscal deficit, and the bigger the pressure for the government to start to maybe reduce some of those oil subsidies, but the consequence then is higher inflation. So it is getting more challenging, I think, for the Indian economy, but it's in a better place than I think it would have been if it didn't start with this positive backdrop that it had.
All right, Rob, we'll leave it there. Thank you very much for joining us. It's always a pleasure, and a lot more questions. We'll have you back on to talk about those. Thanks,
Prashant.
Thank you. Right. Well, we'll just quickly run you through the interactions lined up here on the program. At 8:35, we have the management of Rallis India to discuss their fourth quarter numbers. 9 o'clock, we have Rajesh Ravi of HTC Securities putting the spotlight in the cement space. Ultratech numbers yesterday, 9:20. Nimesh Chandan of Bajaj FinServ. AMC is a market master. 9:30, we have a discussion on the new ECL expected credit cost, the expected loss provisioning guidelines from the Reserve Bank of India and what it means for financial institutions. We have BOFA's Amish Shah joining us at 9:40, and we'll talk about the entire power theme. Later on, we bring you a discussion around supply chain disruption and labor shortages at 9:50. That's an important topic, which I think is getting talked about in the industry. End of the program, AU Small Finance Bank joins us to talk about fourth quarter numbers. Sanjay Agarwal on it. So that's the lineup.
Well, time to slip into a short break, but we've got a lot of stock-specific action to track for you today. We get to that in just a bit. For the time being, I give you a sneak peek. Ultratech Cement, Coal India, AU Small Finance Bank, City Union Bank, Phoenix Mills, Bajaj Housing Finance, Pyramid Finance, and banks. They'll be on our radar on the back of positive news flow. While Jindal Saw and Jindal Stainless could start off on the back foot. Take that break, come back, we get into further detail on all of these names.
Welcome back. Let's talk about stocks. Our research team is standing by with CNBC TV 18's list of top stocks for the day. Nigel, in closing bell, you were telling us UltraTech's volume numbers look good on an organic basis.
Well, UltraTech, at this sort of scale, when you give these sort of numbers and that sort of a commentary, there's no reason to sell the stock. Maybe one would argue that the upside could be limited on valuations and other parameters, but otherwise, stellar numbers, good commentary. You can't fault this sort of, the king of the ring, so to call it, the largest cement company. The volume growth first. They're saying that they're going to be growing in double digit, which is better than what the industry will grow, because the industry will grow in single digits or high single digits. Next, on capex, they're talking about 8 to around 10,000 crores of capex per annum, but they're also saying that they'll maintain a solid dividend payment, which is encouraging. That's a sweetener that's coming there. On market share, they're expecting gains to continue because they're going to be setting up capacity. Brownfield capex, remember, for them will come at lower capex, which will also help them maintain their edge with regard to relatively better ROCs, maybe in the mid-teens itself, which is better than the low teens that others will be at. So capacity addition will be faster than the industry. They're going on focusing on the cost optimization initiatives, and that's been their strength over the last few years. Remember, they've already realized 185 rupees in terms of efficiency gains in the last 2 fiscals. They're bracing for another 120 rupees, which gives you close to 300 rupees in that entire plan on the cost savings front. They say that the cement price hikes will outpay any kind of cost inflation, and Q1 costs are manageable. If you have to see an impact, it'll be in Q2, but they're pushing through some price increases. And, the organic growth has been good, but even inorganic growth, picking up companies and then turning them around. Kesoram is already at 1,000 rupees per ton of EBITDA, and they've maintained their target, 1,000 rupees for India Cements by FY28. So put everything together, numbers good, commentary good, going with green on this one. But hopping across to Ananya, she's here to tell us about Bajaj Housing and Piramal Finance. Ananya, morning.
Now, Bajaj Housing Finance and Piramal Finance both delivered a very strong Q4. Let me first start with Bajaj Housing Finance. Now, AUM grew 23% YOY, disbursement rose 23% YOY, and net interest income grew 15% YOY, PAT grew 14% YOY. When we look at the margins, they softened a bit with NIM declining 3.8% from 4% quarter-on-quarter, and spreads compressed 10 bips quarter-on-quarter due to lower home loan pricing and attrition of higher yield loans. Now, when we look at the asset quality, it remained excellent. GNPA at 0.27%, NNPA at 0.11%, credit costs at 19 bips, ROA at 2.3%, and ROE at 12%. Now, management guided that in the first half of FY27, margins are likely to remain stable, but some FY27 compression is likely. This will be partly offset by lower credit costs and better operating efficiency. Now, ROA is expected near the upper end of 2 to 2.2%. Guidance range. Now, Sambhav Housing is scaling well with monthly disbursement target around 600 plus in 12 months. Now, overall, we can see it was a strong quarter for Bajaj Housing Finance. The margins will be the key monitorable in the coming future. Now, coming to Piramal Finance, total AUM grew 25% YOY and 5% quarter-on-quarter, while the core growth book grew 33% YOY. PAT jumped 390% YOY. Full year PAT rose 210% YOY. Now, margins improved with NIM rising both YOY and Q-on-Q to 6.5%. Now, asset quality strengthened with GNPA improving quarter-on-quarter to 2.3% and retained delinquency remaining low at 0.6%. Now, management highlighted that the legacy book is now below 3% of total AUM and should become largely irrelevant in FY27, which is a key positive for the company. Now, for FY27, management guided for around 25% loan growth and nearly 50% profit growth. So overall, we can see it was a very strong quarter for both the companies.
All right. Thanks a lot for that, Ananya. Well, it's been a busy evening for me and a busy morning as well, because I'm also tracking Coal India. Numbers have been regrouped, so you can't compare it with our poll. Now, what the company has done is they've added the collective cess to the revenue, and they've adjusted in other expenditure as well. So that's why, the top line, all the numbers, in fact, looked inflated. The problem is the core volume growth, that's been missing just in the past quarter as well as over the last few years. Now, if you're looking at one positive from the numbers, it's that the employee cost actually is down. And because over the last 1 year, they reduced the manpower by close to around 4%. However, in the coming months, there'll be a wage revision. So we'll have to track that as well. But the core business, looks extremely weak, and we had some of those numbers with us. The offtake was down by close to around 1%. We already had that number. But the blended realization as well is down by close to around 1.5%. So, you're talking about an environment where global prices are moving up, and Coal India is going ahead and reserving prices at lower levels, to help some of their customers and keep inflation under check. And that's the risk you run with regard to a PSU. So that is well a little bit disappointing. However, the sweetener for Coal India comes in that they give big dividend. For the year, they've given more than 25 rupees. For the, as of yesterday, they announced another 5 rupees 25 paise. So that gives you some kind of cushion. And Jefferies, they retain a buy rating. They have a target price of 500 rupees. They say after the 12% EPS fall that we've seen over the last few years, they are expecting Coal India's earnings trajectory to improve with a 5% CAGR earnings growth over the next 2 fiscals. And valuations they find it attractive at around 9 times PE and 6% dividend yield. So though the numbers are a little bit subdued, but there are triggers going ahead. And as we know, there's so much of focus on power stocks, and this will be a play on that as well. Hopefully, the e-auction prices actually move up in line with what we have seen on the globe. But let's move across back to Ananya. Ananya, you're tracking a couple of more companies. Please go ahead.
So City Union Bank and AU Small Finance Bank also delivered an excellent quarter. Let me first start with City Union Bank. So advances grew 26% YOY, deposits grew 23% YOY, and total business grew 24% YOY. Now Q4 net interest income grew 31% YOY, while net profit grew 25% YOY. For FY26, net profit grew 18% YOY. Margins improved with Q4 NIM at 3.87%, while ROA remained steady at 1.56%. Now asset quality was the biggest positive, with GNPA at 1.91% and NNPA at 0.68%, supported by PCR of 84%. Now capital position also remains strong at CRAR at 21.92%. So overall, it was a very strong quarter for the company. Coming to AU Small Finance Bank, excellent quarter delivered. Net interest income grew 23% YOY, while profit after tax jumped 65% YOY. Loan growth remained healthy at 21% YOY and 8% quarter on quarter, while deposits also grew strongly by 23% YOY and 10% quarter on quarter. Now on ratios, NIMs improved sharply to 5.96%, ROA rose to 1.8%, ROE stood at 17%. Asset quality also improved with GNPA at 2.03% and NNPA at 0.74%, while slippages and credit costs also declined meaningfully. Now management commentary was constructive. They are targeting growth of around 2 to 2.5 times the nominal GDP by FY27. FY27 credit costs at 90 basis point and cost to assets below 4%. Now management also reiterated the medium-term 1.8% ROA target. Now, universal banking license progress and AI-led efficiency remains a key positive for the company going forward.
All right, Ananya, thanks very much for that. Well, Phoenix Mills is the next one we're going to focus on, and Sonal has got details. Sonal, good morning.
Good morning, Prashant. It was a good set. We did get the consumption numbers early April itself, and the revenues on the back of that were up 21%. EBITDA is higher by 32% in the quarter gone by. Margins up 500 basis points, leading to a profit growth of 50%. The balance sheet looks good because their operating cash flow is up 16% on a YOY basis. However, their net debt has also gone higher to 3,160 crore rupees. A lot of it is for lease financing, lease rental financing as well. Their retail consumption was at an all-time high in FY26, up 21% at 16,578 crore rupees. So it means higher rentals or higher income for the mall as well. And their Q4 consumption was up 31%. The stock already reacted around 8-9% on the back of their Q4 update. The results are good as well. Let's see which way things go today.
Okay, all right. Thanks a lot for that, Sonal. Well, I'm tracking two more names. One is Jindal Stainless, and a bit of a negative news actually has come for them, because imports could be a little bit more liberal, which is a bit of an issue, because India has gone ahead and granted QCO exemption for various grades of stainless steel. Remember, QCO is quality control orders. The exemption to be valid for imports with bill of loading having shipped on or before the 26th of October 2026. So basically, imports could continue to trickle in. So that's why that will be a bit of a disappointment on that front, going with a bit of a red tinge on Jindal Stainless. But going to Ritu, she's here, she's tracking some of the banking names. Ritu?
Well, Nigel, in October, RBI had issued this draft, and now you have the final guidelines on expected credit loss provisioning. It's a major overhaul of how banks recognize stress and provide for it, and it is going to come into effect from the 1st of April 2027. Remember, banks wanted the implementation deadline to be deferred, but that's clearly not to be now. Now, RBI has introduced a three-stage structure, as it had indicated. Stage 1 is going to carry 12-month expected loss provisions, and Stage 2 and 3 will require lifetime provisioning, with Stage 3, which is as good as your NPA, going up to 100% for unsecured exposure. Now, RBI has also set the floor, the minimum provisioning that banks will have to do. So for Stage 1, 1, it is at 25 basis points to 40 basis points. And for stage 2, it goes as high as 5% across most loan categories. It is slightly lower for housing and gold at about 1.5%. The 90-day NPA rule is unchanged. So if one loan turns an NPA, all exposures of that particular borrower will also have to be tagged as an NPA. Now, in terms of impact, the stage 2 provisioning rises very sharply. Remember, currently banks to about 40 basis points. That goes up to 5%, and that could push up the credit cost as well, especially for PSU banks, because they don't really hold excess provisioning buffers. There could be a one-time net worth impact of 5 to 10% and credit cost rise of 20 to 25 basis points, while most, at least the large private banks, will be relatively better placed.
Okay, all right. Thanks a lot for that, Ritu. Well, I'm also looking at Jindal SAW. Maybe the stock starts off in the red because the numbers are a little bit disappointing. The revenue degrowth, you had EBITDA number was down, margins compressed by close to around 350 basis points on a year-on-year basis, though the profit number looked up because that's in the base year. There was a big tax outgo. However, there are some positives and they appear to be in the right line of business. So I expect the stock to recover from the lows of the day because they're into transportation of oil and gas and various other triggers as well. They're both domestically as well as with their exposure to the Middle East. The consolidated debt as well has come down on a sequential basis, which is good to see. And the company has reported an order book of around $1.3 billion for the iron and steel pipes as well as pellets business, which is good, with exports constituting close to around 30%. So it's giving you some kind of visibility. Numbers weak, tailwinds in store. Stock could start off a little bit flattish or in the red, and then you expect the stock to recover from the lows of the day. But let's do a quick recap of all the stocks that we're covering for you. The ones with positive news flow: UltraTech Cement, Coal India, AU Small Finance Bank, City Union Bank, Phoenix Mills, Bajaj Housing Finance, Pyramid Finance and banks. While stocks with negative news flow include Jindal SAW as well as Jindal Stainless.
Okay, moving on now to commodities. Manisha is now joining in for a complete roundup. Manisha, crude still at very elevated levels, 108.
Oh, yes, absolutely. The inches away from 110 is how we opened the trade today. So very strong gains continuing into this one. And if you remember, most of the banks and brokerages also did make a point that if this West Asia conflict is prolonged and the Strait of Hormuz does not open, then you could be looking at prices much higher. If I look at the latest reports from many of these banks and brokerages, they're talking about levels of around 120, 135 as well by the end of May if the situation continues as status quo. So inches away from 110 for the Brent prices therein. This is as the US-Iran war is now in its 9th week. And even as we do understand that Iran has sent a proposal, US has expressed skepticism on the Iran proposal. So we do not seem to be getting closer to a resolution at this point in time. But what has seen constant gains has been the base metal prices. Tin is trading at 1-month highs, copper near 2-month highs, aluminum near 4-year highs, zinc prices near 2-month highs as well. So many of these metal prices continue to hold around multi-week and multi-year highs. The only segment that's not doing so great right now is the precious metal prices. Gold and silver in the negative for the week as well, but energy and base metals on the positive.
Okay, all right, Manisha, thank you very much for that. Let's take a quick commercial break here. Mayuresh Joshi is going to be with us with some fundamental stock conversation coming up in just a bit.
Welcome back. Here tuned into Bazaar Morning Call here on CNBC TV 18. Well, we have Mayuresh Joshi, Director Research at MarketSmith India, who joins us on the show. Hi, Mayuresh. Good morning. Good to see you. Well, Mayuresh, I think the last time we chatted, you spoke about Welspun Corp, and that's moved pretty well. And in fact, it appears the street is willing to look ahead. So good call on that. But we want to ask you about a couple of other companies as well. Let's talk about Coal India. Super story, right? Global prices are moving up. Power demand is expected to recover. But neither are they growing in terms of volumes. And e-auction prices also as well are not going up. In fact, they put out a release that they want to keep inflation under check. From a shareholder perspective, how much can you bet on these valuations and dividend yield? What's your view on the stock at $450?
Morning, Nigel. No, I think from an earnings delivery perspective, obviously, I think Coal India has been disappointing investors over the past few quarters. And even on an annualized basis, as we speak right now, both in terms of coal offtake as well as the sales number that has probably come through, is lesser on a year-on-year basis as the numbers indicate. Obviously, I think the expectation in terms of FSA prices, they have actually held up pretty strongly in excess of 2,100 rupees per ton as we speak. But e-auction prices have definitely been lower on a per ton basis, around 2,900 rupees as we speak again. And therefore, I think the expectations in terms of power demand expected to rise exponentially, at least in this quarter and over the next few quarters as well. What does Coal India do with the projects under consideration, specifically in terms of the evacuation lines that they were probably expected to go through, and expectations in increase of e-auction realizations to be more specific? If they're able to do that and manage that well, I think numbers might probably be a little bit different as we exit 27 and 28. It's a totally different ballgame, Nigel, in terms of how execution will probably take place. And that is the biggest risk for Coal India as we speak. The 6% dividend yield works in its favor, but that's not the only factor that is at play. They're probably trying to create alpha in the market. So anybody holding can hold, but from a growth perspective, my own sense is that execution probably has to improve along with realizations to make some element of an impact on numbers.
Mayuresh, UltraTech, right, was the other one which has surprised the street with a big dividend, a dividend policy.
Yeah.
What do you make of it? And what does the stock do from here?
Morning, Prashant. No, I think, again, a decent set. And I think the commentary in terms of expected volumes in double digits is something that will enthuse the street going forward. Obviously, I think what we've probably seen in terms of input cost inflation that is probably expected to go a tad bit higher because of the Middle East prices, or the West Asian prices to be more specific. I think that will probably place some element of a negative bias, if I can call it that, at least as Q1 is concerned. But again, I think the expansion plan probably is being on track. The EBITDA per ton should probably have a steady show as well going forward. And therefore, as a proxy in terms of the entire manufacturing process that India is probably expected to go through, Prashant, and the expectations in terms of a large part of the end user market, specifically the housing market, and specifically the government schemes, I think that should probably affect cement volume growth and consolidation that we've probably seen in the industry as well. Similar to Coal India, I think we're not in the buying camp here, but anybody holding UltraTech should definitely.
Got it. All right. What about, other couple of names? Jindal Stainless, it appears in the near term, imports could come in, because some of those quality control measures have been relaxed. Some believe that the company is actually a converter, so it shouldn't be termed under the basket, under the metals basket. And that's why some believe that it could enjoy a higher multiple. But this appears like a bit of a negative. What's your view on Jindal Stainless?
Let's wait and watch, Nigel, when it comes to Jindal Stainless in particular. I think if you're probably looking at the grades of steel that Jindal Stainless probably produces, I think it's higher grade, premium, niche quality that they're probably having. The realizations are relatively better compared to the market. However, I think in terms of end user demand, how does that play out from an immediate near-term perspective? I think that is a cause of concern. We have obviously heard the applications of stainless steel over the medium to long term. As they improve the kind of dynamics that are probably expected to go through the demand-supply deficit trends that might also probably emerge in terms of converters like Jindal Stainless, I think it might work in their favor over the medium to longer term. But from an immediate short-term perspective, I think there are a lot of headwinds at play, which probably make us believe that it's better to wait and watch.
Okay. Now you like Welspun Corp, but some believe now the other players as well could do well. Case in point being a Jindal Saw. The stock, I recall, from the top has come down drastically. Now, these numbers are nothing to write home about. But some of these companies who are into transportation of oil and gas with a decent order book, balance sheet pretty much in order. And Jindal Saw, I recall, last year they went ahead and they announced a capacity addition after a while. Some believe they were lacking aggression. Any view on the stock at around 240, a stock that's come off drastically from those 400 plus levels?
A very interesting story, Nigel. And again, I think the kind of capacity built up that they're probably expected to do, specifically in terms of the manufacturing bases that they're trying to create out of the Middle East, I think that's still work in progress. And therefore, I think as a percentage in terms of export revenues contributing on the overall balance sheet is still relatively lesser. Obviously, I think the underlying theme, whether it's Jindal Saw or Welspun Corp, or a lot of these pipe companies remain probably in place. I think there is a lot of expansion that is expected to happen. Aramco has laid out a huge budget, and specifically after this war, as it gets over, I think there will be a significant outlay and a push through in terms of execution. Iraq is probably doing a lot of work on oil and gas in terms of desalination, in terms of water treatment as well. And so are projects in Oman, Qatar, and the UAE as well. So there's significant work in the UAE that is expected to come through. And let's not also forget, I think the NCLT case that Jindal Saw probably has, the lower court has probably ruled in its favor. But if there is some element of conviction that probably comes through in terms of a final hearing on that front, I think that can create a huge effect in terms of the balance sheet that Jindal Saw probably possesses. So multiple plays out here for Jindal Saw, but at this point of time, I think we still prefer Welspun Corp. And in fact, even a domestic stock like a Maharashtra Seamless, just as an example, Nigel, I think the kind of capacities and the kind of utilization of the market share that we've probably got, even in our own analysis, I think the Indian government will also go all guns blazing when it probably comes to energy, transportation, and infrastructure, looking at what has probably transpired over the last few months in the Middle East.
Okay, within the banks, what do you like? You know, there is this ECL norms that are come, and Ritu has been telling us for PSU banks, it'll be a little bit negative. It'll be more or less neutral for the private sector banks. Yesterday, you had the Nifty Bank actually ended higher, mildly higher, but there was a big disparity. You had stocks like Axis Bank actually that were down. You had another financial name like Shriram Finance that was down. But InterGlobe Bank did well in trade. RBL Bank was under pressure as well. So there's an entire mixed picture coming in there. What's your preference first between PSU and the private names? And individual stocks, what do you like?
I think point well taken that Ritu probably laid out. And therefore, I think the ECL norms will probably have a one-time impact as far as provisioning is concerned. And again, that's going to happen in the first half of FY27. However, I think if you probably pull out, I think large part of the numbers of the banking universe as a whole, I think if the PSU's provisioning or the PCRs have probably moved way higher than what it was before. And therefore, I think if you look at the large part of the mid-cap PSU universe, the kind of coverage that they've got is now exceeding 85-90% in a large part of cases. So I think even if that impact probably comes, it might be a one-time impact. And they've got the advantage in terms of sticky deposits with them in tough times. And therefore, I think for large banks to grow their deposit base and correspondingly have a significant growth in terms of advanced deposit ratios, managing asset quality at the same time is something to be watched out for. And therefore, I think the bias in terms of rating rankings as we see it in markets in India still remains selectively with PSU banks. Within private, I think a few of the mid-cap private banks is somewhere where the performance might be relatively better. So banks like Crude, which have been lagging for a long period of time, Bank of Baroda within the mid-cap PSU space is something we watch out.
All right, Mayuresh, I'm going to request you to grab a cup of coffee, but stay with us. We're going to slip into a short break. Up next, we'll continue our chat with Mayuresh. We'll also be joined by the management of Rallis India, who reported their Q4 numbers. Stay tuned.
Welcome back. You're watching Bazaar Morning Call. Let's invite the first management on the show, Rallis India. They've reported a steady performance in a seasonally weak quarter. The company's top line has gone up by 6%. The EBITDA loss has narrowed to about 1 crore versus about 20 crore on a year-on-year basis. And even at the bottom line, there has been an improvement versus last year. We have with us Gyanendra Shukla, MD and CEO of Rallis India, joining in on the show. Thank you very much, sir, for joining in. Before we get to, the outlook for FY27, give us an update on the inventory and the trade receivable situation in Q4. Last quarter, you had guided for inventory to normalize. Has that normalized? What are the numbers for inventories, trade receivables, and what can you guide for FY27 on these two?
Yeah, so good morning. Thank you for inviting me for this conversation. If you remember conversation 2 years ago, industry was struggling with excess inventory. I think post situation in the Gulf, things are changing pretty fast. I think inventory actually is at the normal level, so nobody is sitting with a high inventory. In fact, right now everybody is talking about whether I'll be able to supply all the product farmers need on time. And obviously, there's going to be cost increase, which is very obvious. And then it will depend on ability of the companies to pass on the cost increase to protect the margins. So inventory, it depends on the product and category. There's a lot of in the media. As far as we are concerned, I think we are pretty much covered for the Kharif season. When I know all of you want to know what is happening on the quarter on quarter, but I see my business as a Kharif and Rabi. And I believe we are pretty much covered for the Kharif season.
Hi, Mr. Shukla. Good morning. Good to see you, Ben. I also want to know, about how the company fares in a year when you could possibly see an El Nino effect or you could see lack of rainfall. Last few years have been good on the rainfall front, but there are some fears that maybe this monsoon is not going to be as good. So what does the past record suggest?
Yeah, so if you evaluate past El Nino event, I think it depends on, mostly I say it depends on the timely arrival of the monsoon and distribution of the rain. There have been years where there has been a significant lower rainfall compared to the normal, even to the extent of 7%, 8% lower, but still country has been able to produce enough. So I wouldn't worry about, whether it's 5% plus or minus. Last year, season just concluded, rainfall was very high. In spite of that, industry had to suffer. So I would actually worry about distribution. It's too early to say what it will mean. Okay. But yes, there could be some crop shifts. There could be some conservative thinking by the farmers to say, wait for the rains and then invest in the crop production system.
Okay, all right. Let's focus on your export piece then, sir. That business has been under some pressure, right? So let's get a couple of details out first. How much of your exports go to the Middle East? What's been the impact of the war? And do you think there could be a gradual recovery because volumes and pricing both have been plaguing the export business?
Yeah, so obviously this Gulf war has impacted, because all our products, they use a lot of production system uses energy and petroleum-based product. So Middle East per se does not have a lot of agriculture. Agriculture happens in the areas there's a lot of water. So our markets where we supply product are primarily Americas, some in east of India. So from a market perspective, there's no problem. I think what we have to really look at the situation is that how much we keep for the domestic and how much you're able to export. And obviously, freight costs are going up. So the focus is going to be allocate inventory between export and domestic judiciously and optimize the margins and serve Indian farmers fast.
So you've also guided for soil and plant healthcare business to reach 700-800 crore and the seeds business to reach 1,000 crore by the end of 5 years. 1 year is done. By the end of next year, FY27, what do you think these numbers could look like? Just trying to understand the glide path to this target.
So look, seed is something has got some traction now, and we have seen this significant growth in the seed business this year. We expect that momentum to continue. We had a 15% growth in spite of a very difficult supply situation last year. So I expect team to continue to maintain that momentum. And same is true for soil and plant health business.
Can you help with some numbers for the two businesses?
Yeah, so seed business, which was last year about 415 crore, has crossed 485 crore.
And next year?
Well, so it's very difficult to give guidance. We're early in the season. Supplies are coming from the field, but we are targeting high mid-teen growth.
All right. And
Mr. Shukla, good morning, sir. Prashant here. Just a quick word on dimethate is a significant product for you, sir.
Well, in that category, we are number one brand. Yes, this year I'm happy to say we have crossed 100 crore revenue mark.
Okay, just and how much of this is export, sir?
We don't export; it's all domestic consumption.
All domestic. Okay. There were. I was I checked, but Australia, for example, I believe has suspended the use of dimethate. This happened sometime late last year because of health concerns, etc. Is there, has that? I'm assuming governments also sort of talk to each other, and the scientific community, etc. Does exchange notes. Anything you can tell us about this?
Well, so first of all, all pesticides are pesticides, so they have to use very judiciously and in the required quantities at required point of time. I believe dimethate continues to play very, very important role in Indian agriculture because it's one of the most affordable product which only goes during the early season of spraying in some crops. So as a result, it does not have any residue effect. It is proven for its safety. Pesticide is one category where globally countries continue to review depending on the availability of options, and also that will continue. But because our business is focused in India, we believe we are in a good place right now.
And how much is pesticide as a percentage of your business, sir?
The pesticide continues to be still primary business of the 897 crore revenue. If you split it into domestic market is about 1,650 crore, export is about 750 crore, seed is about 480 crore. So that adds up to roughly 2,897 crore we have reported.
Okay. All right. So quick couple of questions before we let you go. What kind of volume growth did you achieve in FY26 and in FY27? What could you look at? Point number one. Point number two, on the seeds business, you had a very ambitious margin target. But I think the seeds business, as of now, it's still to break even, right? Could you tell us what is the margin trajectory for the seeds business?
Let me take the seed first because I think, seed is a very seasonal business. It only happens at the time of planting. Okay. Our portfolio for Kharif season is very strong. As a result, in first half, seed will deliver higher revenue as well as a higher margin. But the cost doesn't go away, cost of running business. So quarter 2 and quarter 3 and quarter 4 tend to be very weak. But on a seed business, our revenue has grown by 15%. Our EBITDA has grown by 87%. And PAT has grown 167% this year. So if I put in the numbers, now our PAT is improved from 12 crore to 33 crores. I think seed, yes, had challenges in the past. We have done a lot of homework to clean it up. But when you look at overall growth of the business, seed actually has delivered the highest growth. So, company has grown 9%. Seed has delivered 15% growth.
Okay. Thank you. Thank you, sir, for joining in. That's the work coming in on Rallis India. Back to markets then, and let's just quickly find out stocks where we've seen momentum. Hormus now joins in with the big movers from yesterday.
Morning, Rima, and of course can't not talk about Sun Pharma as yesterday's session as the top talking point, the top Nifty gainer as well, and the biggest single day gain in volumes that the stock saw since July of 2021 did Sun Pharma, was up 7% in yesterday's session. The 1800 call option was the third most traded option in yesterday's session, premiums quadrupling in value as well. Now Monday's almost close to 3 crore shares were traded on Monday. The 20-day average is just around about 40 lakh shares, and half of those shares were marked for delivery, so around about 1.3 crore shares. For delivery, the 20-day average is less than 25 lakh shares. So strong volumes, strong delivery as well for Sun Pharma, and undoubtedly so it was the most traded stock on the Nifty 500. A positive earnings reaction yesterday came from Varun Beverages. The stock was up 6% after its results. The stock has gained in 7 out of the last 9 trading sessions, and even on the F&O side, the 500 call option saw its premium go up by 50%. Monday's volumes were the highest in the last 6 months. The 1 crore shares or more traded for 4 consecutive sessions now on Varun Beverages. Even yesterday, 3.5 crore shares traded. 20-day average is less than 80 lakh shares. 35% of those marked for delivery. So around about 1.25 crore shares marked for delivery. 20-day average of 40 lakh shares. And in the month of April, the stock has gone up almost 36%. So good going for Varun Beverages. And lastly, continuing with the power theme of stocks that are doing well within this space, Torrent Power was one such name, has gained in 10 out of the last 11 trading sessions, ended at a 52-week high on Monday. And Fridays and Mondays volumes were the second and the third highest volumes that the stock has seen in all of 2026 so far. Close to 20 lakh shares traded, 20-day average of 8 lakh shares, close to 40% of that marked for delivery. So around about 8 lakh shares, 7.5 for delivery, the 20-day average of around 4 lakh shares. And this too is also up 36% in the month of April. And of course, the stock will be exiting the F&O space at the end of this series, this Torrent Power.
All right. Thanks very much for that, Hormuz. Interesting data and stats behind some of the big moves from yesterday. We'll take a break. We're back. We'll have Rajesh Ravi of HDFC Securities. We put the spotlight on the cement space. So we'll have that. We'll also, of course, get you trading ideas. Mitesh and Sudarshan with us in just a bit.
Welcome back. Well, before we get to our technical experts, let's wind the conversation down with Mayuresh Joshi. Mayuresh, what about Sun Pharma? Some thought this, the management has been too adventurous, going ahead, doing $11 billion sized acquisition. The street liked it. Shots in the system got squeezed out. And, after underperforming the markets in the last 1 month, the stock was down close to 11%. Yesterday, it was the top gainer. Your view on the stock?
I think positive news in terms of expectations of what will play out over the next few years, specifically when it comes to women's health and biosimilars, which were clearly lacking in its portfolio. And therefore, I think from a sheer acquisition perspective, I think the size is pretty large. They are taking on debt, which means the debt to EBITDA will increase to 2.3 times from a cash-rich perspective. There are expected synergies at play as well, but the management is very, very clear. It's still going to take a few quarters for all these elements to play out. Margins will also take some time for synergies to probably play out as well. And therefore, I think in my own analysis, I think a large part of the move in terms of the price action that happened is largely now getting gestated. Now, as numbers start trickling in, I think the stock will react accordingly. And let's not forget, I think the specialized portfolio that Sun has also gets impacted on a standalone basis in terms of how the US companies move. Within pharma, I think we continue liking, as I said, stocks like Laurus Lab, stocks like Strides Pharma, where our belief is that numbers might be on a steady state basis over the next.
Okay, thank you, Mayuresh, for that. Let's get in some technical trading ideas. Mitesh Thakkar, Sudarshan Sukhani are now joining in on the show. Gentlemen, good morning. Yesterday was a good session. We saw significant outperformance from the broader markets, mid-cap index ending up with a gain of 1.5%. But this morning, a bit of a subdued start. So what should the trading approach be? Mitesh, you want to go first?
Yeah. Yesterday also I had mentioned this, that the broad view is that the markets will start getting into choppy and a consolidative narrow range, because most of the volatility indicators, the direction indicators have slowly started turning sideways and flat, which typically means it could be a choppy but yet a narrow range. And my sense is that it could be 23,850, 800 on the downside, to roughly about 24,400 on the upside. Broadly, give and take 100 points in there. So I think on the index, you try to trade near the edges. If you get a decline close to 23,850, that's a buying chance. If you get rallies close to about 24,350, 400 zone, that's where you should take profits or maybe even attempt a short.
Okay, well, I think we're getting the first set of pre-open rates coming through as well. Gentlemen, morning. Sudarshan, what would you recommend?
Good morning. Well, yesterday we were long at the open itself, and that was a good day. But today is not the same. It's very different. The chances are that we'll see a lot of choppy market action, which is untradable. So today, my suggestion is completely stay away from the Nifty. You know, the staying away is coming again and again. And that tells us that the markets are in a consolidation, and in the next few weeks, will take a big move up or down. But today, it's stay away.
You know, when one trades nowadays, Sudarshan and Mitesh, actually this is for both of you, makes sense to actually square off whatever you're doing by the end of the day, that day, Sudarshan?
Yes, usually if you get a good move, you square up at the end of the day. And if you don't get a good move, you still square up because then we are not carrying profits over. So either ways, the view is that you should square up when you have a big move on the in your favor.
Mitesh?
My idea is slightly different. I would say that, I'm not a good intraday trader. That's my understanding. So I'm typically not a guy who would square up on an intraday basis. Typically, I carry my positions for a few days. So, I mean, for some it works, for some it doesn't work. But I don't think that the texture of the market has changed that way, because if you look at stocks, a lot of stocks, especially in the mid-cap side, stocks like IRDA, BHEL, power stocks like NTPC, etc., are doing extremely well, and you get some kind of swing directional and those moves over there happening regularly. So I have a different opinion on this.
Yeah. Okay, let's get trades now. Sudarshan, what do you have?
Yeah, let me clarify. I was talking about the Nifty, okay, not about stocks. Okay. And now, Wadi Energy is a buy with a stop under 3,300. Tata Tech is a buy with a stop under 580. Axis Bank is a short with a stop above 1350. Havells is a short with a stop above 1300. And I fully agree with Mitesh that stocks themselves do not lend to intraday trading, only the index does.
Yeah, fair enough. Absolutely. Mitesh, what about you?
I have a mix of buys and sells today. On the buying side is Cipla, which was a call yesterday as well. So in that sense, it's a revision on the upside for the targets as well as stop loss. So fresh buys can be done with a stop at 1298 for targets of 1355. Blue Star is a buy with a stop at 1894. Look for targets of 1970 plus here. On the sell side is Infosys, which kind of gave a pullback yesterday, but the structure is weak. So sell here with the stop at 1191 for targets of 1130. And APL Apollo Pipes, I think that's the final stock. That's a sell with the stop at 2006 for targets of 1950.
Okay. All right. Thanks a lot for that, gentlemen, for joining in and giving us those calls. We'll come back to you all at 9:10 a.m. Let's welcome Rajesh Ravi, Institutional Research Analyst at HDFC Securities, who joins us on the show. Hi, Rajesh. Good morning. Good to see you. Well, UltraTech Cement, right? What a beast. Amazing set of numbers over the last few quarters. Some will argue valuations are getting excessive. But just take a look at the pace of growth. You know, the volume growth, the capacity addition growth, the focus on the cost side as well. They had set out 300 rupees of cost saving, and they've already achieved 185 crores, 85 rupees per ton. What do you make of the numbers, and what would you do of the stock as of now?
Yeah, good morning, Nigel. You're right. UltraTech has been one company which has been delivering on all fronts. Even on a high base, their volume growth hasn't slowed down, and so is on the margins front. So the cost-saving programs, which they've been very transparent in terms of the disclosures and articulation. And, not only that, they have achieved 185, they are further upbeat that another 100 to 30 plus cost saving is on the annual over next 2 years. So, and another good thing which we read through from the yesterday's call, they have a long-term cost fuel agreement, long-term contracts on the fuel side, which was hurting them versus peers until last quarter. Now that will come as a savior for them versus the industry. So when the industry will be seeing a 200 to 300 rupees Q-on-Q jump in the fuel cost, UltraTech's cost, what they have guided will be much lower. So this is where Ultratech is very strongly positioned at start of FY27 in terms of their subdued fuel inflation and overall strong positioning both in terms of volumes and in terms of margins. Largely on integration of this Kesoram and India Cements, where we were skeptical that these two assets being low margin assets will pull down the overall margin, but here it is 1250 rupees despite consolidating these two assets. So indeed, Ultratech will continue to gain premium valuations, and for the number which they have delivered in terms of both volume growth, margins, and balance sheet.
Okay, got it. So what would you do with the, we take that point that inorganic growth has played out well, cost saving has played out well, they have that cost benefit as well, and they have clearly said that in Q1, they won't get hit so much on the cost side. If any incremental negative, that comes in Q2, but price hikes will be pushed through. So at current reckoning, what do you do with the stock? Is it a buy? Is it a hold?
So we have a buy rating on the company, and we have been talking about three names as strong buys in our portfolio from cement name, Ultratech, Ambuja, and JK Cement. And I believe Ultratech, will remain among the top names. Yeah.
Got it. Okay. Since you spoke about inorganic growth, and yesterday the biggest move that we saw actually from the cement pack was India Cements. What a move out there, right? I mean, a company that couldn't grow, now UltraTech Cement has come in as a fresh, as the parent, as the promoter entity, and they're growing in mid-teens. The EBITDA per ton that was struggling to move into the green, that's almost at 500 rupees with a plan to get to around 1,000 rupees. What's your view on India Cement? And do you think it stands the risk of, ultimately getting merged into UltraTech Cement? So that's why it will be done at a valuation that is preferred to the parent. Yesterday as well, there was a question on this in the con call.
Correct. So on the operating metrics for India Cements, while the brand doesn't matter and it is now an Ultratech brand, so obviously that will pull up the margins further because Ultratech will command at least 10 to 15 rupees higher margin versus India Cement what it was delivering earlier. And on the cost front, cement is mostly India Cement has suffered on the power side. On the its skills are older, and that is where the cost metrics were higher. Over next 2 years, all these are going to change, and that is where the conviction which Ultratech has painted that 800 rupees on India Cement level and 1,000 rupees at Ultratech level can be delivered from India Cement. So this is for sure can be delivered given the capex program 1,500-1,600 which Ultratech is investing in cost efficiency.
But you
but
you rather stick to UltraTech Cement than play India Cement. Would that be fair?
I agree because ultimately, it doesn't make sense. See, India Cement has to merge at some point in time, which they have clearly articulated in last few calls that once all the litigation are behind, India Cement should be merged into Ultratech. And it's unfair to believe that Ultratech would be paying any significant premium to their last, paid price of 400 rupees while they do that merger. So any measure of move from here on, some maybe 1 year down the line, 400 may increase by a slight amount, but looking at a very high number, over 400 rupees may not be the right way to look at it.
Extremely good point, Rajesh. That's what I wanted to get your view on this particular merger that should happen, but you rather stick to UltraTech Cement. Very quickly, yes. With regard to the dividend that they paid yesterday, it was juicy, right? Numbers were good and they gave out 240 rupees. Now they're talking about a capex of close to 10,000 crores per annum, but yet they're saying dividends will be maintained. How big a positive is this? And just quickly, if you could leave us from the mid caps, what's the stock you like?
So on the dividend front, they paid 240 rupees, which was much higher. And I believe large part of that is to do with the 200 million ton milestone they crossed. Incrementally, they did mention that dividend run rate could be higher. I mean, that is excluding this financial year. So as against 20 to 25% dividend payout ratio, we are looking at 40% dividend payout ratio because their balance sheet would remain, free cash would continue to be higher. We are factoring in 15 to 17,000 crore annual OCF, out of which 10,000 crore would go for capex. So they would be left with surplus cash to repay some of the debt as well as interest and also pay out higher dividends. So from that perspective, 3,000 to 4,000 crore annual dividend payout is doable. This year, 5,000 crore is indeed slightly on the higher side and may not be replicated in full. And in mid-cap names, I would still continue to be bullish on JK Cement. See, cement is all about delivering in terms of margin as well as volume growth. And while there are multiple names in the sector which are extremely undervalued, one company which has consistently delivered on all the counts remains JK Cement.
Got it.
And that explains its premium positioning on the valuations front.
Thanks a lot, Rajesh, for joining in. So you're clearly in the camp that believes you deliver, you get the valuation, and that's why you remain optimistic as well. JK Cement as well as UltraTech Cement, both those two top names. Thanks a lot for joining in. Well, let's welcome Sudarshan back on the show. Sudarshan, tell us, what's your 9-10 call?
It's Worry Energy with a stop under 3,300.
Got it. Mitesh, what about you?
So I'll go with a buy call on Cipla for targets of 13.55.
Thank you very much for that. Banks should be in focus today on the back of RBI prescribing new ECL norms. A quick recap with Ritu.
Well, yes, the final guidelines on expected credit loss or ECL provision has been released, and that's going to really change how banks recognize and provide for stress. Now, while banks had pushed for the implementation deadline to be deferred, RBI has stuck with the April 1st, 2027 deadline as planned. If you look at the final rules, they're broadly in line with the draft, so there are no negative surprises that have come in. Now, under the new framework, banks are going to be required to classify loans into stages based on the risks that they see. So stage 1 assets will carry provisions based on 12-month expected losses. Stage 2 and 3 will require lifetime provisioning. For stage 3, which is essentially NPA, provisions are going to rise with time. They can go all the way up to 100% for unsecured exposure. Now, RBI has also said the minimum provisioning that banks will have to do for stage 1, it is 25 to 40 basis points and 1% for retail. In stage 2, it is largely at 5% for most categories, lower at 1.5% for housing and gold. Now, remember, currently banks provide about 40 basis points for stage 2 exposure. So it's a big jump all the way to 5%. But there is a transitioning relief because banks will have to move to effective interest rate-based income recognition only by March of 2030. And the transition adjustment amount can be phased into Tier 1 capital between FY28 and 31. So there's a long runway to absorb the hit. Now, on the impact, public sector banks are going to be most impacted. A one-time net worth hit of 5 to 10% as per Macquarie. Credit cost rising by 20 to 25 basis points. Upfront provisioning will also be required in unsecured MSME corporate loans. And according to Nomura, there could be a CET1 drag and a 9% erosion in net worth. If you look at the banks, it varies. Central Bank, PNB are worse off. Union Bank of Baroda are better. InterGlobe again worse off. But large names like ICICI, HDFC, Axis will be insulated.
All right, Ritu, thank you very much for that. We, by the way, have a discussion coming up on this in a little bit from now. Maruti will report numbers today, and let's get a quick preview. Sudarshan is standing by, so take it away.
So we are expecting a steady set of earnings from Maruti Suzuki. Increased volume will support revenue and also realization will improve 12% YOY, will be supported by the increased mix of export segments. If you talk about the headline numbers, profit can see a jump of 12%, revenue may increase by almost 26%, and EBITDA too can expand by 44%, and in resultant, margin can come around 12%. And talk about the going forward, because commentary will be more important than the numbers because company is yet to announce the price increase.
Yeah. And the numbers usually come out mid-afternoon or so?
Mid-afternoon, around 12:45 to 1 p.m.
12:45 to 1. So keep an eye out on that one. It's, of course, the passenger vehicle leader, especially in the small car category. So we'll see what Maruti does. There's about 2 minutes to go for the market pre-open. For the market open, let's just do a quick recap of stocks that we've covered from the morning. UltraTech, of course, is up to 2.5%. Coal India is on your screen. It's about 0.8% higher. There is AU Small Finance Bank, which is up 2% on the back of numbers which came in. City Union Bank is another one, 4%. Phoenix Mills, about 1% higher. There is Bajaj Housing Finance, which is up 0.6. I mean, actually, it's pretty well behaved. Nothing very, very large. Piramal Finance is good, 4% higher. Jindal Saw starting lower, 6%, again numbers. You've got Jindal Stainless, which is up about 0.8, flattish kind of start. The new ECL guidelines, which Ritu just spoke about, so, it's a mix of public sector and private sector. Ritu just told us that maybe for PSU banks, the impact perhaps is larger. SBI is down 1, HDFC Bank is down 0.6, Bank of Baroda is down about 1.5% at this point in time. Just market open. in time for that, a few seconds, and we will be getting the first rates. There we go. The bell is bell goes off. A 0.25% lower on the Nifty, about 0.5% on the Nifty Bank. Of course, those ECL norms having a bit of a dent. And the small cap index is starting 0.5% higher. And the mid cap index, I guess, is also coming up with some gains, about 0.4, 0.5% gains there as well. Yeah, so this is not a bad start for broader markets. For larger caps, it's basically pressure led by banking. We look at IT as well, because IT, after setting off 5% last Friday, went up to 2.5%, the index yesterday. So an eye on that as well. But the Nifty heat map, Eternal, Indigo, State Bank of India are the top 3 losers. Coal India, Grasim and Geo Finance are the top 3 gainers on your screens right now. Rima.
Well, PSU banks are struggling. So in the large cap space, it's State Bank of India, which is the top Nifty loser, a cut of over 1%. But outside of that, a PNB, Bank of Baroda, Union Bank, these banks have lost about 1.5–2% straight away at open. So the ECL norms are weighing. But even the private sector banks are largely subdued in trade. So Kotak Mahindra Bank has opened in the red, and Axis Bank is now inching towards a 1% loss. On the flip side, though, ICICI Bank is holding up steady. Eternal is under pressure ahead of numbers. The street will track the impact of on-food delivery on account of the LPG crisis, how competitive intensity in quick commerce space plays out. Eternal is down nearly 1%. Bajaj Finserv, HDFC Life, InterGlobe Aviation, Trend, Sun Pharma is seeing some profit booking after yesterday's 7% monster rally, but the cut is not very deep. On the way up, well, Coal India is your big mover, 2.5%. In fact, that entire power theme continues to play out. On the way up, NTPC opens up in the green. You also should pull up UltraTech Cement. UltraTech Cement, actually, the first tick was about a 2% higher, now moderating gains, but it's a positive opening on the back of strong comments by the company in the conference call. Grasim, Adani Enterprises are a couple of the other names. TCS opens up in the green. L&T, Geo Financial, M&M also higher. One last word, Maruti, let's just check that up. Today comes out with numbers. Let's see how the stock has opened up.
Well, that's right, Rima. Let's pull up a few more stocks then. Cohance continues its big run in 2 sessions. What a welcome for Mr. Umang Vohra. He is joining in. Yesterday, the stock was up close to 20%. Today, the stock is up close to 10%. So big follow through is what we're seeing. But there are a couple of actually positive earnings reactions. Let's pull up a few of them. AGI Greenpack, just pull up that stock. The EBITDA number more or less flattish on a year-on-year basis and margins maintained. I think the street likes that. Remember, this is the stock that's actually corrected big time from the top. But that one is booming away now, up close to around 8% as we speak. Nippon Life India as well came out with a set of numbers. The street likes that one as well. That as well up close to around 5% in trade today. So good move is what we are seeing. Plastic Blends India, volume's not very, very high. I think close to 1 lakh shares getting traded out there. But that stock is up close to around 15%. I think it's not a very large market capitalization company, but that's up close to 15%. So big move is what we're seeing on Plastic Blends. On the flip side, you have Jindal Saw that was down. It started off with a cut of around 6%. I think it's recovered a little bit. Now it's down close to 7.5%. So that stock is coming for a bit of pounding. So business, it's in the right sector. However, the numbers are disappointing. So that's why the stock is under pressure. We'll try to get you the management to understand how are things shaping up with regard to demand for pipes. Unicommerce, another stock that's down because margins have come at around 12.5%. It compares with 13.5% and 17.5% on a year-on-year as well as on a sequential basis. As we did that market check, the markets that were down, the GIFT Nifty that was down, suggested a 100-point downtick. The Nifty started off with a cut of around 100 points, almost moved into the green. So the bulls are fighting back, Prashant.
Yeah, the bulls are fighting back, and there is general, optimism. Lots of what ifs, right? In the next 10-15 days or so. So let's actually take it forward with Nimesh Chandan. He is Chief Investment Officer at Bajaj Finserv Asset Management Company. Nimesh, good to have you with us here. Thanks for joining us. So you're in this zone where anything can happen, right? The possibility of anything is exciting. So you've got this strait can open anytime, and these are all possibilities. The elections, we'll see what happens on the 4th with regards to results, especially markets quite focused on what happens in Bengal. That's sentiment-wise more than anything else. And then later in the month, mid-May, you got the US Secretary of State in India, So, it's a big visit. Could we have something on that, a trade deal or something? I mean, some broader agreement ahead of it. How is it set up according to you, Animesh? More constructive generally or still cautious?
Let's split it between some near-term view and slightly more medium-term view then. First of all, thanks, Prashant, for having me on your show. And last time I was here, I had mentioned that while the world is still in uncertainty kind of mode, but it looks like that instead of moving into the storm, we are moving slowly out of the storm. And I think that's what markets have started pricing in, that this has to end sometime. At some point of time, there'll be some peace treaty, or maybe situation will be more localized and the Strait of Hormuz, which is important, will open up. So I think that's what markets are now trying to price in. The risks were factored in. So I think we have probably made the bottom. We have to see now when we start moving towards high. And there's a good case for that. Even for oil, as far as we know, the oil infrastructure in the Middle East has not been destroyed much. So the moment there is some kind of a treaty done, there will be an improvement in production. So it is not that the oil production is lost, it is just not being produced. So in 4 to 6 weeks, we start seeing more normalized flows. And that's why when you look at Brent futures in September or December, so the forwards are in deep backwardation. And which is why also you're not seeing any great pricing up for rigs or people talking about exploring shale gas in US in a big way. Because they know this is a temporary situation and it will resume soon. However, the longer this goes on, we will have some impact on inflation, and domestically we may have some impact of El Nino coming in on inflation maybe throughout the rest of the year. When you look at medium term, you extend the trends which we saw in this quarter. So this quarter, we have seen corporates delivering good results, except for this pause that we are going in. I think Indian economy, Indian businesses, the credit cycle are on a very strong footing. So in a way, we are waiting, and that's why market is in this range currently.
Nimesh, hi. Morning. This is Rima here. You were bullish on healthcare. Broadly, you thought the sector was attractive. In particular, do you have a view on Sun Pharma and the acquisition that they've made? Is it a part of your portfolio?
So Sunfire is part of the portfolio, but I would not like to say much about a particular company or a stock. But healthcare, we are definitely positive on. It is a sector which is not affected by these short-term issues. The longer-term mega trends for the sectors in terms of increase in domestic market, increase in especially contract research and development or custom drug development is moving up. I mean, earlier when rupee used to depreciate, we used to run towards IT. But because of all the issues that IT is facing, I think the rupee beneficiaries are now pharma companies with generics, with CDMO companies doing well. So it's an added boost to them. I expect good results from this overall space in this quarter and also the coming quarters.
So that brings me to IT then. IT numbers were disappointing. The expectations were not very high, but yet it was a miss for many companies on the top line. Margin benefit didn't play out on account of the rupee depreciation as expected. But valuations on an absolute basis look pretty okay. So where do you stand on IT now?
So I have been maintaining a stance. So first of all, we've been underweight on IT for a long time. And I've been maintaining a stance that even if the earnings numbers don't change much for these companies, you will see pressure on their valuation because of the technology changes that are being spoken about and say AI affecting many of the service lines and so on. Recently, what we have also seen is the chances of recession in US going up or global slowdown if this conflict continues also being talked about. So which means there is a cyclical downturn also, cyclical pressure on these companies. And when you were growing at say 12 to 15%, a few percentage point reduction in your growth rate, say 2-3% reduction in your growth rate is fine. But when you are already growing at say 5 to 8% and then there's a 3% threat to your growth rate and you come down to 2 to 5, I think that's when investors will start thinking whether I should be invested here right now. So I think still some pain left for IT in terms of stock prices, although the downside may not be much purely because of valuations and dividends and cash flows.
Okay, there's some pain, but the downside may be limited. but you don't see upside from here on, which is why you have an underweight rating. Tell us the one sector you're most bullish on, the structurally where you could ride the upward momentum for the next 3 to 4 years.
I think commodities. Here we think there is a great rotation happening. See, the world possibly after these conflicts moves from just in time to just in case, which means you will see hoarding of commodities. Even when countries do their own capex, want their manufacturing of essential commodities and minerals in their own country, also every country would start relook at defense, how much they are spending on defense, and Europe has already started talking about higher budgets for defense. Commodities is one sector I think is still underappreciated, the kind of growth it can give. And here the supply is constrained, especially in the metal side. In soft commodities or food commodities, you can actually see supply reacting the very next year. But here, when the demand increases, supply takes a long time to come in. And especially in India, the valuations are still attractive of many of the metal players, the commodity players.
Give us some more color on that, Nimesh. What do you like, from commodities? Take that point totally. Supply is getting a little bit constrained. And some of the players in India, on a smaller base, they are increasing capacity. So they can partake on the volume front as well and enjoy the higher prices. What would you like, ferrous, non-ferrous, or the miners?
So the world is again re-looking at all the hard assets where technologies are changing very swiftly.
Yeah.
They all have a kind of a focus or they have shortage in terms of the commodities that they require to build those technologies, whether it is copper, whether it is energy. So we are bullish on ferrous as well as non-ferrous metals. Now, each company, based on its financials, we are taking a bet on. But overall, as a pack, ferrous and non-ferrous, both we are positive on. We are also positive on cement. You've seen very good volumes from these companies. Now they are taking some price hikes, mainly because of the cost increases, but they have not taken much price hikes in the last 5-6 years. So I think there we can see an uptick. The industry has consolidated quite a bit. And the cement prices have underperformed inflation. So it is likely that these companies will start taking some price hikes now as the volume comfort comes in. So ferrous, non-ferrous, cement, I would leave with one more small sector, which is textiles and especially yarn or so, where as the petroleum chain is seeing higher prices, there is a switch from synthetic to cotton, and cotton prices have also started moving up. Yarn prices will also move up. So those textile companies also benefit to a good extent from there. And if they are exporting, then they are also getting the benefit of rupee.
Yeah. Nimesh, you like defense, right, as an area?
Defense is one area where I think it's a structural trend now. Each country would want to invest more on defense side. And within India also, you have good players with good balance sheets, cash flows available. Typically, people get excited about these defense stocks when the war starts, and then they get they sell it when there are ceasefires and all that. But people are missing the point that this is not a short-term cycle. This is a longer-term cycle. The order books of these companies will keep expanding. And you stick to ones that have delivered till now. You stick to ones that have a good track record of delivery. And you can stay with them with good cash flows and good return ratios and good order book visibility for 2030 or so.
Yeah. No, are you buying it, I mean, for the lack of a better way, right? You want to buy it at the low of the cycle, not at the high of the cycle. Because if you buy it at the high of the cycle, then you expect average returns. So just that thought. Yeah, I mean, the sector is great, spending is going to go up, but are you going to make above normal returns?
Prashant, valuations are definitely something that we take into account when buying, but we need to also differentiate a little bit between cycles and mega trends. Cycles can be short. When we speak about metals or commodities and all that, maybe it is difficult to say next year what prices they would be. You can take a probabilistic assumption, and that's why you buy it when they're trading extremely cheap or a near replacement value. Sectors like defense, which are a mega trend, where you will see continuous earning upgrades coming, when you are seeing few companies actually getting bulk of these orders, then they are in a mega trend. I'm not saying you buy them expensive, but you can pay a reasonable price to at least get good compounding, because the compounding will be higher.
Okay, got that. Thanks very much. Appreciate your time here, Nimesh, and thank you for joining us, as always, on the program. Well, Dinesh Khara is with us, former chairman of State Bank of India. Mr. Khara, good morning, sir. Thank you very much for joining us. Lots to talk about, but let's just talk about the sort of ECL norms released by the Reserve Bank of India. There was some expectation of relaxation, reduction, but none of that has happened, and I guess that stands out. So just your sort of overall perspective on this, how is this going to impact, the banking sector, both PSUs and private sector?
Well, I think this is perhaps the best of the time when, if at all ECL was to be introduced, it should have been introduced now. Because considering the fact that, when it comes to the health of the banking system, it is perhaps at the best. In terms of capital adequacy, they're all very well placed. In terms of profitability, they are doing very well. So I think perhaps at some point of time, the bite was required to be bitten, and that is something which has been done. Now, in terms of the impact, I think there is going to be some bit of an impact because it is actually looking at in terms of the likely EAD, what is the likely probability of default, PGD and EAD. All three put together are going to give the outcome of the ECL. So I think from that point of view, it is actually preparing the banking system for the future shocks. So to that extent, I think it was an offing for quite some time, and now it has come. And also it is applicable from 1st of April 27. So still there is almost a year which is available to the banking system for beefing up their reserves, which will actually help them in really withstanding this kind of impact. Well, I think when it comes to what you had asked me about the impact, I would say more than the private or public sector, the impact will differ from entities which are having high PCR versus low PCR. So irrespective of the ownership in terms of private or public. So those who are having the high PCR, they are in a position to really withstand this shock. Much lesser impact will be seen. But whereas those who are having low PCR, they will witness a higher shock. So that's how I really look at the overall impact. I would also like to mention that, today, last year, the banking system profit was somewhere around 4 trillion. And the kind of growth which you are witnessing, I would say that maybe this year it will be around 4.5 trillion or so. That will be the overall profit of the banking system. So my broad calculation is that it will take away about 50 to 60,000 crore worth of profit. So I think it's a one-time impact, but I think it will actually make the banking system much more resilient and also make them eligible for raising foreign capital, because globally this is something which is being practiced.
Thank you, Mr. Khara, for laying it out so well. We also have Abhizer Divanji, founder, Neostrat Advisors, joining us on the show. Abhizer, Mr. Khara was just telling us that this perhaps was the best time for RBI to introduce it, given the health of the bank. Yes, there will be a one-time impact, but in the overall scheme of things, this was much needed and a perfect time. But banks and analysts are perhaps saying that the stage 2 norms, the provisioning required and the jump is quite sharp. Would you agree? And what are your thoughts on the ECL norms?
So I personally think that, we have some guidance now in terms of what the provisioning number should be. But over time, what you will expect is that once this buffer hit is taken, and stage 2 hits are required in a sense because, the gap between the stage 1 and stage 2 is very marginal and it's very subjective. And what RBI is trying to do is trying to build buffers over time. The fact that they have given you 4 years now to do transition provisioning, it says might as well take a lot of buffering on your balance sheet. Because clearly, given the situation, stage 2 provisionings will become very significant with time. And that's the expectation. So RBI is saying that if they're actually giving you 4 years to work out the ECL provisioning norms, might as well spread that provision over 2 years and directly hit the retained earnings. So at the end of the day, this is the best time for banks to actually shore up provisioning. Because it's not going to impact their earnings and it will go directly to reserves, that too over a 4-year period.
Yeah. Mr. Khara, that PSU versus private sector, some analysts are talking about how PSUs are more impacted, private sector lesser so. Would you agree with that, sir? That differentiation you did say, I mean, you gave us an overall assessment of some 50-60,000 crores in terms of banking. I mean, the profit pool on an overall basis gets reduced by that much. But this public versus private question?
No, I think when it comes to, generally public sector banks are colored with the same brush, which may not be the right way. And similarly, even private sector banks are being colored with the same brush. So as I mentioned, that what is a differentiator is that the kind of provisioning which people are maintaining, PCR ratios which they are maintaining, that will be the differentiating factor to my mind as compared to public versus private. So, some of the banks, as Abhijay rightly mentioned, that they have already given 4 years. So some of the banks had taken some preemptive steps and had started building up their reserves in anticipation of that someday or the other ECL is going to become a reality. So I think those banks who have started taking actions in good time, they will be less impacted as compared to the one which have not really built up their PCR as well. So I think that's how I will really look at it.
Abhijay, just that specific question on public sector banks, you think it kind of increases credit costs, makes it difficult for many of them? They've put out this 1% return on assets target. You think it gets harder for many of these institutions?
For the public sector banks, I'm not sure it gets harder or tougher because, at the end of the day, economics across public and private sector banks, in my view, has been blurring over time. Now, the issue has been in the past legacy-directed lending, which may have impacted public sector banks. But over time, with the predominance of retail book, I don't think that's been an issue. However, in terms of the profitability elements, I think still the private sector banks are much more profitable because they seem to be managing fees, etc., better. So that's a very different issue to the ECL issue, very frankly. So I don't think PSU banks should ideally take up as much capital buffer as possible because, as I said again, making balance sheets more resilient will give them better cost of funds, in my opinion, in the long run.
Sorry, Mr. Khara? Sorry, did you want to comment? No, Abhijay, so currently, for example, PSU banks charge about 40 basis points on stage 2 loans. It seems like that floor has now gone up quite a bit. And hence, I was saying credit costs can rise, right?
Yeah, of course. The provisioning can rise. Credit costs and provisioning have to be differentiated. Credit costs is what the bank will ultimately incur.
Lose.
Provisioning is what they will now provide basis and expected credit loss and loss given default. We have to understand this concept very clearly. The concept here is that you are expecting what kind of provisioning will happen over the lifetime, especially for stage 2 and stage 3. For stage 1, it is 12-month period. What is the expected provisioning that will hit the P&L? Earlier, we were going with a lag. Once there is an NPL declaration, there was a provision. So the whole mindset is changing in terms of what the provisioning will be. So this is an anticipated book provision, not really an actual provision. It matches your income with your expenditure. The other element that will impact private sector banks more is the fee element. Now that we are going to have EIR, which is effective interest rate. Effective interest rate basically means that whatever fees that you're charging on a particular loan needs to be amortized over the loan period. That, I think, on the private sector side was more predominant. And we have to see how the earnings get impacted there.
Have you done any work in terms of overall what could be the impact here on this account?
Not yet, not on the EIR.
Mr. Khara?
No, even I have not done any work on that. But yes, of course, what Abhijay has mentioned, because they were amortizing, they will actually amortizing it over the life of the loan, so that will have an impact. So that will certainly be there.
Got that. Mr. Khara, overall, would you say, I mean, this with this done now, and banks have time, as you said, right, to kind of sort of build up for when this finally goes into effect 1st of April, this kind of overall, strengthens the banking system to better prepared to meet any future contingency, crisis, shocks, etc.?
Yeah, I actually fully agree with you. This is a measure which has been taken at the right time and also enough, leeway was given in terms of building up and preparing also. Because, what happens is that when it comes to expected credit loss, even the models have to be really refined in terms of the AI, etc. They can actually deploy AI and can figure out that how their lending has been in the past and how it can be improved upon if at all they have to cut on this. So I think these are some of the subjective issues which qualitative issues which banks have actually embarked upon. So I would say that enough time has been given to prepare, and now also when they have given very clear guidelines, they are given full 1 year to really prepare and implement it after 1 year. So I think, to my mind, this is perhaps the best of the time. On the top of it, the banking system in the best of the health, even the capital adequacies are very well there. So I think if at all it was to be introduced, this was the time, as I would like to mention.
Abizar, for two specific sectors, right, housing and gold, compared to others where stage 2 provisioning is higher, these are about 1.5%. So in a way, positive for these two segments specifically?
These are only base norms. You got to understand that these are only base norms, which says RBI says this should be the minimum provisioning. It really depends on the subjectivity that the banks apply to these sectors and other sectors of the loans. The biggest issue in ECL to remember is the governance issue. At the board level, at the management level, and at the supervisor level at the RBI, I think this will be debated and questioned heavily. So how you have arrived at this subjective mechanism? Just because gold has a minimum norm, you can't use the minimum norm for housing. Yes, they are secured assets. But if you take, for example, the low-cost housing segment, the low-cost housing segment, the delinquencies may be higher than the normal housing segment. And one will have to then figure out what is the reality of your book. And that is where I think governance boards as well as supervisory I think there's going to be a lot of supervisory questions around how the provisioning is done.
So you're saying, it won't be 1.5, it'll be higher.
It could be higher, is what I'm saying. I don't know. It'll depend balance sheet to balance sheet. There are some people who have very good underwriting policies and have been relatively conservative. Their percentages will be lower and the others will be higher. RBI just says make a floor because we don't have enough data to conclude today that your book may be much better than the floor. So at least provide for the floor.
Yeah, but the floor is lower for these two sectors compared to the others. Yeah,
because they're more secured books. Yes.
Yeah, absolutely. On the other side, unsecured provision up to 100% in stage 3. Abizar.
Yeah, absolutely. Imagine what is stage 3? Is impairment and it's an unsecured loan. What do you expect?
Yeah, Mr. Rules have been tightened quite a bit in this regard. In any case, Mr. Khara, this is in that sense the final step.
Yeah, I think my sense is that as far as the unsecured loan is concerned, there were a lot of concerns in the past, and in fact, provisioning was always, if at all it's NPA, it was always 100%. So I think from that point of view, it has become I would say that they have been very pragmatic. I also would like to mention that RBI has been very pragmatic when they have come out with this kind of a baseline. And, in fact, there's a difference in terms of the kind of availability of data and the kind of understanding of that data with various banks also. Some of the banks, they have actually built up the skill set over the years and also have analyzed the data also very well. So actually, they were much better prepared to face the ECL. And what Abizar mentioned that it's actually a floor level. Then actually the banks who are prepared well, they will be in a position to justify their decisions before the board and before the regulator also. So I think this is going to be, it is no more what is prescribed by the regulator. It will be eventually the call taken at the board level, what should be the provisioning done for various category of assets which are there in different industries. So industry level trend is very much available, maybe through the internal data of the banks and also through the external data which is available with the regulator and even with the rating agencies also. So I think that is one of the very important factors. But nevertheless, individual underwriting will also have a bearing because if at all underwriting is done well, maybe the expected credit loss would be lower, which will actually ensure that banks provide at a floor level only. So this is how it will really work out. So, and in fact, in the foreign offices, foreign jurisdictions, we have been doing it like that in the past also.
Okay. Well, overall tightening, sprucing up, and leaving, the sector in a better shape from a longer-term perspective. Mr. Khara, thank you very much for joining us. Always a pleasure. Thank you for running us through the nuances of what has been done. It's a small... the Nifty, by the way, is up about 40 points. I was mentioning Nifty Bank, which is down small, 0.3, 0.4% or so. It's basically come back above where it started. The Nifty Bank, that is. So it's not, it's above that level already. We'll take a quick commercial break here. We'll have Amish Shah from Bank of America Global Research talking to us about markets, but of course also what's happening in the power space coming up in just a bit.
Welcome back. Well, we were pointing out earlier today that April has been a very, very good series, and we started off on the back foot with a cut of around 70-80 points. The bulls have bought into that dip. The Nifty is now up close to around 50 points, and they'll want to end the series with a bit of a flourish. For the time being, the Nifty Bank is dragging itself a little bit, but the breadth of the market is something that's caught your eye all through the month, and that continues to remain positive. A good time to welcome Amish Shah, Head of India Research at BofA Global Research. Hi, Amish. Good morning. Good to see you. Well, the headwinds continue right on the global front. We have elevated crude oil prices. The Indian rupee as well has been weakening a little bit after pulling back. And earnings may not be as good as what we were estimating earlier. How are you feeling about the Indian markets as of now? And also, if you could tell us, what is you factoring in terms of earnings growth for this fiscal year?
Morning, Nigel. So look, I think we have already been conservative. We started, cutting earnings much before in early March itself, in anticipation that what if this goes on. So in our base case, we were a bit cautious. So we are working with 8.5% earnings growth for the whole of FY27 for Nifty. This is remember, on a low base of FY26 at about 7%. But we believe that, unless the conflict goes beyond June, there is now no downside to our numbers. So you're right, weak earnings, but to a large extent, I think now the market valuations factors in. So for the market, for our view on the markets now, we are looking at a 9% upside through the year. We think it is going to be 4-5% very swift as and when the Iran conflict ends. Thereafter, there will be a bit of volatility depending on the events. So obviously, March and June quarter are going to be weaker on the back of Iran conflict. That's a negative trigger. But, post-May, there are no elections in India until February of next year. That opens a window for government to potentially do reforms. There could be potential reforms, we believe. Plus, if the US-India tariff issue gets resolved, the new Fed governor coming in, the conclusion of the pay commission hike numbers, all of these, I think, are going to be triggers that the markets will trade. So +5 as the conflict ends very swiftly, and another 4 or 5 slowly, gradually, through the year, with bit of volatility is the way we think about it.
Amish, hi, Rima here. Now, you all at BofA have put in a lot of thought and research behind this entire energy security theme. And if one thing that we've learned over the last couple of years, that energy security through the Russia-Ukraine war and now even Middle East, that energy security, has to be a prime focus, a policy imperative for all governments, and including in India. So what are your thoughts broadly behind this? And then we'll get into the details.
Absolutely, Rima. So as we know, India is quite vulnerable with imported energy and imported fertilizers. So as we know, India imports about 90% of its crude requirements, about half of its natural gas requirements, and not just the prices of it, but in shocks like these, even the supply of these energy becomes a critical issue, and that really impacts India's macro in a meaningful way. In current account, fiscal deficit, rupee rates, inflation, all sorts of things. So I think this is a wake-up call for India, and we really believe that this is likely to become a global theme, not just in India, and it could be a multi-decade theme. So on energy security particularly, we think that India can do 6 things. More important within that, we think India will definitely go towards biofuels, and we will look to electrify. So in other words, more power capacity. So wherever it is possible to replace oil or gas with electricity or biofuels, we think is going to be the big deal in India. And as a result of that, we think these sectors will see a lot of capex. There'll be a cycle around it, and that will help India indigenize our own energy requirements as compared to be dependent on energy imports.
Amish, hi, morning. 6 things, right? Can you just quickly run through what are those 6 things?
Sure, Prashant. So the first is biofuels. Second is more power capacity or electrification. Third is green hydrogen. Fourth is building strategic reserves for petroleum. Fifth is deep water oil and gas exploration. Maybe I mixed up the 6th one, but I think those are the 6 things that we are working on. We are anticipating right now.
Right. So, Amish, let's take each one by one, right? Because I guess while the private sector will do what it is, what will matter is, or what will also matter is the government push and to these specific areas, right? Biofuels. Have you thought through what can happen? I mean, there were these articles about, E85, etc. Higher rates of blending for retail fuel, right? So is that the direction you're going in?
Absolutely, Prashant. So I think we have seen considerable progress, in fact, on that. So if you would recollect, for gasoline or petrol, the blending ratios used to be only 5% back in 2020. Now it has already gone up to 20%. In about 5-6 years' time. The idea is to increase it further. Biodiesel, currently the blending is only 1%, and the target for FY30 is 5%. And I think that target is absolutely now achievable, learning from the success of gasoline. Then there is a target for aviation turbine fuel or sustainable aviation fuel. And then the difficult one, I think, is going to be biogas, which is basically, and if you look at the numbers, they are quite stark. So India, as we know, consumes about 190 MMSCMD of gas, and the research says that if India fully utilizes its potential of biogas, then we can have 230 to 240 MMSCMD come only from biogas. So basically 120% of the natural gas India uses can actually be substituted by biogas. So all of these 4 things put together, there are roadblocks, especially in biogas. How do you collect this feedstock, the logistics of it, the consistent pricing of it, the regulations around it. So there are constraints from a policy perspective that the government will have to work on. But once they put this in place, we do think that this can actually become substitutes for imported fuels, and the government logically should work on this as a policy framework.
So just to close the loop on this, for biofuels, which is I think the easier than biogas in that sense, are you going down to how to get exposure to this theme as well? Do you have active coverage on names that investors should buy?
So on most stocks, we don't have coverage on all stocks, but it includes the feedstock companies like, let's say, sugarcane. So sugar companies are exposed there. There are some engineering companies that gives you solutions or equipments on how to extract ethanol, methanol from these biofuels. And plus, there are some equipment manufacturing companies that they will all benefit from this ecosystem. But on the second theme of electrification, there we cover a vast variety of stocks. And from a capex perspective, we think that those will be bigger as well.
Okay. Got that. And just on biofuels, right? You're just working with, you're not going to as far as 85% blending or anything. You're just saying, well, given where we are with diesel, 5% by 2030, etc. I mean, that's the theme. Or you think these numbers will go up and the government will mandate these as we because I mean that'll need a reconfiguration of engines, etc. as well, right? It's a slightly longer drawn process.
Absolutely, Prashant. We are. I know the minister made a statement around 85. So we are not taking it as far. From 20 for petrol. Even if we go towards 25 or 27. I think that's quite a big achievement. Similarly, diesel, we are currently at 1%. So can 1 go to 5 without any engine changes is absolutely a possibility from a medium-term perspective up to 2030.
Okay. Now, electricity, Amish, of course, I guess you have coverage on power utilities and transmission, distribution companies, etc. as well. At a high level, it's a longer-term theme, right? It's basically using coal, thermal, rather than oil. So that's in that sense the shift which you're kind of sort of again. Will there be a policy push in any way, a shape or form that you're assuming, or not?
So Prashant, I think that is first of all the simplest policy framework to put in place, because all that we are saying is that put first of all more power capacity. And then the sectors that are consumers of oil and gas, you come up with policies, or in some cases there are already policies existing. You have these policies get implemented on a fast track basis. So let's say, for example, there is already a policy that was implemented in 2023 for transitioning cooking gas to induction cookers or induction based cooking. So there's a policy that already exists. Similarly, as we know, the CAFE norms for electric vehicles, are being debated, has been pushed out a bit, but at least there is a framework in terms of how do you get more electric vehicles instead of ICE cars. So I think if the government can work towards the consuming sectors of oil and gas, go to transition towards more electrification, the actual electrification of it is not a big deal, because you are basically saying that, build more power plants. Now, whether that power plants are on the back of renewable or coal or nuclear or hydro is a separate discussion. But we just need to build more power capacity, more power transmission to evacuate that power capacity, and then have some policies for the use case industries to transition from oil and gas towards more power.
And just to, again, stocks in the electricity, that theme that you're talking about, everything is done quite well, right, Amish? So are we...
They have... Yeah. So, Prashant, they have done well recently on the back of the summer season likely to be hot. So that's more of a near-term reflex to these stocks. But if you do go through the electrification process, that I believe can be a multi-decade theme, because a typical coal-based power plant takes 7 years to construct. A typical hydropower plant takes 10 years to construct. So even if you start some investments today, the first project out will be 7 to 10 years away. And obviously, as you keep on implementing more capacity, it could easily be 15 to 20 year catch up. So I think it can be the rally that you have seen is on back of more near-term factors. We are arguing that this can become a thematic sector for a very long term if there is a policy support. And on the stocks that you mentioned, there is a wide variety of them to look at. So there are power financing companies, there are power generating companies, there are power transmission companies, power distribution, and then the value chain, which is companies that make transformers, conductors, cables, so on and so forth. So there is plenty to play for. Obviously, we are not positive on all. We are looking at which pockets makes more money or returns, and where valuations are more attractive as well. So as of now, we are more selective in what we want to own from a long-term perspective, but at least there's a wide variety of stocks to choose from.
Well, absolutely. Amish, so just, in the entire power value chain, right, there are developers, regulated, unregulated, there's thermal, there is solar equipment, energy storage, electrical equipment like cables, wires, transformers. Tell us which sub-segment, can you rank them in order of high conviction going down to low conviction?
So, keeping valuations also in mind, we think that the power financing companies can offer the best returns right now. That followed by the value chain guys like the cables and the conductors, transformers, etc. And thereafter, you will have the regulated power generators make money. So that is our pecking order. Within the renewable space, we think that returns are likely to be a challenge, especially for the renewable developers. And the valuation for these stocks are currently quite high. So the renewable developer space is something that we want to avoid as of now.
Okay. The companies in the renewable value chain you want to avoid. Yes. Amish? Okay, got it. Just last thing, right? This building of strategic petroleum reserves. I think there was some work which has been done. It'll be companies like L&T, etc., which benefit out of it. If there is, a focus of it, I guess there will be a focus on it in a big way, right?
Absolutely. So the construction engineering companies will definitely be beneficiaries from everything that we are discussing. Even more power capacity build out will require civil contractors plus equipment manufacturers. So any capex will actually benefit the engineering and construction space as well. And Prashant, maybe the sixth theme that at that point in time I could not recollect is coal regasification. Coal gasification I meant. So converting coal to gas is the sixth one. That could also, currently there is little progress on that as of now. The targets out is about 100 million tons that they want to convert from coal to gas. And so far we have only seen $7 billion of investment commitments there. But that could actually pick up as a big theme if there is a policy support.
Amish, always a pleasure having you on the show. Thanks a lot for joining in. Wishing you a good day, and we look forward to chat up with you rather soon.
Thank you, Nigel.
Okay, let's focus on the top gainer then on the Nifty. That's Coal India. Remember, the numbers were recouped for the past quarter, and the company has now added the collected cess to the revenue, and they've adjusted in other expenditure. But if you look at the numbers, there's nothing really to write home about in the past quarter. Both on the volumes as well as realizations, both those two numbers actually delivered a bit of a degrowth. What's been the problem for Coal India? Well, the thermal power generation as well as coal inventories in India have been relatively high, and we have seen weak thermal power generation as well. The other problem is the share of captive coal in India. Well, that's moved up as a percentage of total coal production. Currently, we have captive coal that's at more than 20%. Just around 6 years ago, it was less than 9%. So captive coal mines are ramping up, which is an issue for Coal India. But why is the street excited from here on? Let's pull down 5 factors. One is dispatches. They're expected to recover in FY27 because power demand is expected to come back. That in turn will, result in higher thermal production, and in turn, it'll result in higher demand for coal India as well. The other factor is the reduction in Indonesia's coal production. So that as well could play out. Now, in terms of dispatches, remember between FY21 and FY24, the rough growth on a CAGR basis on volumes was around 10%. In FY25, it was only 1% growth. People were cribbing about that. But in the past year, we actually saw a degrowth. So now the street is optimistic that from FY27 onwards, Coal India returns back to its growth on volumes. Point number 3 is on e-auction realizations. Disappointing in the past quarter, right? But there is a case that e-auction realizations improve from here on, because declining Indonesian coal exports, that will help, in terms of global pricing. Remember, Indonesia, they have said they're going to be producing only around 600 million tons in 2026. That compares with around 790 million tons in 2025. So, lower proportion of exports from Indonesia could keep global coal prices elevated. The other factor is the higher landed cost of imported coal, because coal prices have spiked globally, the rupee as well is weak. So, to import coal, you'll have to pay much more. Fourth factor is Coal India has been a dividend machine. For the past quarter, they've declared more than 5 rupees of dividend. For the past year, they declared 26 rupees and 50 paise. For a stock price that was around 450 rupees, that's a large amount of dividend, close to 6 to 7% yield is what you've seen. And finally, Various brokerages like Jefferies, they have been positive on the stock. They have a target price of close to 500 rupees. They're expecting Coal India's earnings trajectory to improve by around 5% over the next 2 fiscals. And they believe that valuations are attractive at around 9 times its forward earnings and 6% dividend yield. So the past quarter's numbers, nothing to write home about. But the way ahead, the street is quite excited. Explains why the stock is the top gainer on the Nifty.
All right, let's get in some market technicals now. The Nifty is at 24,150, up 65 points. Chandan Taparia, Motilal Oswal Financial Services is now joining us on the show. Chandan, banks are still lagging a bit, though chugging along now for the rest of the market. What's the trading call?
Good morning, Rima, Nigel and Prashant. Thanks for having me. So first to talk about Nifty, on last trading session, it witnessed good recovery from lower levels, managed to close about 24,000. The index is trading higher than its monthly volume weighted average, and being the monthly expiry, some more positive stance could be seen. However, we are witnessing cold writing at 2,400. Because of that, some upside could be kept for day point of view. But it seems the way index managed to hold 24,000, slow and steady index can head towards 24,450 to higher marks. Talking about Bank Nifty index, immediate basis support is at 55,750, and with that support, it can witness a recovery towards 56,250 to 56,500. Now, talking about stock-specific idea, first that is buy on Oil India. We have seen good buying interest in counter like ONGC and Oil India, and Oil India has seen a good price action. In fact, we have seen surge in roll cost, which indicate that momentum could continue into the next series as well. In fact, on the weekly chart, after long consolidation, now the breakout is happening with open interest built up. So one can buy with support of 483, and this counter can head towards 513 marks. Second trading idea, there is buy on BSE. We have positive view on the capital market infra theme, and BSE is one of the strongest counter. After the consolidation and correction of last 4-5 days, now again it's all set to start the next leg of rally. Rollovers are positive, longs are intact. So we believe momentum could continue towards 37.20. One can buy with support of 35.10. Last trading idea, that is buy on Tata Power. We have positive on the entire power energy theme, and Tata Power is one of the strongest counter, has been making higher top, higher bottom on daily and the weekly chart with sustained put writing even into the next series. Rollovers are better, which indicate positive move continue. So one can buy with support of 450 for an upside target towards 477.
Thank you very much for that. Cohan's Live, 17% up, carrying forward the momentum from yesterday. EPAC Durables has moved up 28% in a span of 2 trading sessions. Very strong. Websol Energy up 5%, Upper Circuit reacting to numbers. One MobiKwik up 15% yesterday, another 6% today. And on the way down, Tanla Platforms, Unicommerce is reacting to its numbers. That stock is down 8%. On the other side, Manisha Gupta will talk commodities. Stay tuned. Welcome back. As promised, let's talk commodities. Manisha is now joining in. Manisha.
Thank you so much for that. But the crude oil prices are trading at 109, inches away from $110 a barrel. And we have seen prices gain up by 70% in this year. That has started to have an impact on many of these agriculture commodities now. To begin with, it is about the higher crude oil prices leading to biofuel push. So whether it's about Indonesia, Malaysia, Thailand, Argentina, Australia, US, all of these countries have new biofuel mandates that is depending on food more than fuel imports, and that is keeping the prices higher. There have been various reports about drought concerns in U.S. growing areas, especially Texas, and that's where you have cotton and wheat, and the prices have been gaining because of that concern as well. For the Indian market, it of course is going to be El Nino and the Kharif crop ongoing. We anyways are dealing with heat wave concerns right now. The water reservoirs are depleting. So that is what is also finding its way in case of prices there. China is also restocking ahead of the labor holidays therein from 1st May or 5th of May. China markets are going to be shut, so some buying is happening ahead of that. And then you have the fertilizer prices, all of them trading on the higher side there. So whether it's about nitrogen, phosphate or potash, nitrogen and phosphate especially come in a big quantity from the Middle East, and these couple of prices or units have seen very strong gains. So in 2024 and 25, nearly 30% of fertilizer trade passed via Strait of Hormuz. Now, nitrogen fertilizers, when you look at that, natural gas is 10% of global supplies coming in from or passing via Strait of Hormuz. 20% of ammonia comes in from there, and 36% of urea also travels via Strait of Hormuz. That's about nitrogen fertilizers. Take a look at phosphates now, DAP and non-ammonia. 26% and 13% higher numbers coming in from there as well. And sulfur prices are trading at near record highs. 50% of gains is what we've seen in case of sulfur in this year itself. Strait of Hormuz, of course, is a major one, and China is looking to also ban export of sulfur is the reason this is one fertilizer that has surged up the most. Now, this has led to an impact in many of these agriculture commodities. You have soybean trading at 6-week highs. 2017 highs is where you have rubber futures. Cotton is trading at May 24 highs. Wheat is at 10-month highs. Corn at 4-week highs. So you have all of those commodities trading at multi-week and multi-month highs. When you look at the fertilizer prices in this year till time, this is what we've done. So while sulfur is up 68%, you have urea trading 79% on the higher side, and naphtha futures are trading 90% up for 2026. This has had an impact, sentimental till time, in many of the agriculture commodities. So you have soybean prices, which have gained up by 14%, wheat is up 23%, palm up 12% as well, and you have rubber at 18%, but synthetic rubber is gained up by 40%. Polyethylene is up 30%, cotton rice up 12 to 24% as well. So strong gains continuing in case of fertilizer, agriculture commodities, and markets really concerning about inflation in food as well now.
Thank you very much for that. We will get into a break. On the other side, the management of AU Small Finance Bank will join in to talk about Q4 numbers. Stay tuned.
Welcome back to Corporate Trader. AU Small Finance Bank has posted a picture-perfect Q4. Profits are up 65%. That's, I think, the highest this banking season. Loans and deposits have both grown over 20%. Net interest margin is up an unexpectedly high 24 basis points quarter on quarter to 5.96%. That's the NIM. And credit cost, which is the money banks set apart for stressed loans, is down 40 basis points. So the stock is flat today because in the past 1 month, it has been one of the outperformers. It rose 23% in the last 30 days. So a flat show today. Joining me now is the Managing Director and CEO, Sanjay Agarwal. Sanjay ji, good morning. Thank you very much indeed for joining us. Well, congratulations. Excellent showing. But therefore, let me start with what came after your results, which is the RBI's expected credit loss numbers. Have you all done the arithmetic? What is the impact on the bank now that you know that you have to provide more?
Yeah, Lata. So, I have not done maths, and I have been told that because we were busy yesterday in our whole board meeting and the results. But I've been told by my team that this is as same as the guideline,
Yes.
So, and we have done some back of the envelope calculation. So I don't think it will much hit us, Okay. But if you ask me as a CEO, it's a welcoming move to make your balance sheet more solid, more stable, and very predictable, right? Okay. And it allows you to build a right quality of asset and build appropriately in terms of your provisions. So right. Overall, I'm really looking forward to this kind of provisioning norms, and of course also the whole index norm, if bank can adopt that. So, but it will also come in years. So then you can actually have a picture perfect where bank invest a lot upfront to get the gain over the years. Right?
Yeah, your provisions this time have come down significantly, right? They are down 58%. Yeah. Many other banks have actually provided more. They have kept floating provisions, probably in anticipation because these are good times. Do you all have any floating provision backup at all?
We do have, but it's not so meaningful. But it depends, what asset class you are in, what customer segment you are in, right? So we are largely, predominantly a retail asset franchise, dealing into more of a financial inclusion customers, right? So, and over the period, we know the market so well that, so it's not much required at our end as of now. Our PCR is close to 70%. Okay. Microfinance is coming out from that whole bad period. We are able to manage our credit card book also now. So overall, I'm very comfortable the way we have performed, not only in last quarter. I think over the last 2 years, our understanding of the market had just gone up, and we are able to give you very predictable, yeah.
Sanjay ji, I could not find your SMA 1 and 2. I mean, I couldn't because I couldn't access your investor presentation. I couldn't find it in your website. Can you tell us what is your SMA 1 and 2? Because on SMA 1 and 2, that is what they call stage 2 and stage 3 assets, now you have to provide 5% of the loan. Until now, they are standard assets. So you all were providing only 40 basis points. Now it is 500 basis points. So what is your SMA 1 and 2?
But, back of the envelope, I don't remember the right numbers because it depends, because we are into commercial assets, we do have retail, all those things, right? So you have to get me some time to really tell you the exact numbers. But back of the envelope, there would be some release on your NP assets, because where we provide 70%, right? Okay. And we do provide 0.4 before that. So overall, if you balance it out, it will impact, maybe 10 bips, but largely I believe that ECL provision norms are better way to really provide in case of the bad assets.
Your NIM rise in your net interest margins was absolutely astounding, 24 basis points higher, 5.96%. But now there is a war and then there is higher bond yields as well. So you think you can maintain, what is the guidance for net interest margin?
Very difficult to give that guidance, honestly, Lataji. And we told in our call that it's very a seasonal quarter where a lot of effort comes in, to build a right year, right? That's right. So I don't want to extrapolate that, whatever NIM we have in last quarter would be there in next 2 quarters, right? There is, hardening of the rates. It's not easy to build deposit base, which is the prime objective of the bank. But overall, I would say that we are in that range. And depends, how the next quarter, pans out. Seeing all this extra environment, which is not in our control.
Yes.
But we are not that low NIM kind of bank, because we have so many asset classes, right from vehicle or mortgages, then we have a gold loan, then we have microfinance, we are building our personal book now. So our NIM will always remain on a where you can feel comfortable as a bank, right? So it depends, how it happens, but I don't think we should read much about our extra NIM number this quarter.
Okay. Okay, that's a very good guidance for investors.
Yeah.
I also wanted to clarify if there is anything that you may have to provide on that Haryana Chandigarh thing. The one in which IDFC first provided 645 crores. You all were named and they said that they won't open deposits with you all, which perhaps won't hurt much. But what is the likely hurt, if any?
No, I don't think that that issue is already closed at our end. We have given around 25 crores in goodwill gesture to the Haryana government. The investigation is on. We believe that the bank has no fault at their end. It's more about working with the government, of course, giving your own gesture to, close the matter at the government and between us. But overall, I strongly believe that our recovery will happen. And I don't think there is any more amount to be provided or any more amount in dispute.
Okay. Well, now let me come to this universal bank license, which is almost imminent. I think a few formalities are left.
Not really, Lataji. We have done our case, to the regulator who has really helped us over the period, last 9-10 years.
Okay. No, I'll tell you, Sanjay ji, I'll tell you from your investor point of view.
Yeah.
What 1,000 rupees, 1,050 you are getting for your stock today is for performance so far. Today, the market wants to price in what they can expect from the bank. You have to give us at least an outline of what, benefits, what changes will happen in the bank if and when you get. I'm putting it as if and when you get the universal license.
So, Lata, my own understanding, and we have spoken so many times in the last 8-9 years, that bank is a very long-term franchise. You have to put lot many strategy in place. In terms of input drivers. First you need to understand that it is a very it's not a one-dimension platform. You have to take care of many stakeholders. Be it government, be it regulators, customers, investors, employees, and every kind of segment, right? So what we have done over the years that we have understood the market well, we have understood the customer segment well, we have built our product lines, we have built our delivery system, channel management, we have built our tech system so well, we're investing so much on our AI and all those things. So if you ask me, as far as our input-driven work, we are doing it very well over the years. But, sometime being in a bank from Jaipur, which has no, as such, backing of, good names, we need to create our own goodwill. In that sense, the acceptance by regulator, and that too like RBI, that they can give us a universal license, that too after 15 years, will give us much to say that, you can bank on us, you can actually take us as a very serious player. So for me, getting a universal in terms of product diversification or any kind of business matrices might not be so great, but in sense of acceptance by public in large, because we need a public trust, we need a public backing, we need to be seen as one of the most promising, most transparent, well-governed institution, right? And in that scheme of things, universal license holds a very key milestone for us.
I take your point completely that, you get a higher valuation simply because of the trust, I would assume. No, again, that is my assumption. I'm talking from an investor point of view. From an investor point of view, the question is also, what will be the costs involved? Because even this quarter, your OPEX, operating expenses, has risen by 25%. Once you get a universal bank license, it will mean that many more branches. So should we be prepared for, a rise in OPEX? what therefore can be the impact on other ratios?
No, Lata. Okay, so if you see because again, the seasonal quarter will see you like this, that we have gone up by 25% basis, but in our overall ROT, we actually have decreased our OPEX by 20 bips, which is commendable in my opinion. The way that we have grown ourselves and reducing the cost is not easy task. But we have put much effort on our tech understanding, tech build up, then tech adoption, working around AI. We're the first bank in maybe the country who have launched their LOS, the AI native LOS for the gold loans, right? So I think I would say the normal OPEX will only go down from here. I don't think that normal OPEX will go up because we will become universal. But, once we get the universal license, the idea is to get to reach to the people that, this is the bank which you can do a better product service or better products, right? So there, the outreach program has to be there through marketing, through lot many things. So we are keeping some budget for, the build up of the brand, right? So that our easiness and our acquisition become easy, right? Okay. So I think other than that, Lata, take my words, no extra expense, nothing flamboyant or nothing as such.
No, I am not expecting you to do any flamboyance. I don't think Ranbir Kapoor is flamboyance, but maybe you will replace it with Ranveer Singh, who knows. So, but anyway, my point is, from an investor point of view, again, give us some guidance, yaar. You've got a West Asia war. Do you think that there is some pressure on asset quality, any pressure on cost of funds, deposits, positive or negative? Give us some guidance for how this quarter and next will pan out.
Only got one guidance. This financial year will be better than the last financial year.
Okay. Well,
because it's so difficult to give you the exact numbers and everything. But I can assure you on this call that this financial year will be far better than the last financial year.
Okay. That's as good a guidance as investors will want. Yes. Thank you very much, Sanjay Agarwal, for joining us with all the details of your Q4 and your plans for FY27.
Thank you so much.
We have to wrap up on Bazaar. On that note, markets still like treading water, dibbly-dobbly at this point in time. Let's see how things pan out. We wrap up on Bazaar. Chartbusters coming up after a break.
a very long time. Coal India delivers lackluster fourth quarter results. The tepid results, see more than anything else, the results is the volume and price demand tailwinds that are ahead, which provide growth visibility. So despite results, the stock is 5% higher. Jefferies calls the company 6% dividend yield attractive, retains buy stance with a target of 500 rupees apiece.
RBI introduces a new three-stage asset classification and provisioning framework led by the forward-looking expected credit loss model. Macquarie flags off one-time impact of around 5 to around 10% on PSU Bank's net worth. Former SBI chairman Mr. Dinesh Khara tells CNBC TV 18 that the new norms could entail a 50,000 to 60,000 crore rupee hit on the banking sector profits.
Nippon Life, AMC delivers an overall beat in their March quarter results. Margins expand nearly 200 basis points. AUM grows 3% faster than the industry, average of 0.7%. Stock perks up in early trade.
Shares of Jindal saw sharp opening lows, but the stock has come off the day's low, because the street chooses to look ahead. The reason the stock is down is because the margins contract to 10% versus 14%. Both EBITDA and top line decline on a year-on-year basis.
Unicommerce bleeds after reporting a weak set of fourth quarter numbers. The EBITDA declines nearly 13%. Margins fall over 400 basis points in the quarter that went by.
Well, hello and welcome to Chartbusters. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel and with me is Mangalam. And as we speak, Mangalam, markets looking good. The Nifty is up. And remember the star batsman, which is the Nifty Bank, that's still not participating, but still the Nifty is holding on to gains of around 50, 60 points. I think, Mangalam, the street is looking at probably the election results as well. And they are expecting the ruling BJP to come out with a good showing. I'm guessing that because otherwise crude oil prices close at around $110 per barrel. No big movement in terms of global cues as well. But still the markets continue to move up.
Markets continue to move up, though the question, Nigel, is that whether they sustain up or not, because we are in this range, 20-day moving average at the lower level and the 50-day moving average at the upper level. We're about 100 points away from the 50-day moving average on the Nifty. The Nifty Bank as well is something that we will be tracking, whether it recovers in the latter half of trade or not. Last hour could be crucial also because it's April series expiry. Let's get in Dharmesh Shah from ICICI Securities for a quick technical check on the market. Dharmesh, what do you make of the moves on the market right now? The Nifty rising despite the Nifty Bank not doing well. Macros not necessarily in favor. If you look at, say, oil or the geopolitical uncertainty, which still continues. Is the price telling you more?
So good morning, Mangalam. Absolutely, I think so. If you look at the price movement for last few trading sessions, the market has been moving in this trading range of 23,700 to 24,500, and strong demand seems to be emerging at 20-day EMA. I think so. It's more of a base formation like now going on for the market in this range of 23,700 to 24,500 for the next leg of offset. So it looks to be more of a healthy consolidation going on for the market. And it signals, I think so, for the next leg of upside towards 24,800 in the coming days. So yeah, it's something a buy on this market. Yes, many events panning out in the coming weeks. I think so we have generally state elections likely to be on the 4th of May. So yeah, there will be some bit of a volatility, but we believe this volatility should be looked as a buying opportunity, but strong support placed at 23,700. But eventually we expect Nifty to head towards 24,800 in the coming weeks.
Okay, got it, Dharmesh. What about individual stocks? What's in your radar?
As far as stocks concerned, and Nigel, I think so we remain to be constructive, positive for metal space as a whole. If you look at the metal, I think so the steel sector as a whole remains to be more positive, where JSW Steel remains to be a top pick inside the sector, where we believe, I think so the stock seems to be witnessing a buying from the low end of the rising channel. Also, if you look at the corrective phase, intermediate corrective phase are getting arrested at around 52-week EMA. So we remain to be constructive, positive for JSW Steel for target of 1445, keeping a stop loss of 1150. Apart from JSW Steel, I think so on the mid-cap side, we remain to be positive for CAMS. I think so the one where again the stock seems to be witnessing a falling trend line breakout, indicating the end of the corrective phase. And in the short term, we expect the stock to head towards 830, keeping a stop loss of around 738. So CAMS and JSW Steel remains to be our top pick.
All right, CAMS and JSW Steel. Meanwhile, just keep an eye out on a couple of these stocks which are spiking right now. Sun Pharma continues to do well from a big gain that we saw yesterday and this morning as well. The stock opened marginally in the red. From there, it's seen purchase and currently at the high point of trade. The other one which is doing well is Reliance. That too was a big contributor in yesterday's trading session. Continues to do well right now. The street eyeing better performance coming in from their O2C vertical. Good performance already from their retail business and the listing of Jio. Nigel.
Just one stock, Mangalam, Vedanta. You have that record date that is on May 1st. So tomorrow is effectively the last day to buy the stock if you want to be part of that demerger. And today as well, you'll see some kind of unwinding of long positions because the contract will expire. The stock started off closer to around 730 rupees. But what's working for Vedanta is there is that value unlocking exercise. And also, the largest part of their business comes in from aluminium, which the cycle is strong. And oil prices may not be good for the macro perspective, but it's good for Vedanta because they have a small proportion of their business that's coming in from there. So Vedanta is the stock. The next 24 hours are going to be interesting. Near term, there was some unwinding of long, some kind of profit taking. But, the stock continues to see some kind of interest because of its exposure to aluminium and its exposure to oil and gas as well. Slip into a short break. On the other side, we have the management of Mahindra Holidays. They're waiting for us to tell us about the past quarter's numbers and the way ahead.
We're back. The Nifty continues to hold in the green and the Nifty back marginally in the red. We have Mahindra Holidays. They reported a softish sort of fourth quarter performance. The MD and CEO Manoj Bhatt now joins us to discuss the quarter that went by. The overall revenue of the company grew just about 5%. There was a decline in the EBITDA and the net profit as well. The India business too, which matters a lot more, was absolutely flat with the EBIT margin out there declining by about 100 basis points too. So Manoj, the question, FY26, you can call it a transition year. 7.5% revenue growth, 6.5% EBITDA growth. What do you start FY27 as a target for the company? And how do you define those targets? Revenue, EBITDA, yes, but at the same time, we'll have to speak about membership additions, inventory addition, the company's strategic changes that are taking place as well. You're getting into leisure hospitality.
So first of all, thank you for having me on the show. I think before I get into F27, you're right that F26 was about a lot of changes. But I think the one thing which we did very well was added a lot of keys. So we added about 900 keys during the year, and that's something which will continue going into F27. So F27, we are thinking of adding more than 1,000 keys overall. So I think the expansion plan in terms of just broadening the network, that will continue as we go into the next year. Secondly, I think while you're right, the reported numbers do look flat in terms of the profits for Q4. But underlying, if you see the operating level, because our treasury income dipped a bit, otherwise we are showing a growth in profitability even there. So clearly we are on the right track from a lot of perspectives. If I look at your other point on member additions, I think we have consciously pulled back member additions and focused on increasing value per sale. And that has jumped almost 77% year on year. So as we go into F27, I think clearly there are 2 or 3 objectives. One is continue the expansion. And as I said, 1,000 plus keys we will add at a gross level in F27. The second thing is, of course, scale up member addition. But we will never go back to some of the previous levels, but we will do very measured member addition. And that's something which we'll look forward to. And finally, focus on creating the right kind of pull and the right kind of average sales value. From an overall perspective, those are the 3 elements of the strategy as we go forward.
Got it. Hi, Mr. Bhatt. Good morning. Good to see you in. This is Nigel on this side. We've got the key addition, but what about member addition for FY27? What could you be looking at if you want to give us a quarterly run rate, if you want to give us an annual run rate? And also in terms of ARPU, what should it look like?
So if I look at, I think let me address the second question first, which is about AUR. And we are trending at about 10.1 lakhs right now, including upgrades. And my sense is that we should see an increase in that as we go into a 10 to 20% increase as we go forward in AUR as in F27. On member addition, as I said, that's not really the biggest focus for us. But I think if I look at the next year, we're looking at a 10 to 20% growth in member addition also. So that's the kind of goals we are setting for F27.
All right, 10 to 20% addition in member addition and 10 to 20% growth in AUR, which at the end of FY25 stood at around 10 lakh rupees, and the fourth quarter was close to around 14 lakh rupees. I just wanted to understand about the shift that you've made into leisure hospitality as well, where you said that you have earmarked about 1,000 crores in investment. What are your targets here in terms of revenue contribution coming in from this space? And we see you've bought land also in Chikmagalur for about 37.5 crores. So if you could, explain the strategy, expansion strategy here.
Yeah, so I think I'll first cover the land. If you look at our strategy has been a combination of owned resorts in certain locations, as well as capital light models like lease in other places. So as part of that, we do have a land bank of about 500 acres today in multiple parts of the country. And so Chikmagalur is obviously a very happening destination. It's an area where we see a lot of future demand coming. And hence we bought this 50-acre property, which also has a coffee plantation. And we will eventually build a resort there as soon as we get certain approvals, etc., from the relevant authorities. So clearly it's part of the owned kind of portfolio which we are building. On MSR itself, I think in F27, we don't expect any revenue contribution. It will probably be more likely F28 from a revenue perspective. That's the current plan. And as you know, we are building the first one in Thiog, as we had mentioned, in Himachal. And that's currently on track for F28.
What's the trajectory with regard to your EU business, the European business? Could you tell us what kind of EBIT contribution are you looking at in the coming year?
So I think if you look at the European business, and I have mentioned this in the past, I think it is suffering from a very different economic climate. Also, some of the geopolitical events have impacted it. And so from an overall perspective, the performance there has been slow. in terms of both revenue growth as well as profitability, and it continues to be a bit of a drag on our overall numbers. And I think as we go into next year, I think there are 2 or 3 measures. So one is we are looking to actually increase sales through certain partnerships as well as focus on operational efficiencies. And I think as the Finnish economy improves, which is what is projected to do next year, I think we should see some improvements. But otherwise, broadly speaking, I think the various elements of economics and geopolitical situation are actually muting the performance of our European business currently.
Now, if it continues to be a drag on your business, and it's been so for a while, have you ever considered, just taking that off your books? I understand the synergies that it has with members of Mahindra Holidays. People who are members would get the opportunity to travel to Finland, etc. From a business standpoint, it does not add much to the financials.
So I think from a financials perspective, it's roughly half our revenue, and of course, from a profitability perspective, it is currently a loss-making unit. I think for us, we do believe that it is something which is integral to us right now. But from an overall perspective, I think we believe that from a timing perspective, this might not be the right time to look at strategic options.
Mr. Bhatt, we appreciate you joining in. Wishing you all the best in the coming fiscal year. We look forward to chatting up with you periodically and getting your outlook on the business. For the time being, the street appears a little bit disappointed with the past quarter's numbers, whereas Mr. Bhatt is saying he's expecting things to improve from year on. So we'll keep an eye out on the stock. Well, on that note, though, I think we can slip into a short break, come back. We'll continue to focus on markets. We'll also focus on stocks that are bobbing around. Welcome back. Markets holding in the green, but the problem is the Nifty Bank, that's not playing ball. And that explains why the Nifty is not able to get up and going, but individual stocks doing a thing of their role. The big boy, Reliance Industries, that's approaching that crucial resistance mark of around 1400 odd. Keep an eye out on that one because that's stepping in for the Nifty Bank. It's like an index by itself with around 10% weight on the Nifty. But Hormuz joins in mostly and gives us some interesting piece of data. This time around, he's trading his eye on the margin trading book data for the month of April. Hormuz, take it away.
The markets have staged a bit of a rebound in the month of April, but what has also staged a rebound is the MTF book. Now, from the sell-off in March, the MTF book was almost on the verge of slipping below the 1 lakh crore mark. But just before that, the index is up 8% this month so far. The Nifty Bank has done well. The broader markets have done even better. But the Nifty IT is the one that you need to watch out for because of two very specific reasons. I'll get to those in just a bit. But take a look at the MTF book now. The MTF book as of March 30th was just about to slip below the 1 lakh crore mark. Now, as of last Friday, which is the 24th of April, for which data is available on the NSE, the book now stands at 1.1 lakh crore, 1.14, and that's around about 8.5% growth from the end of March. Now, what are the stocks that have seen the biggest change in this month? Now, the Nifty IT is the two reasons that I spoke about, HCLTech and Infosys. Take a look at the change in positioning here. HCLTech has seen a 400% change in the leverage positions from 143 crore to well over 700 crore as of last Friday. Same is the case with Infosys. From just under 750 crore, the book has now, the exposure has reached around about 1400 crore rupees. HDFC Bank is now having the most leveraged positions on the MTF book as of last Friday. The exposure is nearing 2000 crore rupees. And Reliance Industries, of course, is the second best. The 39% jump in the month of March on an 1100 crore base now stands at close to 1600 crore rupees. But this jump in HCLTech has not taken place all through the month. It has just taken place in the last 3 days, the 3 days after its results. As of the 21st of April, when the company came out with its results, the stock was not even in the top 200 in terms of the leveraged positions. It stood at around about 150 crore rupees. Take a look at the change on the 22nd when the stock fell 11%. That exposure grew to 569 crores. And again, when the stock fell 6% after the day Infosys announced its results, the exposure now stood at 715 crore rupees. So that jump that has been seen is only the period of 3 days. Same is the case with Infosys as well. Before its results, the position stood at around 833 crore. On the day the company came out with results, that positioning stood at around 1100 crore rupees. And on the reaction day, when the stock fell 7% after its results, the positioning went all the way up to 1400 crore rupees. So significant increase in positions in both Infosys and in HCLTech. Now take a look at the stocks where the positioning has reduced. REC is one such name. REC has done well this month. The positioning has come down by 24%, and Anupam Rasayan has seen positions come down by 22%. HAL continues to see liquidation in this book because at one point, for a better part of the last year and for a better part of this year as well, HAL was the most leveraged stock on the MTF book. That is now on the verge of slipping below the 1000 crore mark. And Nazara Tech and Keynes Tech too have seen a liquidation of anywhere between 13% each this time around. So a significant increase in the book, MTF book in the month of April, but Infosys and HCLTech, the two names that stand out.
Right, Hormuz, thanks a lot for that insightful data out there. The margin trading book in April has seen a big increase. But what happens going forward depends on numbers. So let's talk about those numbers. Eternal, a stock which is down 30% from its peak. Street is penciling in decent performance in the fourth quarter. So if you look at it, the 5% growth that the Street is working with is quarter on quarter on the revenue. The CNBC TV18 poll throws up a number of 17,155 crores. Why are we looking at these numbers quarter on quarter instead of year on year? Because remember, in the last couple of quarters, the company's changed its Blinkit inventory model. So that business model makes year on year comparison null and void. 8.5% growth is what we're expecting in the EBITDA. Margins stay stable between 2–2.5%, which means that on a low base, the net profit actually jumps nearly 90% from 100 crores all the way up to 191 crores. But more than the numbers of Eternal, the internals of Eternal are a lot more important. Food delivery, the net order value is expected to grow between 16 to 18%. Blinkit, which is the growth driver of the company, expected to double year on year. And Blinkit contribution margins too, seen between 4 to 5%, which implies that their breaking even in Blinkit continues. What is also important to track, the impact on food delivery due to LPG crisis. A lot of restaurants had curtailed their menus and a lot of them had gone off delivery. So let's see how that pans out in their NOV business, the food business. Competitive intensity in quick commerce, obviously important. Commentary around gig worker payout and the impact that could have in their contribution margins. And finally, potential impact on increasing cost of delivery due to higher fuel prices. So post the election results, it is imminent that there could be an increase in fuel prices. And if that was the case, could there be an impact on their margins, delivery margins going forward or not, is something that the street will be eyeing. So overall, these numbers are not likely to be bad, but the concerns going forward may have the stock a little under pressure.
All right, Mangalam, thanks a lot for that. We'll wait by for those set of numbers. By the way, keep an eye out on a few stocks in the broader market. Sun Pharma, yesterday it was up. Today, in fact, it's continuing to see some follow-through. And I'll tell you what the street feared didn't really come about. The valuations were a little bit lower than what was feared at around $13 billion odd. And the stock had underperformed, actually. Now, it's almost made up for all of that underperformance because the stock was down close to 11%, in the last 1 month. And yesterday it rallied. Today as well, it's up 1.5%. It's almost made up all of that. HCC, that's another stock from the broader market that's moved up. So keep an eye out on that one. And SCI, that's the other one. We should be getting some intraday charts up for our viewers on the screen, which should come up in just a bit. So, Mangalam, a few stocks doing a thing of their own. And as we speak, the Nifty as well moving to the high point of the day.
Yes, the Nifty is moved to the high point of day. HCC is doing well. Look at Tata Chemicals before we wrap up. It's a big surge that we've seen on that stock as well. Taking this week's gains to about 10% on that counter. And the last 4 minutes or so, we've seen a big surge, up 6.5%. For that stock.
Just one stock, Mangalam. Jindal Saw. Earlier today, we pointed out the numbers were weak, but there's a probability that the street buys into the dip because the business prospects are good. So Jindal Saw is a stock that's almost moved into the green as we speak after it was down 6%. But we'll wrap up on this session of Chartbusters. Stay with us. The team of Trading Hour comes up next.
You're watching us here on Trading Hour. We come to you live from the CNBC TV 18 Motilal Oswal studio. I'm Manglam Malu, with me Hormaz Fatakia and Ritu Singh. Thanks a lot for tuning in. And the market's not doing too bad either. 70 points higher on the Nifty. This despite the Nifty Bank being down 220 points. Led high by Reliance. A lot of these FMCG names. We've seen some traction in Bharti Airtel as well. And decent recovery in the metals pack. The index is up around 1.5%. The broader markets will have you believe that your portfolios are looking a lot better than what the Nifty Bank shows. So we have about 1,800 stocks which are advancing, for about 1,200 stocks which are declining. The India VIX for the second consecutive session lower. All of these things, decent signs for the bulls. Hi, Ritu.
Hi, Manglam. Despite what's happening globally, oil prices have also inched up almost $110 a barrel. I mean, things are holding up well here. The Bank Nifty is a bit of a drag, but despite that, the markets are holding up. For the Bank Nifty, of course, it's news specific on the back of the new RBI guidelines we'll talk about in just a bit, which is adding pressure, especially to the public sector banks. But apart from that, broader markets here doing pretty well. Nifty Metal is, the rally is being led by them. They're up and about. Stocks like Coal India have surged more than 4%. Apart from that, you have some of the other sectors, PSU banks and IT. Those are the key drags in trade today that are exerting some pressure. The energy, pharma sector, autos, all of them doing relatively better. But let's go across to Hormaz, who's standing by with the top movers and shakers. Hormaz, good morning.
Good morning, Ritu. And it's plenty of stock-specific reactions actually in today's session. Most of them related to earnings and news flow as well. We'll start off with some of the positive earnings reactions that have taken place today. Shriram Finance is one such name. We'll hear from the management in just a bit. 8.5% higher on the stock today. Among the top performers on the Nifty 500. Nippon Life India is doing well for itself as well. 5.5% higher. City Union Bank after the results. The bonus issue that the lender has announced, 5% higher here as well. And Coal India now nearing its 52-week high, which is at 476, and 4% higher on this stock as well. On the flip side, the negative earnings reactions are coming in from Unicommerce eSolutions. That's down 8% in today's session. Phoenix Mills not doing very well, and Rossari Biotech too among the top losers on the broader markets today. 5% lower on this stock as well. Take a look at the newsmakers. Cohance was up 20% yesterday. It's up another 17 today, and once it crosses 528, it would have reversed all the losses that it has made in the year 2026 so far. MobiKwik, the 5.5% higher. A block deal took place earlier in the day, so extending its gains from yesterday. And Indus Towers ahead of its board meet, where it will be considering a dividend as well along with its results. You mentioned PSU banks. They are not doing well in today's session. Of course, not significantly lower, but underperforming nonetheless. So losses of anywhere between 1.5% to 3% in today's session. And lastly, stocks that are at 52-week highs in today's session. BSE continues to move higher. A new high for BSE today, nearing levels of 3,600 now. Aarti Industries, ONGC, RR Kabel is one that is also at a 52-week high today.
Thanks a lot for that. Meanwhile, a couple of other stocks which are spiking right now. You did speak about, Sun Pharma, which is doing well all of yesterday and today, adding on to those gains. But look at Dr. Reddy's. That's caught up as well. It's moved to the high point of trade, and a lot of those gains coming by in just the last 15 seconds or so. Alongside that, we've seen some traction in Crompton as well. Crompton is recovered about 3% from the lows, currently at the high point, surging. Vodafone Idea as well, not doing particularly bad, has seen a big surge. But it's now time for our big story of the day. The RBI has introduced a new 3-stage asset classification and provisioning framework led by the forward-looking expected credit loss model, ECLM as we know it. Ritu joins us on the big story with the details. Ritu.
Well, the big change really is in how banks recognize stress and how they provide for it. And it's a massive change. The draft guidelines were issued sometime in October. And now what you have is the final form. What's a bit of a sentimental negative also is the fact that banks have been pushing for the implementation deadline to be deferred, some relaxation in the stage 2 provisions. None of that has come through. In fact, these kick in from the 1st of April, and the final guidelines are more or less, the same as what we saw in the draft. So there's no negative surprise, at least. Now, in these final rules, banks are asked to classify loans into stages based on the risk that they foresee. So stage 1 assets are going to carry provisions based on the losses you expect over a 12-month period. Stage 2 and stage 3 are going to require lifetime provisioning. Now, for stage 3, which essentially in simple terms is NPAs, the provisions will rise with time and they can go as high as 100% for the unsecured exposure. Now, what RBI has done is set the minimum provisioning floor. You have to provide above that. This is just the base. Stage 1 is at 25 to 40 basis points. It's as much as 1% for unsecured retail. And stage 2 is pegged at 5% across most categories. It is lower for housing and gold loans at 1.5%. Now, remember, currently, banks provide about 40 basis points for these stage 1 and stage 2 exposures. So it's a huge jump to go all the way to 5%. But there is a transition relief as well. The transitional adjustment amount can be phased in your Tier 1 capital over FY 28 to 31. So that provides banks a pretty long runway to absorb any hit. Now, as far as the impact is concerned, why are we saying public sector banks are going to be most impacted? That's because the buffers that they hold relative to, say their private peers are lower. And so private peers may be better off, whereas the public sector banks will have to take this one-time hit. Now, what is the hit? Macquarie estimates a one-time net worth impact of 5 to 10%, with credit costs rising 20 to 25 basis points for PSBs. Nomura says there will be higher upfront provisioning that is going to be required, especially in unsecured retail, MSMEs, corporate loans, and it expects PSU banks to face a 55 to 130 basis points drag on the Tier 1 capital and up to 9% erosion in their net worth. Now, individually, if you look at the banks that are most impacted, Central Bank of India, Punjab National Bank among the PSUs, and IndusInd Bank among the private names will see a higher hit, whereas the large private banks, ICICI Bank, HDFC Bank, Axis Bank, they're more or less insulated because they have enough capital buffers. So, we spoke with former chairman of State Bank of India, Dinesh Kara, and Abhizar Devanji of Neostrata Advisors to understand the impact of these ECL guidelines. Listen in to what they had to say.
Last year, the banking system profit was somewhere around 4 trillion. And the kind of growth which you are witnessing, I would say that maybe this year it will be around 4.5 trillion or so. That will be the overall profit of the banking system. So my broad calculation is that it will take away about 50 to 60,000 crore worth of profit. So I think it's a one-time impact, but I think it will actually make the banking system much more resilient and also make them eligible for raising foreign capital, because globally this is something which is being practiced.
The biggest issue in ECL to remember is the governance issue. At the board level, at the management level, and at the supervisor level at the RBI, I think this will be debated and questioned heavily. So how you have arrived at this subjective mechanism? Just because gold has a minimum norm, you can't use the minimum norm for housing. Yes, they are secured assets. But if you take, for example, the low-cost housing segment, the low-cost housing segment, the delinquency is very higher than the normal housing segment. And one will have to then figure out what is the reality of your book. And that is where I think governance boards as well as supervisory I think there's going to be a lot of supervisory questions around how the provisioning is done.
That's your big story of the day. The PSU banks opened lower but are recovering from the lows of the day. The private banks rather relatively insulated from the turn of events based on what a lot of these brokerages are also saying. Take a short break. More earnings reactions on the other side when we return. Welcome back. The big result of the day today, along with Eternal, is going to be Maruti, and that's India's largest passenger car manufacturer. Sudarshan is here to tell us what the street is working with this time around for the company. Sudarshan.
So Maruti kickstarts the earnings for the auto sector here, and it's going to be a steady set of earnings from Maruti for Q4 FY26. So if you talk about the revenue, now the double-digit volume growth that company has seen in Q4 FY26, that is going to aid revenue growth, and we are going to see a double-digit revenue growth in Q4. And as far as one of the most important factors is the realization, that will also be increased by almost 12% YY and 1% on a sequential basis. And the reason is the rising export mix that company has seen over the last few months. That will help the realization. Now coming to the overall numbers, so profit may see an increase of 12%, revenue can see a jump of almost 26%, and EBITDA can expand by 44%, and in resultant margin can come around 12% or say 11.8 to 11.9%, and that would be against 10.5% in the same quarter last year. Volumes were up 12% YY, 1% on a sequential basis. Realization, as I told you, 12% up YY, 1% on a sequential basis. But for the auto sector this time, more than earnings, what would be important is the commentary. So in the passenger vehicle segment, except Maruti, majority of the companies have already announced price increase. So we'll have to see when exactly Maruti announces price increase, and also what's the update on the capacity front. Because of capacity constraints, volume growth in Q4 FY26, Maruti has, despite reporting a 12% increase, it has underperformed the industry. And also commentary related to recently announced cafe emission norm draft by central government and also Delhi government's EV policy draft. Then we'll be awaiting exactly what does management say. But as far as earnings are concerned, it will be a steady set.
All right, Sudarshan, thanks a lot for that. Shriram Finance is up 9% right now. We'll take a short break, come back on the other side, the conversation with the management. Welcome back. You're watching us here on Trading Hour. A bunch of these stocks spiking right now. AGI Greenpack reported its results yesterday. It seems like there are some of the internals which the street likes a lot more. The foray beyond glass packaging and now going into perhaps canned packaging as well, helping their cause. Stock up 13% right now. Alongside that, we're seeing some traction on Brigade Enterprises as well, up around 3%. A lot of the other real estate stocks doing well too. Kolte Patil, for one, has recovered from the lows, currently into the green right now. But let's speak about Shriram Finance. Reported a good set of numbers, and this is what the management had to say. Post the numbers. The stock surging as we speak.
Piramal Finance has reported a strong fourth quarter with growth, profitability, asset quality, all of it improving. Their total assets under management grew 25% year-on-year. The core book grew about 33%. Profits jumped 390%, driven by stronger core earnings, better margins. There was, of course, an exceptional item as well. But let's bring in Jairam Sridharan, the Managing Director and CEO of Piramal Finance, for more on these numbers and the way ahead. Jairam, always a pleasure to have you on the show. Very good show in the fourth quarter. Now you're telling us about a 25% AUM growth guidance, 50% profit growth in FY27. Which segments are going to contribute most to this, especially gold loans? That seems to be a focus area for you now. What kind of AUM scale and profitability there specifically are you expecting, say, in the next 2-3 years?
Thank you, Ritu, for having me. And yes, it has been a great quarter for us. We crossed 1 lakh crores in terms of assets under management. We crossed 2% in terms of return on assets. And we grew our profit 3x on full year basis and 5x on a quarter Q4 to Q4 basis. So all in all, it's been a great quarter and a great financial year 26 for us. Looking forward, as you rightly said, we have guided for a 25% growth in profits and an approximately 50% growth, 25% growth in assets and approximately 50% growth in profits. There are two main drivers here, Ritu. One is, of course, the continued rundown of our legacy book, which is today come down to less than 3%. But as it goes down to near zero, that'll automatically boost profits, because remember that the legacy book is a loss-making book. So the less of it we have, it's like having less negative marking in your exams. Automatically your scores go up. So our scores are going to get better just by having less negative marks. So that's an important element. The other element is our credit rating, which has been upgraded to AA+ in the last 2-3 months. And that hopefully should result in a 50 to 80 basis point improvement in our cost of borrowing over the next couple of years. So that should help us as well. In terms of segments, while we have started gold loans very recently, we opened our first 22 branches in March. I don't expect this to scale too much in the next couple of years. It'll be still a very small business compared to the 1 lakh crore size that we have as a company now. Building an organic business is always time consuming, and we are going to be slow and steady in this. So don't expect any big dramatic movements in gold or rural, our two big focus businesses in the next year or two. The growth will all come from our regular businesses, our mortgage businesses, our unsecured lending businesses, our real estate business, etc. So the growth will continue to come from there.
Margins have improved to 6.5%. How much further upside, and when will the borrowing cost benefit start to flow through?
Yeah. See, the borrowing cost benefit, Ritu, is going to take a couple of years to flow through because our average borrowing stack is about a 3-year maturity stack, which means it'll take a couple of years for it to fully churn out and for the benefits of the new borrowings to show up on the borrowings. Every quarter it'll improve a little, but it'll take a couple of years for the full benefits to show up. On NIMs, our overall NIM in the fourth quarter was 6.5%, but the core book with NIMs was about 7%. So basically, if you take out that negative marking business that I spoke about before, the legacy business, then the remaining book has had a NIM of about 7%. So as that part of the business continues to shrink to near zero over the course of this coming year, then the rest of the book will automatically kind of reprice up to that 7% NIM. So about 40-50 basis point of improvement in NIM seems kind of much on the cards as we keep shifting our book away from the old legacy book.
Okay, let's talk about asset quality. I mean, your gross NPAs have come down to about 2.3%, retail 90 days past due at about 0.6%. But would you say this is the bottom of the credit cost cycle, or what kind of trends are you seeing, especially rural, which is a focus area for you, microfinance, the unsecured book in particular?
Yeah, it's a great question. It's been surprising to me how much risk has improved in the last couple of quarters, particularly in the last 4 months. Risk has improved quite a bit. As you said, our GNPA ratios are now at 2.25%, give or take, and that is kind of a 5-6 year low for us, right? And on unsecured lending, delinquency levels are at 2-year plus lows. That continues to do really, really well. And Q4 was pretty spectacular on credit risk on those businesses. And this has continued in the eye of kind of what's going on in the Middle East and the potential risk a lot of us have seen on what could happen to MSME borrowings, unsecured MSME borrowings. So far, nothing to report, honestly. March numbers were great. April numbers continue to be good as well. So it looks like, at least so far, the risk from some of these macro events hasn't yet permeated in here. Now, at Piramal's level, our credit cost was 1.5% in Q4, lower by 10 basis points compared to last quarter, and about 30 basis points compared to the previous year. So overall, it has been actually very good.
Of course, in the March quarter, you haven't started to see any impact from the West Asia crisis. It will perhaps start to show in Q1 and Q2. But if you could give us a sense of what percentage of your AUM is exposed to these sensitive sectors, and if there's a worst case scenario you've built, for instance, crude touching a specific level, currency depreciating by a certain amount, that will make you change your FY27 guidance.
Yeah, I think the big thing to watch is sustained crude prices. So if the crude price, let's say on a 3-month average or a 4-month average basis, stays at, let's say, 110 plus or something, then we are all in pretty significant trouble as an economy. A one-off kind of, the price going up to 110, 120, staying there for a couple of days, I don't think it matters too much. But let's say a 3-month average or 4-month average staying above 110 would be serious trouble for everybody, and growth expectations would need to get recalibrated. Risk expectations would need to get recalibrated at that point. In terms of the portfolio composition, I would say that there is a core vulnerable population, which is, again, we used AI to actually, here's an interesting thing we did. We exposed AI to a lot of the news items and a lot of our customer characteristics and asked AI to determine by itself which segments it thought were vulnerable and which customers within those vulnerable segments were the most vulnerable for us.
Okay, so far, so good. April's been good, Jairam, and we hope it continues to remain that way. Thanks very much for your time here today. Always a pleasure having you.
Welcome back. You're watching us here on Trading Hour. Perfect time to get you an update coming in from the F&O desk. If you look at the markets right now, the Nifty is holding up despite the weakness that we're seeing in the Nifty Bank. We've seen the mid-cap index do well as well. But if you look at the contribution chart of the Nifty, you'd realize that, there has been a fair amount of support which has come in from the likes of Reliance. We've seen the metals pack do extremely well as well, and the contribution chart comes up for you on the screen. Beyond that, if you look at all the other parameters in the market as well, we do have the India VIX that comes up for you. The India VIX has been lower for the last couple of trading sessions, which tells you that bulls are feeling a lot better right now. The market is just consolidating after seeing a bit of a rally and thereafter a decline right now. What is this consolidation likely to entail? If you look at levels, it is the April series expiry. And you have the options data that is, that is up for you on the screen. 24,100 put has a premium of 40 rupees, telling you around 24,050 is where support is expected. 3 crore shares outstanding out there. The 24,200 call and the 24,150 calls are both equally active as well. So 24,200 call has a premium of about 8 rupees. So maybe a bit of punt buying taking place out there. The 24,150 call, that's the one that should come up for you right now. Premium of nearly 35-40 rupees. Telling you closer to that 170, 180 is where we are expecting some sort of resistance. If you look at some of the important technical levels as well, the 50-day moving average on the Nifty seems like a bit of a resistance zone, and similar is the case for the Nifty Bank as well. But amidst all of this, we do have a bunch of stocks which we need to monitor, and also monitor how the market will react in the light of higher crude prices and a weaker rupee. Dollar is now close to 94.5. And Brent this morning was about $108, $109, swiftly surged to $111 per barrel. And that explains why the markets moved off highs as well. And the Nifty Bank has moved to the low point of trade. Amidst all of this, the stocks that I told you, right? You do have a bunch of them where Nippon India, after a good set of numbers, seeing some shorts covering their positions. And we have Eternal ahead of numbers, seeing some fresh short addition.
The market has taken a bit of a turn now in the last few minutes. The Nifty is now turned into the red, and that's a significant move down from the highs of the day, and led by the Nifty Bank. The Nifty Bank is now down close to 500 points as we speak, and a lot of these frontline private sector banks, which were supposed to be rather insulated from the new RBI norms, they are the ones that are leading this leg down. Axis Bank has moved to the lows of the day. HDFC Bank has moved to the lows of the day, as has ICICI Bank. So all of these three names have seen a bit of a sharp reversal from the day's high, and have now moved close to or at the lowest point of the day. So the Nifty too now below the mark of 24,100, 20 points lower as we speak. Ashish Kyal from Wave Strategy Advisors is joining in for a quick chart check. Ashish, good morning. Thank you for joining in. Do you believe that the Nifty bulls have enough strength to hold on to 24,000 for today's expiry? And then your call for the index on the May series and your stock recommendations as well.
Hi, afternoon to you and all the viewers. See, if you look at index today, we are seeing it in a range. The culprit is Bank Nifty. Honestly, the Bank Nifty has given away nearly 500 points now as we speak. And Nifty is finding a lot of hurdle around that 24,200, 24,190 mark, from where there is some kind of a hurdle coming in. So today expiry, I think it might be around about 24,000 psychological level. We might expire around 24,040, 24,100. That's the zone that I'm looking at. And in the coming series, I think the overall tone is going to be in a range. The reason being the event is still not behind us. But the very interesting observation is that the options market are behaving very normally, because put options IDs have crashed, India VIX have crashed, and we can clearly see the parity has been returning back. So the anxiety in the market has lowered down. That shows the range is going to reduce now. We might move between the range of around 24,300 and 23,800. That's the range I think we might move in the coming weeks. And overall, the undertone is going to be use the dips as a buying opportunity, and then we can again expect market to go towards 24,300 level as far as Nifty goes. And from a stock specific perspective, the first stock pick is going to be in RBL Bank. We can see there is good momentum that is picking up from the stock after a lot of time. The volumes are good enough, and the stock can move towards the target of around 340. Stop loss can be placed at 314 levels. And the next stock on the buy side is going to be Vedanta. The entire metal space is doing well, and I think this is going to continue as a secular rise we see across the material space. And overall in Vedanta, we can expect a target of around 795 on the upside, and one can maintain a stop loss of around 730 levels.
Ashish, thanks very much for those calls. Appreciate your time here. Let's move on to get you the macro signals of the day. Markets, like we were just telling you, have slipped into the red. It's 2457 on the Nifty, down about 40 points as we speak. The broader markets are holding up, but the bank Nifty is dragging the markets lower, down about 520 points odd as we speak. Now, oil prices, they're also rising because global markets are reacting to the stalled peace negotiations between the United States and Iran. The Brent crude now trading at $110 a barrel. And this is the 7th consecutive session of gains for the benchmark. Now, the 10-year GSEC yields, they've been rising as well, trading at about 6.96 to 6.98. That's the range they've been trading at today. They've climbed for the 2nd consecutive session, reacting to the oil prices, of course, and very heavy domestic borrowing schedule. Today itself, states are set to borrow about 14,500 crores in an auction that is scheduled for today. The rupee, meanwhile, is also weaker. It is now trading at 94.47, down about 28 paise in trade today. This is near the record lows we'd seen earlier. Again, thanks to the higher oil prices weighing on the sentiments. There's also persistent dollar demand from oil importers, month-end hedging by corporations. All of that is eroding support for the currency. We also understand the Reserve Bank is intervening in the Forex market today to prevent any sharper fall, beyond the 94.50 kind of a level. So rupee is a key one to keep an eye out on. We'll slip into a short break on that note. Up next, we'll discuss market fundamentals with Ruchit Mehta from SBI Mutual Funds. Stay tuned.
Welcome back. 40 points lower now on the index. So it's a bit of a U-turn from the day's high where we were at the start of the show. And it's almost 120 point downtick from the day's high. Now 24,050 is where the index currently stands. Of course, the 24,000 level on the downside remains the most important level to watch for today's session, at least from the bull standpoint. Ruchit Mehta from SBI Mutual Fund is now joining in to talk more on the markets. Ruchit, good morning. Thank you for joining in. There has been this big moves that you have seen in this pharma space. The one major acquisition announced by the leading drug maker. There has been a lot of management churn also seen in a lot of these mid-sized pharma companies as well. What is your preferred bet within the pharma space? Do you like the CDMO players? Do you like the generic players? Where does your preference lie at SBIMF?
We have been more positive on the CDMO plays, particularly given the potential for better growth prospect that's there. The generic side has been a bit of a mixed bag, given issues of pricing pressures, potential pipeline issues, etc. So I think overall within the pharma, healthcare space. We like the CDMO space, we like hospitals. I mean, those are our preferred areas to invest in right now.
Ruchit, in that case, what is the other, where is it that you are putting money to work with? Because there was a sharp sell-off in the market in the month of March, and now in the month of April, there has been a significant recovery. The index is up 8%. The broader markets have done even better, or 14, 15 odd percent on the mid-cap index as well. Where are you putting money to work? The large caps, the mid-caps, or within those, where is it that you are placing your bets?
Sure. So I think the large cap space is something that's quite attractive, given that valuations are a lot more reasonable at this point in time. And they seem to be able to weather some of the current sort of storms that can occur because of the issues around the Iran war that's there, with whether being able to manage costs properly or not, or funding, etc. The mid-cap space also is pretty interesting. There have been a fair bit of price corrections in many of those stocks. However, we still have to foresee how much of an earnings cut that may come through, right? So the first cut earnings season has been okay. I mean, some sectors have done well. I mean, FMCG has seemed to have some bit of a positive surprise for the numbers that came for the 2-3 odd companies that have reported so far. IT has been on the weaker side as expected, but slightly bit more weaker, that's there. But I think, if the current situation persists for some more time, then there can still be a bit more earnings pressure to come through, right? So whatever recovery we were seeing towards the later half of last year from a macro standpoint, and therefore, seeping into earnings, while so far it seems to have held on, but the longer this thing drags on, I think there can be more earnings cut that's there. So while yes, mid caps are interesting, there are a lot of names that have got corrected, but one has to be selective. I think there are certain sectors that are looking quite attractive still. Banking, for example, consumer names, the metals, mining, industrial names. So those will still look quite attractive, whether it's large cap or mid cap of the basket.
Ruchit, let me pick up on banking then. The private peers have been underperforming. PSUs have been finding some favor. But now with these new regulations on the kind of provisioning that these banks will have to take and the expected hit being larger for public sector banks, does it change the equation in any sort of way, at least in the near term? Or do you think because it's just a one-time hit and there's a long runway for banks to absorb that, is the worry on the PSU stocks being overdone?
I mean, I think in generally, these are hits that the market will sort of see through, right? I mean, few days later, the focus will be down about, what is the impact, markets will have absorbed that. And then you get back to the basic brass tacks of, what is the growth outlook looking like, what's going to be on both on the loans and the deposit side. And then more importantly, what's happening on the NIM side of it, right? I think PSUs are likely to do better for the time being. And they did better because they were a little bit more aggressive on the loan growth side of it. So if you see recent loan growth data, large PSU banks have done better than the private sector banks. And that's probably why, they were a lot more in favor recently. But going forward, again, it'll be down to every individual bank, right? How are they able to grow their book and manage their NIMs? This ECL thing, I think, will just get sort of factored in very quickly. And then it'll just be taken as a one-time hit. There is a long leeway that's been given for these banks to sort of absorb it. So I think it's just going to be a short 2-3 day kind of an issue.
What about the asset quality, Ruchit? Any concerns there? Because, in the fourth quarter, what's been a standout in some of the large, especially private names, has been the vast improvement in asset quality. But then, this West Asia crisis and what happens from there on, it's not going to reflect immediately. We might start to see it in Q1, perhaps in Q2. Any sort of concerns there?
Yeah, I mean, see, the longer this issue drags on, right, there will be the second and third order derivative impact for a lot of industries that will start to, seep in. Whether it is merely from the ability to not export or not being able to pass on costs, or in some cases, not even being able to secure supplies. So there will be balance sheet stress that can pop up a lot. I mean, if this continues to drag on a lot more, but it won't come up immediately, right? I mean, there will be certain mechanisms that companies will try. There will be ways to sort of raise short-term capital. Maybe there will be some ministry level or industrial level support that may come through. But eventually, 3-4 quarters down the line, in some of the more impacted segments, there can be, asset quality concerns that can crop up. I mean, sectors which are heavily dependent on energy supplies coming in from the Middle East, the gas the companies which have been impacted by a lack of gas supplies, be it on the ceramic side, tiles, and therefore the real estate plays that are there, or you would see stuff like even those who are dependent on plastics and the inability to sort of procure plastics itself or pass on those costs. So I mean, we still don't fully know the extent of the impact that can happen. But I think toward this quarter may not be a good reflection. I think this is sort of more backward looking. But I think the first and second quarter will show up some impact. And I think, from a banking sector perspective, it may still be second or third quarter before some uptick that could come through from an asset quality perspective.
Right. You did say there are opportunities in the consumer space. I just wanted your, split between consumer discretionary and consumer staples, because so far, all the staples that have reported their numbers have been way above street expectations. But then the worry is that come quarter one, quarter two, raw material inflation will start eating into their margins. Would you believe that too?
Yeah, I mean, there is going to be some bit of an impact from the raw mat side of it. Right? Look at, for example, the paint sector. Right? There's been a 12-13% price hike that's been taken simply because the input cost has gone up. Right? Packaging is an issue for many of these companies, and something as basic as getting plastic packaging is a bit of an issue. Therefore, EU sort of prioritize between passing on the cost of making larger packs, etc. So that is going to be an issue. But I think the bigger picture is that the volume growth so far has to be much better than anticipated. Right? The companies that have reported the volume growth is pretty solid, which shows that barring the crisis, fundamentally on ground demand seems to be holding up pretty solid. In fact, it's surprising slightly more on the positive side of it. Within the consumer space, we obviously like the discretionary space a lot more, right? Be the automotive, white goods, etc. We like that space a lot more than the staple space. Within the staple space, you probably would play, some of the aggregators better, because you don't know which brand, which segment is going to do well over the next few quarters. And either as an aggregator, you are able to, play across brands, even startups, unlisted, etc. So, and they just are beneficiaries of the consumer spend that's that's sort of starting to be looking up at this point.
And what's your view on retail?
So retail, very early days, I think they had a fairly bit of a tough time the last year. I think there is some early signs of an improvement. Some companies on the apparel space have reported an improvement. And I think going forward, they will in fact face a little bit more on margin pressure, given that, cost of commodities have gone up a lot more sharply. And this segment is a lot more price conscious. There's a lot more competitiveness on the pricing side of it. So I think the retail space could see some bit of a hit on the margin side of it, particularly most on the apparel side of it. FMCG retail is, as I said, these are the aggregators. I think they look pretty okay, right? There will be brand level competition, and they will just benefit from the fact that the consumer is spending back again.
Rishit, thank you so much for sparing time and joining us today with your views on these specific sectors. Take a short break, focus on the bond markets on the other side with Manisha Gupta.
Welcome back. Pine Labs has acquired D2C checkout platform Shopflow in an 88 crore rupees all-cash deal. Let's bring in Amrish Rao, the CEO of Pine Labs, for more on this. Amrish, hi. This is Ritu. Welcome, and thanks very much for your time here. 88 crores for a company that's generating under 15 crores in revenue. That's a 6 times multiple. How do you justify that to shareholders? What is the value you see? And, over a period of time, say 2 to 3 years, what kind of revenue generation do you expect from the Shopflow business?
This is clearly a product-led acquisition on our side. When you go to a mall or an airport, you generally tend to see the Pine Labs terminal everywhere. What you don't realize is that's about 27% of our revenues. All our growth drivers are actually coming on the transaction processing side. May that be on bill payments or what's happening on the online space, or even what's happening in the prepaid or wallet space. So when Amazon Pay is a client of ours, Cred, 100% of all bill payment transactions that you do with Cred runs on our platform. In the online space, we started to make some very, very good progress, and we've been doubling revenues for the last 3 years. So we have all the 3 Q-commerce companies and all the 3 e-commerce companies as our customer. However, when it comes to D2C, more and more merchants are asking for consumer insights, consumer behavior related information. They want a differentiated checkout experience. We wanted to be relevant in that space. That was an area where we felt that partnering with Shopflow and making that acquisition works very well for us. As I told you, our online business and our bill payments business has been doubling any which ways. So I don't see any stop in our growth on that side of the business. Along with this new product, we should be able to accelerate into the mid-market segment, which we were not known for. Now, Shopflow has about 1,000 merchants, has access to about 65 million consumers. This is really going to be a very strategic acquisition for us.
Okay, 1,000 odd customers. But Amrish, correct me if I'm wrong. I mean, the preferred payment method for Indians still seems to be UPI. You'd be very much aware of that. And the preferred checkout form or fulfillment method is very much, we love our cash on delivery. So in a market like that, you're talking about Shopflow's pitch being the 15-20% kind of a conversion rate. How much heft does that hold in a market like this? And, over a period of time, what is the contribution to your payment revenues you see simply from this acquisition?
See, the UPI volumes on our platform, both on the POS business as well as in the online business, has now started to reach almost 70%. So 70% of our transactions are any which ways coming from UPI. But what the consumer expects when he comes to an e-commerce merchant is he needs to see that transactions are successful every day. Like literally 5 minutes back, my wife was somewhere and she sent me a payment link that did not work. Now, that's not acceptable in today's time, right? You should get to an 100% success rate. That's what we are promising along with Shopflow. As I told you, the entire bill payments and online business for us has been sort of doubling for the last 3 consecutive years. I see that to continue going forward.
Right. I just wanted to understand a couple of things. With the Shopflow acquisition, what kind of capabilities do you get for your own existing business? And what are the synergies, the scale synergies that your existing business brings to Shopflow?
That's a great point. So one of the things what happens is beyond the payments landscape, merchants are asking for more services. Now, in the case of Shopflow, to go to a merchant and provide these plus services, the CAC associated with it was quite high. In the case of Pine Labs, because of our offline presence and our online presence, we already had the distribution capabilities with us. We required this product stack to come together. So what we are adding to it is we are basically creating distribution. As we speak, we have more than 1,500 people selling to both e-commerce merchants, government institutions, and also to offline stores. Now we will distribute the Shopflow product through that platform, along with our payments capabilities.
So eventually, what does that do to your, additional revenue coming in because the data that you guys provide to them? And I suppose because it's a value-added service, this would be margin accretive as well. 88 crores goes out of your books for acquiring this company. Just give me the ROI.
So the way to look at this is, if you can compound your business and continue to compound it, I think that is important. One of the other things which I want to be very clear with everybody who wants to listen to the Pine Lab stories, we are a tech company. We'll invest into tech, we'll build capabilities, and we will use those capabilities to drive revenues. What I don't want to be doing is look at everything which says that, okay, this business is going to give me a 30 crores revenue in next year on a standalone basis. I rather look at it along with the standalone business and what I have on my payments platform. Can I continue to grow at 100% on a year-on-year basis, which I've been doing for the last 3 years? This allows me to do that. 88 crores, just to put that into context, when I look at my adjusted EBITDA for per quarter, that is less than 20% of my adjusted EBITDA, for the year.
Amrish, you spoke about the acquisition and the synergies and so on, but the point that I wanted to ask is, what about the founders of ShopFlow? Do they stay on? And what is the lock-in, if there is any, in this transaction? Could you shed more light on that?
Yes, so the founders of ShopFlow, there are 3 founders of ShopFlow. A couple of them will be exiting the company. One of them will continue. The couple who are exiting will continue to remain with Pine Labs at least for an 18-month period on a consulting basis. The reason why we wanted to do it that way, because the team right now, 2 of them are based in the US. Just to put it mildly, they've been bit by the AI bug, so they are quite keen to do something in the US markets, but they are absolutely involved working with us. We also have some sort of a structure which will keep them incentivized to work with us and partner with us and deliver to what we have looked at as a future model.
Amrish, very quickly, I know you haven't reported your fourth quarter numbers yet, but in your third quarter itself, your operating cash flow was negative, about 124 crores. You've just turned profitable, about 42 crores. And I know inorganic has been a huge strategy for growth for Pine Labs. But are you going to be able to continue on that path for growth going on, from here with the kind of balance sheet you have?
Absolutely. In fact, what we have actually gone to great lengths and told the street is, you got to look at Pine Labs, the payments business, the working capital and the cash flow generation on a full year basis. Now, as you know, the third quarter is the quarter of celebrations, and that's why we had a situation when the cash flow turned negative. But you got to look at it on a full year basis. As you would expect, I can't give you certain guidances related to Q4, but we've continued to insist that you should look at our business on a full year basis when it comes to cash flow generation. So look forward to what's coming through in the Q4.
Wish you good luck for that. Amrish, thank you for sparing time and joining us today on this acquisition as well. Shifting focus to the bond markets, Manisha Gupta is here with the latest. Manisha.
Well, yet another day that we are looking at India bonds starting on a weaker note today. This is because of the rise in the crude oil prices, which are trading almost at $110 a barrel. Well, if you look at the crude oil prices, we've gained up by 11% for the month of April. It's up 80% for the year 2026 till time, and it has been impacting the money markets. For the Indian rupee as well, it's yet another day that we are looking at further decline. 94 really seems to be holding when it comes to Indian rupee in the trades therein. Also, the US yields have seen a decline. The 15-year bond has slumped quite sharply. That seems to be impacting many of these Asian bond markets as well. What the street will watch out for also is the 7 states which are raising nearly 145 billion through the sale of bonds today. The expectation is that the demand is going to be stronger because there are buyers coming in from state-owned banks, insurers and mutual funds as well. The other thing that the street will keep an eye on from the global markets is going to be the US Fed meeting. The announcement for that, of course, is on Wednesday. But this is going to be Jerome Powell's last meeting that he would be chairing. So announcements, Strait of Hormuz, inflation impact, all is something that the street will keep an eye on. And then just refreshing on all the corporate bond issuances that are available in this week. You have NIF Infrastructure Finance Limited, which is looking to raise 10 billion, and they're doing this via 28th August 2031 bonds, and they're issuing a fixed coupon at around 7.88%. SIDBI is looking to raise 60 billion via 10th August 2029 bonds. The bidding for that is today. NIF infrastructure we spoke about. You have NHPC, which is looking to raise 80 billion, and this is via corporate debt throughout FY27. Again, a very big number of almost around 400 billion coming in from IREDA, and they're looking to raise all of this between FY27, and this is going to happen via debt markets.
All right, Manisha, thanks a lot for that. Meanwhile, we're looking to wrap up on this edition of Trading Hour. As we do that, just keep an eye out on a couple of these stocks which are spiking. Tata Chemicals has been doing well all through today's trading session so far, but now has accelerated those gains, coming in near that 9% mark for that stock in terms of an up move. Cohance Life, Umang Vohra's appointment has had a massive re-rating on the stock. Last 2 days itself, the stock is up 40%. After a 20% upper circuit yesterday, the stock is up 15% right now. And AGI Greenpack, good numbers coming in. That stock up 12%. Electronics Mart is the other one, which is up 11.5%. It may perhaps be on account of the promised heat wave, where a lot of these stores will see some of their larger appliances move, the likes of air conditioners as well as refrigerators. So that should do well for them, because last summer was a very weak one for them. They were stuck with a lot of inventory. Inventory moving for them would be beneficial. Not necessarily Whirlpool, but maybe Blue Star and Voltas. All of them have been doing well, not today, but over the last week or so. And now the retailers also spiking.
Indeed, and they were feeling the heat last summer. We are feeling the heat this time around, of course, pun intended there. But Piramal Finance has moved higher to the highest point of the day now, 12% on the stock. So that, after you just heard the management a few minutes earlier, and now at the highest point of the day is the Piramal Finance.
Saurabh, you track movies very closely. Is there any big blockbuster which is likely? Because I thought this would be a lean period during the cricket season. So no big blockbusters barring Michael Jackson's documentary. PBR is up around 5% in a market like this. So what explains that?
Oh, that's a good day as well for PVR, of course. No movie that comes to my mind as of now.
If it doesn't come to your mind, then there is no movie.
We take a leave on this edition of Trading Hour from Ritu Mangalam and me. Thank you for watching. The team of Halftime Report takes the action forward on the other side.
Stocks trade steady with mid-cap seeing some outperformance as US-Iran talks fail to make any meaningful headway. Metals and energy notched some gains while healthcare and financials drag.
Coal India gains despite a muted Q4 as the heat wave-driven surge in power demand and a dip in coal output in Indonesia fuels investor interest. A healthy dividend yield also adds to its appeal.
RBI has issued expected credit loss provisioning rules effective April 1st, 2027 that require banks to factor in future credit losses. The move, while aimed at making Indian banks more resilient, is expected to dent bottom lines in the near term.
Crude oil prices flare up on reports that Trump is unhappy with Iran's latest proposal. The continuing blockade of the Strait of Hormuz remains a concern for oil importing countries like India.
Hello and welcome to Halftime Report live from the CNBC TV 18 Motilal Oswal studio. I'm Ekta Batra, with me Sonal Putra as well as Vinny Motiwala. Well, it's turning out to be a session where we are seeing a sluggish trend come through on the markets. So we have the Nifty, which is just about fighting for 24,000 as we speak. We have the mid-caps, which are managing to hold up with a gain of around 0.2%. But the Bank Nifty is under pressure at this point in time. So the Bank Nifty, which is down around 1% at this point. Just want to point out that it is Brent Crude, which is one of the key reasons why we're seeing this kind of sluggishness in the markets. So Brent Crude, for example, has risen just about around 12 to 13% just in the past 1 week, risen from levels of around $98 to $99 per barrel, all the way to around $110, $111 per barrel at this point in time. Well, let's see how the rest of the day pans out. But as of now, not looking great.
Not looking great at the day's low, and of course it's the monthly expiry as well. Time's flying by the way. We're already towards the end of April, and that is something which will keep markets volatile. What happens in the last 1 hour of trade is important to track. At the day's low for the Nifty, actually the low today was 23,999, and we have seen a lower low from those levels as well. So just checking that number out. But yes, Nifty not doing so well. Bank Nifty is the one which is leading to a lower number on the Nifty as well. We have the auto index which is lower, IT index which continues to be lower. So we'll focus on a lot of them through the course of the show, and big numbers expected. Maruti and Eternal from the Nifty pack.
Absolutely, we'll watch out for those numbers as well. But like you said, on the show, we have something exciting lined up for our viewers as well. And first up, we'll have splendid moves that's seen in Cohance Life Sciences for the second straight day following the appointment of Umang Vohra as the new executive chairman as well as group CEO. A deep dive into the fundamentals and what these management changes mean for business coming up in just a bit. And in our Movers and Shakers segment, we'll be putting the spotlight on earnings-led move in Coal India, City Union Bank, Piramal Finance, and we'll also take stock of triggers aiding the rally in Tata Chemicals. This is a subsidiary of Rallis India. Now, moving on, let's also put the spotlight on a trending segment, and we will unpack March quarter's results of iFinance with founder and managing director Sanjay Sharma. And in our earnings expected today, Nifty majors, Maruti, Eternal, they'll be reporting their numbers. What are the polls looking like for that? We'll talk about all of that as well. But first up, let's start with our Movers and Shakers segment, and we'll put the spotlight on the top Nifty gainer today, Coal India. Results coming in here as well, but a lot in terms of catalysts that are there for this one as well, Nigel. Not only results, but catalysts that we are highlighting today.
Well, that's right. Coal India reported its numbers, and the numbers actually were regrouped. The company added the cess to the revenue, and they've done some kind of adjustment in their other expenditure as well. But in terms of the numbers, there's nothing really to write home about in terms of the past quarter's numbers, both on the volumes as well as on the realization parameter. The problem for Coal India, remember, has been that thermal power generation itself has been weak, and coal inventories in India have been relatively high. Remember, the share of captive coal, as a percentage of the total mix, that's moved up to around 21% from just around 9% around 6 years or so ago. But the street is excited on the path ahead. So let's highlight 5 key reasons why the street is excited. First, on dispatches, the street expected to improve in FY27 because power demand is expected to remain strong, and also there's a reduction in Indonesia's policy with regard to their coal production. Now, the volumes actually should pick up. And the reason is we have had a very, very subdued past year. In fact, if you look at it between 2021 and 2024, the average growth that you saw in volumes was around 10%. Then FY25, it was a subdued year, only 1% growth. But the past year, there was actually a degrowth. So now on a low base, the street believes that they will show some kind of growth. then there's a good chance that e-auction prices actually perk up a little bit, because Indonesia will be producing less. To give you a number, in 2026, they have laid out a roadmap, but they produce only around 600 million tons, which is sharply lower from around 790 million tons that they produced in the previous calendar year. Also, imported coal has got more expensive because the rupee has weakened, and also you have global prices that have perked up. Point number 4, they have been a dividend machine. For the past quarter, they declared more than 5 rupees of dividend, and also for the year, it was close to 26 rupees and 50 paise. And finally, various brokerages, case in point being Jefferies, they are positive on the earnings trajectory. They're expecting them to grow, the earnings to grow by around 5% CAGR over the next 2 fiscals. They also say the stock is attractive. It trades at around 9 times on a PE basis and also offers 6% dividend yield. So put all that together, Coal India, past quarter's numbers not so exciting, but the street is optimistic on the prospects ahead.
Okay, all right, Nigel. Thanks very much for that. So that's on Coal India. That stock up around 3.7%. A part of our movers and shakers this afternoon. But also a couple of financials are buzzing in trade on the back of their quarterly numbers. For example, Shriram Finance, City Union Bank. Ananya joins in for a fine print on these. Ananya.
City Union Bank and Shriram Finance are sharply up today, and the move looks justified. They both delivered strong Q4. Now, City Union Bank advances grew 26% YOY, while deposits rose 23% YOY, and total business increased 24% YOY. Net interest income grew 31% YOY, while PAT was up 25% YOY. Now, NIM remained healthy at 3.87%. Now, the biggest positive was the asset quality, with GNPA at 1.91% and an NPA at 0.68%, while PCR at 84%. Now, the management guidance for FY27 is a loan book growth of 2 to 3% above industry growth, with focus on MSME, gold loan segment and secured retail. Now, the branch expansion may keep the OPEX a bit elevated, but gold loan risk will remain well cushioned. Now, coming to Shriram Finance, they delivered excellent quarter, with AUM grew 25% YOY, while the core growth book grew 33% YOY. Now, the PAT jumped 390% YOY. FY26 PAT grew 210% YOY, while NIM improved to 6.55%. GNPA improved to 2.3%, and retail delinquency remained low at 0.6%. Now, the management mentioned that the legacy book is now below 3% of the total AUM, which is a key positive and will become largely irrelevant going forward in FY27. Now, the AA plus rating upgrade can lower borrowing costs by 50 to 80 bips over time. For FY27, management guided for around 25% AUM growth and nearly 50% profit growth. Now, overall, we can see the stocks are not just reacting on good set of numbers, but on cleaner asset quality and strong guidance by the management going forward.
Yes, we can see that in the stock price as well. Thank you so much, Ananya, for joining us with all those details and financials on our radar. We do have Tata Chemicals and Rallis India in focus as well. Now, remember, Rallis India reported numbers yesterday. It is seasonally a weak quarter, but the company has done well. If you look at the numbers, they have seen a revenue growth of 6%, which is versus an estimate of 4%, which was driven by 5% volume growth and 1% price growth. So the volume growth is something that the street is liking. There was an EBITDA loss, yes, but it has narrowed on a YOY basis, and it has also lower than the estimates that the street had as well. So 1 crore versus an estimate of 5 crores. This is because of the cost saving measures that the company has been undertaking. Crop care business grew 5% for the company, and their B2C segment did very well, 15% on a YOY basis. The seeds business with a 23% growth is where the company expects seeds business to grow at high mid-teens. So strong commentary coming in from Rallis's management as far as the outlook on revenue growth is concerned in some of the segments. Now, why is Tata Chemical rallying? Because Rallis is a subsidiary of Tata Chemicals, and the consolidated numbers do take into account Rallis numbers as well. The company will be reporting numbers on 4th of May, and there are some Kotak estimates that I would like to put on board. Revenue is expected to decline by 6.5%, EBITDA expected to decline by 9%. There will be a loss again, lower loss than what was there last year, but this is because of lower soda ash prices and the supply chain constraints that we've been seeing globally. But yes, on the back of decent set of numbers coming in from Rallis, commentary as well, at least it will not look as bad as what the street is factoring in. But yes, the numbers are next week, so watch out for that one. For now, both these stocks doing well in trade.
Okay, surely we'll keep an eye out on the numbers next week as well, Sonal. Thanks so much for that. But on that note, we're going to slip into a very short break. On the other side, we'll talk about iFinance. Their March quarter numbers, a good show that came in from the company. We'll be joined by the founder and the managing director of the company, Sanjay Sharma. Stay tuned in.
Welcome back. You're still tuned into Halftime Report. A strong set of quarter 4 numbers were reported by iFinance. The company's profit more than doubles while cost of borrowing falls nearly 11%. We are now joined by Sanjay Sharma, founder and MD, to break down the quarter numbers, the analysis, and most importantly, the outlook going forward. Mr. Sharma, good afternoon. Thank you so much for joining in. Strong set of numbers, and you've guided for even stronger numbers for FY27. Your core portfolio is the MSME business, right? I wanted to understand how have disbursements been there? How has collections been there because of what we've seen due to West Asia war? This is one segment which is impacted a lot. And is this the reason why your yearly NIM guidance lower than what you've done in the quarter?
Thank you and good morning to everyone. This is been a good quarter, certainly. And I think the reason it is looking so phenomenal, it's almost 110% increase over our last quarter, is primarily because credit costs have really come down. And we've seen 5 consistent quarters of reducing credit costs. I think that's what's now becoming visible. So this was all, you could say, iceberg below the water surface. Now, finally, we have overcome the challenge of credit costs, which we saw in the earlier part of the last financial year. Our segment is MSME, and these are micro-scale MSMEs, which are not linked to the supply chain of the regular industry. So it's a segment that is quite insulated from many of the things that we hear of in terms of tariff, in terms of West Asian war, etc. Many of these things have very limited impact on this segment, and therefore we are beginning to see disbursements now come up. We have done 20% extra disbursements in the last quarter. And I think that trend will continue, although first quarter is always a slightly weaker quarter on disbursement, but it is not going to be anything different from the normal business that we do.
Okay. Hi, Mr. Sharma. Good afternoon. This is Vinny joining in the conversation as well. Any concerns maybe coming in on the unsecured loan side or first cycle borrowers as well? Any stress on that front that you're seeing?
The answer to that is that we do not see any major stress, Vinny. This segment, unlike when we talk of MSME, often we think of the organized players who are linked to the supply chain. These people are not. These are typical small manufacturers who sell the entire product into the local market, and there's a huge local market to absorb his production. So these segments have not seen any sort of dent in their business. In fact, if anything, they benefit from the rub-off of the rural demand going up last year. I think that's had a positive impact on this segment. And these small manufacturers, traders are doing well. Even when we monitor the effects of war and more recently the LPG shortage, we've not seen any sort of a change in the credit behavior in March, although it's still very early days. But whatever seen in March and parts of April doesn't show that there is an area that immediately comes up for concern.
Okay. All right, Mr. Sharma, so no credit quality risk as of now. Just extending that point and just wanted to add on the AUMs. So first, for your collection efficiencies, what are you guiding going into FY27? And what are you guiding in terms of AUMs as well? I'm presuming you've met that 29 to 30% AUM guidance for FY26.
Sure. So we will, on an AUM growth, the demand is immense. So demand is never a challenge for this segment because there's no one else who delivers services to the unorganized MSME segment. So we will continue to look at a possible growth of 25 to 30% in the coming financial year. The second is on the collection efficiency, and that's a very relevant point because everyone is worried that last year has been an area where we've seen collection efficiencies dip. So are we going to sustain that? Our collection efficiency in the last, if I take the last quarter, on non-OD or regular customers was 99.5. In fact, we ended March with 99.5% efficiency. And even our largest states, which are Bihar, Rajasthan, and Uttar Pradesh, all were above 99.5%, Rajasthan being the best at 99.7%. Also, the bucket one collection efficiency was, in fact, 62%. It had jumped up from somewhere close to 52%, went up to almost 62%. And these are two areas which we'll continue to focus on to ensure that the collection efficiencies remain high. And I think a hallmark of the work that was done last year is that our stage 2 delinquency today stands at just about 1.2%. This is the typical marker that tells you that there's no stress in the portfolio and things are going fine. Because if there was stress, then the stage 2 would have ballooned.
Okay.
And that's not the case.
Okay, so there is no stress. So asset quality is not a concern. Collections have been fine. Coming back to your NIMS guidance, you did 16.4% in Q4. The range for FY27 is anywhere between 14 to 14.6%. I'll just give the corrected numbers for the benefit of our viewers as well. It is 14.25 to 14.75%. Why not those 16% levels that you've seen in Q4? Is there a risk for the volatility because of global rates that we have been talking about?
No, I think, we find that the yields for our hypothecation loan remains very stable. There's been no fall in the yields there. The mix of hypothecation loan to mortgage loan has changed. We are today 23% mortgage loans. 2 years back, we were just about 12%. So that mix is changing, and mortgage loans are typically given at about 3 or 4% lower yields. So that is changing the yield structure, and gradually the yield mix is bringing the yield down. The borrowing costs also are coming down at the same time. So I think that effect is in a way moderating the change in NIM. Otherwise, NIMs would have probably dipped. So we are beginning to, last year, if you look at the data, the NIMs actually went up. This year, we expect the NIMs to stay stable because the cost of borrowing is likely to come down. And yes, everyone would talk of, the rates are likely to harden. But in our case, it's the replacement of the stock of old borrowings with new borrowings. Our old stock is at 10.9% rate of interest, and the new borrowing is coming at 10.13. So I think as that old stock gets paid out and the new stock comes in, it will lead to a 30 to 50 basis points reduction in cost of borrowing for us. So I think that is what will help the NIM stay stable.
Okay. So the factors that you've highlighted, cost of borrowing coming down, will help in supporting the NIMs of the company as well. Just in terms of specific trends that you're seeing in your key states, whether UP, Rajasthan, Bihar, the cash flow, borrower trends, what are that right now?
While we are there in 18 states and 3 union territories, but these 3 are the biggest states. All 3 are performing very well. As I told you that all of them are in the 99.5% collection efficiency. And initially there was a concern that in Bihar there was a new regulation. We've not seen that affect our target customer because these do not come from the MFI world. These are businesses. And Bihar continues to deliver 99.5%. Rajasthan continues to deliver 99.7% as of March. And the trends in April also show that the collection efficiencies are likely to be quite high.
Okay. All right, Mr. Sharma. Thanks very much for joining in and speaking with us and giving us your sense in terms of the numbers. So the AUM guidance remains quite strong at around 25 to 30% for A Finance. And that stock is up around 2.3% at this point in time. We'll take a short break, but up next we're going to be talking about the technicals. We have Sachatan Nanotekar who will join in with some of his trading calls. Stay tuned.
Welcome back to Halftime Report on CNBC TV 18. While the Nifty continues to trade almost near the day's lowest point, the sectors which are dragging the market is the bank index that's pulling it down. We have the auto index that's dragging the market as well. And apart from that, we're seeing realty index as well as FMCG in the red, while oil and gas, metals continue to see a bit more traction and trading on the positive side. So that's what the market is looking like. Advance decline ratio still in the favor of declines versus advances, a bit more in the favor of declines versus advances. But on that note, let's also bring on board Mangalam to take us through what's happening in the world of F&O as well. Mangalam, over to you.
Well, the market's off highs. Clearly, the Nifty is closer to the lower end of today's trading range, led lower by the Nifty Bank in particular, along with the other sectors that you mentioned. The mid-cap index, however, at an index level is a mild green. However, if you look at, again, the broader markets, the market breadth tells you that the weakness has been there over the last few minutes or so, where both those lines crissed and crossed, and now we have the red line above the green one, marginally so. It's telling you that there is some selling and there is fear which is back in the system, because at one point the India VIX was down by about 6%. Now it's just marginally lower. And ahead of expiry, we've seen a lot more call writing emerge now. So 24,100 call writers are fairly active, 24,150 call writers are active as well. And alongside that, we have the 24,000 put writers equally active. So that's telling you that maybe the bulls believe that they can hold on to that 24,000 mark, even though the market's off highs. But on the way up, bears believe 24,150 and 24,200 is their territory. The macro impact is something that's weakening the market right now. Brent has swiftly moved above $110 per barrel. And we have the rupee as well, which is inching to a record low once again. 94.5 thereabouts is where we are on the rupee versus the dollar. The Nifty has been on a broader range, consolidating between both the 20 and the 50-day moving average. So that's a broad range that we're looking at on the Nifty. The Nifty Bank, which failed to cross and close above its 50-day moving average, is now looking at the next leg of support coming in around that 54,765 mark. Remember, these are broad ranges for both the Nifty as well as the Nifty Bank between the 20 and the 50-day moving average. But ahead of that, the expiry, you want to narrow it down. It's 23,950 to around 24,150 or 24,200 on the Nifty for expiry today.
Okay, take that point. Thank you so much for joining us with all those details, Mangalam. In fact, let's do one thing and talk about some specific stocks. Cohance Life Sciences, a big surge yesterday, a big surge today as well. Ekta, the leadership change is something that the street is really liking.
Yes, absolutely. Umang Vora, who's a veteran in the pharmaceutical space, has come on board to take on Cohance Life Sciences. So that is something that the street definitely likes. And remember, Umang Vora comes with the background of Dr. Reddy's as well as obviously Cipla. So the street is very positive and a possible turnaround there. But I'll just give you a sense in terms of Cohance. The background for Cohance, let's start with that. Advent acquired 50.1% stake in Suven in September 2023. That was at 495 rupees per share. They merged with Cohance Life, which is basically Advent's group of companies, which included RAChem, ZCL, Avra, and they rebranded the whole firm, which is basically these three companies as well as Suven, in May of 2025. So there were three verticals created: pharma, CDMO, specialty chemicals, and API+. Now, if you look at the stock performance, it's been weak. 52-week high was around 1,189 odd rupees, which it hit on April 29, 2025. 52-week low is 267.8 odd rupees. So there's been a fall of around 77% from the highs to the lows, though it's recovered from that 52-week low. It's down currently 50 to 57% from its 52-week high, counting yesterday's and today's move at current reckoning. Now, one of the reasons is that there's been a little bit of instability at the top if you look at Cohance. For example, their MD resigned in October of 2025, as well as in July 2025, we did see the CEO resign as well. So there's been a bit of a shake-up in the top. Now, in October, the company did announce a new structure with 3 business CEOs reporting to the executive chairman, Vivek Sharma. So that was the latest case before Umang Vora stepped in, or there was news of him stepping in. Now, weak numbers is the other reason why the stock has underperformed. 9 months FY26 revenue was down 7%. Margins crashed all the way to 20% versus 32%. Profit was down 54% to 169 crores. Their Nacharam facility received a US FDA warning letter as well. It already had an official action indicated status. FY26, they've said, is termed as a transition year. Guidance was revised to early to mid double-digit decline. So that's basically the guidance for FY26. and the timeline of $1 billion revenue by 2030 is likely to shift as well. The triggers, Umang Vohra joining, FY27 expected to be a growth year, China +1 and Europe +1 would be key opportunities, key starting material order from a Western CDMO by second half FY27, and the platform story is intact but delayed, and the execution will be something which the street will watch very closely.
Absolutely, Ekta. Thank you so much for that. But second day of gain coming in for the stock. But let's also bring on board Sachidanand, the taker of Trade Bulls, joining us now on the show to take us through the trading strategies. Hi, Sachidanand. Good afternoon. Now, today we're seeing a bit more of a pressure coming in, especially on the PSU bank side. So if you could look at the charts for Nifty Bank, PSU banks, what are we watching out for in terms of levels, expiry day as well? What should we watch out for?
Good afternoon, Vinny. Good afternoon to all the anchors here. If you look at the overall performance, I think Nifty is range bound today. We already saw it, oscillating within the range of 24,150 on the higher side, and on the lower side, 24,000 looks like a decent support. But if you look at the averages, the 200 5-day exponential moving average is placed at 23,960. So there's a good chance that we may see a decline towards the same. But on the higher side, we need a very strong, confident close above that 24,200 mark, where it's 50-day exponential moving average resistance is also placed. So I think for the day, we may see this oscillation, getting continued. Initially, we are of the opinion that there could be a rebound towards 24,150 at the end of the session. And hence, we continue to deploy long positions. One can keep a stop loss at 23,890 on closing basis and try to accumulate Nifty close to that 23,960 mark. On the higher side, we may see a respite towards 24,150 in the second half. When we look at the other pockets of strength, clearly Nifty Pharma is something which looks interesting, at least on the weekly and the monthly scale. After almost 8 months of consolidation, there are signs of steady breakout. On the weekly chart, at least if you look at the RSI, it has already displayed a clean breakout. So we are expecting the price action to follow. On the higher side, in the coming series itself, we are expecting that the Nifty Pharma could scale towards 24,900 plus zone. So the support at around 22,200 has been very strong. Until unless we don't see the Nifty Pharma, giving a close below that level on weekly basis, the possibility of a good surge remains open. So we are focused on Nifty Pharma. We are expecting a good run up in the coming weeks. We are expecting a level close to around 24,900 coming soon.
Okay, all right. Thank you so much for all those levels. But what about individual stocks, Sachidanand? Anything that you're liking? Is it a sell call or a buy call?
Good afternoon, Sonal. Clearly, the focus is on pharma, and going forward, we are expecting some outperformance here. Divi's Lab is one particular stock wherein we have already seen a breakout from a declining wedge formation. The pattern itself is, pointing a target towards 6850 kind of a zone. So we are expecting this particular move to unfold in a couple of weeks' time. Hence, we are recommending, building long positions here. From a trading perspective, one can keep a stop loss at 64.10 on closing basis and review positions close to around 6,600 for a target of around 6,850. The second stock on our radar has been Dr. Reddy's. Disclosure here that we have also recommended this stock to our clients. There's a clean breakout from a bullish flag formation, again a continuation pattern indicating a price target somewhere close to around 1450 going forward. From a trading momentum perspective, we may see an immediate move towards 1400. Keeping a stop loss at 1316, even long positions can be chased here. We are expecting this particular price target to unfold in the coming May series itself.
Okay, all right, Sachidanand, we're going to leave it on that note. Thanks very much for joining in and giving us all of those stocks in focus on the technical. Since you were talking about pharma, just want to point out Piramal Pharma is one stock is in focus because it is coming out with its numbers post-markets today. So that stock is down around 2.5% going into its numbers at this point in time, a bit weak, as you can see. We'll take a short break. On the other side, Manisha Gupta will join in. She has with her Peter McGuire of Trading.com.
Welcome back. Joining us on the show now is Peter McQuarrie. Peter, hi, thank you so much for joining in. And it continues to be bullishness in case of the crude oil prices, 111 at last count. How are you looking at the prices constantly moving up? Markets seem to be perhaps reading that the US and Iran peace talks perhaps could get stalled even further.
Well, good afternoon, Manisha. Yeah, 111.30 I think we hit during the day. And I tell you, that's 7 straight days of gains. It's pretty hard to be short at the moment, isn't it? I mean, you've got also WTI approaching that magic 100 number. And the overall theme is going to be, are we going to take out those all-time highs of 119 over the last, when it was earlier in the in this whole, 2-month situation? So I think one's got to be very mindful. We've got a lot of big decisions this week as far as central banks, and the geopolitics seems to be centre stage, Manisha.
Oh, absolutely. That was my next question, really, Peter, because Jeremy Powell's last meeting that he would be chairing as the Fed head, what are we anticipating on him to say about Strait of Hormuz and inflation and, of course, crude prices?
Well, I'll tell you what, we've got an inflation number that will drop this week, core PCE. You've got I think he's got to take a very, very even stance as far as the geopolitical. He's conscious as far as inflation numbers and the impact as far as higher energy prices. Everyone is, and all of Main Street is, as well as Wall Street. So the theme is going to be one of, I think, taking it forward, erring to the upside as far as possibly a rate hike if he was to stay in the role. But I don't think he wants to spoil the cake for Kevin Warsh. But again, it's got to be very tempered. I'm looking forward to his comments. And I noticed that Tokyo today, it was 6-3 as far as keeping policy the same. That was the BOJ, Manisha. So, that seems to be the current theme.
Peter, most of the banks and brokerages believe that if the status quo continues for the month of May as well and there's no resolution between US and Iran, then we are perhaps looking at 120, even 130 by the time it's May end. How are you looking at the month of May? What various scenarios were you working with, and what's your range for the crude prices?
Well, I think it's pretty hard not to go against those sort of numbers, because I think that seems to be the common course of events, what we've seen over the last 7-day trading, Manisha. So, yes, I would say that 120 is very achievable, and it could even be as high as 130. But the storyline is going to be very much gauged on what President Trump, how he plays this, and, of course, the Iranians, the counterpart. So if it does drag on another month and we're sitting here together in good health, then, and this situation's still on, then yes, I wouldn't be surprised you're closer to certainly 125 to 130 than where we are at the moment.
And how would you look at the dollar index in that scenario? Because that really seems to be behaving like a safe haven right now.
Yeah, you bet. 98.5, that sort of thing. I'm noticing bond yields 10 years around that 430, 435 sort of number. I would think that the US dollar would probably come under a little bit more, power and momentum to the upside. There isn't a lot of currency moves. If you're looking at euro, yen, pound, they're very, very, stable, and they're in a very tight channel. So I'm expecting US dollar to probably take a little bit further nudge up and may even take 100 out, Manisha.
And that really brings us to gold and silver now. So if we are looking at a dollar index rate around 100, would you say the further pressure in gold and silver, both of these commodities, which by the way are trading in the negative for the week and for the month as well, could see further declines?
Yeah, I mean, gold 46.42. I got 73.54 for silver. I reckon what's happened, there is no doubting this, that the smart money all moved to crude. They traded it. This is the traders, and the volatility was so immense. This is where it's been the flavour, and everyone has done so well on, trading either long or short. Looking at the fundamentals, the technicals over that last 2 months, the highlight hasn't been the bullion market or precious. Let's see how this next month rolls, Manisha. I'm expecting the second half to be a lot stronger than the first half, but, in the sense of the second half of the year. So we've just got to get through where this Iranian situation takes us, and I don't think it's a time to be in precious at the moment.
A final word on silver, really, because we've seen $120 an ounce, and we are trading at around, 73 right now? Where do you see prices go from here?
Well, it's 60%. I mean, it's got to move up a massive amount to get back to where it was. I think in the second half, over 100, but over the medium term to leading up till, the end of the first half, dependent upon what happens as far as Iran, It's going to be range-bound, Manisha. It's going to try and nudge up to 80. It might even nudge a little bit further, but I just don't think it's got momentum. There's not enough conviction, and I'm looking for conviction. And you need conviction if you're going to be long. And at the moment, there's other markets to be long.
Peter, always a pleasure hearing you. $125 to $130 per barrel on crude. Manisha, thank you so much for taking us through that conversation. That's about the commodity segment and those crude prices leading to higher prices for Oil India, ONGC. Oil India is also in focus because a consortium of Indian Oil and Oil India, they have some exploration operations in Libya, and they've made a new hydrocarbon discovery. So it's very important from a discovery viewpoint, considering the global disruptions that we're seeing in the energy space. So Oil India is the stock that should be on your radar. We'll slip into a short break. When we come back, we'll get you more on markets and stock-specific action. Stay tuned for that.
Welcome back. Well, for the markets, it's quite quiet at this point in time. So the Nifty is down around 67 odd points. We have the mid caps, which are holding up, and the Bank Nifty, which is still down over 550 odd points as we speak. But let's step back from the noise of quarterly earnings and ask a far bigger question. Is one of India's most defining economic engines, the IT services sector, at an inflection point? Rima joins in for more.
Well, the Indian IT industry is not just any industry. It employs nearly 6 million people. It contributes 7.5% to India's GDP. And it is an industry which is built on coding. And now AI can code for free. So the question is, what happens next? Stocks are feeling the heat. TCS is down 47% from its peak. Infosys 42%, Wipro down 45%. The FY27 guidance is pointing to the fourth consecutive year of a low single-digit growth. So today, we've got three panels, and we're asking the questions that matter. Is this AI tech cycle different? Can the Indian IT industry navigate this one like it has in the past? Nandan Nilekani talks about a $300 to $400 billion opportunity for the Indian IT industry by 2030. What does the Indian IT industry need to do to capture this AI opportunity? We've seen massive job losses in the US. Is India next? And then on valuations. Are they cheap or they're still too expensive for an industry growing slowly? Come join us as we debate today.
So much for that. It's an exciting lineup. It's an exciting lineup for you all. Three panels today, 4:30 p.m. onwards, so watch out for that. But on that note, we're actually going to slip into a very short break. After the break, we'll come back with the expectations from Eternal's earnings. What are we watching out for? Stay tuned in.
Welcome back. Still tuned into Halftime Report. A lot of nifty earnings that we're expecting today. The broader markets will also see a lot of important earnings, but Eternal is one of them. Reports numbers today. Mangalam is joining us to tell us what is the street penciling in. Mangalam.
Well, the stock is down about 35% from its peak, given today's fall as well. The street is expecting some sort of improvement in operating performance coming in for both their quick commerce and the food delivery business. The only thing that everyone's a little worried about is what happens in the very near term, with costs increasing or likely to increase. So revenue quarter on quarter, we're seeing a 5% uptick, 17,155 crores. EBITDA jumps by about 8.5%, and we are looking at net profit on a very low base, which jumps from over 100 crores to a little under 190 crores. Now, the reason why we're looking at these numbers quarter on quarter is because, remember, the company changed its inventory model in Blinkit, and as a result of which year-on-year numbers are not necessarily comparable. The key expectations, the internals, are something that we'll be watching out for with the shareholders letter that the company reports. And out there, food delivery NOE growth of 16 to 18% is what the street is positioned itself for, and Blinkit will be extremely strong, near doubling of revenues year-on-year as well. The contribution margins of Blinkit between 4 to 5% would mean that their break-even continues out there as well. But important to track, and what the street is fearing, the impact of food delivery due to the LPG crisis that took place in the fourth quarter, the bigger impact in the first quarter, competitive intensity in quick commerce, commentary around gig worker payout and the impact that could have on their contribution margins for quick commerce, and finally, any sort of potential impact on increase in cost of deliveries due to the imminent fuel price hikes, which are likely once the elections get over.
Okay, thank you so much for that, Mangalam. As of now, Eternal is down more than 3%, but with that, we're absolutely out of time on this edition of Halftime Report. Thank you so much for tuning in. Up next, to Business Lunch.
Stocks have slipped to the lows of the day. Oil prices surge above $110 a barrel as the US-Iran talks fail to make any meaningful headway. Metals and energy notch some gains while the financials are the big drags.
Coal India gains despite a muted Q4 as the heat wave-driven surge in power demand and a dip in coal output in Indonesia fuel investor interest. A healthy dividend yield also adds to its appeal.
The RBI has issued expected credit loss provisioning rules effective from the 1st of April 2027 that require banks to factor in future credit losses. The move, while aimed at making Indian banks more resilient, is expected to dent bottom lines in the near term.
Crude oil prices flare up on reports that Trump is unhappy with Iran's latest proposal. The continuing blockade of the Strait of Hormuz remains a concern for oil importing countries like India.
Good afternoon. You're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormuz Fatakia. With me, as always, Arundhati Raman. And Arundhati, good afternoon.
Good afternoon, Hormuz. You know, what started off in the green is now mostly in the red, right? So the Nifty banks underperformance pulling the Sensex and the Nifty lower.
It's a very important day as well. Today is the monthly expiry of the April series, and the bulls are fighting tooth and nail to hold on to that 24,000 mark on the downside. But factors going against it. The biggest factor is the underperformance of the banks. The Nifty bank is now down over 1%. It's down almost 600 points. The defense of that 56,000 level has now become distant, and the Nifty is now headed towards the next important level on the downside, which is 55,500. So a 650 point cut on the Nifty bank, and the Nifty fighting to hold that level of 24,000. What's keeping the index afloat was Reliance Industries. For a better part of the day, it was up almost 3.5% in yesterday's trading session, and that stock too is still trading around 0.8% higher, still contributing to some bit of, or capping some bit of the downside on the index. The other important factor, what's souring sentiments right now, is the surge in oil prices. Brent had closed just above or just below $109 a barrel last night, and today that has moved past 111. So another 3% surge on Brent. We are heading towards the 100 mark on the NYMEX as well. So banks underperforming, oil rising, not good for the markets. Very interesting to see what the second half of the monthly expiry brings.
Absolutely. And if you look at the sectoral performance, we've got those oil and gas names that are doing well. As Hormuz pointed out, Reliance up nearly 1%. We've got ONGC and Oil India, both of them up over 3% in trade. We've also got those metal names that are doing quite well. Tata Steel, Hindalco and Vedanta, all of them between 0.5% and 1% higher in trade. But on the flip side, we've got those PSU banks that are losing. It's underperforming. The index is down 1.8%. SBI, Canara Bank, Union Bank, all of them between 1% and 4% in the red. Private banks also not doing well. And autos are also losing in trade. Eicher Motors, TVS Motor, Bajaj Auto, all of them down over 1% in trade.
You just highlighted two important factors that were keeping the market sentiment sour. The third one is the currency, and that is also under pressure because of the rise in oil prices. But it's an across-the-board fall, of course, in the Asian currencies compared to the dollar. The Philippine peso also fell to a record low earlier this morning, 94.55 on the currency currently. Lata is here with more on this. Lata.
Yes, the rupee under pressure. It is at the lowest level in the month of April itself, and now the dollar costs well over 94.50. The reasons quite clearly is crude oil. Every time crude rises, India's balance of payments rises. You're buying more dollars for the same amount of crude, and that is worsened by the fact that it is there is very little hope of an early reopening of the Strait of Hormuz. The small consolation is that all EM Asian currencies are impacted because Asia is at the mercy of the Strait of Hormuz, and countries like Philippine peso or the Thai baht are hurt even more because the impact for them is more serious than for India. The rupee is at the lowest point since RBI announced those caps on banks' speculative FX positions. If you remember, that was announced on March 28. So we have hit the lowest. That set of steps ran their course, and the dollar became as cheap as 92, 90 and 93 rupees. But now that has run its course, and now we are beginning to see more pressure build up. One safety valve which the Reserve Bank opened is helping. The oil companies have been directed to buy oil only from one or two specific PSU banks so that there isn't an exaggerated demand. Normally, when you're buying dollars, you would put bids with many banks, and that gives an exaggerated sense of dollar buying. That is kind of quelled by the way in which the banks are being directed to RBI-directed banks. The pressure today is also because, if you remember, on Friday, there was a massive FII selling of equities, 8,828 crores, which is almost $1 billion. That gets settled, and today is the day they buy dollars and remit. So that dollar buying pressure is also coming on the market. The attitude of dealers is that Reserve Bank is still keeping plentiful liquidity, rupee liquidity, and trying to keep yields lower to help growth, which is otherwise impacted. Now, as long as you have that soft liquidity, pro-growth stance, you are allowing rupee by implication to take the hit. So mentally, people will short the rupee. And of course, oil is another good reason. So the expectation is that we have not yet seen the worst.
So we've not yet seen the worst. Thank you, Lata, for taking us through those details. Now, crude prices have surged above $110 a barrel as the United States expresses skepticism over Iran's new peace proposal. Manisha Gupta is here with all of those details. Manisha?
Oh, yes, it continues to be a very, very strong day for the crude oil prices. The last couple of sessions have seen an increase of 5%, and that brings the crude oil prices gains to around 12% on a week basis, and it's made it 82% of gains for this year till time. We are looking at 111 or thereabouts holding for the Brent prices, 100 for the US crude oil prices also. While there is some skepticism that US has expressed on Iran proposals, Iran basically has put out three things via Islamabad, saying that US should lift its naval blockade. They should also revise the framework for the transit via Strait of Hormuz, and also assure against any future military action as well on Iran therein. In the meanwhile, the Strait of Hormuz just about has 5 to 7 ships passing through it on a day-to-day basis, vis-a-vis 130 to 140 ships that were passing through the strait before the West Asia conflict. And if this continues, the markets do believe that you could be looking at higher crude oil prices from here on. The worst case scenario is that if the status quo continues until the end of May as well, then $120, $125 a barrel perhaps is not ruled out.
Manisha, thank you for that update there. Back towards that $112 a barrel for Brent and 100 for WTI as well. Now, the RBI has introduced a new three-stage asset classification and provisioning framework led by the forward-looking expected credit loss model. Ritu is here to give you more details on that. Ritu.
Well, the Reserve Bank of India has issued final guidelines on expected credit loss provisioning, which is going to overhaul how banks recognize and provide for any stress. Now, while banks had pushed for the implementation deadline to be deferred, RBI has said nothing doing. These are going to kick in from the 1st of April 2027. Now, the final rules are broadly in line with the draft version, so there are no negative surprises per se. Under the new framework, banks are going to be required to classify loans into stages based on the risk that they see. So, stage 1 assets will carry provisions based on the 12-month expected losses, and stage 2 and 3 will require lifetime provisioning. For stage 3, which is essentially NPA, provisions are going to rise with time, and they can go up to as high as 100% for the unsecured exposures. Now, RBI has also set the minimum provisioning floor. So stage 1 is at 25 to 40 basis points, higher at 1% for unsecured retail, and stage 2 provisioning is pegged at 5% across most categories, with lower levels of 1.5% for housing and gold loans. Now, remember, currently banks provide only about 40 basis points for these kind of exposures, so it's a big jump to 5%. But there is a transition relief. The transitional adjustment amount can be phased into CET1 over FY28 to 31, so that provides banks a long runway to absorb any hit. Now, as far as the impact is concerned, public sector banks are going to be the most impacted, while large private banks that hold excess buffers will be better off. Macquarie estimates a one-time net worth impact of 5 to 10%, with credit costs rising by 20 to 25 basis points for PSBs. Nomura says higher upfront provisioning will be needed in unsecured retail, MSME, corporate loans, etc., with PSBs facing a 55 to 130 basis point drag on CET1 and up to 9% erosion in their net worth. Now, at a bank level, the impact varies. Names like Central Bank, Punjab National Bank, among PSUs, IndusInd Bank, among private names, will see a higher impact, while large private banks like ICICI, HDFC and Axis will be more or less insulated with adequate buffers.
All right, Ritu, many thanks for those details. Now, the spotlight is on one of the top Nifty gainers today, which is Coal India. Results not so exciting, but there are a lot of catalysts ahead. Nigel D'Souza is here with all of those details. Nigel?
Well, that's right. Coal India reported its numbers, and the numbers actually were regrouped. The company added the cess to the revenue, and they've done some kind of adjustment in their other expenditure as well. But in terms of the numbers, there's nothing really to write home about in terms of the past quarter's numbers, both on the volumes as well as on the realization parameter. The problem for Coal India, remember, has been that thermal power generation itself has been weak, and coal inventories in India have been relatively high. Remember, the share of captive coal, as a percentage of the total mix, that's moved up to around 21% from just around 9% around 6 years or so ago. But the street is excited on the path ahead. So let's highlight 5 key reasons why the street is excited. First, on dispatches, the street expected to improve in FY27 because power demand is expected to remain strong, and also there's a reduction in Indonesia's policy with regard to their coal production. Now, the volumes actually should pick up. And the reason is we have had a very, very subdued past year. In fact, if you look at it between 2021 and 2024, the average growth that you saw in volumes was around 10%. Then FY25, it was a subdued year, only 1% growth. But the past year, there was actually a degrowth. So now on a low base, the street believes that they will show some kind of growth. Then there's a good chance that e-auction prices actually perk up a little bit because Indonesia will be producing less. To give you a number, in 2026, they have laid out a roadmap, but they produce only around 600 million tons, which is sharply lower from around 790 million tons that they produced in the previous calendar year. Also, imported coal has got more expensive because the rupee has weakened, and also you have global prices that have perked up. Point number 4, they have been a dividend machine. For the past quarter, they declared more than 5 rupees of dividend, and also for the year, it was close to 26 rupees and 50 paise. And finally, various brokerages, case in point being Jefferies, they are positive on the earnings trajectory. They're expecting them to grow, the earnings to grow by around 5% CAGR over the next 2 fiscals. They also say the stock is attractive. It trades at around 9 times on a PE basis and also offers 6% dividend yield. So put all that together, Coal India, past quarter's numbers not so exciting, but the street is optimistic on the prospects ahead.
Nigel, thank you for that update there. 3% higher on the stock now for Coal India. Continues to remain among the top gainers on the index in otherwise choppy market. Now, take a short break. Just as we do that, here's a quick programming reminder. We step back from the noise of quarterly results and ask a far bigger question. Is one of India's most defining economic engines, the IT services sector, at an inflection point? Catch sector experts on our special market forum, The Tech Trade, starting 4:30 p.m. today. Stay tuned. We'll be right back.
Welcome back. You're still with us on Business Lunch. On to updates from West Asia as we speak. A U.S. official says President Donald Trump is unhappy with an Iranian proposal because it did not address Iran's nuclear program. This comes after Trump discussed the proposal with his top national security aides. Meanwhile, Iran's Foreign Minister Abbas Araghchi has met Russian President Vladimir Putin in St. Petersburg and says Tehran is considering a U.S. request to restart talks. Meanwhile, dozens of countries gathered at the United Nations have warned that instability in the Strait of Hormuz is continuing to disrupt global trade and energy supplies. UN Secretary General Antonio Guterres has appealed for freedom of navigation in the critical waterway, saying a prolonged disruption risks could trigger a global food emergency.
And while the Strait of Hormuz remains effectively closed amidst the tensions, the U.S. Secretary of State Marco Rubio told Fox News that Iran was trying to use the strait as an economic nuclear weapon against the world. Listen in.
Suffice it to say that the nuclear question is the reason why we're in this in the first place. Look what they've done with the Straits. Great example. The Straits is basically the equivalent of an economic nuclear weapon that they're trying to use against the world. And they're bragging about it. They're putting up billboards in Tehran bragging about how they can hold 25% or 20% of the world's energy hostage. Imagine if those same people had access to a nuclear weapon. They would hold the whole region hostage.
Meanwhile, the U.S. Federal Reserve's two-day meeting begins later today. The central bank is widely expected to keep the interest rates on hold. The meeting could be the last presided over by Fed Chair Jerome Powell, whose term ends in May. CNBC's Steve Leisman joins us now with the CNBC Fed survey that gauges the sentiment around Fed Chair nominee Kevin Warsh and his ties to the White House. Take a look.
Kevin Warsh could take the helm of the Federal Reserve on schedule in mid-May, assuming a Senate Banking Committee vote on Wednesday and a quick floor vote by the full Senate. His confirmation would open a very different era for the Fed with major questions on the policy outlook. Respondents to the CNBC Fed survey are divided over how independent Warsh will be from the administration. 50% say he will conduct policy mostly or very independently, and 46% say only somewhat or not at all. Those are high levels of concern over the issue, but it is 13 points better than the prior survey, so Warsh may have made a few converts at his nomination hearing last week. 58% say Warsh will be dovish when it comes to rates, up 14 points from March, and 65% say he's going to be hawkish on the balance sheet, up 9 points. While Warsh has made reducing the balance sheet a major agenda item, there's skepticism he can actually do it. 42% say he'll bring it down in his first year, but 46% say it will remain the same. Among those who see a decline, the average amount is $800 billion compared to the $6.7 trillion size of the balance sheet. When it comes to the issue of how the Fed should think about AI-led productivity and monetary policy, Warsh has strong disagreements with survey respondents, something that might be true among his colleagues on the FOMC as well. 81% say the Fed should wait until productivity is in the data before incorporating it into current policy. Just 19% agree with Warsh that the Fed should put it into policy now. There's also concern about the balance sheet reduction. A 46% plurality think it could increase interest rates, with substantial division about whether it's good for economic growth or bringing down inflation.
Steve Leisman, thank you for that update there. Now, Ray Dalio, the founder of Bridgewater Associates, has given his take on the rate cut debate in the U.S., and he believes that a rate cut at this point in time would be a mistake. Listen in.
Issues of the issues that are here in terms of a more immediate inflation, farther from the target in terms of inflation target, and also the credibility that everybody's going to look at how he behaves in terms of monetary policy. So if you were to take and ask that question to almost anybody who's objective, they would say, certainly you would not cut interest rates now. Okay? You will lose your credibility. The Federal Reserve would lose its credibility, particularly now. We're in a stagflationary period.
You think we are?
We are certainly in a stagflationary period.
On that note, it is time for us to head into another short break. But more news and updates continue on the other side. Stay tuned.
Welcome back. Now, Google has broken ground on a massive $15 billion AI data center hub in Visakhapatnam. The ceremony was attended by dignitaries including Andhra Pradesh Chief Minister Chandrababu Naidu and IT Minister Ashwini Vaishnav. Shivani is here with more details on this.
We are coming to you from Visakhapatnam's Tarluvada, where N. Chandrababu Naidu today laid the foundation stone for Google's proposed $15 billion AI data center, one of the largest such projects planned in India. The facility, designed with a 1 gigawatt capacity, which signals the scale at which global tech companies are now looking at India for data and AI infrastructure. The project will come up across nearly 600 acres in Visakhapatnam region, the area that you can see behind me. Now, this also ties into Andhra Pradesh's ambitious plans of building Visakhapatnam and Andhra Pradesh in totality as an AI hub with a stated target of around 6.5 gigawatts. As the states attracts large-scale digital infrastructure investments. Now, for Google, this strengthens its cloud and AI footprint in India. For the state, the focus will be on execution timelines, power availability, and actual job creation on the ground, areas that typically determine how quickly such mega projects translate into economic gains. But for now, today's groundbreaking marks a significant step in India's ambitions to become a global hub for data center and AI infrastructure. Back to you.
And moving on, a high-profile legal battle between Elon Musk and OpenAI has begun. Musk has filed a lawsuit against the organization and its CEO, Sam Altman, alleging they strayed from and misrepresented the company's original non-for-profit mission. CNBC's Kate Rooney joins us now with the latest.
Well, the big headline is that the jury has finally been selected in that Elon Musk versus Sam Altman trial. We had a handful of potential jurors today saying that they had negative views of Elon Musk and of AI overall. The judge did acknowledge that about Musk, that the reality, this is a direct quote, is people don't like him, but she did also express faith that the jurors in this case could actually put aside that and then respect the judicial process. So it is moving forward tomorrow. Altman was inside at least this morning, and the backdrop here, Musk is suing OpenAI, its CEO Sam Altman, as well as President Greg Brockman, and Microsoft is a co-defendant as well. Musk was a co-founder of OpenAI. He alleges that he was deceived into funding the company under the guise of a nonprofit, mission-driven startup at the time and nonprofit. The two claims in this case, the first one in focus is breach of a charitable trust. So Musk's team saying that the promise at the time was to keep OpenAI an open source nonprofit and then prevent any sort of big tech company from monopolizing that technology. Google was the big one at the time. And then that move towards a for-profit structure and deal with Microsoft compromised that promise. In a tweet this morning, Musk saying that Altman and Brockman, quote, stole a charity, full stop. The second claim at hand here, unjust enrichment. So Musk claims that Altman and Brockman used Musk's funding and connections to build what is now an $800 billion company and then personally profit from that. Musk is looking for up to $134 billion in damages, and the removal of Altman and Brockman from their leadership positions, as well as changes in the recent restructuring that happened for OpenAI in the fall. Opening arguments kick off tomorrow. We will also start getting a high-profile list of witnesses. That will be next after opening arguments includes Elon Musk himself, Sam Altman, Greg Brockman, and then Microsoft CEO Satya Nadella is also on that list, Mel.
A big high-profile trial begins today. We take a leave on this edition of Business Lunch from Arundhati and me. Thank you for watching. Midcap Radar on the other side as numbers start to trickle in at the bottom of your screens.
Good afternoon. Welcome to Midcap Radar. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, Vivek Iyer. It is the expiry day today. And that's why we could see a lot of volatility in the last 1 hour of trade. For now, Nifty is at the 24,000 mark. Off the day's high, continues to be very volatile, led by a lot of action in the bank Nifty. But the broader markets are quite steady.
Right. Good afternoon, Sonal. And like you mentioned, weakness persists as far as the Nifty Bank is concerned, given the fact that when you're looking at the new norms that's coming as far as ECL is concerned from RBI, that's something that's taken quite a bit of the sheen off the rally that the PSU banks have seen. But a lot lined up on the show, so let's start off with the top headlines. Stocks slipped to the day's low as Nifty trades around the 24,000 levels. Market, metals and energy knocked some gains, financials, auto and IT drag.
RBI introduces a new asset classification and provisioning framework led by the forward-looking expected credit loss model. Former SBI Chairman Dinesh Khara tells CNBC TV 18 that new norms could entail a 50,000 to 60,000 crore hit on banking sector profits. PSU banks bleed.
Divergent moves on a couple of asset management companies. Nippon Life delivers a strong set of Q4 results, while mark-to-market losses dent profitability for Canara Robeco AMC.
Management of AU Small Finance Bank tells CNBC TV 18 that the lender will now leverage AI to help reduce OPEX. City Union Bank and Piramal Finance both gain on the back of strong March quarter results.
Tata Chemicals subsidiary Rallis India delivers a steady show in a seasonally weak quarter. The company reports its highest ever EBITDA in FY26. Losses narrow, supported by cost-saving measures.
Okay, these are the top headlines that we are tracking. A lot of action in the broader markets. We are awaiting a lot of earnings as well. Maruti Suzuki and Eternal from the Nifty pack. But this is the mid-cap special show, and we do have a lot of moving parts in the broader markets. So let's go across to our colleague Upasana for our special segment, Mid-Cap Movers. Upasana.
Well, first up, let me start with the top gainers today. AGI Greenpack reported a steady revenue growth in its Q4, but the company's net profit has jumped significantly. So we can clearly see the stock giving double-digit up move that is as high as 14%. Next up is Plasti Blends India, one of the key volume buzzers today. Today's volume stand as high as 8.8 lakh versus the average of 7,000. EPAC Durable is the next one on our radar. It continues its double-digit up move even for the second straight trading day. If we look at this week's up move, it's as high as 26% this week, and the month it's up 47% this month. Next up is Crompton. It continues its rally with a 4% uptick, and overall in this month has seen an up move of as high as 21%. And lastly, coming to Afcon's Infra has seen an uptick of more than 5% today. Now let us look at some of the defense stocks. We are seeing some sort of green out there. Data Patterns up about 2%. Idea Forge up as high as 4%. And Garden Reach Shipbuilders is seeing a up move of 1% ahead of its Q4 earnings schedule today. Overall, the street is estimating a good execution pickup. And mind you, Q4 is a seasonally strong quarter for these kind of companies. Next up, let us look at some of the stocks that have hit 52-week high. Kirloskar Oil, KRN Heat Exchangers, and lastly, CleanMax Enviro Energy Solution. All these counters have hit their 52-week high today. And on the flip side, now let us look at some of the important losers in today's trading session. Lumax India is 7% off its high. Rosari Biotech down 8% this week. And Bluestone Jewelry seeing a hit of as high as 5% today. And lastly, coming to Dynamatic Technologies down nearly about 5%.
Well, thank you so much, Upasana, for joining in and giving us a list of all of the stocks that are buzzing around as far as the broader end of the markets are concerned. But it's a good time to welcome Jay Thakur, Head Derivative and Quant Research from ICICI Securities, for a quick technical check on the market. Good afternoon, Jay. Thank you so much for joining us. Well, Nifty is now cooled off a little bit from the 24,000 mark. Where exactly do you see markets headed from here on? It's time for a pause, you think?
I think it's time for a pause, and I think that until 24,200 levels are not taken off, Nifty might just consolidate within this band of 24,100 on the upside, where we have the highest call base as of today for the monthly expiry. I mean, more than 4 crore shares now. So it looks really less likely that Nifty recovers from these levels. And even if it recovers, then it will not be able to surpass the levels of 24,100 in today's trading session. That looks quite likely. And keeping that in mind, I think, Vivek, now Nifty would below 24,000 levels might inch towards the levels of 23,700 to 23,500 in the near term. So I think that's going to be the 600 points range. And since you are just reversing from the upper end of the range, Nifty is likely to inch towards 23,700 to 500 levels. And in that, in most of the stocks which have already seen good amount of short covering, we now might see some profit booking from these levels. In fact, the sectors which were quite resilient during the fall during the wartime, and power, metals, pharma. I mean, these are the sectors again which are likely to outperform in this consolidation phase. Hence, I believe stocks like Dr. Reddy, which is trading around the levels of 1350. Can be bought at these levels, keep placing a stop loss below 1250 and targeting around 1500 to 1550 in the May series. Likewise, Glenmark also looks quite promising. It has provided a very good breakout, and we have seen a good long build up there as well, along with Dr. Reddy. So Glenmark can be bought around these levels of 2410. It can be added if at all there is a dip towards the levels of 2350. One can place a stop loss below 2250 and target 2700 in the May series. So pharma looks relatively better.
Okay, pharma looks relatively better, and some of those stocks which will be your pick as well. Jay, thank you so much for joining us as always and taking us through some of these technical levels that you're watching out for. With that, we'll do one thing. We'll slip into a short break. When we come back, we'll get you a slew of buzzing stocks on the other side of this break. Stay tuned. Welcome back. You're still tuned into Mid-Cap Radar. A lot of stocks in the broader markets which are higher. Oil India because of higher crude oil prices. But apart from that, there is a news piece as well. Both Indian Oil and Oil India, they have made a hydrocarbon discovery in Libya. And this is happening at a time when we are seeing global energy shocks, crude oil prices going higher. And when India is so dependent on imports as far as gas and oil are concerned, both public sector companies, they hold around 25% participating stake in this consortium. This is the operations in the area 95-96 block. It is a basin in southwestern Libya, and there's already some production that has happened here, both for gas and some of the other hydrocarbons as well. They've achieved production of 13 million cubic feet of gas, 327 barrels of condensate per day as well. It's important, considering the global scenario and the energy market that we are in, that there's some production happening for Indian companies, and they're part of this consortium. So that is a good news, and of course we'll watch out for the progress here. But for now, Oil India, on the back of higher crude prices, higher realizations, and this news continues to be on our radar.
Well, thank you so much, and clearly positive news flow coming in as far as the Indian oil PSUs are concerned. Moving on to the NBFC space, one particular stock that's doing and outperforming very well in the session today is Shriram Finance. Ananya joins in with more details on how exactly Q4 panned out for the company.
Shriram Finance stock is surging today and backed by all the right triggers. They delivered an excellent Q4. Their AUM crossed 1 lakh crore milestone, growing 25% YOY, while the core book grew 33% YOY. Retail now contributes 85% of the total AUM, confirming the successful shift to retail-led NBFC. Now, profitability was also impressive. PAT jumping 390% YOY. Net interest margin improved to 6.5%. Asset quality remained healthy, with GNPA improving to 2.3% and retail delinquency staying low at 0.6%. And the management guidance was very strong for FY27. They are targeting 25% growth in AUM, 50% profit growth. Now, the management said that the legacy book is now below 3% of the total AUM and will become largely irrelevant going forward in FY27, which is also one of the positive triggers for the company. Now, a major positive was a AA+ rating upgrade, which can lower borrowing costs by 50 to 80 bips going forward, and also improve funding access and potentially lift steady state ROE by 3 to 4 percentage points. Now, they also plan aggressive expansion in new growth engines, especially gold loans, where branches are expected to grow from 22 currently to 200, around 200 going forward in FY27. So overall, we can see this was a fantastic quarter for Shriram Finance.
Okay, all right. Thank you so much, Ananya, for joining us with all those details. Let's talk about the pharma space again. Zydus and Lupin, both of them are in focus. MSN has become the third Indian firm to settle with Astellas Pharma. Actually, let's go across to Ekta to understand what does this really mean for Lupin and Zydus. So what's the connection here? Lupin, Ekta, sorry.
Well, yes, MSN has settled with Astellas for the drug Mirabegron. Now, what the news is that is basically that, MSN would be paying $75 million to Astellas, indicating its generic launch would be soon. Now, this is a similar settlement that Astellas, which is basically the innovator of this drug, which is used for overactive bladders, is, something that they had done with Lupin and Zydus in the past. Now, I'll just give you a background. In fact, Zydus and Lupin had launched Mirabegron at risk in the US in 2024. That means that the patent was still on. They got approval, they launched it in the US, and hence it went into litigation. Zydus and Lupin then eventually settled with Astellas in Feb 2026. And now the companies are paying they paid a license fee to Astellas, which was $120 million for Zydus and $90 million for Lupin, to sell the drug till September of 2027. So this settlement that MSN has done with Astellas is very similar to the settlement which has already taken place with Zydus as well as for Lupin. Now, the MSN settlement may also open up opportunities for other generics also. So what this means is that there could be more competition which could be coming in for this particular drug. If in case MSN's launch takes place immediately, then Zydus and Lupin's FY27 estimates on this particular drug could then be hit. For Lupin, for example, Mirabegron is around 5 to 6% and 9 to 10% of revenue, as well as EBITDA estimates for FY27. For Zydus, it's 4 to 5% of revenue and 7 to 8% of EBITDA estimates for FY27. Additionally, Lupin's drug Tolvaptan also may see competition going into FY27 because an Alchem generic might come into the market. So there could be additional competition and pressure which could be coming in for Lupin as well as for Zydus, for these two drugs, and for Lupin an additional drug as well.
Thank you, Ekta, for that. I think pharma and Ekta are synonymous for us at CNBC TV 18 and the industry as well, and that's why maybe the slip up. But thank you so much for joining us with all those details. With that, we'll do one thing. We'll slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned for that.
Welcome back to Midcap Radar. Well, Indian Airlines are sounding an SOS over rising fuel costs. The Federation of Indian Airlines has warned that the situation is becoming unsustainable. Madiha Mujawar joins us with more details.
Right. The Federation of Indian Airlines, which includes Air India, Indigo and SpiceJet, is seeking urgent government support on ATF pricing. In fact, they're saying the industry is under extreme stress and even warning of a shutdown risk if things don't improve. Now, this warning comes just days before 1st May when OMCs are set to revise the monthly ATF pricing. Airlines say ad hoc ATF pricing is creating a huge imbalance between domestic and international operations, making airline networks unviable and unsustainable. And the biggest hit is on international routes, is what airlines are saying. There's been a 73 rupees per litre spike in ATF for international flights in the April pricing revision, which is leading to significant losses for carriers, is what they're claiming. Earlier, ATF made up to 30 to 40% of operating expenses. Now that has jumped to 55 to 60% according to airlines. But here's the key point airlines are making, and this is important. They're flagging something called crack spreads, which is essentially the refining margin that oil companies earn when they convert crude into jet fuel. Now, normally this margin is around $11 to $18 per barrel, but now airlines say it has spiked to over $130 per barrel. So in simple terms, even if crude oil prices are not rising as sharply, jet fuel prices are still staying very high because refiners are charging much more. Now, Brent crude went from $72 to $118 per barrel, a 64% increase, but ATF went up from $87 to $260 per barrel, now at which is now at $235 per barrel. That's a roughly 295% increase. To deal with this, FIA is asking the government to reinstate the crack band mechanism that existed earlier to keep crack spread between $12 to $22 per barrel. Then airlines are asking the government to temporarily suspend the 11% excise duty on ATF to provide some immediate relief. They are warning that if this kind of pricing continues, it could lead to unsurmountable losses for airlines, forcing them to ground aircraft and cancel flights. So clearly the industry is signaling that without intervention, this could turn into a much bigger disruption for Indian aviation.
It's a fix, absolutely. Thank you so much, Madhya, for joining us. And even if refining margins are capped or the cracks are capped, that would not be good news for oil marketing companies because they're already making losses on petrol and diesel sales. So let's see which way things go. Definitely, it's an issue both for the airline companies and the oil marketing companies as well. That's about some of the sectors that we're focusing on. Let's talk about stock now. AGI Greenpack, the stock is surging in trade. Ria is joining us now with the results analysis. Ria.
Well, yes, AGI Greenpack has shot up in trade today after reporting its Q4 results. Now, for Q4 and for the full year FY26 as well, they've seen steady revenue growth of 5%. On the net profit level for Q4, the net profit has gone up by 19% on a year-on-year basis and 62% sequentially as well. And even for the full year of FY26, the net profit has gone up by around 9% compared to the previous year. If you look at the EBITDA for Q4, the EBITDA has remained stable on an absolute basis. But if you look at the margins have contracted by around 120 basis points in this quarter, and even the full year margins are down by nearly 200 basis points. And remember that Q4 typically does have weaker margins for this company. Apart from this, interest costs have fallen by around 56% on a year-on-year basis, so that has somewhat supported the profitability for the company. Apart from this, they have also released some updates about their capex plans. This strategic entry into the aluminum beverage cans market remains on schedule for the company, with the annual capacity of 1.6 billion cans currently in the final stages of equipment procurement. And even their greenfield glass container plant in Madhya Pradesh is on track for commissioning in March of 2027, and this is expected to add around 25% to the current glass container capacity for the company.
Well, thank you so much, Ria, for joining us and giving us all of the details as to how exactly the results, Q4 results of AGI Greenpack panned out. Well, moving on, AMC stocks too are uppers in trade today on the back of their Q4 results. Differing fortunes though. Nippon Life AMC and Canada Robeco see divergent moves, with Nippon Life seeing an uptick while Canada Robeco falls. We have Devyani now joining in with more details.
A strong set coming in from Nippon AMC with a beat across the board. Nippon AMC is now one of the only market share gainers in Q4 of FY26. In fact, it was the fastest growing AMC out of the top 10 AMCs by AUM in FY26 all throughout. ETFs are now leading the charge, with 21% market share coming for Nippon all throughout, and about 33% of their overall AUM coming from ETFs alone. On the numbers front, quarterly average AUM was up well over 3%, and that is well above the industry average of less than 1% that the industry clocked this particular quarter. Revenue was up 5%, operating profit was up 8% on a quarter-on-quarter perspective, with margin expansion of roughly around 200 basis points, beating estimates across the board. And in fact, profit also beat estimates across the board in spite of the fact that it fell 5% on a quarter-on-quarter perspective. Now, this 5% fall was almost entirely as a result of the mark-to-market swing. Other income swung from positive 75 crores to a negative 33 crores this quarter sequentially. Strip that out and the core business performance was rock solid. Systematic flows have also held steady at roughly around the 10,000 crore mark on a quarter-on-quarter perspective. On the big regulatory question, SEBI's total expense ratio changes, management says that an impact of roughly around 3 to 4 basis points is expected, but that will largely be passed on to distributors, so the profit and loss impact is likely to be limited. Coming to Canara Robeco AMC, it's been a mixed quarter for the company. Operationally decent with revenue up 4% on a quarter-on-quarter perspective. Operating profit did jump roughly around 16%, but keep in mind that was largely as a result of a drop in employee expenses on a quarter-on-quarter perspective. As is consistent across the industry this time, mark-to-market losses have dragged profitability down for Canara Bank AMC as well. So all in all, a strong quarter coming in from Nippon AMC, but a mixed quarter coming in from Canara Robeco AMC.
Well, that's right, Devyani. Thank you so much for joining us, clearly and neatly explaining as to why both of these names actually are enjoying divergent fortunes in the session today. Nippon, as you can see, high up almost 4%, Canara down 4% in the session. Well, a couple of stocks, pharma names under a bit of pressure, like Ekta pointed out, significant competition likely in Mira background. So both Lupin as well as Zydus Life, both of these names have seen quite a bit of selling pressure emerge, and Nuvama at that particular stock at the day's highest point. But with that, it's all the time we have on this edition of Midcap Radar. MF Corner when we return.
Hello and welcome to MF Corner. I'm Sonal Bhutra. With me as always, Vinny Motiwala. And on the show, we try to decode different aspects of mutual fund investing, different categories, and few of the methods you can use while your mutual fund investments as well. And we're going to decode one of them today. And Vinny is going to give us a lowdown before we go across to our guests. Vinny, tell us more.
First up, we're going to talk on the IDCW. IDCW is what? It is actually an income distribution cum capital withdrawal that we are talking about. Now, what is this? Actually, this is just an option that you have, right? When you're picking up your mutual funds, if you select, there would be growth and IDCW. So what does that mean? A lowdown in terms of IDCW is not a mutual fund category. It's just simply an option, like I mentioned. One in 2021. It was called, before that it was called dividend option. There was an option according to that. Then it was renamed, and then it came in at income distribution cum capital withdrawal. And because of this, there was more clarity that came in that what does IDCW do? That when they pay out these dividends, that's exactly by the amount the dividend will be paid out, your NAV of the fund also will come out by that amount as well. So investors normally worry, what is this happening? You're getting extra bonus. No, it's not that. Your own money is coming back to you. Your NAV will get adjusted with that amount as well. Now, what's the taxation of this? Every IDCW payout is taxed at your income slab tax rate, right? So if you are in a growth fund, long-term capital gains, then you're taxed at that 12.5%. In IDCW, you will be taxed at your slab rate. So if you're on the higher end of the slab rate on 30%, then you will get taxed at that. Now, who should actually pick IDCW funds or that option that comes in there? Who should avoid it? Does it beat growth fund option at any point of time? Is it better than that? What are these other withdrawal methods maybe you can look at, if not IDCW as well? To discuss all of this, we are joined by Kshitij Mahajan, co-founder of Complete Circle Consultants, as well as Tarun Birani, founder and CEO at TBNG Capital Advisors, to talk to us about all of this. Gentlemen, good afternoon. Thank you so much for joining us on the show as always. Now, let's just start by that basic point, right? How should one decide in terms of IDCW and growth fund? When you have this option, why should you pick up IDCW or why should you pick up growth fund? The basic in terms of the highlights over there. Kshitij, let me start with you.
Well, good afternoon, Vinny. Thank you for having me on the show. So, it's a very interesting topic, and time and again we keep on talking which one is good. So it depends firstly on the income slab of an individual. Let's say any individual who is not having any income and he or she has a window of that 12 lakh, which is open, or less than 12 lakh, which is open, they can still opt for IDCW plan, because the tax, which is, as you mentioned in your starting statement, tax is as per the tax slab. So if you are not qualified as a tax giving person, then maybe you can look at IDCW. Second, if someone who is in need of funds, at the same time, they want to start this monthly income option, and there is no monthly commitment which they want. It's not a 100% commitment by a fund that they are going to keep on giving every month dividends. So let's say in this market, which is like the last 1.5 years, we have seen hardly much movement in the capital markets. In fact, markets have corrected. So it's not a surety product. If you are not depending on only this IDCW income for your monthly goals, then I think then you can still offer, again, clubbing it with the tax benefit. Now, someone who's looking at a growth option is the one who's actually looking at compounding machine for your investments. Because every time you keep on withdrawing from IDCW, it's your profit pool which is getting withdrawn. But when you do a growth option, and if you don't need the funds, it compounds much, much, much faster. Second, somebody who's at a high tax slab, this is totally a very unfriendly option, if you ask me, because whatever withdrawal you're taking from your from this dividend option, it's been taxed at a full tax. But at the same time, if you're in a growth option, if you need some funds, then it works like the capital appreciation part will be taxed on the basis of your 12.5 as long-term capital gain and 20% short-term capital gain, which is less than 1 year. So I think broader aspect is this, wherein I feel that these are the key things which one should take into account.
Okay, yes. So IDCW, it's slab rate at every distribution. So if you're in 10%, it'll be 10% of the dividend or the money that is paid out to you, and 30%, as Vinny pointed out earlier, if you are in that slab rate. Take that point, Kshitij. But if somebody is looking at IDCW funds, so let me come across to you, Tarun, on this one. When evaluating IDCW funds, what metrics should investors look at beyond the payout history? Are there other things that one should consider, not just the payout amount?
So, thank you for having me here. I think Kshitij broadly covered most of the points related to IDCW. I think what is more important for us is to understand the core principles of withdrawals. I feel these are not understood well, and due to which I have seen time and again the withdrawals have not been managed well, and a lot of behavioral mistakes which happens there. So let me try to come up with 6 core principles of withdrawals which everybody should be aware of while looking at withdrawing any point of time. First important point is that your portfolio is not an income machine. It is a wealth machine. One need to be very clear and understand this fact very clear, that if you have built a long-term equity portfolio, it should be managed to produce income. It should not be, it should be managed to manage real wealth. The moment you start optimizing for yield, you begin making decisions that destroy that principle over time. So that is one very important part. I strongly feel sustainable withdrawal rate is 4 to 5% of the portfolio, not of returns. That is also one very important fact investors should be aware of, that 4% of the portfolio can be managed as a withdrawal based on Indian growth rate in the equity markets and all that what we have observed. So that is also one principle. If investors follow, they will be better off. Again, never sell equities to fund withdrawal in a down market. That is also a mistake where I have seen investor and investor returns have been very bad, because time and again withdrawals have been timed very badly and no plan has been made for that, due to which people miss out. According to me, SWP is the only rational withdrawal mechanism for the equity investment. I strongly feel the reason for it is the investor stays in equity, control the redemption amount, only the gain portion is taxed. IDCW destroys compounding by distributing capital on the fund manager's schedule, not on the investor's schedule. That is one of the most important problem. And I feel IDCW is only relevant for a very small set of investor where the income level falls in 5% tax slab or a 0% tax slab, which I don't think exist anywhere currently. So I feel IDCW should not be discussed at all also, because this is actually not at all an option for in redemption.
But people are still giving it as an option, the mutual funds, Tarun. But anytime, any point of time, you know, they are idle investors, or who are these idle investors maybe who could even look at this option? And you're saying it's not an option that one should look at, so avoiding for most of them. But maybe if someone is looking at it, who should those investors be?
Yeah, so someone who is in a very low tax bracket, 5% tax bracket or 0% tax bracket, I think this is the only option available for them. Otherwise, I don't think for anyone else in the higher tax slab should actually look at it, because you have a SWP option where you can control it, time it, and manage it the way you want, right? Again, you are of the option that you find it very difficult to plan it. I think you just plan it once, let's say 4% of portfolio, 3% of the portfolio, and just shut it. I think something like that can be built up as a withdrawal option in the SWP. But IDCW is just not making sense, because the post-tax returns, according to one study, that almost in a 15-year on a 1 crore corpus, the gap between the growth and the IDCW can easily be 25 to 35% of the terminal value, which is not a preference, and according to me, this is a planning failure completely.
Planning failure, and also I think the tax changes that came by is something that changed the way one looks at dividend funds as well, right? Nobody saw it coming, dividends getting taxed in the hands of the shareholder, which was earlier exempt. So I think that has changed this category completely. Kshitij, coming on this, of course, Tarun has said this is not a category for anyone unless it's a nil tax bracket that you're in. But any category from which, if there is dividend payout happening, apart from the tax benefit, which one would that be? I think, Kshitij, you're on mute.
My bad. Many categories have, on the fixed income side also, where you have this option available. And many people, they don't have a risk appetite of equity. So for those type of, investors, I think, and where there is a benefit of that they don't have an income other than this income, then those type of investors are still looking at, IDCW plan. There are many funds also where there is a consistency of payout, although there is no guarantee of payout, but seems like there is a consistency of payout which is happening. So those type of funds are still attracting people on the IDCW platform. So I think it's not one against another, but yes, if you're a long-term investor, you are looking at compounding your wealth. There is no other way but to go for a growth option and then SWP option. So, we just did one comparison, somebody with 10 lakh rupees starting and starting withdrawing at after 5 years time and kept withdrawing till 25 years, of the entire investment journey. And that's an investment growing at 12% and withdrawal is 6%. The difference is almost 50 lakh rupees of the corpus at the end of the tenor. 1.7 crore for a growth option with the SWP and 1.2 crore for a IDCW option. Because tax is actually, and here we are taking 20% tax into account, not even 30% tax into account. So tax is a big, deterrent in this entire part. So I think those people, again, I'm reiterating, where you have a tax slab which is not hitting you, then you can look at this type of plan. But again, your dependency is not only on this withdrawal, because there's no guarantee of withdrawal happening every month, irrespective of whatever track you have seen in the past. There can be a market movement like what happened in COVID and global financial crisis. We all were the part of it. So there were no withdrawals. If then the withdrawals are coming from the scheme, although it has to come from a surplus, they can't give it from the scheme. You will have to take a bigger hit.
Taken there, gentlemen. But on that note, we're actually going to slip into a very short break. We'll continue with the conversation and discussion in terms of what other withdrawal options can you all have as well in mutual fund. So stay tuned in for that. Welcome back. You're still tuned into MF Corner. Still have with us Kshitij Mahajan, co-founder of Complete Circle Consultants, and Karun Birani, founder and CEO of TBNG Capital Advisors. Let me start with you, Tarun, this time. We are talking about maybe IDCW not being a way to go about your investments into mutual funds. But when somebody does need money, when to pick, say, SWP, you have STP as well. Explain it to us for our viewers and then tell us how does one go about picking any of these ways of investments or withdrawing money from mutual funds?
Correct. So I feel this is a great question because investors often confuse the three. They sound similar, but they solve completely different problems. Let me try to separate them very clearly. Systematic transfer plan or STP is for accumulation phase. You use it when you have a lump sum sitting in your account and you want to deploy it gradually into equity. You park the money into a liquid or a similar parking option and instruct the AMC to transfer a fixed amount every month into your equity fund. It earns you a debt fund returns and unemployed portion gives you a rupee cost averaging on the way in. STP is essentially a SIP funded from a lump sum. That's the main structure. Systematic withdrawal plan is for drawdown phase. You have a corpus, you need cash flow out. You instruct the AMC to redeem a fixed amount every month and credit it to your bank account. The corpus stays invested in the growth option. Only the gain portion of each withdrawal is taxed. And after 1 year, that gain is taxed at 12.5% LTCG. in the equity option. SWP, according to me, is one of the most disciplined way to convert a corpus into income, and it's, according to me, it's a behavior hack. Like how SIP has helped in ensuring every month savings are going and ensures that market volatility doesn't impact your contribution into the markets. In the same way, when you require money to come in, the contributions are behaviorally completely managed through a SWP option. So it's a great option. IDCW, according to me, is a payout options within the same scheme. If the fund house decides when, how much, and from where, you don't have any control. After 2020, every rupee is taxed at the slab rate. That's the large problem, and I think we discussed it in detail. The narrow use case is a low bracket investor who genuinely cannot or will not operate a SWP. So my simple framework is STP when you are building wealth into a from a lump sum, SWP when you are spending wealth in a controlled way, and IDCW only when neither is operational feasible or tax bracket is very low. For everyone else, SWP from the growth is the answer, according to me.
Okay. SWP is the way for growth in terms for the way one should go about. STP is when you're building wealth, spending wealth is SWP, and IDCW comes in only when you're at that lower tax bracket, then maybe it does make sense. Thanks for that. But on that note, let's pick up a query as well. We have KM Khanna from Visakhapatnam who's writing to us and wants a few recommendations for systematic withdrawal plans at 25,000 rupees per month. At around 12% per annum, wants to know the lump sum amount that is required to be invested as he is superannuating in August 2026. How should they go about this as well? Kshitij, your take.
Well, Vinny, let's say if he requires fund for next 28 to 30 years, so in that case, the corpus will be around 30 lakh if the corpus is growing at, let's say, 12%. So that assumption we have to take what type of funds he's investing into, and if you want withdrawals to sustain for that level, because every time, whenever you are withdrawing money, you are impacting your compounding also. And we always suggest 5 to 6% of the total, corpus one should look at on a higher side to withdraw. Let's say if the corpus has to last for 20 years, then he requires a little less money. It can be doable with 25. But if the returns are at 10%, not 12%, and he wants the corpus for 20 years, then he has to look at 32, 34 lakh rupees of current investment to be parked, for his SWP plan. But his portfolio, if is fixed income heavy, and the average return expectation is around 8%, and for 20 years sustainability, then he need to have 42 to 43 lakh of rupees, which he has to park in funds right now, so that he can enjoy the benefit of the entire wealth. Because depending on what rate you are generating revenue out of your entire corpus, your withdrawals impact in the same way, but your expenses remain same, so your longevity reduces. So I think ideal way to look at is just take 10-11% of expected return from your portfolio as a consideration, and take out 5% on a higher side from your portfolio, for the SWP plan. So that will help you to keep on enjoying the corpus and God willing, if you live long, very long also.
Okay, all right. So that's about a query coming in. But the next question is, for retirement, say for a retiree needing regular cash flow, how does an IDCW plan stack up against SWP from a growth option? I think Tarun will say it's the SWP option that wins mostly. But is there a different answer to this, or one has to go through SWP or other options when it comes to getting back money during your retirement?
Right. So I think my answer to this will be a general principle. If one want to look at withdrawals, an inflation-linked withdrawal, a 4% safe withdrawal model, according to me, if you have done an asset allocation into various assets, and let's say 60-70% bias towards equity, then a 4% safe withdrawal is a beautiful structure which I feel over a long period of time one can follow. Let me try to explain that. How does this work? So let's say somebody has income requirement of 1 lakh rupees per month to come in. From a 4% safe withdrawal model, you need a 3 crore corpus to be invested, let's say, into a mix of assets. And if you have a high risk profile, let's say a 50 to 70% equity oriented portfolio, based on the past experience and past history, let's say the return of the overall portfolio is around 10%. Okay. So now out of this 10%, if you start withdrawing 4%, 6% keep compounding for you. That is one of the beautiful way, according to me, to create long-term wealth, at the same time making sure you are withdrawing 4% of the portfolio. One problem in this assumption is when there is a great market fall, like from September 2024, we have seen Indian markets have generated flat to negative returns. In that period, I strongly feel one need to have a cushion of 2 to 3 years of expenses available into a fixed income or a fixed deposit or liquid kind of structure, where you can take up the money and you can stop the SWP at that point of time. So this ensures that behaviorally, in a bad market, you are not pulling out money from a portfolio which is going down, but at the same time, you are ensuring that your corpus, which is kept in the fixed income, is used for that. I feel if anybody, just because you have retired, it does not mean that you should stop building or compounding your wealth. Only thing is you need to have a very strong structure. And this 4% safe withdrawal model, according to me, is a very good structure if anybody can build with a 2 to 3 years of contingency of funds, which will take care of bad markets. This will ensure your long-term compounding of funds keep happening, and you don't have to rely then on these options like IDCW. Yeah.
Okay. Tarun, a quick one. Amit Jadhav has actually written from Mumbai, a small business owner, and practically wants working capital periodically. So in SWP, STP, it's not fixed income option, but SWP, STP, is there a way maybe he could go about it? A quick one.
You want me to take this?
Yes, Tarun.
Yeah. First, an important clarification, SWP, STP and IDCW are not really fixed income tools. They are cash flow tools. Okay, Amit need to understand that the amount you receive depends on the underlying fund and the market conditions. So for a business owners who need a predictable buffer, the structure has to be designed very carefully. I feel he need to take care of two pockets, a two-pocket arrangement. One is and both in the growth options of mutual fund, both fully redeemable on demand. Pocket one is a working capital reserve, which he need to ensure park 3 to 6 months of typical working capital needs or the requirement in a liquid fund or a overnight fund, basically in the growth options. When you need cash for the business, you redeem partially. That should sit in your liquid fund or ultra short-term fund, not in equity. That is one very important part. You don't want to take market risk on that, and it should give you a risk-free kind of return and available to you at that time. The pocket two is basically your long-term wealth, money you don't need for the next 2 or 3 years.
Okay.
That can sit in your diversified portfolio aligned with your risk profile.
Take that point. Take that point, Tarun. That was very helpful. Kshitij, thank you so much for your insights as well. With that, we'll do one thing. We'll take your leave on this edition of MF Corner today, but stay tuned for Closing Bell to take you through the last hour of trade.
beyond market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
The Hang Seng was slightly above the flat line yesterday. It's slightly below the flat line today.
Post-elections, question is, will we see fuel price increases?
We start to see inflation expectations going up.
The realization will improve 12% YOY.
0.25% lower on the Nifty.
India is quite vulnerable.
We have seen weak thermal power generation as well.
If you ask me as a CEO, it's a welcoming move.
And the market's not doing too bad either. 70 points higher on the Nifty.
Final guidelines are more or less, the same as what we saw in the draft.
Where we are seeing a sluggish trend come through on the markets.
Asian currencies are impacted because Asia is at the mercy of the Strait of Hormuz.
Some skepticism that US has expressed on Iran proposals.
We could see a lot of volatility in the last 1 hour of trade.
Okay, well, that is the day so far. Markets, of course, are down about 100 odd points. The Nifty intraday will come up on your screens. It is, I think, the unwind of some of the 200 plus point gain that we had yesterday on the index. What's happening, of course, with oil prices is not helping. From 107-ish kind of levels, we are now inching closer to about $111 odd. That is Brent, which should come up on your screens. I think that's the broad. It's actually plus 101, 111 plus. So in the last, 48 hours or so, we've moved up about $4.5, $5, which is not great at all. So slow creep higher, slow burn, whatever you want to call it. But that's the one which is, putting some amount of pressure. The dollar rupee, of course, is also making, a high for the day as we speak, which means that the rupee is making a low. That will give you a quick sense of what's happening as well. On your screen, 94.50, about 1/3% higher on the dollar rupee and 1/3% lower in that sense on the rupee as well. Well, this is Closing Bell. We are coming to you from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. Rima is with me and Nigel should be with us in just a bit. Rima, hi.
Hi, but the mid-cap index is still holding up in the green. Yesterday, it had rallied 1.5%. It's added on another 1/3 of a percentage point. It's come off sharply from the day's high, but still managing to hold up in the green. Today is also the Nifty monthly expiry. It's been a good April series for our markets. We've rallied about 8% on the index, but today some profit booking is visible. The street is also awaiting numbers from Maruti. Usually comes out around 2 to 30. So awaiting those numbers. Stock is got a little bit of a downside bias right now. And Eternal is selling off sharply, 3.5% down on Eternal ahead of the numbers. And it's taken Swiggy along with itself lower.
Well, that's right. Just a quick check. Dalmia Bharat, the numbers look actually a little bit better than what the street was working with. You're not seeing any big outsized reaction on some of these stocks because the fear is that cost will spike up from the first, second quarter onwards. So the stock has come off the lows of the day. The number we were working with was around 850 crores in terms of the absolute EBITDA number. It's come in at more than 900 crores, so the street likes it. The sales volume number, yes, it's up only around 3%, but that's something that the street was working with, 3 to around 4%. The reason being that one of their units in Odisha, it had a part shutdown for around 14 to 15 days in the month of March. So put everything together, these numbers look better than expected. It's a beat in comparison to what our poll threw up. The only problem is, what is the cost guidance from here on? We saw a stock like UltraTech Cement as well. Numbers look good. Balance sheet as well was in better shape, as well as their promising dividend payout. But the stock really hasn't reacted because there is some profit taking that's coming. And there is fear that, this cost spike will hurt. UltraTech has clarified, Q1, no worries. But for Dalmia Bharat, we'll wait by. These numbers go down as a beat. Q1 for cement actually has been quite good. India Cement, UltraTech Cement and Dalmia Bharat. All three, good set of numbers.
Okay, thank you very much for that. Banks are underperforming greatly. The the Nifty Bank is down nearly 700 points, 1.2% lower on the Nifty Bank. Large cap banks are weak, like Axis Bank down 2.5%. But mid cap banks in particular, a Union Bank 3.5%, Bank of India, PNB, PSU banks are selling off hard and fast today. Let's tell you what we've lined up on the show today. So markets hovering around the 24,000 mark, but it's been a good day for small caps. The pressure is far more accentuated in the banking names. So we'll discuss that in greater detail. Tata Chemicals is in the spotlight, up 17% this week. Its subsidiary Rallis delivered a good set of numbers for the March quarter. What's next for Tata Chemicals? A deep dive coming in. And also, we'll talk about the asset management companies on the back of their numbers. A comprehensive fine print of the numbers coming up in just a bit. But 1 hour to go. How should you position yourself? Important one. It's the Nifty monthly expiry. Mitesh is joining in as always. Mitesh, come off sharply. Banks in particular are feeling the heat.
That's right. I think, as I said yesterday also, I think this is a market which just might start contracting because most of the directional indicators have started turning flat and then they may turn down, which means that volatility will keep on shrinking. 23,800, which was the low, 23,813, which was the low made on Friday, is an important pivot on the downside, while on the upside there's a gap of 24,400. So we are starting with that 600 point as the initial assessment of the range. I think next 3 to 4 to 5 days, the markets might just be moving within this range. Intraday can be volatile, but I'm not sure that we'll have a big breakout or breakdown from these levels. So I think trading should be more stock specific. I have one buy and one sell right now. Buy on ONGC with a stop at 292 for targets of 310, and a sell on BEL, that's Bharat Electronics, sell with a stop at 440 for targets of 420.
ONGC has come up nicely. Oil India, Mitesh, is the other one?
Yeah, Prashant, I have positions over there, so it will be unfair for me to comment. But obviously, I think I like both the stocks, Oil and ONGC. And Oil India is just like ONGC is also given a breakout. And the first target is close to about 503. Once it clears that range, I think I'm even looking at 525 to about 540 on gaps.
Just one more name, Mitesh, Tata Chemicals, and we'll bring in Sonal on what's happening and why the stock is up. But just price action wise, Mitesh, Tata Chemicals?
I think, some kind of a big breakout has taken place today on the charts of Tata Chemicals as well. I would have given a buy, but the stock is up 11%, so the risk reward doesn't fit in. But I think once it clears this 815, 820 zone, the stock could see the upmove continue to about levels of 875 as well. So there's good enough upside left. But maybe, if it takes a breather at 820 odd levels, then I think on a pullback, let's say to about levels of 780, 775, this will become a strong buy.
Okay, all right. Mitesh, thanks very much. More later. Well, let's tell you what's happening and why the stock is up 11, 12%. Tata Chemicals, that is. And I think Rallis, of course, reported strong numbers. We had the management with us. Sonal is here with all of that. Sonal, afternoon.
Afternoon. Well, a couple of reasons. Of course, the first one being that Rallis reported numbers. In a weak season, it was a good set. There was a revenue growth of 6%, which was above what the street was working with, driven by 5% volume growth and 1% price growth as well. There was an EBITDA loss, but it was lower than what the street was working with. Again, 1 crore EBITDA loss this time around. And it narrowed because of cost-saving measures taken by the company. The crop care business grew by 5%. Their B2C segment delivered 15% growth. The company also said that seeds business, which did see strong growth this time, will continue to see strong growth. High to mid-teens is what they highlighted. Now, Tata Chemicals today is seeing the biggest single-day gain since August 10th of 2022. Now, remember, Rallis is a subsidiary of the company where Tata Chemicals holds 55% stake. And the consolidated numbers do take into consideration what Rallis reports as well. And hence, some sort of positivity is rubbing off on Tata Chemicals as well. The company reports numbers on the 4th of May. So, I do have some Kotak estimates this time around. Revenue is expected to decline by 6.5% and EBITDA is expected to decline by 9% on a YOY basis. There will be a loss again at 52 crore rupees because remember, the soda ash market has been seeing a lot of supply chain issues that could continue as well because of what we have been seeing around West Asia war. Now, earlier this month, we also did see Shapoorji Pallonji Group calling for the listing of Tata Sons. Tata Chemicals holds around 2.5% stake in Tata Sons. So that is one of the probable reasons because on that news as well, the stock rallied. It has come off from those levels yet again. The stock is off 20% from 52-week high. It is up 17% this week. So yes, a couple of reasons, but of course, the big trigger would be when Tata Sons list and there could be some monetization plan for Tata Chemicals.
Thank you very much for that. Dharmesh Kant, Head of Research, Chola Securities, joins in. Dharmesh, you want to weigh in with your thoughts on Tata Chemicals?
Yeah, good afternoon, Rima. I mean, it's more to do with Tata Sons listing and the value unlocking for Tata Chemicals if it goes through. Otherwise, the business per se for soda ash is not happening for last 2 years and still the difficulty continues. So even the numbers are suggesting on the estimates that they would be reporting loss. So it continues. And Rallis, again, it's a very muted kind of a growth numbers which the management has come out with. Though, I mean, sequentially it looks better compared to last year numbers. But again, the company is into loss, and with the El Nino kind of environment prevailing, one has to see. So management did sound confident, but just on, I mean, the business per se, I won't be buying Tata Chemicals. But if somebody is looking for a trade on the prospects of value unlocking from Tata's listing, then it may make some sense.
Yeah, got that. Dharmesh, good afternoon. Good to have you here. Just a quick word, Dharmesh, on the oil producers we were talking about, and Mitesh had ONGC up on his radar as trades, Oil India, ONGC, etc. Upstream companies, oil prices are where they are. Stocks are not, of course, not pricing in oil at 100 plus. I think they're still pricing in oil at $65, $70. Would you be willing to look at names like this?
Yeah, got on, Prashant. No, Prashant. I mean, it's just a one-off kind of a trade which is playing out. And I mean, all the noise and sounds and work is on the areas of replacement of, fossil fuel, and particularly crude oil. So structurally, if you look at last 3-4 years, there has not been any volume growth on the consumption for any of the oil companies. It's 104 to 105 million barrels per day kind of a global oil consumption has been there. So on that light, I mean, the day the announcement comes, Strait of Hormuz opens, these entire gains will be reversed very sharply and deeply. So I mean, for Brevards, they can continue, but we are not looking at any of the upstream companies.
Although I must say, it's not just trades, right? Some funds have also bought ONGC. And there the bigger bet seems to be that, maybe, of course, replacing oil is one, which we don't have, but maybe more sort of incentivizing companies to actually explore more. And of course, I mean, they sell what they have. The other point which no one knows is at some point, like back in the day, the government may ask not just the downstream companies, but also companies like ONGC to shoulder some of the burden. Upstream, the losses on fuel, which obviously they're not going to pass on completely because those are going to be very, very large. But in any case, debate up, and stocks are doing well. 300 back to 300 on ONGC. The high was about 340 or so at this point. Anything else from the energy and that's been the big theme. We had Bank of America's Amish with us in the morning, and he was talking about kind of sort of six themes. He's talked about biofuels and of course, I mean, electricity is a theme, power demand, transformers. Anything out there? This is it's of course structurally a theme, but also it's doing very well because it's here and now and it's thematically quite popular.
Yeah, Prashant, I mean, to your earlier point, it has happened in the past that ONGC and all have to share the burden of fuel subsidy. So it may happen. I mean, wait for a week after the elections are through. We don't know, but there can be things happening on that count. As far as energy is concerned, a lot of, news flow surrounding the renewable energy is back into the system. But in 2023, we have picked up this, the entire theme quite early. I mean, JSW Energy, we did an IC at 270 rupees in 3 years back. And Hitachi Energy, which is Power India, we did at 4,700 rupees initiating coverage on that. But the type of stock price run-up which has happened across the board is, phenomenal, and it becomes very difficult to justify a valuation multiple on any of the companies out there. So in between, there was a 1 year kind of a lag period because ROW was not coming, that is right of way, use of land was not getting sanctioned, and that's why the evacuation of power to the grid was a problem out there. But that has been sorted out. Now things are again flowing in, the commissioning of plants are happening. So we do like the space as a thing. But as of now, we are finding it very difficult to pick up a company out there, stock out there where, the valuations can be justified. However, we still carrying initiating coverage on NTPC Green. The commissioning this year has started picking up. Now it's over 10 gigawatt kind of power generation capacity they have. And by the time they end FY27, it would be 19 gigawatts. So based on those kind of a capacity additions, and 100% it's a PPA arrangement out there for NTPC Green Energy, we have a price target of 140. So that's the only sole company where we are, still going with a buy rating in the entire energy space.
Dharmesh, request you to hold on and comment on Maruti. The numbers are flashing for you on your screen. Prima facie, it looks like a margin miss. The street was working with EBITDA margins of 12%. Compared to that, I think the margins have come in slightly lower than expectations, which is why the profits too have missed the mark. The company's delivered well on the top line. Revenues have come in at 52,449 crore rupees. That's a strong growth seen in the company's revenues. But profits have not kept pace. Profits are down nearly 3.2%. And there seems to be a little bit of a miss compared to on the margin front compared to what the street was anticipating. So perhaps it's the higher commodity costs which has impacted the company's profitability this time.
Absolute EBITDA numbers are slightly lower, right? I mean, compared to what was expected. We'll put out the year-on-year numbers as well. EBITDA at 61.57 compared to 61.42. So there's no beat, but it's slightly in line with expectations. In any case, I mean, for companies like Maruti, beyond the fourth quarter numbers, there is the fuel price hike, the commodity price inflation. I mean, general sentiment all across is not expected to be all that, I mean, rosy in that sense. But let's just get a prima facie first cut.
One reason is the other income is sharply lower. So the other income this time is 480 crore, which compares with 1,500 crore. So straight away, there is that difference of 100 crore. And secondly, as you can see, the tax expense has also gone up. The tax expense is broadly at 1,250 crore, which compares with 1,000 crore. So tax expense is higher. Other income is lower, which is why there is a sharp miss on the company's profitability. Though revenues are ahead and margins may be slightly lower than expectations.
Okay. All right. Ashwin Patil is with us, equity research analyst at LKP. Ashwin, good to have you with us here. Good afternoon.
Good afternoon.
What do you make of the numbers, Ashwin?
Well, the numbers look like quite of a miss on the margins front at least, and then below that definitely because of the lower other income, and the profitability has been a miss. At the top line, they are like in line with our expectations, but because we know what are the volumes and also it is quite easy to guess at that level. But below that, like because of the higher commodity prices and higher fuel prices, etc., and no significant operating leverage at this point in time, I guess, because most of the launches are done and the other expenses are also slightly on the higher side because the promotional activities also were quite slightly higher in this quarter. So on and on, the set of numbers are not looking that great. But we need to look going forward, about the pipeline of products and all. And so, and also FY27, we think that, the El Nino will be creeping in and that may have some impact on the rural numbers. So on and on, looking at the Q4 as well as the FY numbers, we don't think that there is something exceptional about it.
What was your margin estimate, Ashwin?
They were slightly about 12 at about 12.3 to 12.4%.
Okay. And what constitutes Maruti's other income, the other operating income? Because we've seen a very wild swing there, 500 crore versus 1,500 crore.
Yeah, that we need to see. I mean, exactly what has happened last year, as compared to this year. So that we need to read the fine print and then only we can comment on it.
Anything you'd watch from the management commentary, Ashwin?
The demand as well as the new product pipeline. We need to see how the sentiment's playing off and how FY27, overall the commodity prices, what they have the outlook on that. So these 2-3 things we need to, gauge from the management.
Okay.
And
how are the valuations of Maruti?
They were quite, in line with, what it had been previous in the previous quarters. Because last time when the Q3 numbers came out, we were having a target close to 16,000. Now the stock, and that time the CMP was close to 14,000. So the stock has moved out now. We are getting a bigger upside, but we need to look at the numbers and then only, comment on the valuations as well as
Okay, we'll leave the conversation here. Ashwin, thank you very much for joining in. The stock has seen a sharp downtick reacting to the profit miss. Profits for the company are down 3.2% on a year-on-year basis, despite very strong growth in the company's top line. Sudarshan now joins in with some more analysis on Maruti.
So for Maruti, it's largely in line set of earnings, and you're seeing a 7% fall in profit, largely because of sharp drop in other income and also increased tax expense that company has reported. And because of that, there's a 7% drop in net profit. But if you take a look at revenue, its increase is higher than our expectations. On EBITDA front, also, it has seen an increase of almost 44 to 45%. That also almost in line with our expectation. Margin has come in slightly below our expectations. We were expecting around 12%. It is coming at 11.7%. That's because of increased material cost. And because of that, there's a drop in gross margin also for Q4 FY26. Gross margin has come in at 26.6%. And that's a drop of almost 140 basis points. It's going to be the same for majority of the auto company. And that's one of the reasons why Maruti and Hyundai have underperformed. And also on the volume growth also, company had seen volume growth of 14% in Q4 FY26 despite capacity constraints, and it has underperformed the industry. But on the realization front, it has seen an increase of almost 15% YOY and 4% on a sequential basis, much higher than our expectation. We were expecting 12% increase YOY and 1% on a sequential basis. In the commentary, all the eyes would be exactly what does company say about the price increase, because apart from Maruti, majority of the companies have already announced the price increase. And also, what does company talk about recent draft that we had from central government related to CAFE emission norm and also from Delhi government related to EV policy. But as far as the earnings for Q4 are concerned, it's largely in line.
Okay, thank you very much for that. So operationally in line numbers. Dharmesh is still with us. Dharmesh, in the auto and the auto ancillary space, you want to tell us your pick?
Yeah, I mean, just to highlight on the Maruti number, the miss in the margin, it's has to be taken note of, because Q1 would be far more difficult on the margin front. They have not taken price hikes, and 1 month has already been lost. Even if they announce price hike, Q1 numbers would be reflective of that. And the input prices across the board has, taken a sharp upturn. So that is where we are expecting around, on an average for the entire auto space, 100 to 150 basis point of a margin hit going forward. So that's the challenge out there. And going forward, I mean, as far as top picks are concerned, we are still going with Mahindra & Mahindra, Hero MotoCorp. These are the two companies which we have been recommending to our clients to buy on multi-clients, though not to chase the price. But largely, I mean, much will depend on the monsoons as well, because El Nino effect is there. So M&M with this farm sector exposure can come under a bit of a pressure out there. So these are the challenges for the auto space. But we don't expect much, price action happening out there on the upside. So one has to be an investor, and if we're willing to give 5-6 months, then only one should be buyer out there. Top picks remains M&M and Hero MotoCorp.
Got it. Thanks a lot for that, Dharmesh, for joining in, giving us your view on all of those stocks. Wishing you a good remainder of the day. By the way, just pull up Adani Enterprises. That stock, in fact, has moved to the high point of the day. I understand that there was a rights issue, and that could possibly lead to a higher weightage on the Nifty, and that kind of a rebound could take place. Explains why that stock now at the high point of the day, up close to around 4% or thereabouts. Slip into a short break. On the other side, Aniruddha Naha of PGIM India Asset Management will be joining in. Stay tuned. Welcome back. You're tuned in to Closing Bell, and we have a lot of earnings that are coming in. Maruti Suzuki, a bit of a knee-jerk reaction on that one, but actually Dalmia Bharat is another stock where the numbers actually look good, but the stock has come for a knee-jerk reaction, I think so, and that's why it did move very, very swiftly. Dalmia Bharat, let's put that one up for you on the screen. But the numbers actually are better than what the street, was working with, because the volume growth was only around 3%. But that is what was expected, because they had a plant shutdown that was taken place in the past quarter, that is in the month of March. And for 14 days, they didn't have that particular plant that was functioning. So that volume growth of around 3%, that's actually in line. It's not a disappointment. 3 to 4% is what the street was working with. It's coming at around 3%. And when you don't have the benefit of operating leverage, yet the EBITDA per ton number has jumped up by close to around 10%. So initially, the street was fearing that why is it only a 3% growth while the remainder of the industry grew by close to around 5 to around 6% odd. And now they come to terms with, in fact, yes, that was in line. Short point being, Dalmia Bharat has valuation comfort, and without any volume growth, yet, in fact, you have the EBITDA per ton that's improved, and the margins as well have expanded. So just pulling that, because initially the stock did see a sharp drop. I think it was down close to around 5%. And now it's recovered from the lows of the day. 1880 was the low on that particular name. Well, it's the end of a very, very good series. So let's do a quick check on what's going on in the F&O market. First, the Nifty is down, but I don't think it's a need to worry. Why do I say that? Because, in fact, you have the Nifty that's down, and the India VIX as well has cooled off. So I think you should get that up for you. We're cooling VIX as well as the Nifty down. That's normally not a cause to worry. Two strikes are fairly active. 24,050, or there the premium has come down to around 9 rupees from around 130 rupees. There's aggressive writing that we're seeing at that particular level. While, the 24,000 put as well, the premium out there has come down to around 10 rupees from around 47 rupees. It's actually come down to around 3 rupees. That's the gap between from the time we send these graphics to when it's firing. So the levels for the expiry that you need to look at on the downside, today's low, 23,961, all probability that should hold out. However, if the Nifty can get past the 24,100 mark, we'll see a bout of short covering. The reason I say that is because calls have got written aggressively as well. So just keep an eye out on that. Individual stocks to focus on. You have Reliance Industries, that's fresh buying that's taking place on that particular name. While you're seeing some signs of buying and some positive rolls, even on Vodafone Idea, I don't know what's the news flow out there, but that one as well as seeing some kind of positive rolls out there. While on RVNL, there's a bit of a short squeeze that's taking place on that name. Explains why the stock is up. So we're in this 140-point range. That's where expiry should take place. All in all, it's been a good series, but let's see whether or not the bulls have a little bit more fight. 24,100 is the important mark on the Nifty.
Okay, all right. I think we've bounced a little bit, and that's good news as we go into the last 30-35 minutes of trade. Anirudh Naha is CIO alternates at PGIM India Asset Management. Anirudh manages the Mid-Cap Opportunities Fund, the Small Cap Fund, Flexi Cap Fund. Anirudh, good afternoon. Good to have you with us here. Prashant this side. Have we snapped back? Because across the board, as we wrap up this month, I was looking, Anirudh, we're up on an average between 25 to 35% across a range. If you just take a basket of 200 companies outside the Nifty 50, average bounce 30%. So it's, that deep discount in that sense has disappeared. What are you doing, and what's your sense?
Thank you for having me here. Absolutely right. I think the bounce was mandated because valuations had really corrected. We generally look at valuations on a PEG basis, which is the PE divided by earnings growth. And beyond the Nifty top 100 stocks, they had actually gone down well below 1, which was very, very lucrative in that sense. I think so. We've seen a sharp bounce across sectors, and more specific with companies in the mid and small cap space, where earnings were really strong. We believe earnings, even this quarter, will be very strong. But the next couple of quarters, there would be an impact on earnings, primarily due to the logistical chains getting broken down. There would be a cost pressure building up. But if there is some sense of the conflict getting over in the Middle East, I think the market will look beyond and start looking into FY28 even a little early. And FY28 in light of that would look reasonably good for a continued rally into the mid and small cap space.
What have you done, Anirudh? Give us a sense of what you own, top holdings, etc.
Sure. So we've been, without naming stocks per se, but we've been largely around the capital goods side. capital goods and the pickup in investment cycle, largely led by engineering goods, railways, defense. This has really helped us. Other than that, discretionary consumption on the low ticket side. We believe we didn't move into too much of high ticket discretionary items, but anything to do with low ticket discretionary items. Of course, alcohol was something that we believed as a small segment which will do well. And pharma. Those are the three spaces. We've completely avoided IT from the portfolios and been a big underweight on financials.
Well, the point on alcohol, what are you all factoring in? Because we hear a lot about people tentatively drinking less. I don't know how far that's true. But, maybe India will consume more premium liquor. There's a hope as well that maybe Bihar reopens because they have a bit of a revenue crunch out there. So positioning in that particular sector, I mean, all those stocks saw a very sharp correction, 25, 30, 35% on individual stocks, and then they have bounced back in style, actually.
Right. So we've stuck to either the real premium end, where we believe it will continue to show reasonable amount of volume growth, or segments at the lower end, which has an ethanol blend also. To that extent, it benefits out of ethanol, the ethanol demand for ethanol just purely from the automotive side, plus some amount of premiumization coming into this lower end segment. So premiumization is the theme. The higher end is continues to do very well. And if there are some couple of plays out there where ethanol is a part of that basket, that just adds a little more to the earnings outlook out there.
So it is capital goods, all right, engineering goods and railways and defense and all of that, basically that one big bucket.
Yes.
Low ticket discretionary consumption.
Right.
And
Pharma.
And pharmaceuticals.
Pharma and healthcare.
Pharma and healthcare. So more hospitals compared to pharma, or?
So we've got a reasonable amount of, it's more or less a 50-50 out there. With regional hospitals where we find good valuations, supporting it out there, and domestic-oriented pharma companies, which we believe, along with CDMOs, of course, which we believe over the next 2-3 years should go ahead and deliver good earnings.
Yeah, regional hospitals, so not Apollo, not Max, not Narayana.
Actually, that end of the market is reasonably expensive even now. Okay.
I see.
So we stuck to the mid cap and the small cap. So some of the names, some of where we believe the room additions have happened, the bed additions have happened, and the operating leverage plays out in the next couple of years.
I see. Which one are we talking about? Without,
I could see a few of them on the screen actually.
we put up Narayana. I think Narayana was on the
so
Metropolis.
There's Thyrocare, there's Narayana, there's some of these names actually look very interesting from where they are.
I see. So underweight complete IT and financials as well. One of the two we often hear, but both.
Yes, we've been. We had taken a very aggressive call on, especially on IT, with literally a zero weightage out there, sitting out there. And on the financial side, our view is we generally like to stay from industries which are fragmenting or where there are too many players. What has happened is clearly one is on the balance sheet side, we've seen balance sheets being pristine and not other than working capital demand, there isn't too much of demand from the corporate side. So everyone is fighting for the personal balance sheets of Indians out here. The competitive intensity is extremely high. And growth, we believe, will not show too much to that extent. And hence, we do like the non-lending side of financials. But on the lending side of financials, we've just stayed away from them.
So this underweight call in IT has worked very well for you, Anirudh. But at some point, would you start looking to add back some exposure? I mean, where are we in this whole cycle?
Yeah, our sense is if you turn it around, they're still at about 3 to 4% dividend yield stocks today. So either I played for growth or for dividend yield, and it's exactly at a point where it doesn't fit into any of the baskets. So either it goes down to 7-8% kind of dividend yield, it looks interesting from a dividend yield perspective, or growth comes back to somewhere around 12-14%, which I would have a lot of skepticism with regards to at least the frontline IT stocks. The mid-cap IT, some of them might still continue to deliver, 16-18% kind of growth. But there again, we would want to see our valuations giving us better entry points.
Okay. Okay. And just to the first area which you said you liked, which is engineering, capital goods, etc. Again, weighted which side? I mean, if you mentioned the railways, the defense, and
we've got names into railways. You know, what we try and do while building the portfolio is to see there shouldn't be too much of a competition, or they are probably leaders in their space. So in the railways, probably the covered system is something which we believe will play out in a large way over a period of time in India. It will at least be a 5-6 year story playing out there. So stick to someone probably out there who has some leadership out there. In the defense, we've largely stuck to mid-cap names out there, and the pack as a whole has done very well. On the cap good side, there is some exposure to power and power-related ancillaries. But as a caution, I would say valuations there have become extremely, unreasonable to that extent. So one needs to, balance out the long-term story along with where valuations are stacked. Most of these companies are today stacked at above 1.5 or 2 PEG in that sense. And hence, we aren't adding them anymore. So our sense is we would look to just maintain our positions as of now, but would be very conscious about where valuations are stacked up.
Okay, Anirudh, this has been a great conversation. Thank you very much for joining in. Rich in context and very helpful. Wish you could have spoken about more stocks as well, but thank you very much for joining in. We will slip into a very short break. On the other side, we'll get you a check on what dealing rooms are saying in our segment D Street Chatter. We also get you a few BTST calls. Stay tuned.
Welcome back. Well, as promised, let's get in Nimesh, who's joining to tell us what is he picking up in D Street Chatter. Nimesh?
Hi, Nigel. A depth consolidation around that 24,000 levels on the Nifty, but clearly 24,350, 400 is a level of resistance, and that's playing out for the last couple of days. And also the macro challenges persist, right? So crude at almost 111, rupee at 94.5. So those challenges still there, and that's the reason why we are in that very narrow range of late. From a flow perspective, again, a mixed day of trade. There is a bit of selling in the financial names, especially the PSU names because of the TLC norms, and also private and NBFC. So that one leg is dragging the markets down in today's trade. Largely the sense is that the broader market outperformance is likely to continue. Even in today's market, the breadth is positive. A lot of individual names in the broader market tends to do well in today's market as well. So there is a bit of selling in the financial names in today's market. And two, the broader market outperformance, at least the sense is that it's likely to continue, and that's backed by some bit of institutional activity as well in the last couple of days.
Nimesh, what about stocks?
Well, the first stock is PTC India. It's basically buzzing in trade for the last couple of days. Today, also, there is very strong FI buying. So But the last couple of days, at least the delivery buying is quite high and looks like some FI interest is back. Also, I'm told this stock is technically on a multi-decade breakout, and hence you've seen that activity as well picking up in PTC India. The second name is Karnataka Bank. It's come to my chart list few times in the past as well. Some HN activity is pretty much there in the last couple of days. All eyes will be on the numbers. But in general, from a flow perspective, the HN activity is quite high in Karnataka Bank of late. The third is IIFL Finance. It's been volatile in the last couple of weeks. From the recent low 400, it's picked up a bit. Bit of buying has resumed as well at these levels in IIFL Finance. I guess in the very near term, the settlement with regards to the IT figure, income tax figure, that will be very important to track in IIFL Finance. And the last couple of names where it is selling today, Lodha as well as Axis Bank. I spoke about overall selling in banking names, but Axis Bank stands out in terms of sell flows. And Lodha, after the earnings call and a bit of cut in the guidance, there is a bit of selling in Lodha as well in today's market.
Okay. All right, Nimesh, thanks very much for that. PTC India, Karnataka Bank, IIFL Finance, Lodha and Axis Bank are stocks on the radar as far as D Street chatter is concerned. Mitesh is with us with what he wanted to do in terms of trades as we count down 20 minutes out to market closing. We basically, by the way, recovered in a pretty dramatic fashion during the course of the show, and then we've sold off again. So 50-point recovery and then a 50-point sell-off on the index. Mitesh, what's on your list?
I have a BTST on Nestle with a stop at 1428 for targets of 1460. ICICI Bank and banks are slightly weak today. Negative price patterns, hourly charts to see negative crossovers. So ICICI Bank is a STBT with a stop at 1302 for targets of 1272.
Okay. All right. Thank you very much, Mitesh, for that. Well, Indian Airlines are sounding an SOS over rising fuel prices. The Federation of Indian Airlines has warned the situation is becoming unsustainable. I think in Indigo, the stock is down about 2.5%. It's, of course, fuel being one of the top items, ATF being one of the top cost lines for any airline, Indigo included. Madiha is here with what the demands are, if there are demands. Madiha.
Right. So the Federation of Indian Airlines, which includes Air India, Indigo and SpiceJet, is seeking urgent intervention from the government on ATF pricing. In fact, they're saying that the industry is under extreme stress and even warning of a shutdown risk if things don't improve. This warning comes just days before the first May pricing revision, when OMCs are set to revise the monthly ATF pricing. Airlines say ad hoc ATF pricing is creating a huge imbalance between domestic and international operations, making the entire airline network unviable and unsustainable. And the biggest hit is on international routes, is what airlines are saying. There's a 73 rupees per litre spike in ATF for international flights, which is leading to significant losses for carriers, is what they claim. Earlier, ATF made up about 30 to 40% of operating expenses. Now that has jumped to 55 to 60% according to airlines. And here's the key point that airlines are making, and this is very important. They are flagging something called crack spreads, which is essentially the refining margin that oil companies earn when they convert crude oil into jet fuel. Normally, this margin is around $11 to $18 per barrel, but now airlines are saying it has spiked to $130 per barrel. So in simple terms, even if crude oil prices are not rising as sharply, jet fuel prices are still staying very high because refiners are charging much more. Brent crude went from $72 to $118 per barrel, a 64% increase, but ATF went up from $87 to $260 per barrel and now at $235 per barrel. That's roughly a 295% increase. So to deal with this, FIA is asking the government to reinstate the crack band mechanism that existed earlier to keep the crack spread, the margins, between $12 to $22 per barrel. Then airlines are asking the government to temporarily suspend the 11% excise duty on ATF to provide some immediate relief. They're warning that if this kind of pricing continues, it could lead to unsurmountable losses, forcing airlines to ground aircraft and cancel flights. So clearly the industry is signaling that without government intervention, this could turn into a much bigger disruption for Indian aviation.
Thank you very much for that important story. We'll keep coming back to you. Jay Bala of cashthechaos.com is joining in. Jay, it's been a very strong rebound in the month of April. Today we're down about 0.5%. Do you want to quickly run us through your near-term view?
Yeah. Hi, Rima. The markets are due for a pullback towards 23,500 thereabouts, 23,500, 23,650. Maybe even if the markets were to drop deeper to 23,000, that will be a bullish reset for the market. The medium-term trend is up, as I've been pointing out. I'm expecting Nifty to be about 29,000 by September, October. So the medium-term trend is up, and the very near term, the markets are pulling back towards 23,500 to 23,000.
Got that. So markets headed lower. What will underperform from here on? What drags us lower?
See, there might be some minor profit taking coming in on Nifty metals. I'm bullish on the Nifty metals too, but Nifty IT needs a washout low. So IT, is probably going closer to 26,000 mark, and we're seeing new 52-week highs come through for HCLTech and in Infosys. So probably IT might be a drag, and some profit taking is coming on the Nifty metals index.
All right, got it. Hi, Jay. Good to see you in. Jay, what about the tech index? That showed a lot of signs of promise actually in the first half of the series, and then it got sold in two in the past week. What are the levels you're looking at on that one?
Yeah, closer to 26,000 on the Nifty IT. That's the level, very important support, and I'm anticipating that to be tested. But the price structure, the market printed, Nifty IT index printed 3,900 and 31,423 in the last couple of weeks. Those are all bullish signs for the medium term. So the very short term needs a washout low closer to 26,000 mark. So once that's done, the IT sector would turn around and would catch up for the last several months of underperformance. And if you look at the US markets too, there's also positive signs emanating for the software sector, which had been beaten down due to the Anthropic scare and all those things. So there is some negativity due, but it's likely to be the final low here.
All right, internal numbers are there at the bottom of the screen. Revenues are slightly higher than expectations, about 150 odd crores better. And at the profit level, there is a miss of about 20 crores coming through, about 15 odd crores, 16 crores coming through as a miss at the net level. EBITDA coming in at coming higher, 486 crores compared to a poll of 400 crores. Margins are looking better at about 2.8% compared to a poll of 2.3%. So about 3-4 numbers now coming through. And I think from the looks of it, looks like a decent set. We'll, of course, get the food delivery numbers and the quick commerce numbers, etc. The breakup in a bit as we go along, and there'll be there's a extensive read-through of the numbers in the presentation. But for now, we've got the headline numbers, and doesn't look like a bad set. Looks like a better set on EBITDA margins, and at least as far as the top line is concerned. At the net level, there's a bit of a miss, but we'll have to just see what happened there. So that is Eternal. Mangalam should be up with us in just a bit to talk about the Eternal numbers in some more detail. But it's, by the way, at EBITDA, absolute EBITDA level, it's about almost seems like a 20% beat compared to the expected number. Devyani is here. We'll come back to Eternal with Mangalam in just a bit. But in the meanwhile, let's just quickly wrap up earnings from the asset management companies. And across the board, Nippon, for example, is stronger, UTI report and others as well. Devyani, take it away.
Well, AMC's all saw a mixed Q4, and that was largely as a result of steady flows but weak profits as a result of mark-to-market losses. The core businesses themselves have stayed strong, with Nippon AMC and ICICI Prudential AMC both leading AUM growth, while the HDFC AMC stayed stable. However, the treasury losses have dragged earnings lower, with UTI AMC slipping into a loss and others reporting sharp profit declines. The quarter also saw a clear divide as leaders gained market share, while UTI AMC and Aditya Birla AMC lost market share. Now, there was one other theme that's been steady across the sector. That was the tilt towards passives. Now, keep in mind, while the passives AUM is growing, for every rupee that the AMC manages in passives, they receive a lower amount of fee. So, this could lead to a margin compression for the company going forward. The bottom line is that while the flows have remained strong, the rising ETF and passives mix and the total expense ratio cuts that
that are coming up, execution on margins is going to be a key monitorable for these companies in FY27.
Okay, thank you very much for that. The Eternal shareholder, the letter that Eternal writes to the shareholder is also up for you on your screen, is also been released. The food delivery net order value has gone up by about 18.8% on a year-on-year basis. Margins stand at 5.5%. For Blinkit, it stands at 95.4% net order value NOV with an EBITDA of about 37 crore versus 4 crore in Q3. So that's been a pickup. And they go on to talk about the quick commerce competition, but they are saying that they are confident about getting to those margins of 5-6%. Mangalam now joins in with his read. Mangalam?
Well, these are decent numbers that have come in. The street was expecting operating leverage to pick up. The street was expecting, the net profit to pick up as well on a low base. So all those factors have played out. Two positives for me. The one part is that, the operating profitability of the quick commerce business has improved a lot more than what the street was anticipating. And over and above all of that, it hasn't, caused a dent on their growth. The growth is at 95% as against street expectations of anywhere between 98 to 100% odd itself. So the growth engine for, quick commerce continues. The good part is the food delivery business. Now here, the NOV growth, which was expected, was around 16 to 18%. The company has gone ahead and reported about 19% growth out there. So the two internals on Zomato are a lot better, on internal rather, a lot better than what the street was anticipating. And now it's over to what the management has to say about the very near term when it comes to gig worker payout, when it comes to, contribution margins in light of imminent price hikes. So far, these numbers are pretty much in line with street expectations.
And the shareholder release also talks about no meaningful impact on account of the recent LPG shortage in India. He said, yes, some restaurants in affected pockets did see some temporary disruption, but at a platform level, there was no impact. So that's what they had to say. And going back to the point about Blinkit, the adjusted EBITDA margins, their guidance is 5 to 6%. The company says we are more confident about getting to our guidance of 5 to 6% margins. These are adjusted EBITDA margins for Blinkit. We're more confident today than ever before. The only variable is the speed at which we get there. And they say that Q1 FY27 broadly is going to be meaningfully stronger on a quarter-on-quarter basis. Mangalam, you want to quickly add on a couple of these points?
Well, on the LPG crisis itself, the street wanted this comment to come in, largely because, the hullabaloo was so much that restaurants are shutting and maybe there could be an impact on players like Zomato and Swiggy. I'm glad that, the company's gone ahead and said that at a platform level, there wasn't as big an impact. Obviously, for quick commerce, the important part is that the EBITDA margins between 5 to 6%, what the company is feeling confident about, is a good thing because competitive intensity, they believe, can be managed out here. The first quarter significantly better than the fourth quarter, also led by the fact that this is an event-heavy quarter. You will have the IPL and all those factors playing out. So typically, the first quarter, as compared to the fourth quarter, is seasonally stronger as well because you also have the summer vacations and all these factors playing out. So obviously, in the food business and the quick commerce business, these businesses quarter on quarter will look significantly stronger.
We'll let you,
Sorry, Mangalam, this is also the first full quarter under Albinder as CEO, right?
That is correct. This is the first full quarter under Albinder as CEO. And obviously, the way the company has been running, leadership, the change between Deepinder and Albinder, irrespective of what the street was saying, from a process-driven standpoint, it wasn't a very big one because Deepinder already had taken a more superior strategic sort of role while Albinder was running day-to-day operations of the company. And remember, the valuation, if you look at it on an SOTP basis also, a large part does come in from quick commerce. So Albinder running this business, obviously, there wouldn't have been any major strategic change or strategy change that would happen. And even if it were to happen, wouldn't happen in a quarter, I guess.
Absolutely. Thanks very much, Mangalam. For that, stock's actually almost in the green now. It was down about 3%. And look at that. It's a sharp spike and almost back into the green now. 255 is where Eternal is now almost at. So completely recouping some of the losses. Confident of Blinkit getting to 5 to 6% margin before the earlier guided. So I think those are comments and commentary which is adding confidence to the Eternal investor. We'll take a quick commercial break here. On the other side, we'll of course continue our conversation with Jay, who's with us. There's about 7 minutes to go for market closing. Nifty's down 120.
Welcome back. Then we're winding down the series, which has been a rather good one actually from a bullish perspective. We're going to be going home with gains of close to around 8% or thereabouts. So keep an eye out on the bottom of your screen. Eternal, the street likes the commentary actually that's come in there. There's a bit of a short covering bounce I think that's taking place as well. Normally you see volatility towards the end of a contract. So that spiked up. And Dalmia Bharat, the stock initially saw a knee-jerk reaction because the volume growth was only 3%. But actually the street was working with 3 to 4%. So that's why after hitting a low of around 1,880 rupees odd, the stock has actually seen a very, very sharp recovery because margins are better despite not having any big volume growth. Jay Baba still with us. Jay, give us a couple of stock trades then. Something that's looking good or not so good on the charts.
Yeah, since I'm anticipating a very short-term pullback for the Nifty, I just have one pick today, and that is RR Cable. And it's looking very interesting on the medium-term charts. With a invalidation level of 1398, I'm anticipating this stock to scale fresh all-time highs past 1900. It's got coming out of an inverse head and shoulders pattern on the weekly time frame, so it's a very large pattern. So the potential here is quite bullish. But the very near term, I'm anticipating the Nifty to be pulling back lower towards 23,500. So I know that's just one way. Also, I liked Wari Energy and KNR Constructions, but KNR Construction more of a counter trend bounce towards 180. One energy might have a good potential because I'm most bullish on the capital goods space, and also with the energy crisis that's going through here. We are looking for energy stocks to get further fill up, and since Maruti Energy is also in the capital goods space, look for positives here. I don't have a clear setup here, but I'm bullish on this.
Jay, quick word. Reliance Industries 5% up in 2 days.
Yeah, that's an encouraging sign. So far, for the market's underperformance, Reliance has been the key stock, and the fact that it's rallying, it's quite a good sign. The short-term setup is not quite clear, but the medium-term, I'm anticipating Reliance to head back to fresh 52-week highs, fresh all-time highs past 1650. It's not completely clear. The April low at 1290 completed the bottom, but it's a bit ambiguous here. But if it were to start trading above 1440, I'll get really bullish on the stock.
Thank you very much for that. Just counting down to today's trading session, the Nifty ending exactly at that 2400 mark. A cut of about 83 points, Sensex lower by 350 points. So we've given up some of the gains that we had yesterday. The good part is the mid-cap index continues to see momentum on the way up. Yesterday, up 1.5%. Today, it's added on another 0.5%, though the advanced decline ratio was in favor of the losing side. Banks were the big drags today. The Nifty banking index ending down more than 800 points, 1.5% lower. Private sector banks weak. Axis Bank is the top Nifty loser, 2.5%. ICICI Bank under pressure, but PSU banks particularly sold off on RBI's new ECL norms. So SBI in the frontline pack. Outside of that, Union Bank, PNB, Bank of Baroda under pressure as well. Maruti Suzuki reported operationally okay numbers, but profits were down 2.5%. Stocks took a hit. IT continues to sell off after last week's rout. HCLTech another 2% lower. Wipro under pressure as well. Along with that, Infosys. HUL, Bajaj Auto, InterGlobe Aviation were a couple of the other names weak in trade. ONGC was the top star today, 5.5%, as Brent crude prices continue to inch up, $111.5 per barrel. Adani Enterprises, Coal India, Reliance, Eternal numbers look good. Stock ending with a gain of 1.7%. Well, that brings us to a close on this edition of Closing Bell. Thank you very much for watching. Don't go anywhere. On the other side is Markets Forward.
Markets end the day in the red with the Nifty closing below 24,000 level. Banking stocks drag and broader markets outperform.
Coal India rises despite a soft quarter four, rising power demand and supply tightness. Meanwhile, eternal beats on revenues and margins. Stock rebounds from lows.
PSU banks decline after RBI tightens norms for bad loans. The framework will be effective from April 2027 and requires banks to factor in future credit losses. The move is expected to dent bottom lines in the near term. Hello and welcome to Markets Forward, your go-to show where we aim to get you all the key data points to gear up for the next trading session. I'm Vivek Iyer and with me today is my colleague Sonal Bhutra. Well, good afternoon, Sonal. It's a session where we saw the banking pack clearly underperform, the Nifty not managing to hold on to the 24,000 levels and expiry day, so that volatility clearly did play out.
It did, but the mid-caps continue to do well, at least in a very volatile market like that. So that is something that we are tracking very closely. 171 points higher on the mid-cap index today. We did have a lot of sectors in focus. PSU banking index on the back of that ECL framework. So we'll discuss that in greater detail. But oil and gas really stood out. Top gainers from the oil and gas pack, Coal India being one of them. We did have the energy pack again doing well, metals higher in trade, but largely the sectoral movers were in the red rather than green. The advanced decline ratio also in the favor of declines today. So a lot of moving parts in the markets. We had earnings, and that is something that we'll be discussing on the show. But here's a lineup of what we have in store for you today. We start with top movers and shakers of the day with Hormuz. Earnings action takes center stage alongside RBI's new bad loan rules. Last but not the least, we delve into the key market events to watch out for tomorrow's trading session.
And now on to our first segment of the day. Hormaz Fatakia is standing by the wig wall with all the top movers and shakers of the day. Hormaz, over to you.
It was a subdued trading session. Of course, the stock-specific activity was paramount in today's session, but the one stock that kept the losses in check for the Nifty today was Reliance Industries. It did so in yesterday's trading session as well when it contributed to the upside, and today it ensured that the fall found a floor in today's session. So almost 2% higher on Reliance Industries today as well. Second straight day of gains. A segment that didn't do well right through the trading session was PSU banks on expected lines. At one point, they had recovered from the lows of the day as well, but then that recovery got sold into. Every single stock on the PSU bank index ended lower today, losses ranging from anywhere between 2% to 3.25%. Some other positive earnings reactions that came in for today's trading session, there were plenty of them. Positive earnings reactions as well as negative earnings reactions in today's session. But Piramal Finance was one name that was a positive earnings reaction today. But before that, the higher oil prices having an impact on both ONGC and Oil India, both of them ending higher. Piramal Finance ending 9.5% higher today. Dhanlakshmi Bank was the earnings that came in just a few minutes before market close, 15% higher on that stock. And AGI Greenpack too, after its results, ending with gains of 18% in today's session. On the flip side, the negative earnings reactions in today's trading session, a lot of them that didn't do well after their results. Unicommerce eSolutions was one of them, 9% lower. Maruti, of course, ending lower, 2.5% among the top losers on the index. SBI Cards and Dalmia Bharat too having a negative reaction to their results. Lastly, a couple of newsmakers. Cohance Life was one of them. Second straight day of gains after 20% upper circuit, ending 13% higher. And Tata Chemicals too ahead of its results, and after results from Rallis, 11% higher on the stock. And a couple of IT names ending at 52-week lows. The big duds from last week, Infosys and HCLTech, continuing to extend their losses, and Eris Life too seeing a 52-week low today.
Well, thank you so much, Hormaz, for joining in and giving us all of the top movers and shakers of the day as far as the trading session today was concerned. But remember, shares of public sector banks today slipped after RBI tightened norms for bad loans. The new guidelines now mark a shift from the incurred loss approach to a forward-looking three-stage provisioning framework. This will come into effect from April 2027. Ritu now joins in with the key highlights and the impact that banks will face.
Well, the Reserve Bank of India has issued final guidelines on expected credit loss provisioning, which is going to overhaul how banks recognize and provide for any stress. Now, while banks had pushed for the implementation deadline to be deferred, RBI has said nothing doing. These are going to kick in from the 1st of April 2027. Now, the final rules are broadly in line with the draft version, so there are no negative surprises per se. Under the new framework, banks are going to be required to classify loans into stages based on the risk that they see. So stage 1 assets will carry provisions based on the 12-month expected losses, and stage 2 and 3 will require lifetime provisioning. For stage 3, which is essentially NPA, provisions are going to rise with time, and they can go up to as high as 100% for the unsecured exposures. Now, RBI has also set the minimum provisioning floor. So stage 1 is at 25 to 40 basis points, higher at 1% for unsecured retail, and stage 2 provisioning is pegged at 5% across most categories, with lower levels of 1.5% for housing and gold loans. Now, remember, currently banks provide only about 40 basis points for these kind of exposures, so it's a big jump to 5%. But there is a transition relief. The transitional adjustment amount can be phased into CET1 over FY 28 to 31, so that provides banks a long runway to absorb any hit. Now, as far as the impact is concerned, public sector banks are going to be the most impacted, while large private banks that hold excess buffers will be better off. Macquarie estimates a one-time net worth impact of 5 to 10%, with credit costs rising by 20 to 25 basis points for PSBs. Nomura says higher upfront provisioning will be needed in unsecured retail, MSME, corporate loans, etc., with PSBs facing a 55 to 130 basis point drag on CET1 and up to 9% erosion in their net worth. Now, at a bank level, the impact varies. Names like Central Bank, Punjab National Bank, among PSUs, IndusInd Bank, among private names, will see a higher impact, while large private banks like ICICI, HDFC and Axis will be more or less insulated with adequate buffers.
Thank you so much, Ritu, for explaining those new norms for us. Let's get stock specific now. Shares of Shriram Finance surged after net profit in the quarter ending March jumped nearly 5-fold. What was the reason behind this? The analysis as well. We have Ananya joining us with more details. Ananya?
Shriram Finance stock is surging today and backed by all the right triggers. They delivered an excellent Q4. Their AUM crossed 1 lakh crore milestone, growing 25% YOY, while the core book grew 33% YOY. Retail now contributes 85% of the total AUM, confirming the successful shift to retail-led NBFC. Now, profitability was also impressive. PAT jumping 390% YOY. Net interest margin improved to 6.5%. Asset quality remained healthy, with GNPA improving to 2.3% and retail delinquency staying low at 0.6%. Now, the management guidance was very strong for FY27. They are targeting 25% growth in AUM, 50% profit growth. Now, the management said that the legacy book is now below 3% of the total AUM and will become largely irrelevant going forward in FY27, which is also one of the positive triggers for the company. Now, a major positive was a AA+ rating upgrade, which can lower borrowing costs by 50 to 80 bips going forward, and also improve funding access and potentially lift steady state ROE by 3 to 4 percentage points. Now, they also plan aggressive expansion in new growth engines, especially gold loans, where branches are expected to grow from 22 currently to 200, around 200 going forward in FY27. So overall, we can see this was a fantastic quarter for Shriram Finance.
Clearly a fantastic quarter, like you mentioned, and the stock rallied almost 9%. Thank you so much, Ananya, for joining us. Also, Shriram Finance's MD and CEO highlighted that a credit rating upgrade could reduce borrowing costs by 50 to 80 basis points over time. He also indicated that growth will be led by home and personal loans, with gold and rural segments likely to remain muted. Well, to take this discussion forward, we are now joined by Jay Bala from Cash the Chaos and Sudeep Bandyopadhyay from IndiTrade Capital. Good afternoon, gentlemen, and thank you so much for joining us. Jay, let me come across to you first. Do you feel like most of the volatility today was due to expiry-related moves, or do you feel Nifty is now taking a breather after the sharp rally that we've seen from the recent close?
Hi, Vivek. The markets needs a breather, and then that's what it's doing. I'm anticipating the very short-term Nifty to pull back closer to 23,500. Once that's done, it will be a bullish reset for the market. In the medium term, the Nifty is heading for 29,000. I'm anticipating that to happen sometime around August, September. Maybe it can be sooner than that, but the medium term is continues to be bullish. And I'm looking for a very short-term pullback to come through for the market. The minimum pullback it needs to break the low of last week below 23,800. So once that's done, we can look for the market to resume the uptrend it started from the 2nd or 3rd of April.
Take that point. Sudeep Bandyopadhyay is also joining in now. Sudeep, specifically on financials, Bank Nifty has been quite volatile. Then we had these ECL norms which led the PSU banking index lower. What do you make of the space, considering the numbers and then these regulatory interventions that are coming in?
Well, I think, what's happening is, as far as the banks are concerned, as far as public sector banks are concerned, these norms promulgated or, being put in place by RBI will definitely have a dent on their profitability going forward. So I'll be a little cautious as far as PSBs are concerned. Of course, PSBs had a very good rally during the last financial year and even in this financial year beginning. But I think now we have to be a bit cautious and we have to examine which PSB is in what position as far as their buffer in the provisions. But as far as private sector banks are concerned, particularly the large private sector banks, they have enough and more buffer and will be minimally impacted by these new norms of RBI. So if I have to look at the banking space, I will probably go back to the leaders like ICICI Bank and HDFC Bank or even an Axis rather than looking at PSBs. Overall financial services space, we continue to remain our positive view, but we have to be careful. Some of the NBFCs have come up with fantastic numbers. Shriram Finance, Piramal Finance, I think numbers have been very good. Housing finance companies are coming up with good numbers. I'm reasonably confident gold finance companies also will come with good numbers. So we have to be a little careful in selecting the companies. But fundamentally, BFSI does look good in spite of the volatility.
Okay, so that is on financials, but we did have a slew of earnings coming in. Shares of Eternal recovered from the day's low. The company reported its numbers. Most important, a lot of commentary as well. Mangalam is joining us now with the report card. A massive recovery from the lows, Mangalam.
A massive recovery indeed is what we saw on Eternal. It was a steady show that the company reported on the reported numbers as well as the management commentary as well. So let's take it one by one. The revenue of the company, 17,300 crores. The street was working with a number of around 17,155 odd crores as well. The management's, commentary on margins was fairly sanguine. The EBITDA came in at 486 crores. The street was working with a number of 400 crores. So there was a mild beat out there. And the net profit as well, 174 crores. The street was working with a number of 191 crores as well. Here, the key internals. If you look at the food delivery, out there, the growth was slightly ahead of expectations, 18.8% versus street expectations of 16 to 18%. Quick commerce grew 95% on an NOV basis year on year versus expected 95 to 100% growth. And district loss narrowed from 121 crores to about 81 crores quarter on quarter. The company has been saying that it will take 5 to 7 quarters for them to actually invest in this market and for them to be EBITDA profitable in District 2. The other important management comments, first quarter, which is the quarter that we're currently in, will be meaningfully stronger quarter on quarter because the fourth quarter is seasonally the weakest for quick commerce. They're confident of getting to their 5 to 6% margins in the quick commerce business. Not about the timeline, but definitely the direction is fairly sure. And they saw no meaningful impact coming in on food delivery due to the LPG crisis. All things said and done, with the expansion, with everything, with the losses in Blinkit, with the losses in District as well, the important part is cash for the company quarter on quarter has seen an increase. The cash balance stands a little under 18,000 crores versus third quarter numbers of 17,800 crores. So this, in the light of a 35% decline from the top on the stock price, would be viewed positively.
Thank you so much, Mangalam, for joining in, giving us all of the details as far as Eternal is concerned. Stock recovered towards the close of the trading session. Now, moving on, Maruti Suzuki met estimates in the fourth quarter. Revenue rose over 28%, while margins remained largely steady despite rising input costs. Sudarshan Kumar now joins in with more details. Sudarshan, over to you.
Maruti has reported largely in-line set of operational numbers for Q4 FY26. You are seeing a sharp drop in profit. There was a drop in 7%, largely because of sharp drop in other income we have seen. And also there was an increased tax expense that led to a drop in net profit, which has come 7% lower at 3,590 crore. But if you take a look at the number of on revenue front and EBITDA front, revenue has increased by 29%. EBITDA has seen a jump of 44%, despite an increase in the commodity cost that we have been seeing over the last few weeks. And due to that, there was a drop in gross margin. Gross margin has come at 26.1% against more than 28% in the same quarter last year. On the EBITDA margin front, it has come at 11.7% versus our expectation of 12%. So overall, it was an in-line set of earnings. One thing that we track for auto companies is the realization. We were expecting a growth of almost 12% YY and 1% on a sequential basis, but company has beaten our estimates. It has reported 15% YY growth, and on a sequential basis, the growth is 4%. So overall, in line set of earnings as far as Q4 FY26 is concerned. But for the auto sector, more than the earnings, what would matter the most is the commentary, because in the passenger vehicle segment, Maruti is the only company which is yet to announce the price hike despite a sharp increase in commodity cost. So we'll look for the management commentary related to the price hike, and also what does company talk about recent draft on CAFE emission norm that central government had released, and also on Delhi government's EV policy. But earnings largely in line.
Okay, for sure. The commentary continues to be very important, but as Sudarshan explained, the reason for the stock fall, a weak set of numbers coming in. Let's go back to Jay Bala. Jay, what do you make of Eternal and Maruti chartically? Auto stocks have been under pressure. Anything that you think stands out here?
Eternal has got a bullish structure in the medium term and the long term. The July 22 low to the recent high of 368, that's a very bullish structure for the medium term. But in the short term, it needs to go below 200 to complete the corrective structure for the medium to long term price movements. So once it's below 200, somewhere about 192 is my objective. Once that's done, I think it's ready to resume its medium-term uptrend. When it comes to Maruti, it's done a stellar job recently, along with the Nifty Auto Index. But I think it's taking a back seat for now. Probably a pullback closer to 10,500 may be possible. But it's not a bullish structure, and it's not aggressively bearish structure either. So it might just middle somewhere around here. So look for some of the better names within the auto space.
Okay, Jay, look for better names in the auto space. Well, Sudeep, would you agree with Jay? Do you feel we can overlook Maruti at this point of time? What are your preferred picks in the auto space?
Well, my preferred pick for quite some time have been Mahindra and continue to maintain my view. I think they're experiencing secular growth in all the segments in which they operate, whether it's the tractors, whether it's the SUVs, and even including the EVs, which they're coming up with, are getting good traction. So, and valuation, while it is not cheap, I think it's still reasonable if you consider, kind of models they're coming up with, the kind of business growth and the kind of potential which we expect. So Mahindra is my top pick on the automobile space. I also do like the Bajaj Auto in the two-wheeler space, considering the export business which is gaining traction and the EV business which is expanding rapidly. So I think both M&M and Bajaj Auto are my favorites.
Okay, all right. Take that point. Thank you, Sudeep, for your thoughts as well. It's time to focus to AMCs now. Devyani is joining us now with a wrap on all the earnings and the stock moves that we saw in the day today. Devyani.
Well, AMCs all saw a mixed quarter 4, and that was largely as a result of steady flows but weak profits as a result of mark-to-market losses. The core businesses themselves have stayed strong, with Nippon AMC and ICICI Prudential AMC both leading AUM growth, while the HDFC AMC stayed stable. However, the treasury losses have dragged earnings lower, with UTI AMC slipping into a loss and others reporting sharp profit declines. The quarter also saw a clear divide as leaders gained market share while while UTI AMC and Aditya Birla AMC lost market share. Now, there was one other theme that's been steady across the sector. That was the tilt towards passives. Now, keep in mind, while the passives AUM is growing, for every rupee that the AMC manages in passives, they receive a lower amount of fee. So, this could lead to a margin compression for the company going forward. The bottom line is that while the flows have remained strong, the rising ETF and passives mix and the total expense ratio cuts that are coming up, execution on margins is going to be a key monitorable for these companies in FY27.
Well, thank you so much, Devyani, for giving us a neat wrap of how the results of AMCs have delivered in the quarter gone by. Well, Sudeep, coming across to you now, within the AMC space, do you have a preferred pick? Would you go with the leader? Would you go with a slightly smaller name, that has scope for significant AUM growth?
Well, I think I will like to go with the leader. I think in this space, what is extremely important is growth in AUM, and the leader has been growing the AUM rapidly at the cost of some of the other players. And under the current construct of the business, I think the bigger the AUM, the better are your chances of profitability and margin expansion. So I will definitely stick with the leader ICICI as well as HDFC.
Okay, all right. Take your insights, Sudeep. Jay, Sudeep, thank you so much for joining us on the show. It's been an earnings-heavy day, so we would have a lot more questions, but we have to take a quick commercial break. When we come back, we'll get you the top corporate voices along with the key market events to watch out for on the other side.
Welcome back to Markets Forward. Well, now time for some corporate voices of the day. The management of Mahindra Holidays said that the company will focus on expansion, higher realizations and operational efficiency. The company added around 900 keys in FY26 and is targeting over 1,000 additional keys in FY27. The revenue is also expected to increase by 10 to 20% by the next fiscal.
And EU Small Finance Bank management says it remains comfortable on asset quality with a provision coverage ratio of around 70%. The bank expects stability ahead with only a marginal impact of about 10 basis points on net interest margins and sees FY27 outperforming the previous fiscal.
Rallis India reported a mixed Q4 with improving EBITDA trends but continued pressure on profitability. Speaking to CNBC TV 18, the company's MD and CEO said input cost pressures persist due to the West Asia conflict and the outlook remains largely dependent on the timely monsoons.
And before we wrap, we bring you some key market events to watch out for. Ria is standing by with that list. Ria.
Well, yes, first up in the US, we have the Fed interest rate decision as well as the crude oil inventory data to watch out for. We also have a lot of earnings coming out from the US, including Alphabet, Amazon, Qualcomm, Ford, Meta, as well as Microsoft. In India as well, a whole host of Q4 results to keep your eye out on, including Vedanta, Bajaj Finance, Adani Power, Federal Bank, Granules India, India Bulls, IIFL Finance, and a whole host of other companies also reporting their results tomorrow. In terms of board meetings, we have Bajaj Finance, IIFL Finance, Indian Bank, Lloyds Metals, Mass Financial, as well as Vari Energies, which will be considering fundraise proposals. And also watch out for the assembly elections in West Bengal, for which phase 2 happens tomorrow, and the counting is on the 4th of May.
Well, thank you so much, Ria, for joining us, giving us a list of all the key events to watch out for. It's an earnings-heavy day. That's what we understand from the list that you've just shown us. But with that, it's a wrap on this edition of Markets Forward. We will be back with more news and updates on the other side.
Good evening. Thanks for joining us on Business 360. I'm Shriram Finance. The big stories that we're tracking for you this evening. The Trump administration is reviewing Iran's peace plan, which involves reopening the Strait of Hormuz and deferring talks on the nuclear program. Reuters quotes a U.S. official who claims President Trump is unhappy with the proposal. Dozens of countries call for the Hormuz to reopen, and the UN Secretary General warns of a global food emergency. Brent crude prices breach $110 per barrel as Hormuz remains choked for shipping. British energy giant BP more than doubles its profit in the first quarter thanks to the surge in oil prices. The Sensex and the Nifty end with marginal losses. The Nifty drops below 24,000. Bank stocks lead the decline. The rupee weakens by more than 30 paise against the dollar as it moves towards the 95 mark once again. Maruti Suzuki meets estimates in Q4. Revenues up over 28%. Margins largely steady despite rising input costs. The board approves a dividend of 140 rupees a share. Zomato's parent Eternal reports a steady Q4. Revenue up 6%. Food delivery orders rise 19%. Quick commerce orders see a sharp surge of 95%. The management expects the first quarter of this fiscal to be meaningfully stronger. India's top 3 airlines warn the industry is on the verge of closing down, seek urgent government intervention to reduce the cost of aviation fuel by suspending the 11% excise duty. Fuel prices have more than doubled for airlines since the war in Iran. Venture capital firm Peak 15 exits MobiKwik in a 130 crore rupee block deal, manages to triple its initial investment in the fintech company. With this, all private equity players have exited MobiKwik. Shares rally after the RBI grants an NBFC license. India's top cybersecurity agency warns of risk to companies and individuals over Anthropic's Mythos and OpenAI's new AI model. Asks companies to stay alert and increase their detection. Anthropic has not released Mythos to the public, saying the chatbot could be used as a cyber weapon. The Supreme Court appointed tribunals clear more than 1,400 voters in West Bengal to be included in the electoral rolls after the controversial special intensive revision by the Election Commission. This out of 34 lakh people who have appealed against exclusion from the voter rolls, only 1,600 have been cleared to vote. The second phase of polling begins tomorrow. Heatwave continues to scorch India, with the mercury almost touching 47 degrees in Maharashtra's Akola. More than 90% of the world's top 100 hottest cities in India. Mumbai to face a 10% cut in water supply from the 15th of May. A court battle on the future of artificial intelligence between two titans of the industry begins today. Elon Musk is suing Sam Altman for transforming OpenAI from a non-profit entity to a for-profit company. Well, we do have a packed show lined up for you, but first, the big story of the evening. The United States is set to be reviewing Iran's latest proposal to end the war and reopen the Strait of Hormuz, but Iran does not want to negotiate over its nuclear program, at least at this point in time, and wants those talks to be deferred to later. Now, let's take our viewers through the key developments. President Trump is reportedly unhappy with Iran's plans as Iran proposes to set aside discussions over the nuclear program until the war has ended. The Wall Street Journal has reported that Trump has not rejected the offer outright yet. The White House maintaining that the U.S. will continue to negotiate and is likely to offer its counter-proposal in the coming days. Meanwhile, Iran has maintained that it needs credible guarantees that neither the U.S. nor Israel will attack again before it can ensure security in the Gulf. Tehran's envoy to the UN said lasting stability in the region can only be achieved through a permanent cessation of military operations. And all of this uncertainty has pushed Brent crude above the $110 mark. In fact, the rising energy prices have helped British energy major BP's quarterly profit more than double. The company said the first quarter results reflect exceptional oil trading contributions and stronger midstream performance. Now, the Strait of Hormuz remains choked for shipping. Bloomberg reports Iranian oil tankers are clustering near the Chabahar port, just shy of the U.S. blockade line. Around 6 to 8 supertankers were idling in the waters near the port in the Gulf of Oman late last week. Trump has claimed that Iran's oil storages are so full that the country has about 3 days before oil pipelines risk explosion from being clogged up. The U.S. and Iran clashed at the UN over Tehran's nuclear program and its inclusion in the leadership of a month-long conference to review the nuclear non-proliferation treaty. The U.S. representative told the conference that Iran's selection was shameful. Iran's representative rejected the U.S. statement as baseless and politically motivated. Dozens of countries and the UN General Secretary also called for the Hormuz to reopen. Meanwhile, in Lebanon, Israeli forces continue their strikes in the southern part of the country. The Israeli military says it has also destroyed more than 1,000 sites used by the Hezbollah in southern Lebanon, including what it called booby-trapped buildings where weapons were located. Meanwhile, Germany's Chancellor Friedrich Merz has criticized the Trump administration's approach to negotiations with Iran. Merz has said that the U.S. is being humiliated by Iran's leadership.
The Americans clearly have no strategy, and the problem with conflicts like this is always that you don't just have to go in, you also have to get out again. At the moment, I cannot see what strategic exit the Americans are now opting for, especially as the Iranians are obviously negotiating very skillfully, or rather very skillfully not negotiating, and letting the Americans travel to Islamabad only to leave again without any results. An entire nation is being humiliated by the Iranian state leadership, particularly through these so-called revolutionary guards.
Suffice it to say that the nuclear question is the reason why we're in this in the first place. Look what they've done with the Straits. Great example. The Straits is basically the equivalent of an economic nuclear weapon that they're trying to use against the world. And they're bragging about it. They're putting up billboards in Tehran bragging about how they can hold 25% or 20% of the world's energy hostage. Imagine if those same people had access to a nuclear weapon. They would hold the whole region hostage.
I appeal to the parties. Open the Strait. Let ships pass. No tolls. No discrimination. Let trade resume. Let the global economy breathe. Prolonged disruption risks triggering a global food emergency, pushing millions, especially in Africa and South Asia, into hunger and poverty.
So the impasse continues, no breakthrough yet on Iran and U.S. talks. But let's talk about the day's market action now. The market's ending largely in the red today, with the Nifty closing below the 24,000 mark. The mid-caps did outperform blue chips, with Tata Chemicals and Oil India leading the pack. The Nifty down 0.5%, similar story for the Sensex, just about in positive territory, 170 points higher for the Nifty mid-cap and 1.5% lower there for the Nifty Bank. The Nifty PSU Bank Index down 2%, this after RBI finalized the expected credit loss norms. The currency market action now. The rupee has fallen to its lowest level in April, weighed down by surge in crude prices. The impact on the currency has been limited as oil companies are buying dollars only from specified banks. Currencies in all emerging markets weakened today. The rupee finally closing at 94.54. On to earnings corner now. Maruti Suzuki's first quarter in line with estimates. Revenues rose over 28%. Margins remained largely steady despite rising input costs. Sudarshan is here to wrap up Maruti's numbers for us. Sud.
Maruti has reported largely in-line set of operational numbers for Q4 FY26. You are seeing a sharp drop in profit. There was a drop in 7%, largely because of sharp drop in other income we have seen. And also there was an increased tax expense that led to a drop in net profit, which has come 7% lower at 3,590 crore. But if you take a look at the number of on revenue front and EBITDA front, revenue has increased by 29%. EBITDA has seen a jump of 44% despite an increase in the commodity cost that we have been seeing over the last few weeks. And due to that, there was a drop in gross margin. Gross margin has come at 26.1% against more than 28% in the same quarter last year. On the EBITDA margin front, it has come at 11.7% versus our expectation of 12%. So overall, it was an inline set of earnings. One thing that we track for auto companies is the realization. We were expecting a growth of almost 12% YY and 1% on a sequential basis, but company has beaten our estimates. It has reported 15% YY growth, and on a sequential basis, the growth is 4%. So overall, in line set of earnings as far as Q4 FY26 is concerned. But for the auto sector, more than the earnings, what would matter the most is the commentary, because in the passenger vehicle segment, Maruti is the only company which is yet to announce the price hike despite a sharp increase in commodity cost. So we'll look for the management commentary related to the price hike, and also what does company talk about recent draft on CAFE emission norm that central government had released, and also on Delhi government's EV policy. But earnings largely in line.
All right, Sid, many thanks for joining us. And on to earnings now. Zomato's parent Eternal has reported a steady set of numbers in the fourth quarter. Both the food delivery and quick commerce business reporting strong growth. Mangalam is standing by now to do the number crunching for us. Eternal's numbers out, Malu, what do they look like?
A massive recovery indeed is what we saw on Eternal. It was a steady show that the company reported on the reported numbers as well as the management commentary as well. So let's take it one by one. You know, the revenue of the company, 17,300 crores. The street was working with a number of around 17,155 odd crores as well. The management's, commentary on margins was fairly sanguine. The EBITDA came in at 486 crores. The street was working with a number of 400 crores. So there was a mild beat out there. And the net profit as well, 174 crores. The street was working with a number of 191 crores as well. Here, the key internals. If you look at the food delivery, out there the growth was slightly ahead of expectations, 18.8% versus street expectations of 16 to 18%. Quick commerce grew 95% on an NOV basis year on year versus expected 95 to 100% growth. And district loss narrowed from 121 crores to about 81 crores quarter on quarter. The company has been saying that it will take 5 to 7 quarters for them to actually invest in this market and for them to be EBITDA profitable in District 2. The other important management comments, first quarter, which is the quarter that we're currently in, will be meaningfully stronger quarter on quarter because the fourth quarter is seasonally the weakest for quick commerce. They're confident of getting to their 5 to 6% margins in the quick commerce business. Not about the timeline, but definitely the direction is fairly sure. And they saw no meaningful impact coming in on food delivery due to the LPG crisis. All things said and done, with the expansion, with everything, with the losses in Blinkit, with the losses in District as well, the important part is cash for the company quarter on quarter has seen an increase. The cash balance stands a little under 18,000 crores versus third quarter numbers of 17,800 crores. So this, in the light of a 35% decline from the top on the stock price, would be viewed positively.
All right, Mangalam, many thanks. That's Eternal for you. On to CNBC TV 18 exclusive. Public sector undertakings are likely to participate in the offer for sale portion of the upcoming NSE IPO. Sources say the exchange is likely to have received expressions of interest amounting to nearly 4 to 5% of its equity. The issue is expected to involve a stake sale of around 4% and could raise upwards of 20,000 crore rupees. Shares of public sector banks declining in trade today. This after the Reserve Bank issued final guidelines for the expected credit loss framework last evening. Now, the new guidelines shift from the current incurred loss mechanism to forward-looking provisioning. These norms will come into effect from the 1st of April 2027. The central bank has said banks wanted more time for the transition as they needed to build databases and upgrade their systems. Speaking to CNBC TV 18, former SBI Chairman Dinesh Khara said the new norms could cut overall bank profits by 50,000 to 60,000 crore rupees, and that is why you saw today the PSU bank stocks under pressure.
Last year, the banking system profit was somewhere around 4 trillion. And the kind of growth which you are witnessing, I would say that maybe this year it will be around 4.5 trillion or so. That will be the overall profit of the banking system. So my broad calculation is that it will take away about 50 to 60,000 crore worth of profit. So I think it's a one-time impact, but I think it will actually make the banking system much more resilient and also make them eligible for raising foreign capital, because globally this is something which is being practiced.
Well, that is the former SBI Chairman Dinesh Khara. Venture capital firm Peak 15 has exited MobiKwik in a 130 crore rupee block deal. With this, all private equity players have now exited MobiKwik. Ritu joins us now with the details. Ritu, the cap table looks completely different now, doesn't it?
That's right. Venture capital firm Peak 15 Partners has fully exited MobiKwik in a block deal that was worth over 130 crore rupees. They sold about 60.8 lakh shares, which is roughly 7.7% of equity at an average price of 214 rupees per share. Now, the buyers in the block deal included Florentree, Viridian Asset Management, Daemon Asia and Karma Capital. Now, while Peak 15 had sold some stake in MobiKwik in 2024 as well, they held about 7.8% stake in MobiKwik as of the end of March, which was the last disclosed figure. But with this transaction, they've completely exited the company, and this is significant because Peak 15 was the last remaining private equity investor on their cap table. Now, remember, Adia had already exited MobiKwik back in September of 2025 as well. Now, Now, this also comes at a time when MobiKwik has seen some regulatory progress. They got that stockbroker license and more recently an NBFC license from RBI as well. Now, Peak 15 was one of the earliest investors in MobiKwik. They'd made their first investment in the company in 2013 and now they've exited with about 3 times return on their investment.
Ritu, many thanks. Next up, India's top 3 airlines warn that the industry is on the verge of closing down. Seek urgent government intervention. That and more when we return. The Federation of Indian Airlines has sent an SOS to the government over rising jet fuel prices. The association has said that the airline industry is under extreme stress and, I quote, on the verge of closing down. Madhya standing by with the details. Madhya, what do they have to say?
The Federation of Indian Airlines, which includes Air India, Indigo and SpiceJet, is seeking urgent intervention from the government on ATF pricing. In fact, they're saying that the industry is under extreme stress and even warning of a shutdown risk if things don't improve. This warning comes just days before the first May pricing revision, when OMCs are set to revise the monthly ATF pricing. Airlines say ad hoc ATF pricing is creating a huge imbalance between domestic and international operations, making the entire airline network unviable and unsustainable. And the biggest hit is on international routes, is what airlines are saying. There's a 73 rupees per litre spike in ATF for international flights, which is leading to significant losses for carriers, is what they claim. Earlier, ATF made up about 30 to 40% of operating expenses. Now, that has jumped to 55 to 60% according to airlines. And here's the key point that airlines are making. saying, and this is very important, they are flagging something called crack spreads, which is essentially the refining margin that oil companies earn when they convert crude oil into jet fuel. Normally, this margin is around $11 to $18 per barrel, but now airlines are saying it has spiked to $130 per barrel. So in simple terms, even if crude oil prices are not rising as sharply, jet fuel prices are still staying very high because refiners are charging much more. Brent crude went from $72 to $118 per barrel, a 64% increase, but ATF went up from $87 to $260 per barrel and now at $235 per barrel. That's roughly a 295% increase. So to deal with this, FIA is asking the government to reinstate the crack band mechanism that existed earlier to keep the crack spread, the margins, between $12 to $22 per barrel. Then airlines are asking the government to temporarily suspend the 11% excise duty on ATF to provide some immediate relief. They're warning that if this kind of pricing continues, it could lead to unsurmountable losses, forcing airlines to ground aircraft and cancel flights. So clearly the industry is signaling that without government intervention, this could turn into a much bigger disruption for Indian aviation.
Well, trying times there for India's aviation sector. Yet again, Madhya, many thanks for joining us. Andhra Pradesh Chief Minister Chandrababu Naidu laid the foundation stone for the Google Cloud AI hub in Visakhapatnam. Google announced an investment of $15 billion over 5 years, making it one of the largest digital infrastructure FDI projects in India. The AI data center will have a capacity of 1 gigawatt. From bangles to bottles and decor items to lab apparatus, India's glass hub, Firozabad, produces nearly 70% of the country's unorganized glass output and employs over 5 lakh people directly or indirectly. But this energy-intensive industry is under severe pressure as the war in West Asia disrupts both cost and supply. CNBC TV 18's Kiran Khatri finds that the war has compounded the impact of the high US tariffs. Take a look.
Behind me is the famous Agra fort, which once served as the administrative nerve center for 3 Mughal rulers. Back in the day, markets were set up within these premises and glass bangles and other glass products were a big draw for shoppers. Today, just 40 kilometers away, the hub that makes these products has lost its gleam. Dreams are being shattered by geopolitical headwinds the industry has no control over, and the spreading cracks have no quick fix. Firozabad is home to over 200 manufacturing factories and 200 others that specialize in finishing and decorating products for exports.
यहाँ कांच के अलावा अन्य कोई भी काम नहीं, जो भी काम है कांच का ही है.
Natural gas is the backbone of production, making up about 30 to 35% of costs. At the heart of this unit is a 160 metric ton furnace that runs non-stop at temperatures of around 1500 degrees Celsius. This is where glass is melted with chemicals like soda ash, limestones and dolomite before being molded into bottles. This factory alone produces around 4 to 5 lakh units, which are then sent to companies like Diageo, Pernod Ricard, Amul and Mother Dairy. Nearby, a bangle making unit depends on gas for multiple processes, from melting to winding and shaping. And the West Asia conflict has doused those flames.
ईरान युद्ध के बाद जो एसेंशियल कमोडिटी एक्ट लगा है 1955, उसके बाद हम लोगों को ये आदेश मिला है कि आपने जो 6 महीने का गैस का खपत किया है उसका 80% गैस खपत करनी है. तो 80% गैस खपत के कारण हमारा प्रोडक्शन करीब 50 से लेकर 60% रह गया है.
कुछ इंडस्ट्री ऐसी है कि जिनको जो 20% कट के बाद नहीं चल सकती, तो वो बंद हुई है. ऐसी करीब 20-25 यूनिटें हैं.
The domino effect has sent costs surging across the board, from shipping to packaging.
पहले जो ये अमेरिका वगैरह कंटेनर जाते थे, तो जैसे एक कंटेनर हाई क्यूब है तो $3500-$3600 में जाता था. आज उसकी रेट $6,000 या $6,500 होती है.
चूड़ी की जो पैकिंग होती है प्लास्टिक की डिब्बी, वो बहुत महंगी हो गई है. वो लगभग 70-80% कॉस्ट बढ़ गई है उसमें, क्योंकि पेट्रोलियम प्रोडक्ट ही होता है प्लास्टिक.
This industry was already reeling under the high tariffs imposed by American President Donald Trump, and while the US Supreme Court eventually struck down those tariffs, businesses say the damage was already done.
एक्सपोर्ट तो तब से हम लोगों के 60% डाउन में चल रहा है. एक्सपोर्ट का मार्केट। हम लोगों का क्रिसमस सबसे बड़ा सीजन होता है, तो अभी क्रिसमस के हम लोगों के यहाँ से सप्लाई जा रही है। अब जिस समय ख़रीदारी का समय था, हमारे बाहर आए हुए थे, उसी समय ये टैरिफ बार शुरू हुआ। अब टैरिफ बार हुआ तो हम लोगों की उन्होंने 50% से कम खरीदारी की है पिछले साल की अपेक्षा, तो वो इफेक्ट तो हमको पूरे साल चलने वाला है।
With the industry's margin shrinking, laborers are feeling the heat.
पहले महीने में लग जाते थे 12-13 चक्कर, अब तो महीने में 6-7 चक्कर लगते हैं।
महीने में हो जाता था 25 हाजिरी हो जाती थी, अब तो 20 हो हैं, 15 भी हो हैं, ऐसा हो रहा है।
Glass manufacturers in Firozabad say they have no alternative to gas as they fall within the Taj Trapezium Zone, a 10,400 square kilometer area around the Taj Mahal in Agra. In 1996, the Supreme Court prohibited industries in this area from using polluting fuels like coal and coke to prevent the monument from turning yellow. As global shocks repel through the industry, its future is now at risk. In Firozabad, Kiran Khatri.
Well, difficult times there for India's glass industry on account of the war in West Asia, and we will continue with our ground reports through the week here on CNBC TV 18. But with that, it is time for us to wrap up this edition of Business 360. But don't go anywhere. We have a very special lineup for you. The CNBC TV 18 Market Forum on the future of Indian IT industry. Is the sector at a key inflection point? How should you position yourselves? We ask top experts and investors. Coming up for you right after this short break, the CNBC TV 18 Market Forum. Is India's IT sector up for further derating, or is this the time to get in? Catch Prashant Nair and Rima Tendulkar in conversation with top experts.
Hello and welcome to CNBC TV18 special town hall, The Tech Trade. Today, we step back from the noise of quarterly earnings and stock moves and ask a far bigger question. Is one of India's most defining economic engines, IT services, at an inflection point?
For over 3 decades, the Indian IT services has been not just an industry. It's been a nation-building force. From the liberalization era of the 1990s to today's digital economy, it has shaped India's global identity as the world's back office and increasingly its innovation partner.
Well, the numbers are staggering. India's IT BPM industry today generates over $250 billion in revenues, with exports accounting for roughly $190 to $200 billion.
And to put that in context, IT services account for over 51% of India's total services exports, making it the single largest driver of external services earnings.
Its contribution to the domestic economy is equally significant. The sector now contributes 7.5% to India's GDP, up from just about 1.2% in 1998.
Beyond the macro numbers, the sector's deepest impact has been social. It has been one of the largest creators of India's salaried middle class, offering formal employment, global exposure, and upward mobility. The industry today employs 5.5 million people directly and supports an additional 12 to 14 million indirectly. And these jobs have consistently been among the best-paying entry-level opportunities in India's formal economy. Engineering graduates entering the IT services have historically earned 2 to 2.5 times the median salary, starting across sectors, according to the labour market data sets.
Crucially, Indian IT has navigated disruption before. It scaled rapidly during the Y2K transition, survived the dot-com collapse, adapted through the 2008 GFC period, the global financial crisis, and repositioned itself during the cloud and the SaaS wave. Each time the industry moved up the value chain from coding to consulting, from execution to transformation.
But this time may be fundamentally different because generative AI, led by platforms like ChatGPT and Claude, is not just automating repetitive work. It is compressing the need for human intervention in core IT services tasks, from coding to testing to maintenance.
McKinsey estimates that generative AI could automate up to 40% of work activities in software engineering. And that raises a tough, difficult question. If the very foundation of the IT services model, human effort arbitrage, is challenged, what replaces it?
Financial markets are already reacting to this shift. Across global software and IT services, valuation multiples have compressed as investors reassess growth durability. In US, several software companies have seen forward price earnings multiples contract by 20 to 40% from 2021 peak levels, even as AI optimism builds. In India, IT services stocks have also underperformed the broader markets over the last 2 years, with growth visibility weakening.
Well, which brings us to the central question here. Is this another technology cycle that Indian IT will adapt to, as it always has, or are we looking at a structural break in the very model that built the industry? We have 3 top-notch panels to answer all of these important questions. They sound easy to ask, but I guess it'll be a little more difficult to answer. Let's give you a sneak peek of what's coming up.
Well, we're calling our first panel AI versus outsourcing, and we have with us 2 great analysts joining in. We've got Phil First, CEO, Chief Analyst of HFS Research, and Dan Ives, Global Head of Technology Research, Managing Director, Senior Equity Analyst, Wedbush Securities.
Well, the next panel will try to answer the question, can IT services stay relevant in this new AI, ChatGPT, Claude era? And we've got 2 veterans joining us to talk about this. Frank D'Souza is Managing Partner and Co-founder, recognized. He, of course, was a co-founder of Cognizant, which is an IT services giant. He, of course, ran it as CEO for many years. And by the way, Frank is also going to come up with a white paper, which is going to release right here on this program in just a bit. Srikanth Velimakani is co-founder, Group Chief Executive Officer, and Executive Vice Chairman at Fractal Analytics. So that's our second panel.
And our third panel takes a sharp look at how investors should think about pricing all this disruption into stock prices. We have with us Sumit Jain, Senior Research Analyst, CLSA, and Nilesh Shah, Founder, Envision Capital.
Okay, well, that's the panel, that's the lineup. Parima, let's kick it off with our first panel. And Phil and Dan, great to have both of you here. Thank you very much for being part of this program. Really appreciate it.
It's great to be here.
Let me ask you a simple question. And Phil, if I can start with you. Is this cycle different? I mentioned all those prior cycles which Indian IT navigated through successfully, but do you think this is fundamentally different?
I absolutely do. And, I grew up in the 90s, betraying my age a bit here. And this is the biggest structural shock since the Y2K, the big millennium issue that really shocked the industry back then. And it's all compressed into 2 to 3 years. So firms treating it as AI, sprinkling business as usual with AI are just sleepwalking into a crisis right now. So AI is compressing delivery timelines in ways that make traditional staffing economics unworkable. So this is a secular fundamental reset that's going to impact our industry quite significantly, and the roots are already being set.
Phil, I agree with you, but let me push back on that just for 1 second. Did the start of the prior, all those other cycles also seem so transformative? I mean, did we think it'll change the world like we think this will now?
Yeah, I think the most comparative era was the dot-com and then internet revolution that really kicked in the late 90s. And it really took 15 years for the vision to become reality, whereas everybody had to take their businesses and move them online and become digital businesses. It took longer than we thought. So I think that's the first lesson we could probably take is these things are slow burns. And I know AI is hitting us a lot. It's affecting our lives a lot. A lot of us are very excited using these LLM tools, etc. But it is a slower burn. There is time to reset. There's time to retrain talent, and there's time to readjust. And I think there's a big opportunity for India if it gets it right, but it needs to move a little faster than it is right now.
Dan, would you agree? Every disruption or every technology cycle started with a disruption. Initially, there is compression, there is fear, but eventually, the addressable market expanded. Would you say that by the end of 5 years, the addressable market for Indian IT services would expand, or would it contract?
Well, I think ultimately it's probably going to expand because, look, Phil, I agree 100%. This is the fourth industrial revolution. So this is different. This is the biggest tech transformation that we've ever seen in our lifetime. And I think you'd have to go back to really the true industrial revolution to what we're going to see. My view is IT services, specifically, when I think about India and all the work that we do there, you're going to see today maybe 30, 40, 50% of overall services at a company being AI influenced. Maybe if you look at what Accenture's done, 25% of their consultants right now are AI driven. So my view is that for every dollar spent on a NVIDIA chip, there's an $8 to $10 multiplier across the rest of tech. That's software infrastructure, but that's also that's going to be services. It's going to be power. So I think it's about how quickly this industry could pivot into AI. That's going to be the key.
Dan, Rima and I were talking about how you wrote this piece and you sort of put out the first level impact, second level, third level impact in terms of how this is going to play out. We didn't find a mention of IT services there. At the third level, I think you had software companies. I think software product companies, but I didn't see IT services there.
We're not talking for another 2 years, year and a half. I mean, when you think about it, the data centers are still getting built today. You haven't even seen part of why software stocks have gotten crushed is because you haven't seen monetization of software yet. 2026 is going to be the year of software, and 2027. But I think this tidal wave comes when I look at IT services. This is much more as we go into 2027, 2028 in terms of IT services. And I think that speaks to, it's like they're on the clock right now to make sure that they're well positioned.
You're saying 2026 is going to be the year for software companies? Because at the moment, AI is making coding very easy and very affordable. So every company perhaps will look to build its own custom sovereign build. Why would they pay for multi-year subscription platforms? Your SaaS companies, basically. What's the moat behind that?
I mean, there's a better chance of me being an all-star cricket player than that happening. I mean, the point is, I think that's a fictional narrative in terms of the Anthropic's going to unseat the Oracles, the Salesforce, the ServiceNow. They'll disrupt on the edges. But it goes back to right now, there's so much confusion, but the reality is those are AI sort of native stacks. They're never going to unseat the install base players. They're going to be partners of them, but also it just shows we are going through a massive time of confusion and growth, but that creates the opportunities. But I strongly disagree with that software AI ghost narrative.
Dan, just to get that timeline out, just to clear that, what did you mean when you said 2026 will be the year of software and then the tidal wave in 27, 28? I mean,
the use cases are going to get built in 2026.
I see.
And we've seen it, Palantir, ServiceNow, and Oracle and Snowflake. But IT services, how are you going to build these architectures? What's going to be the hybrid cloud environment? Talk about the complexity in terms of how companies are actually going to do it. That's going to be where IT services is going to play a huge role.
Okay, Phil, and by the way, we have an audience here watching both of you. I think you guys can see some of the faces are familiar. Shrikant, the Fractal, is with us. And I think, Phil, you know him well. And Shrikant, you know Phil, and of course, Dan as well. Phil, where does Indian IT services fit in? I mean, this is a big wave, fourth industrial revolution. To your mind, you work with lots of IT services companies, Phil. Where do they fit?
Well, I think, Dan talks a lot about from a sort of Silicon Valley software mindset, and I agree with a lot of what he says about traditional software vendors. I think the difference here is we're seeing the first real convergence between services and software. We trademarked a phrase at HFS called services as software, because clients traditionally buy services by buying numbers of bodies per year. It could be 500 FTE over a 3-year contract, all that sort of stuff. The first phase of this disruption is where the enterprise clients are going to the services firms and saying, I know that you can run my coding, my app support, my BPO with less people. So they are forcing the services firms already to start to figure out how to deliver more as a product than as a people-based service. So this shift away from selling effort is now moving to selling outcomes. And they're being forced to deliver the same services or sometimes different services with less people. And this is the shift that's happening fairly quickly. We're seeing a lot of agentic AI being weaved into IT services deals. I just saw, for example, a 700 FTE deal, which was one of the tier 1 Indian firms. They had 700 people running that deal. They lost the deal to actually an onshore-based company in the US, which had 300 people running that contract. So right now, it isn't all about a massive tech transformation. What we're seeing are companies figuring out how to do the same work with a lot less people, because you can do simple, basic coding a lot faster with the technology we have today. You can automate a lot more voice and BPO work. It's really happening. The squeeze is starting. It's not happening at a lightning speed, but when you get into the contracts, when you look at the numbers, you look at the hiring trends of the big service providers, you can see the change happening quite quickly.
So, Phil, Indian companies need to adapt. They need to pivot to capture this opportunity. But you have this theory that of a CIO trap. Indian companies have spent decades building relationships with the CIOs and the CTOs, who are the masters of how to get the work done, the doers. But AI transformation is more of a business decision, a why decision, and that decision rests with the CEO, CFO, the board level. And Indian companies do not have that kind of a relationship with the CEO, and that could be a bottleneck.
It's more than a bottleneck. I mean, this is one of the biggest changes that the Indian industry has to face, which is they've built an amazing industry effectively servicing the CIO's office and the CIO -1, CIO -2. When AI decisions are being made, particularly amongst Global 2000, which are the big clients of the Indian industry, it's becoming increasingly a business decision, not just a tech decision. And accountability stops with often the COO or the CFO or the CAIO, which is a role that we're seeing springing up everywhere. So being able to have deeper relationships across the C-suite outside of the CIO's office is really important. So when you look at a more Western style services company, like a Capgemini or an Accenture or a Deloitte. They have heavy Indian resources, but they also have deep consulting where they're working directly with the CMO and the head of supply chain in these areas. So this really is the time where we need to see the leading Indian heritage firms make deeper investments into transformational consulting beyond traditional tech work that has fed them so well for so long.
Phil, we've heard that word transformation, not on the AI side, but transformational work from IT services companies for the last 7-10 years now. One would imagine. You're saying it's sort of talking to the right people across large organizations. I mean, that is a challenge and it's sort of hard to surmount.
It is a big challenge because you need to take a conversation from a technology-driven conversation to a business transformation conversation. So the companies who are being successful in AI right now are linking AI to revenue growth. That's the big conversation that needs to take place ultimately. And that's often happening at the C-suite level within companies. The big challenge then is how do you translate that down to the middle layer to execute against the C-suite vision? So being able to work with clients at that level, articulate a vision, and then be the partner of choice to transform those businesses is where you need to be right now. And the risk is the big strategy business transformation work goes to non-Indian companies, and then they bring the Indian companies in to try and implement, which has been the traditional model. That needs to flip, I think, for the Cognizants and TCSs of this world to deepen their footprints into other business functions. I think it's absolutely critical that they do this.
Okay, what we're going to do is stay with us, Phil and Dan. We're just going to take a very quick commercial break here. I have to do that. We'll just come back and continue this very interesting conversation. Stay with us.
Welcome back to this special broadcast. Still with us, Phil first and Dan Ives. Phil, I have a question. As the Indian IT companies navigate through this disruption, the structural disruption, what would they look like 5 years down the line? Say a TCS with a $30 billion revenue, Infosys with $20 billion of annual revenues. If you have to deconstruct their business model and tell us what it would look like, say 5 years down the line, give us a sense.
So they're going to get flatter. This pyramid model, which traditionally has fueled these organizations, is changing. So right now, you've actually seen some of the leading providers adding more entry-level talent, but training them very specifically for AI roles. And they're hollowing out the middle more. So they're getting a broader number of freshers coming in. I think Cognizant's doubling down. Accenture, actually, they've been growing their revenues, and they've managed to cut 22,000 mid-tier roles. So we're seeing the pyramid shape becoming more diamond-like. They're not probably going to get bigger from an employee perspective. They're probably going to shrink. The question is, how fast, and is it going to shrink profitably as things change in time? Now, when Jeff Bezos at Amazon came out and said, I'm going to double Amazon by 2031 with the same number of employees, Wall Street went crazy. They loved that statement. And that's the same thing that's happening with services firms right now, is they've got to grow and find increased profitability without increasing their headcount base. That's the big goal that they're all focused on. So I would say some shrinkage in size, a flattening out of the pyramid, a lot more retraining of skills. There needs to be a lot more deep dive relationships with universities, because the curriculums right now are still built for an era that's ending. And there needs to be, I think, more responsibility from big industry bodies like NASCOM to really talk about the change and stop having their heads in the sand, pretending that nothing different's happening while we're still growing at 3%, it's okay. So yes, there is some real shifts happening, but I don't think it's going to be like a massive shock. I think it's just going to be a structural change in the types of skills, the types of management skills. Everything is changing in that regard.
Dan, from the other side, which is, foundational models and companies which are causing all this disruption, the large language models, generative AI, etc. Are we looking at, when we look at who gets impacted how, should we, and you can sort of build out a grid, right? Say repetitive, data-intensive tasks perhaps get hit more, and that has been a worry with IT services companies here in India. But stuff which has got regulatory compliance built in, which needs authoritative outputs, liability-bearing judgment. Those are things we've heard from experts like, some of the top people in India like Nandan Nilekani, etc., saying, well, those are not things which, these LLMs, that you can't leave these things to, a Claude and others. Just wanted your perspective, Dan. Is that the right way to think about it, or you think they will get good enough very quickly to do these things as well?
They'll never get good enough. At least in the next 5-10 years. Look at relative compliance, security. Companies are never gonna, they're not gonna rely on an OpenAI and Anthropic for that. And it speaks to the point, like Phil brings up, obviously a lot of key points in terms of a flattening, but there's going to be opportunities created within software, within cybersecurity, within infrastructure, within hybrid cloud deployment. Take a company with 200 employees and they're deploying AI models. You think they have the internal IT ability to navigate where they want to get from a use case, from a compliance, from a security perspective? And one security breach when it comes to code, that could be lights out. And it just speaks to our point where, yeah, there are headwinds here. But then there's going to be companies that could be the new winners. So there's other companies. Like when I was at Davos in January, I was with many Indian IT service executives that are well aware of where this is all heading. which is why they're at Davos. The point is, like, I think you're going to see them go further up the stack.
And Dan, one final question on your view on jobs for the Indian IT companies. Up until now, what we've seen over the last 3 years is that the headcount has stagnated. It's not grown, but it hasn't fallen too much. While on Wall Street, we keep reporting about massive job losses. Meta looking to cut their workforce by 10%. Do you think what's happening in the US is what will happen in India to the IT services 18, 24 months down the line?
Also remember, Meta basically hired a small city since COVID. In other words, I think it's very, sometimes these numbers get more like dystopian or misleading. I mean, I think there will be job cuts, but it's my view, AI over the coming years will create more jobs than it cuts. And I don't think there's ever been a technology the last 100 years, and then the US Fed talks about this a lot, that's ever been a net job cutter. And I think that it just speaks, there's areas that are going to be much more negatively impacted. And you're going to definitely see much more scrutiny. But then there's going to be opportunities as well. And I think that it's about companies pivoting, like a lot of stuff Phil talks about, into the right spot when it comes to the Indian IT world.
Yeah. I think our audience is getting they have questions. So, gentlemen, please.
Hi.
Please go ahead.
My question's for Phil. Phil, I'm Shayak. At the beginning of every transformation cycle, we see new platforms getting created. Google, Facebook, the last time round. And this time round, we're seeing Cloud Code. Every large company and the CTO, CIO, they're all moving towards Cloud Code, establishing quite a bit of capability there that leads to some capability loss in India. On top of it, all the service companies as well are moving towards these platforms, which means it could potentially be that a lot of the value percolates to these platforms. So my question to you is, should India focus on building these platforms by capability, by domain, research-led, or should we still focus on building the services and the applications?
It's a great question. So the shift to Anthropic has really taken the industry by storm, and we can talk about Anthropic's fair marketing. It's quite brilliant, actually, the way that they're scaring everybody into it. But they're absolutely starting to dominate the enterprise conversation, and it's very smart for leading Indian firms to invest in Anthropic in the whole ecosystem. So you've got the partner and implementation layer, and you've got a bunch of companies there who are either Claude first partners, and you've already got like Cognizant, Infosys, Deloitte, Accenture in that bracket. There's a lot of model agnostic partners, companies like Altimetric, Genpact, for example. TCS is a pending partner there. And then you go into the platform partners like IBM, Zapier, things like that. So I think it's important for the Indian firms to really figure out how to become Claude first, which means you've really got to do more than just think about functionally implementing the technology, to really figuring out how to apply it to solving real business problems, real domain problems. And that brings me back to the conversation around invest in that consulting layer, because it's really all about having those seasoned relationships at the top of your clients to guide them. You've got to be the guider, and then you've got to then apply an environment that can take full advantage of Anthropic, can really understand, what is real versus what is not. Like some of the stuff around mythos, solving 5 decades worth of coding hell, a lot of that is not true. That does not happen overnight. But it can provide tremendous capabilities to do things a lot faster, to code a lot better, and things like that. So I think, yes, gravitate to being a Claude first partner. I think Anthropic, they're going to IPO this year. It's going to be one of the biggest ever. I mean, that company grew from 7 to 30 billion last year. I mean, that is insane growth. They're absolutely dominating the market. OpenAI is completely struggling on how to catch up. And I do think that that's an environment that Indian firms need to double down on.
We have, it was a fantastic question, by the way, and we have more questions, but I have, we're greedy. We just want to ask both of you before we run out of time, what is the best way, what is the one thing, to both of you, and Dan, you go first. IT broadly, not IT services, but in your universe, for those who can invest in India, outside in India, at this point, what's the way to do it, to get exposure to this super cycle, AI super cycle?
I mean, look, to me, I mean, I'll start first. I think it's playing the second, third derivatives. It's not just Mag 7, but it's playing software infrastructure, what I view as the power component, because it goes back to the multiplier. For every dollar spent on NVIDIA chip, there's an $8 to $10 multiplier that's spent across tech. We are going to see $4 trillion spent over the next 3 to 4 years. We've only seen 15% of that already spent. And to me, from an IT services perspective, I think it's trying to find the companies that are positioning themselves well to make sure, kind of like Phil talks about, they're skiing to where the puck's going. And I think that's going to be the opportunity for companies like a Cognizant is a good example where, they're trying to pivot. That's a big focus for them.
Phil, same question to you. And if you want to give a shout out to any specific companies which are kind of sort of, handling this transition, pivot, whatever you want to call it, well in India.
Yeah, I think it's services companies don't make billion-dollar acquisitions, and they really struggle them over the years. I think Dan's got the point of look at specific domains, look at specific industries. I think we saw. Here's an example I like. Wipro bought a company called Mindsprint, which has a major foothold in agribusiness in Southeast Asia. It's a massive, massive market for them. So by acquiring the assets and the people within that business, it gives them the ability to infiltrate their supply chain, to really understand the processes and the data and the supply chain flows. Ultimately, it's about building out business expertise. You can go out and hire tech people all day long. The real issue right now is understanding the business, the supply chains, how to help clients reinvent their business models so they can actually take advantage of AI. Because ultimately, the goal of AI is to grow revenue. And if you can figure out how to help businesses address their process debt, their people debt, and their data debt, worry less about the technology, focus on the business transformation. That's the key. That's how services firms are going to be successful in the future.
All right, and Phil, if you have to rate this disruption on a scale of 1 to 10, 1 being just another tech upgrade, this is great for Indian IT companies, and 10, this is the end of the road as we know it. How would you rate it?
A flashing 10.
I'll give it a 9.
A 9? Dan?
I'd give it a 7.5.
So we're veering towards the side of bearishness, right? Yeah.
No, I mean, I think opportunity, right? I mean, there's the other way to look at it. Dan and Phil, thank you very much, gentlemen, for joining us. Great conversation. And I think this is going to be the first of many that we plan to host. And see you both here. I know you travel, Phil, you travel to India a few times a year. So looking forward to hosting you here in the studios. Thank you. Dan, thank you very much.
You should make it here too.
All
right. Well, that is panel number 1. We've got 2 more top-class panels coming up. And we have Frank D'Souza, who's going to be with us in just a bit. You can see him there up there. And he's going to be sort of releasing a white paper. Frank, hi. And Srikanth, the Fractal, of course, is with us here in our studios. He's going to come up on stage. And we will get into the next panel discussion and ask 2 actual practitioners, people who are running IT companies, what can they do to stay relevant and what needs to be done across the industry. Stay tuned. Welcome back to this special town hall. The IT tech trade is what we're calling it, but it's more than a trade. It's a long-drawn process. You just heard from Dan Ives and Phil Fesher just a while back on, the analyst view, the consulting view on how the industry will change, what needs to be done. Let's talk to people now who are running large companies, who've run large companies. So Frank D'Souza is with us. He's is one of the co-founders of the IT services giant Cognizant. Is of course now he's managing partner and co-founder of Recognize. And we also have Shrikant Velimakani, who's the group CEO, executive vice chairman at Fractal, which of course made its D-Street debut recently. Shrikant, great to have you with us here. Thank you very much for joining us. And Frank, great to have you with us here as well.
Pleasure to be with you. Thanks for having me.
So Shrikant, what we thought is that Frank has written a white paper, which he has promised to unveil here on the program. And I think it goes right to the heart of the problem, if you want to call it that, which is what will be the shape and size and form of IT services companies. And it's got some really prescient good points. So Frank, if I can ask you to sort of, present your thesis, the main points that you're making in that white paper. We've got graphics ready, so it'll come up as you speak. Go on.
Great. Well, thanks again for having me. It's great to be here to launch the white paper, which is available on our website, recognize.com. I wrote the white paper because the industry, as you've heard, is going through a substantial transition. I believe it's a large transition, but perhaps an operating model transition that we haven't seen in some 35 years in the industry. And I wanted to Recognize is a firm that's been investing in building the next generation of services businesses. We founded the firm about 6 years ago. And so we've got about 6 years of experience now on working with really leading edge digital services firms that are pushing the envelope on what is the next generation of services business look like. And of course, that's accelerated over the last 3 years or so with the advent of generative AI. The key thesis of the white paper is this, that you have two paradoxes that form the basic structure around this transition. The first is that you have a divergence going on. The divergence is that code has never been more valuable. If you look at the valuations that underpin firms like Anthropic and OpenAI, and even Main Street firms like Walmart, these valuations are based on the value of the code that these companies have. But yet, the value of coding, the act of producing that code, is going towards zero. So you have this great decoupling going on where the value of code has never been higher, and the value of coding is heading towards zero. That is the first paradox. I call that the paradox of value. The second paradox is that creates a paradox of complexity, which is that abundant code, which is what we're seeing now, does not necessarily translate to reliable software. Those two things are very different. Abundant code and reliable software are not the same thing. And the act of producing reliable software in a world where code is abundant actually produces its own sets of complexities. Complexities in managing the security environment, complexities in terms of managing the compliance, managing the integration of systems, accountability. And so you have these two paradoxes, the paradox of value on one side and the paradox of complexity on the other side. And these two paradoxes, as they come together, will have fundamental implications on the industry, on the profit pools, on the structure of services businesses, which the white paper attempts to unpack.
And there is, if you can, Frank, if I can ask you to just briefly tell us what's the advice, because there is a section there in the white paper in terms of how the business models will move and what companies themselves should do to move towards that, because it's headed there anyway.
Yeah, so the white paper outlines 4 big areas that firms need to think about. The first is moving towards what we think of as effort agnostic commercial models. So commercial models where your price or value to the customer is based on what you deliver to the customer as opposed to the effort that you put into delivering that value. So moving towards effort agnostic commercial models is the first. The second is learning how to prioritize impact over headcount. So thinking about how you create the culture internally within the firm to speak with the customer in the language of impact, as opposed to speaking to the customer with the language of headcount. The third is the ability and necessity to create proprietary IP in the areas that you've chosen to compete in. And the fourth is what we think of, or what I think of as the talent geometry. Phil first spoke about it a few minutes ago. This move from from a pyramid to a diamond. These are the four big structural changes we see in the industry. But all of that maybe is underpinned by one very important change, which is the courage that leadership teams need to have in order to make this transition. Each of these four transitions are substantial transitions. There's a lot of muscle memory over the last 3 decades or more on how to do things one way. We now have to build new muscle memory to do things in a completely different way.
And Frank, what you're saying in a way sounds a little alarming for an industry which is $300 billion and it's built on coding. And now you're saying this is the biggest operating model shift that we've seen in the last 40 years. Now for the companies to execute on this 4-point program that you're outlining, say for instance, moving towards from the act of building to the impact of build, right? Outcome-based pricing. Now you've run an IT company, and now that I've tracked it for close to about 2 decades, even I've heard IT companies talking about that consultative approach, making products, building outcome-based pricing, but it's not been that easy. So how challenging do you think it's going to be for IT companies to pivot?
Yeah. Okay. Let me first set the stage and then answer the question specifically. I think the big framing here is that this, to me, is a tremendous opportunity for the services industry. I've never been more excited about what lies ahead, because fundamentally the world is becoming more and more technology intensive. The value of code has never been higher, and therefore folks who know how to produce that code, who know how to produce it at speed, who know how to do it reliably, who know how to do it with great ethics and compliance, I think those firms are going to be tremendously relevant and therefore tremendously valuable going forward. I think you're right, Rima, in saying that the industry has talked about moving to outcomes and outcome pricing for a long time, and that's why in the white paper we actually make a distinction between input pricing, output pricing, and outcome pricing. Outcome pricing has been difficult because sometimes outcomes are difficult to measure. It's hard to ascribe the value of the outcome or the impact of the outcome only to one service provider. But there is a middle ground, which is output pricing, where you price based on some volume metric that's relevant to the client, not on an input basis. And moving more towards output pricing, we think is a good, solid middle ground. And by the way, I don't think the industry needs to move entirely to any of these three models. I think in the future, we're gonna wind up with a combination of the three. Input pricing is still going to be valid and relevant for some types of work. Output pricing is going to be valid and relevant for other types of work, and there'll be some amount of work that's priced on an outcome basis as well.
Shrikant, welcome again. You heard Frank, great points. What's your sense? You're in the middle of all of it, in the thick of all of it. How fast is this change happening, and how quickly are firms being able to adapt, in your opinion, Shrikant?
Firstly, there's no doubt that this is a huge revolution. It's going to shape the world in a very significant way, and we're just starting the very early signs of this. So this movie or this book, this is the first page of the first chapter of this book that we are currently witnessing. So there's a lot more to come, and it's going to be very exciting and scary at the same time. And as far as Frank's points are concerned, I agree with almost everything that Frank has said in terms of, first, effort agnostic pricing, or second, increasing revenue per employee, therefore not headcount based. 3, driving more IP. I agree with all three, and they're pretty consistent with each other. The one I have a little beef with is the diamond-shaped model org structure that we are referring to, which essentially means that I'm narrow at the top, I'm narrow at the bottom, but I'm fat at the middle. That is something that doesn't ring well for me, because that's exactly what the companies are doing right now. So what companies are doing they're not hiring entry-level talent because they can replace that with some AI tools. But this is not a sustainable org structure for the last 200 years of the world, no company has survived a diamond-shaped org structure, so I don't think it will work even today. If I were to do this, and it is consistent with the other 3 points Frank has made about higher revenue per employee, more IP, is increase the density of talent. You still have a pyramid. In fact, make it even flatter and have extremely high quality talent that is inexperienced but is extremely high quality. That is the kind of pyramid I would build, a flatter pyramid rather than a diamond. So that's the only big sort of beef I have with Frank in this white paper.
I think Phil made that point about the diamond the thing.
Dan was talking about it,
structure.
yeah.
But just in terms of Srikanth, will we see? I mean, everything that Frank mentioned and what you said and what we heard earlier from the analysts as well. Are we going to see revenues shrink first before they grow, or is going to be this slow growth which continues and then kind of takes off? What's your sense?
The first thing I'll say is the world does not have nearly enough software. We need 1,000 times more software than we have today. I don't have to, give you lots of economic data to suggest that. You can just look around and see the technology that we all use every day. In businesses, the software that we use is very, very clunky, very user unfriendly, not enough software, etc. So the world needs 1,000 times more software. And yet, building of software will compress rapidly to maybe 10x in 1/10 of the time it used to take. So there's a 90% compression in the time it takes to build software, but we need 1,000 times more software. So there is eventually, that's 100x the opportunity that it is today, 0.9 or multiplied by 1,000. So there is a massive opportunity out there, but what we are seeing initially is the compression coming through. So if I'm a big IT services company and I'm pitching for a large $100 million project, which was $100 million 3 years ago, now I'm probably pitching at 70 or 80 or 85. And at that price, there are other players who are coming in and saying, I can do it at 50. By the way, I have a much smaller team. I'm going to be fully AI native and I can do it at 50. So you're seeing that compression already starting to play out. But the AI related expansion, the new market that gets created because AI's software is going to be cheaper, has not yet played out. So therefore, this multiplicative effect of the AI compression versus the AI expansion is a net result that you're seeing in the revenue growth of the big companies out there. So yes, at this point of time, growth is challenged, but it is a matter of next 1 or 2 years that the AI expansion starts to come through, and I think it'll create a massive opportunity. I believe this is the biggest opportunity that Indian tech services companies have ever had, except that if they don't leverage this opportunity, they can actually get extinct.
So Frank, if this is a J curve, right? Initially, the revenues compress and before it accelerates and takes off. Where are we in the J curve?
No, I think Srikanth said it best. Look, I think both things are going on in parallel. I don't think that these are sequential things. In the white paper, we do talk about the J curve. And the reality is that you will see on the current base of work, much of it will experience some amount of deflation. That's going on right now. That's going on in real time. But at the same time, the other part of the trend is also happening, which is that we're starting to see AI adoption at scale now, where enterprises are starting to adopt AI. The technology is getting the surrounding technologies in order to govern AI, in order to put the guardrails in place, in order to assure and validate that the outputs are reliable and consistent. Those technologies are getting better and better every day. And so we're starting to see enterprise adoption at scale. One of our businesses, Blend 360, for example, which is a key architect of solutions, AI solutions for clients, Blend is starting to see large-scale enterprise AI adoption at scale in the business. And so I think you're starting to see both of these things are happening in parallel. I think how deep the J curve is and how long it lasts really depends on one thing, which is somewhat unknowable. And that thing is how fast the models get better over time. Because in some senses, the depth of the J curve is a question of how good the models get. Because the productivity gains that we see on existing work will depend on how good the models are, and that's somewhat unknowable at this point.
But your best sense, I mean, Frank, 10% more to go, to the bottom, 20% more to go?
You know, I would say that we're probably 2 years into this journey at this point, and we probably have another year to go before we start to see the lines cross.
Which is basically the end of, I mean, the maximum deflationary kind of point. That's the bottom we're talking about, Frank, right?
I think that's right. I think, again, I don't have a crystal ball here, but based on anecdotal conversations that I've been having, I think that's the likely time frame here.
You agree?
I think the worst is yet to come in terms of the contraction. We are just seeing in current numbers are in the tech industry in India is growing about 2 to 3% right now, and the expectation is that in the next 12 to 18 months it will be similar, if not worse. And after that, it might start to take off, because what we are seeing is the worst of that is not yet played out. Because remember that getting enterprise technology right is not easy. There is incredible complexity that most of the tech services companies have talked about in their earnings calls. They've talked about how complex it is to build things inside large enterprises. No prizes for guessing that. It's certainly true. But there's one more topic that they don't talk about much, is about accuracy. So when you're taking a foundation model and trying to deploy it inside an enterprise, you have to make that system work, match and exceed human performance in a consistent, reliable, predictable way. This is much harder than just plugging in an enterprise, just bringing in a foundation model and asking it to do magic. You need to fully understand the enterprise context. You may have to fine-tune the models on the enterprise data, which the models have never seen, and get that entire AI engineering and design going in a way that this is done well and adoption happens inside the organization. So there is an incredible amount of opportunity that still exists for these companies. Now, as soon as the big tech services companies are able to pivot into solving these kinds of problems and also sort of reforming their talent or reimagining their talent, they open up 3 big opportunities inside companies. Number 1, AI-led business transformation. Can I transform every workflow, every process, every aspect of my business with AI? Can I reimagine that with AI? Today, the McKinseys of the world are sort of advising companies on that, but getting that right with high accuracy is a huge opportunity. It's a multi-trillion-dollar opportunity. The second opportunity is building the AI foundations. You have to have a whole ontological or a knowledge layer on top of your data so that these models can do their intelligent job. So that knowledge layer, bringing all that data in and creating the knowledge layer is much harder than what it seems, and the tech companies in India can address that opportunity. And 3 is, as AI starts to become predominant in big companies, you need to transform work and workforce. So the tech companies and consulting firms can also help companies in reimagining their work and workforce in an era of AI. So these are the massive big opportunities that get presented in the world of AI for anybody. It is for as much for AI companies as for it is for IT firms or management consulting firms. The question is who's going to be ready and who's going to scale.
You know, as Frank said, if these foundational models get really good, I mean, are we going to get to a point where you don't need, I mean, the enablers, the services firms? Is it possible we get to that stage?
What will happen is that
because you still need the context, as you said, right, Shrikant?
Yes. If the models get really good, it's going to make your work more impactful. The ability to drive impact will actually dramatically improve. And to Frank's point, if you're able to charge on outcomes and outputs, you can make a huge killing. So models actually become a part of your input rather than a competitor for you. You can use the models to drive significantly more outcomes. And therefore, models getting better is not a bad thing, it's a good thing.
So there is an opportunity, but there's still no clarity on who will really benefit from it. Indian IT companies can, but it's not a done deal.
Yes.
Also, another point, right? The previous tech cycles gave Indian companies enough time to pivot, right? Cloud was first spoken about in 2012, but it only scaled up in 2020. So most cycles gave Indian companies 7, 8, 10 years to pivot. But this time, with agentic AI, the disruption cycle itself is 18 to 24 months. Are Indian companies agile enough to pivot that fast and capture that opportunity?
Yeah, I got paranoid about cloud in 2008 when Amazon launched its EC2, and it took many more years for the media to get interested and the world and finally adopt. So yes, it is true that there is a technology diffusion cycle, and it is going to take time for large enterprises. In the afternoon today, I was having a chat with one of the CTOs of a very large automotive companies in the world. And they were talking about how challenging it is to deploy it in the Western world, in the European markets, and how the talent transition and ability to adopt AI is not as easy as it sounds. So there is a timeline for diffusion that will be there. So for example, one of the things I say is, if you stopped all AI progress today, how long does it take for that AI to percolate inside companies? That is another 5 years. So yes, it seems like AI models are making enormous progress, but that is not translating into enterprise performance today. So that cycle will be 5 to 6 years it will take for enterprises to fully start getting value out of that.
Okay. So how many of the large Indian IT companies will successfully pivot? If there are 10 of them, how many do you think will make it?
I would think that at least a third of them should be extraordinarily successful because of this, because they have made the transition, they have managed to take some bold bets. One of the things that's lacking is, if you're thinking as a services company for a long period of time, you're not invested in AI R&D. You're not invested in any R&D. Your R&D spends are less than 1% of revenue. I would say push that up to 3 or 4%. That would be a good number. So a company that is willing to say, I'll take some short-term hits, I'll increase my R&D spends, I'll talk to the street and convince them that I'm increasing these expenses and reducing my margins for a couple of years, but this is very crucial for my long-term sustenance. I think those companies will succeed, because the terminal value assumption that most of these analysts are talking about these days, that assumption will be revised upwards for these companies. So I think a third of them will do that. And given if the threat becomes larger, more companies will do better, because right now there's still some complacence. Yes, the stock market has punished them, but the companies have not degrown yet as of right now. When that becomes even more real, many more companies will feel the urge.
Frank, just one last question to you from my side, and we'll just take an audience question as well. You are from running a large company, you're an investor now, right? So what would you invest in? What kind of company? And what are the signs to watch? Because you have the inside view, you've got the outside view now.
Yeah, I would go back to the 4 points I made at the beginning, which is, when you look at services companies, I would look at the services companies that have demonstrated the four things that I mentioned at the start. Have they been able to move to effort agnostic commercial models? Are they prioritizing impact over headcount? Have they really invested in IP, to Shrikant's point? And have they changed the talent geometry and moved from that pyramid to the diamond? I know Shrikant questioned that move. I still think that I don't think we're that different in our views. I think you will have to find, even in a diamond model, you will have to find ways to bring people into the industry. I think that'll create new apprentice models for the industry and so on. But I would look for those four things as leading indicators of success. And we've seen it in our portfolio companies. Just to dimension it, one of our businesses, Cyclum, has already been through this J-curve. We've taken this business over about 4 years from being a business that was predominantly a staffing business to now a business that's an AI forward engineering partner. And that transition took about 4 years. We saw, we took it through the J-curve. We observed the J-curve. We measured it. It was a very deliberate transition that we took the business through. And so I think if we can do it at that level with Cyclum, that should be extensible to the industry as a whole.
Wonderful. Fantastic. Let's just take a question or two, gentlemen. If you can pass the mic.
Nilesh, I think you've got a mic.
Hi. There are a lot of implementation of autonomous AI agents nowadays, and specifically when you talk about in the financial sector, as there is no human intervention and there is no specific rules and regulation as of now in international market as well as in India. And on the contrary, when you talk about China, they have already ruled it out that if autonomous AI agent is working in the financial sector, there should be a human intervention. So what is your perspective on implementation of autonomous AI agents, and specifically looking to the financial sector itself? where rules and regulation is scattered completely and human intervention is also in doubt. So how you see in the future?
See, my view on this is that, firstly, I divide all kinds of decision making into three categories: the strategic decisions, tactical decisions, and operational decisions. Operational decisions are high volume, small decisions of types. The types like invest in a stock, for example. If you're a quant trading algorithm, you're investing rapidly in stocks, making 100 decisions every minute, that would be a highly operational decision. Tactical decision, something I take maybe once or twice a week or once or twice a day. And strategic will be one-off large impact decisions. In operational decisions, it's more or less sure that in the next few years, human intervention will go away and humans will only be in the loop to govern, not to make those decisions. So that's what we will see, a large, let's say, adoption of AI agents to do the work, even including investing in stock markets and things like that. In the tactical decisions, yes, it will be AI decisions, but with humans firmly in the loop and having consultation and so on. And in the strategic decisions, one-off high-impact decisions, like doing an M&A and things like that, it will be basically a human decision, but with assistance from AI. So this is how one has to think about that. In each of these three areas, we need to have the right guardrails and a responsible AI framework guiding these decisions so that we don't have catastrophically bad outcomes. But I would predict that we will have a few of these bad outcomes before the rules kick in a big way. Because that's really how it always works. You'll have some incidents, and then we'll all get together and start to create those rules and guardrails. There is a fully evolved responsible AI science out there and methodologies out there. It's just that it's not uniformly implemented across all industries.
Wonderful. I think we can go on. I think there are more questions here, but we're completely out of your time. And as I told the earlier panel, you said this is the first. We're in the early stages of this movie, so we'll do many more of these. Thank you very much, and see you back on this forum again. Frank, thank you very much for joining us, and I really appreciate you releasing that white paper on CNBC TV 18 on this program. Thank you.
Thank you.
Okay, well, we'll take a quick commercial break here and we'll just sort of get to the investing part now, right? What should you do with IT services companies? Where should you make the bets? That's the question. And we have two gentlemen joining us on the other side. We have Sumit from CLSA. He tracks the IT services space there. And we've got a veteran investor, Nilesh of Envision, joining us as well, right here on this forum. Stay tuned. Coming back.
Welcome back. Now, before we get to our third panel and we talk about growth, valuations, stocks, let me quickly contextualize what we've seen in the sector so far. Now, Indian IT stocks are down 40 to 45% from their peak levels. From January alone, 25% gone. TCS is down 47% from the high. Infosys 42, Wipro 45, LTI Mindtree 43. And the trigger was not a bad quarter, not bad earnings, not recession. It was a product launch, Anthropic in February. But now if you zoom out and look at the sector and the kind of growth rates, now FY07 to FY12 was the hyper growth phase. Every sector, the entire sector was riding a structural offshoring wave. 20 to 40% growth became normal. Even the global financial crisis barely dented it beyond a single year. Then came FY13 to FY19, the steady growth. Growth rates moderated to 8 to 15%. It was consistent, predictable, reliable. Margins held, headcount grew, campus hiring became a national event. Then came FY20 to FY23, the COVID cycle, the most dramatic two-year swing that we've seen in the sector's history. FY21 was near flat as clients froze discretionary IT budgets overnight, but FY22, a demand explosion unlike anything that we had seen before. Infosys alone had delivered a 20% organic revenue growth. But then came FY24 to FY26. Slowdown hit. Rate hikes killed discretionary tech budgets. Transformation deals were replaced by cost optimization deal. And then AI triggered another round of compression. And if you look at what the FY27 guidance is telling us, well, HCLTech is talking about a 1.5 to 4.5% growth. Infosys, 1.5 to 3.5. We're basically staring at a fourth consecutive year of anemic growth. Now, the question is, are the valuations today cheap or is it a value trap? TCS and Infosys approximately trading at 15 times forward multiple. The peak valuation multiple for these companies was 30, 32 times. But in the previous disruption cycles, the trough was about 10 to 12 times. Is the market today pricing in a bad cycle? The industry has survived before. Or is it pricing in something it's never had to price before? And how does one price it? I think that's the conversation we're about to have. And joining us today, we've got on panel 3, Nilesh Shah, founder at Envision Capital, and Sumit Jain, senior research analyst at CLSA India.
Well, fantastic context there, Rima. Nilesh and Sumit, great to have both of you here. And you both heard Frank, Srikanth, Phil, Dan before that. To me, you know, the thing which came out, and I think Srikanth made that, he's in the audience here, which is maybe a year, 1.5, 12 to 18 months more, maybe this flux and some more pain. The worst is not over, as he said. And then perhaps things start to pick up and they get better. Nilesh, your thoughts?
Well, I probably think that's a kind of a best case scenario, okay, because that's like expecting quite a lot to happen over the next 4 to 6 quarters. It's like a complete pivot. How do you essentially, you've hundreds and thousands of workforce, how do you reorient, how do you change your DNA of the last 30, 40 years, reorient it, make it relevant? I'm not quite sure if really these companies, these big companies of this size can actually achieve it in the next 4 to 6 quarters. I think the challenge always is that when you pretty much get into a rut and you're really kind of getting disrupted, it becomes very, very difficult to pretty much change yourself. I mean, I'm just saying is, just let's step outside of the world of IT and say, you look at the automobile sector and EVs have been around for a while, but just look at it. The conventional IC vehicles companies have not been able to kind of change themselves, okay? I think the Indian IT services is pretty much staring at a similar situation. Unless they do dramatic restructuring.
But do they have a choice, Nilesh? I mean, it's like a do or die kind of situation. They've got to take it. They've got to leap. Right?
Yeah, but do you have it in you to change yourself? At times you don't have a choice, but it's just sheer inertia. It's like saying, okay, fine, I don't want to kind of take too much of risk. See, the AI thing is not something new. It's obviously, of course, getting talked over for the last few weeks, last few months, but it's been coming. And just keep in mind, let's take a step back. And I think Reena pointed that, she gave a fantastic context. But just look at it. Over the last 3 years, what's been the growth rate of, say, a company like Infosys? 7% in rupee terms. Knock off the currency, you probably had 3% of dollar growth. In an environment where digital transformation has happened, okay, there was a huge opportunity. Despite that, that's the growth rate. And that was not something which was going to basically disrupt IT companies, right? But despite that, that's the growth rate. You kind of take even a slightly longer term outlook and say over the last 10 years, what's been the growth rate? It's been around 10%, give or take 1%. That's it. Knock off again currency, you're looking at a 5% dollar revenue growth. That's the challenge. And I don't know how that's going to change. And we still kind of think of them as growth stocks. That's the challenge. The moment they fall into the value zone or the value category of stocks, I think the lens changes for investors. Then that's a very different proposition.
Power utility stocks are trading more expensive than Infosys now. I mean, NTPC, Power Grid are trading at on trailing basis.
Because markets essentially are a slave of earnings growth. Today, the whole talk is that yes, data centers and everything else is going to drive demand for power. Therefore, power rates could be higher. There is growth rate, all of that. I think that's the challenge. The challenge is not so much about the business model. Yes, business models can change. You've got to reorient yourselves. But ultimately, what markets look for is basically growth. And where's the growth going to come in from? And this has been a challenge which has not been a recent phenomena. It's been a phenomena for the last 5 or 10 years, which has led to a continuous and a consistent derating of the Indian IT sector. And I think that's the big problem.
Sumit, where do you stand? Do you think Indian IT companies can grow fast enough, or will they continue to struggle with this 3, 4, 5% kind of growth, say for the next 3-4 years?
See, I guess near-term visibility is obviously clouded by the AI deflation narrative. But if you look at the broader picture, the IT services spend globally for the last 2.5 decades has been growing at 3 to 4%. Now, I think till pandemic, Indian IT was gaining market share. But post-pandemic, that has not been the case because pandemic was a big reason for scaled practice of global IT service players to be in India, plus the GCC. So to me, the structural headwind for the sector has been GCCs growing much faster in India. For the parent entities in US, Europe, it's an additional outsourcing or offshoring center rather than an IT services company. And then, of course, the Indian IT companies are not gaining market share at the expense of global guys. And I think our narrative around AI has been spun by the stock prices and the valuations. Remember 2023, when the Silicon Valley Bank crisis happened, the whole IT services spend, the discretionary spend in BFSI went through a very bad phase. But then the discovery of NVIDIA led to a rally of entire software and IT services sector just because there was a perception that the second derivative impact of upgrade in hardware and chips will come to software and services guys. What we have seen, it has come to the software guys in form of OpenAI and Anthropic, and rest of the software value chain is getting impacted. But if you look at the numbers, and that's where I fully agree, that earnings growth is what drives the valuations eventually. And if you look at the results from ServiceNow in the SaaS space or SAP, they have maintained their guidance. I mean, absolutely not material change. Now, as far as the AI deflation versus the incremental volume opportunity is concerned, it's a tricky space right now where managements have to be extremely aggressive. And that's where I think we are favoring those names where the managements are going out and signing the deals, willing to pass on the AI deflation or rather the AI productivity to the clients and gain market share, which is where I think the winners and the losers will emerge from every tech cycle. That's what we have seen. So my viewpoint will be the guys who are gaining market share, prefer them. Now, if you remember before the Anthropic and the Palantir comments, which actually spooked the market, the guidance by Cognizant and Capgemini in early part of Feb was actually better than last year. So the overall US macro being better than last year was playing out in the guidance. And if you look at the guidance by Infosys and HCL now, I guess both of them are facing few client-specific challenges where the organic growth seems to be slightly lower than last year. But then if you look at Tech Mahindra or TCS, they might grow faster than last year. So I think it's a situation of haves and have-nots. But yes, you have to implement AI, you have to be aggressive around that and look at the additional volume opportunities. There is significant amount of retooling work that is required in terms of cloud migration, in terms of cybersecurity spends. I think look at Mythos, the kind of news it has created. I think everybody...
So Phil made that point. There seems to be a fair bit of fear-mongering as well. Is it a brilliant marketing strategy by especially Anthropic? Do you agree with that?
I mean, there could be some...
He's not saying it's not happening, but he's saying that it's a brilliant
I mean, they are gunning for IPO later this year.
Yeah.
So you never know, the claims might be over-exaggerated, but they have ARRs to prove. I mean, 3 months back, the ARR was around $9-10 billion, which is now at $25 billion. And they are getting a $350 to $400 billion market valuation. Whereas OpenAI market valuation has gone up beyond $1 trillion. So they have numbers to prove, but yes, I think it is exaggeration to some extent going into the IPO. And I would look at 3 things to make sure IT companies are taking right steps. One is order book, and that have expanded in the current quarter for almost everyone. Second is the revenue per employee, because you have to infuse AI in your delivery solutions, and only revenue per employee would be the key metric. And for most of the IT companies, you can see growth coming in the revenue per employee metric. And last is the profitability, the EBIT margins, because you have to use more either third-party AI tools or your own AI tools. And if there's a higher pass-through element, that can hurt your profitability. We have seen in the last 10 years with cloud and SaaS coming in, your cost of software and hardware expenses have gone up, although that has been offset by improvement in gross margins. So that's where I think for IT companies to reinvent themselves, they have to reskill their employees, make sure they increase the pricing to the clients.
I'll give you an example. Tech Mahindra said in its earnings, part of its earnings, that revenue per employee went up 7%. And we asked them whether they've passed that 7% on to clients, right, which is as savings. And then what does that mean for, so as an analyst, Sumit, what are you really looking for? What will lead you to, are you going to, revenue per employee goes up, but the customer knows that, I mean, you know, you're getting a lot more done with a lot less. So they're going to want that price deflation that we're talking about is going to happen. Is it a good thing, bad thing? As an analyst, how are you treating that?
See, to me, I mean, one part is deflation, how much productivity you are getting in the existing work and how much you have to pass it on. And the second is the hourly billing rates. Actually, the hourly billing rates are actually moving up because you need more skilled employees. And that's where if you look at the hiring strategy by TCS, Infosys at the fresher level, I think the starting salaries used to be pretty low, around 0.4, 0.5 million INR 3 to 5 years back. Now they are hiring it in a staggered way, with the highest salary tag as almost 2 to 2.5 million INR. So they know the importance of being skilled in these latest AI tools. And by the way, if you look at the startup community in Bangalore, a lot of freshers straight out of colleges are starting up these AI startups. So I think it's an interesting space. And coming about the pyramid, again, I mean, if you look at the numbers, I mean, Infosys and these companies publish their pyramid numbers in the sustainability report. And we could see that the fresher hiring, what they have done in the last 2-3 years, that is maintained. 20,000 number for Infosys and 40,000 for TCS. So I guess it's a sort of a environment where you have to be aggressive, pass on the AI productivity, gain more market share, and winners and losers will emerge in the next 1 to 2 years.
Sumit, but even if the revenue per employee goes up, but the overall headcount shrinks more than that, ultimately your revenue is down. So how is that as a useful
Not really,
metric?
Rima. I think that's where I think the sector is reinventing itself to an extent where you have to provide more value to the client. And that's where I think if you look at the average cost per employee for this sector is around 20 to 25 lakhs. And on top of that, you have a 40% gross margin. Now, I believe with the fresher salary increasing, there will be an overall upgradation of your average cost per employee. So you are delivering more to the client with additional tools what you have in hand. And I think Phil made a very interesting comment about services as a software, where if you look at Globant, I mean, they are shifting towards AI pod-based delivery. Sort of $2 billion annual revenue, $20 million comes from the AI pod. So it's just 1%, but they have given a guidance of $100 million to touch by the end of this year. So, that's how under the hood that transformation is happening, where you have to use these AI agents. And by the way, Anthropic and OpenAI will not see those revenue growth unless they don't partner with the system integrators.
Yeah, and they're partnering.
They are partnering, yes.
Nilesh, Srikanth had this prescription, right? Indian IT companies need to invest more in R&D. From the current 1%, maybe increase it to 4-5%. One of the experts spoke about Wipro and that Mindsprint deal. Make these bold bets. And even if it compresses margins in the near term, change the narrative, convince the street. But this could come at the expense of buybacks and dividends that the street is used to. How will the shareholders, the retail participants react? That if companies say that we're increasing R&D spends, we'll be more acquisitive, but we will not give you
Well, that's a tough one, Rima, because unfortunately, public markets are public markets, and I think IT companies are going to be damned either way. Okay, you don't do this pivot, you're essentially going to sacrifice growth. You make this pivot, you're damned for the next 8 quarters, right? So I probably think the street will wait for really the outcomes of these investments into R&D to really take that leap of faith. Okay, so I think you will continue to see that J curve extend itself further downwards. Eventually, yes, between the two options, I agree with what Shrikant says that yes, they need to make this bold bet. And it's high time that they make these bold bets because it's a question of survival, it's a question of sustenance, it's a question of relevance. So I think it's inevitable. But purely from just the way public markets would react to it, I would still think that the public markets essentially would react to it negatively. But I think that should be fine with managements. Managements will have to take a 3-year or 5-year view and not be concerned too much about what happens for the next 3 quarters or 5 quarters.
You see more downside in the sector as a whole?
I think so, because I think the challenge always is that investors always look for relative growth. It's not so much about legacy and entitlement. Just because you're a fantastic company, a great balance sheet, after a point of time, that doesn't mean to value accretion. Value accretion will come from capital efficient growth. And today there are many other sectors which are growing in double digits and have the potential to sustain that. So till investors do not see a double digit growth, I do not see a case where these become very strong long-term investment candidates. Yes, you can have a bounce back and all of that can happen, that you come down to a 12p multiple and you bounce back to a Nifty P of 15 times, something like that. Then that's quite possible. Or if a company gives a guidance of 1% to 4% and a company delivers 3%, and obviously the markets will cheer it temporarily saying, wow, this is at the top end of the guidance. This is fantastic. Okay. But I think
those are just bounces.
After a few quarters, a year, 2 years, 3 years go, and you look back and say, hey, the growth was just 3% or 4% or 5%. Do you want to be in equities for that? Are you in equities to make 3, 4, 5%? Then you're better off being in bank fixed deposits. You're better off being in fixed income. I think that's the challenge. And that's a challenge not just for IT, but that's a challenge for many of the large companies, even in sectors like FMCG and all of that, where there is a bit of disruption which is coming in from relatively smaller players who are not just ambitious, but are way more agile and are demonstrating their ability to grow at a faster pace.
Want to just give us some names, Nivesh? Any names?
In
the smaller players, more agile, more in IT.
So I'll just say within IT, like I'm just saying is the leadership has changed, Prashant. If you look at it earlier, TCS was not even listed in the 90s, but there was Infosys, Wipro. There was pretty much these names stood out. A few years later, it came into companies which are doing a lot more specialized work, okay, in areas like design, ER&D. Sure. So you had names like Tata Elxsi, which came in and ended up being very strong performers. Then came in COVID, and post-COVID, there was digital transformation, and companies which aligned themselves to hyperscalers did phenomenally well, which was companies like Persistent and Coforge. And there's a huge difference, both in terms of their growth rates as well as in terms of their stock price returns. And I'm quite sure you're going to see somebody here. It's still early days, but you will think? It's very hard to say, Prashant, really, right now. Because I'm just saying is, I'm not even too sure whether the world understands what's really going to happen 3 quarters away, 4 quarters away. What are the kind of skill sets required? Who knows? We talk of software as a service. Somebody might just stand up and say, I'm going to now have agents as a service. And here it is. I've created this platform. I have these agents. And here it is. Why do you need hundreds and thousands of people? I have this platform of a few hundred different kinds of agents. And here it is. I'm there.
Sumit, anything which you think one can bet on in terms of your coverage universe or otherwise, which, your investing is about uncertainty. If it was certain, then,
No, of course. So I think companies who are delivering a double-digit earning growth in dollar terms, I guess at least the foreign institutional investors, that's what they care about. Otherwise, S&P 500, ETF funding is good enough. I mean, it's delivering a low double-digit dollar returns.
Do you have any buys on in your coverage universe?
So we have a high conviction outperform on Persistent and Coforge on these two names, where the company managements are quite aggressive. They are winning deal wins. They are acquisitive and willing to take bold bets. So I guess double-digit dollar earning growth is visible in these two names, but of course not in the large cap names. I guess that low to mid single digit growth is the visibility what investors have right now, for which we don't believe the multiples will re-rate in a hurry. At least mid to high single digit dollar revenue growth is required, for which maybe only patient capital can probably invest.
Okay, I think we can maybe open it up for a...
We've got so many questions.
Shrikant, do you want to take a question? As an analyst, a question to the analyst community? Anything?
I want to ask about, you said damned if they do and damned if they don't, if they invest in innovation or not. So if you are a CEO of a big tech services company today, what would you do? How would you transform in a way that you think the street will buy into the narrative?
So the way I would probably think about this, Shrikant, is that I would look at that within my company, what are the kind of capabilities which have a chance to essentially help me to become relevant? And I'd probably take on what you have said and maybe what the other speaker also said, is look around for competencies around data, analytics, engineering, and IP. So there's, and I'm sure every company, every IT services companies has these pockets which are meaningful, which have capabilities around these four broad areas. I think I would probably position these pockets basically to create capabilities around AI and to kind of make themselves relevant. And if required, if I need to essentially demerge these pockets and create a separate identity, get them separately listed, let them do what they want to do, but they're not bound by the walls of the conventional IT services companies, I think I would have a better chance at winning this game versus essentially a status quo, or trying to basically reorient the entire firm of a few 100,000 employees. That I think is a non-starter. Versus that, I'd say, okay, fine, within my 200,000 people, what is that bucket of 2,000, 4,000, 5,000 people who essentially are focused on these 3 or 4 broad areas, which is data, analytics, engineering, and IP. And probably just kind of carve that out separately, demerge it, get it listed separately, and do it.
Nilesh is saying stand up, make a lot of noise, and do it, basically, right? I mean, you got to be bold and be seen to be bold as well.
Just give an example. I mean, and I go back to the example of automobiles, right? We've had companies like Tata Motors and Mahindra, and then there was Maruti, right? And you just look at it, I think, and it's known, like, who made themselves more future ready in the world of electric vehicles, right? Versus Maruti, it was Tata Motors and Mahindra. And look at the outcome. And flashback 5 years, 7 years back, and you would say, who actually could succeed? And I think the answer would have been, it would be Suzuki, Maruti, because Suzuki knows what's happening globally, right? But who it was? It ended up being domestic players, Tata Motors and Mahindra, who, I mean, Mahindra didn't even have, right, the vehicles.
Let me, a couple more questions, quickly, please, please.
One question from me for both Sumit and Nilesh. Sumit, when you analyze IT services, you made a very good comment about service as a product. And we had a discussion about J-curve by Frank. So are you looking at any companies that have potential to transition over a period of time from offering services to offering many of the software as products that define that particular enterprise, as Shrikant also mentioned earlier? And to Nilesh,
one question, please. We'll take one more. Sumit, please go on.
I guess it's too early to call out because it's a very small proportion of the overall business. But I guess, as you know, we need to look at the capability of the IP platform they have created. I mean, we were doing some channel checks, and we came to know that IBM has launched an internal IP around coding rather than using Anthropic and OpenAI. And obviously, you can start charging to your clients based on service as a software in terms of how much tokens are consumed on that internal IP. So it's still pretty early. I mean, these companies are reporting Gen AI revenues, 5 to 7% of the overall revenue, growing at almost 20-30% CAGR. So, but yeah, I think it's difficult to address that question because the disclosures are quite limited.
One more question there.
Sumit, this question is for you. That you had rightly mentioned that the companies like Capgemini, HCL, they are very well on paper, on balance sheet, they are putting good numbers. But at the same time, if I look at the data of the trade from the FI end, they are selling huge IT sector. In February alone, they have sold out 17,000 crore rupees.
Question, please.
Right.
Question.
So what exactly we can do to make FI come back to Indian market?
No, I guess innovation and R&D spends, I think as Shrikant mentioned, I think that's what the overall IT sector has to do. And I guess there, we have this AI capability framework where we analyze what kind of competencies hyperscalers and SaaS companies who are the real innovators, how are they partnering with the system integrators? I mean, the growth is coming to the hardware supply chain right now. How are you growing along with them by creating solutions around it? That's what will define your growth.
Yeah.
So that's the bottom line.
I know we have more questions. We're completely out of time,
I also have more questions.
We all have more questions. I guess we have more questions than answers at this point. Maybe that's the way to put it. But Nilesh and Sumit, thank you very much for joining us here. And a big thank you to the audience for being such a wonderful audience. Shrikant, thank you very much for being such a sport and staying with us throughout and all your insights. Thank you very much for being with us here. I think we're going to wrap up, but it's a promise, Rima, that this is, I think as Shrikant put it, this is the first innings in a long movie. So we'll do many more of these with all of you here and, of course, some of the experts here on the program as well. So thank you very much for staying with us. This is the first of many. Thank you for being here. We will take a quick commercial break. Programming continues on CNBC TV 18 on the other side.
Hello and welcome to On the Record with me, Shriram Finance. It's been a big year for banking. We've seen a lot of deals take place, but it's also a difficult environment that the banking sector finds itself in as the war in West Asia continues to rage on. It is taking a toll and an impact on investment decisions. For HSBC in India, it has been a strong year. They've grown both as far as profits are concerned and, of course, improved on operational efficiency, and doing that all with great provisioning. Joining us now to talk about the road ahead is HSBC's Hitendra Dave. Hitendra, always a pleasure. Many thanks for joining us here on CNBC TV 18. You know, before I talk to you about all things HSBC, we've just seen the news coming in from the RBI, so let me address that. And for the benefit of our viewers who are just tuning in, this is what the RBI has done. It has withdrawn the circular that it had issued on the 1st of April, which was ostensibly to try and stabilize the depreciation of the rupee. Now, what the RBI has done today is that corporates can now rebook cancelled hedge contracts. This had been disallowed in the April 1 circular. Banks can quote and offer corporate hedges in the offshore market. Of course, the overall cap of 100 million still remains. Let's start by what the impact and the implications will be of the relaxations that the RBI has now announced.
First of all, thank you, Shireen. Always good to be speaking to you. No, I think the governor said it in his post-policy press conference, where he was asked about these measures, that unusual times, unusual volatility, the Indian rupee perhaps moving almost singularly. On days where the rest of the pack was weakening, we were weakening. On the days where the rest of the pack was not weakening, but we were still weakening. And, you know, their analysis, their data suggested that if they were to put some wedge between the onshore markets and the offshore markets, it could help. And the data would seem to suggest it has at least helped calm some nerves out there, because, you know, as we all know, currencies can be, you know, you can just get into your own self-created spiral a little bit, and therefore, if the market regulator feels that that spiral needs to be broken, I think they've broken it. But I think they had clarified that it is to address an unusual circumstance, and today's withdrawal of the April 1 circular would seem to suggest that hopefully this is the first of the overall withdrawal that they will do, so that the market liquidity, the access of corporates, access of banks, and access of all stakeholders in India and outside India to a deeper and more liquid market goes back.
But do you believe that today's relaxations are on account of the fact that the rupee has stabilized somewhat, and that's given the RBI the comfort to take this decision? Or do you believe that it is because of feedback coming in from stakeholders? And we've seen that many have been saying that this was perhaps a little too harsh, maybe almost sledgehammer-like. Which of the two do you believe could have been the reason behind today's move?
Well, I think it will be a mix of both. Yes, there was feedback. I think the central bank immediately after the circular and in the days that have followed has been in constant touch with the market. And I think even while wanting to achieve the regulatory objective of you know, putting a curb on speculative positions or very large positions, in the process, when you come out with a circular like that, even bona fide transactions could also get curtailed. There were also a situation where a lot of us had deals out with our own counterparties.
So it was impacting you?
No, I think it was just making it more cumbersome to unwind those transactions, and which is what they have. So they have taken away some of those things which remove the cumberness, which remove the friction without adding to the demand for dollars just through this process, is my sense.
Okay.
So I think it will be a mix of both feedback as well as the desire to be a opening of the market slowly.
But, you know, on the back of what we've already seen the RBI do and today's decision and the move that we've seen in the currency market, what's the outlook now as far as the currency is concerned?
Yes, so I think remove these circulars and the last 2 weeks because ultimately in the long run, any asset, any currency is a function of demand and supply. You can put a halt to temporary demand, which is what these measures did. You can add some supply through some other measures. We are reading about OMC's demand having been taken out of the market or whatever. But ultimately, I think the currency was weakening not just in the month of March. March was accelerated, but through the last many, many months. And that I think most people think partly was caused by this persistent selling in the stock market by FPIs, which was almost a, on a good day, $100 million, on a good day, almost going up to $500, $600, $700 million. And it was almost daily, right? So, and that demand had to be met in the market. Usually you would meet that demand through either FDI coming in.
Yeah.
Now we all know that the net FDI number is turning out to be relatively insignificant, while the gross numbers are relatively unchanged and healthy, but the outflow has taken away the impact from a currency perspective. Yeah. And I think the third thing, which is more technical, is that because there was a like I said, currency was in a self-fulfilling cycle of expectations, which caused exporters to hold back dollar supplies and importers to accelerate dollar demand. So this combination has to be, one of the three of these has to break, or two of the three of these, or three of the three of these have to break for the currency to fundamentally change its direction. We are seeing early signs of FPI selling tapering off. I mean, just let's not make too much of 1 week, but it looks like at least, and you hear from experts that perhaps in any case we are coming towards the end of that because of valuations or whatever. So yes, you would expect currency to be more range bound than it was, but the bias for slow weakness will change only when either the FPIs come back, or you have gross FDI, and the exporter-importer narrative will follow these two, as opposed to lead these two.
So let's address both the FPI as well as the FDI issue. And, it could be a function of valuations. It could also be a function as far as the currency is concerned that FPIs will consider in the midst of a whole host of other factors. But do you believe that we could perhaps have seen the bottom, the worst as far as the FPI selling is concerned? What do you think could turn sentiment?
Well, the best way to turn sentiment is to report good growth in earnings, right? I mean, if you show good growth in earnings, the kind of earnings growth that historically India has delivered, mid-teens and above, why would people not come back? Because India offers one of the most broadest markets in the world, right? Domestic market economy, IT economy, consumer economy, a very thriving financial services sector, infrastructure sector, real estate sector. You don't get too many markets in emerging markets that have this broad a range. And that's what has attracted FPIs over the years to India. So you really want this to change? I think track earnings. The moment you see earnings growth breaking out of the last 15, 18 months of, high single digit, low double digit kind of numbers, it'll come back. Or we need FDI. I think FDI, because it's much more stable, much more predictable. We need a couple of sectors here where global boards start feeling a FOMO, right? We have to create a sense of FOMO about our market.
So which could those sectors be where between the government and all other stakeholders, in your words, we can create FOMO?
No, we've seen, like you mentioned in your opening comments, right? We've seen significant FDI in the broader financial services sector. We have seen significant money coming into NBFCs, significant money coming into banks, exactly. And it's not over yet, right? I mean, there are other banks which are still in the process of being identified for appropriate buyers or suitors. So in the financial services sector, yes. I think everyone thinks the next round of growth for India has to come from manufacturing, whether manufacturing for the domestic consumer base or manufacturing for the world, and especially with all these FTAs being signed with the UK, with EU, let's see what happens with the US tariff agreement. So I think it's very difficult to say this sector will drive, but you can sense that last 15 to 18 months, both people in the policy making circles, people in the business circles, I think are looking for that one thing to create that sense of excitement for international investors.
But speaking of sentiment at this point in time, as I pointed out, the war in West Asia continues. We don't know how quickly this will be resolved or whether this is going to continue to be a protracted battle. How is this starting to impact boardroom decisions? Are people now saying, look, let's wait it out, let's wait to see how this settles and then make fresh moves? Or are they saying, let's get on with things because we don't know how this is going to end?
I think there'll be two types. One is if there are strategic markets, right? I mean, you will continue to invest in that strategic market and see through this war situation, because you don't go into a market, commit lots of money, and then because of this you withdraw or you stop investing. That's not how real money or serious money considers itself, right? If you haven't made that commitment, would you go a little slow? Yes, possibly yes. But my own sense is, and our own surveys seem to suggest that, over the last 7, 8, 9 years, the world has got so used to such unusual periods. COVID was perhaps even more unusual than what we are living through. Then we had the tariff-related uncertainty for most of last year, and then we have, the Iran-US conflict out there. I think most boardrooms have become a little tougher on that side. That if we stop at every news flow, at every event,
we're not going to get anything done.
We are not going to get anything done. So I think at least our surveys, our research, our conversations seem to suggest that the world is not going to put things on pause. They might look for higher returns, purely because some of the risks have now surfaced. And now that the risks have surfaced, you want that appropriately captured in the return metrics.
So how do you think India finds itself positioned at this point in time? If you look at what's happening in some of the other high growth markets or high growth regions, they have been very directly impacted by the West Asia conflict. So do you believe India stands at an advantage today on account of that? Or do you believe that, because of the supply chain disruptions, because of the uncertainty, etc., the risks, even for India, have gone up and will then be factored into these investments decisions?
So, Shireen, I think it's almost impossible to say risks have not gone up for any part of the world. I mean, there will be some countries here, there, which might even be beneficiaries of the development since the end of February or so. But overall, global risks have gone up, and that's what is reflected in so many measures of risk. That said, in the context of India, see, why do people come to India? That hasn't changed. Okay, they come to India because we have a large domestic market. They come to India because, by and large, law and order is very acceptable compared to countries at our levels of income. They come to India because of the soft power that India wields in terms of the number of engineers we have, the number of doctors we have, the number of nurses we have, etc. They also come to India because of the talent in if I can call it, modern economy, like IT and potentially AI, etc. Right? So that hasn't changed. And I would say that at the margin, because it's impossible to recreate an economy with 1.4 billion people, or to create all the other factors that I've listed, right? At the margin, you are slightly better off. You are worse off than where you were 6 months back or so. But at the because there are so many economies which have much bigger problems. We have a problem. Our fisc is definitely going to be much more challenged than what we thought when the budget was presented. Our trade deficit or current account deficit likely to be more challenged also. But that's a 1 year, 2 year challenge. It is not that you are permanently looking at India now going back to some high inflation, high fiscal deficit, high current account deficit kind of days. So I would actually say time is for us to somehow or the other make use of this period. I know it sounds almost too difficult to rose tinted or whatever, but we will need to do this because the country does need the FDI too. As I mentioned in the previous question, So
and that's what I want to double down on. What can be done to use this crisis? I mean, as they say, never waste a crisis. Yes. What can be done to use this crisis? We've seen, for instance, the government amend Press Note 3, making it easy for FDI to come in from China. Any tangible next steps that you believe we could look at?
I think, and I'm sure the government is working on it, but the amount of so-called reforms that the government has done is actually not if you put it together, it's quite substantial, right? I mean, on electricity availability, prices, it's very different to what it was 5 years back. On central government approvals, even if single window has not worked properly, but just the competition among states for high-profile businesses, high-profile sectors definitely is much easier. You look at what's happened to commercial real estate, right? Real estate.
Yeah.
The largest owners of real estate, which 20 years back nobody would have thought of any foreigner will ever touch, are foreigners. The top 3 owners of real estate in the country are foreigners. So there is a lot which has been done. I think the last 2-3 bits, or maybe the one most important bit would be land. It is still a difficult thing, and it doesn't fall in the central bucket, it's in the last. So I think land availability and creating infrastructure around it, and then just I would suggest, take 10 marquee projects. Just run them in whatever they choose to do. Just run those and show the world that you can build a steel factory, whatever you want, automobile factory, or electronics gadget manufacturing, and really, really showcase those. And that creates a little bit of the FOMO that I spoke about.
Let's talk about HSBC's plans for India. You've come off a great year, strong profitability, expansion as well. You've got the clearance for 20 new branches. You've done 5 already. Take me through what it's looking like now for the year ahead as far as HSBC is concerned, and the aspiration of being in the top 5.
Yeah, so I think, so thank you for the comments. Please play the headline like that.
Which headline do you want?
No, I think we think we can add a lot of value to the Global Indian. That Global Indian is a company, Global India is a partnership firm, Global India is a mega corporate of Indian origin which wants to go abroad, make acquisitions abroad, trade with the rest of the world, source from the rest of the world, sell to the rest of the world, or could be mega companies outside India, or who want to come to India, the commercial real estate we spoke about, or the healthcare we spoke about, and many, many other ways. It could also be the Indian diaspora wanting to come back to India or buy a house, send their kids back, or it could be Indians wanting to send their kids abroad or start a nest egg abroad or something. So that's our principle. We want to be the global bank of India. Okay. In the process, will we do some business for people who have business? Of course we do, and we do very, very substantial amount of that. The second thing is we can really, really help young companies. So we are the only bank possibly which has a dedicated innovation bank. I think we are already committed about $1 billion. These are companies which are owned by typically venture capital funds, etc. So very, very early stage young companies. The third area is trade. HSBC is the world's largest, and if I may say so myself, we are the best trade bank in the world as well. And what we help people with, I think our customers do realize that, and that's why we get disproportionate, because we are able to also tell them what is the credit risk of a counterparty, which very few other banks can around the world or something. So, and in the wealth space, as you mentioned, I think we are experiencing significant growth. I think maybe it's the data is not publicly disclosed, but if you want to search up which credit card spend has been fastest growing in the last 3 years, I won't stop you from doing so, as long as it's part of the headline. So, and even our Premier, which is our go-to top brand, I think is growing faster than it ever has. Our CASA is growing at a healthy pace. So it is all looking good. Like I keep saying, I think with all this combination,
Fourth quarter revenue rises 6% and food delivery orders rise 19%. Quick commerce orders see a sharp surge of 95%. Management expects the first quarter of this fiscal to be meaningfully stronger.
Venture capital firm Peak 15 exits MobiKwik in a 130 crore rupee block deal, manages to triple its initial investment in the fintech company. With this, all private equity players have exited MobiKwik. Shares rally after RBI grants NBFC license.
Snabit has raised $56 million in its Series D funding round. This is the firm's fourth fundraise in 15 months, with valuations jumping over 2x since Series C round 5 months ago. The firm's top micro markets now exceed 1,500 daily jobs, while burn per order has declined by 50% over the past 6 months.
Wellness brand Badam India has reported 350 crore rupees in revenue for FY26, registering a 31% year-on-year growth while maintaining profitability for the second consecutive year. The company is now on track to achieve a 500 crore rupee run rate in FY27.
Google has signed a deal with the U.S. Department of Defense to use its artificial intelligence models for classified work, the information reported. The agreement allows the Pentagon to use Google's AI for any lawful government purpose, putting it alongside OpenAI and Elon Musk's xAI. Those were the headlines that we're tracking for you this evening, but let's go to the top story today. The maker of one of India's most iconic biscuits, Parle-G, is eyeing a Dalal Street debut. Sources tell CNBC TV 18 that Parle Products has initiated conversations with at least 5 investment banks for a potential initial public offering. Rachna Dhanrajani joins us now with all of those details. Rachna, what are you picking up?
Well, India's most beloved biscuit brand may be heading to Dalal Street. That's what we're learning from our sources, because our sources have said that Parle Products, the parent company and the maker of Parle-G, has initiated conversations with at least 5 investment banks for a potential initial public offering. These banks include Axis Bank, Kotak, and JM Financial for now, and formal pitches are expected somewhere in mid-May to move forward. Now, here's what makes this transaction even more interesting. The IPO, if it goes through, is expected to be entirely secondary in nature. No primary infusion is expected. So the money raised through an IPO will directly go to the Chauhan family. Now, this would also mean that the promoters will be selling stake in this OFS. Now, the company has been 100% promoter-led since its formation, which was in the 1950. We did reach out to Parle Products, and in their comment, they said, and I quote, that we are focused on running and growing the business. Such opportunities come through advisors to create value. So there's nothing as of now, but they did not deny this either. So to put the scale of this IPO, the potential IPO that we're looking at just in perspective, is that Parle Products posted a revenue of about 16,000 crore rupees in FY25. Compare that to the rival Britannia Industries, which had somewhere about 17,000 crore rupees. Now, this IPO, if it moves forward, will put 2 biggest biscuit makers in direct competition with each other in the public market. So it will be an interesting one to watch out for because it will be Parle-G, and Britannia's already there, like I said. So that's what we're learning for now. We will keep an eye out for more details and updates on this story.
Thank you, Rachna, for those details. Appreciate you joining us. Moving on, also on what's brewing, quick home services platform Snabit has raised $56 million in a fresh Series D round, doubling its valuation in 6 months and taking total capital raised to $112 million. But this isn't just about growth. The company says it marks a pivot from rapid expansion to building a more efficient, deeply local and scalable model. With over 40,000 daily jobs, 1 million monthly orders and a network of 15,000 plus service professionals, Snabit is doubling down on hyperlocal density, stronger unit economics and high-frequency use cases to power its next phase of scale. Joining me now is Ayush Agarwal, the founder and CEO of Snabit. Ayush, welcome back to Startup Street. $56 million in fresh capital. This is your 4th fundraise in 15 months and a 2x jump in valuation in just 6 months. Ayush, can you confirm whether Snabit is now valued at $360 million or higher, and what's driving this level of investor conviction?
So yeah, thanks for having me. We're currently valued at roughly around 400 million as of this round. And the fact that we've been able to raise such a large amount of capital in a relatively short period of time reflects the conviction that the investors at large have on this category. And the reason behind it is that we're basically digitizing one of the last urban offline habits in consumer internet. For most of the high frequency use cases that we may have, there are one or two mobile applications that we all look at. But as far as high frequency services are concerned, that's a really large segment which has not seen any disruption in the last couple of decades, something that Snapit has been driving over the last couple of years. And that's basically the reason why we're seeing this amount of investor interest.
All right, so $400 million in valuation. Ayush, you've said that this round marks a shift from category creation to category dominance. What changes operationally? Which levers are you tightening to improve unit economics? You've cut burn per order by 50% even as you scale. So what's driving that and how sustainable is it?
So yeah, in the last couple of years, obviously the first year was spent in just understanding and building this category out to a point where enough number of consumers take notice and understand the value it provides. That obviously is now behind us. For us to get from a million jobs monthly to a million jobs daily is going to be a trajectory where we will be more mindful of the capital that we have. Sure. We think this fundraiser is more of a mandate than a milestone, and that we need to deeply think about capital allocation, looking at every nano market, every pin code, and making sure that mature micro markets are now turning profitable, whereas more and more investments are now geared towards launching new micro markets and other categories.
Sure. You know, Ayush, your model is built on micro-market depth rather than broad expansion. You've scaled from 400 to 40,000 daily jobs in under a year, a 100x jump. You're now targeting 1 million daily jobs. What does the path to scale look like? And with $112 million raised till date, how are you thinking about capital allocation and runway from here?
So yeah, I think, see, for every, we basically, 6 months back, we had roughly 10 micro markets. Today, we have 140 micro markets, which means that for every one mature micro market, we have 14 new micro markets, right? So the mature micro markets, which are fewer in number, are actually beginning to give us more than 1,000 jobs daily. And as we progress, the 140 micro markets we have will also start following the same trajectory. So it's all about more and more mature markets, which actually help us drive more and more density and increase the overall job base. Even if you think about the top 10 cities in the country, that's roughly 500 micro markets, which gives us a very, very large pool to expand into 1 million daily jobs, which is our objective.
You know, picking up from what you just said, Ayush, your top micro markets are already clocking over 1,000, 1,500 daily jobs. What does a mature micro market look like for you in terms of profitability and retention, and any revenue targets that you can share with us?
So honestly, we're very positively surprised by the depth of even mature micro markets, which continue to grow at an astounding pace, even after the fact that, they're 1 year old. The way we look at it is that our retention cohorts seem to flatline after 30 days, which is something that holds true for most of the consumer cohorts. And as far as looking at profitability is concerned, we basically want to keep investing in customer acquisition and start making profits from customers that we've already acquired and are now generating, more and more jobs for us.
All right, so you haven't given me a number, but Ayush, you started with core home services, but are now expanding into categories like home cooks. Do you see Snapit evolving into a broader home operating system? And also your workforce of 15,000 plus experts is entirely women. How central is that to your brand and business model?
Home services is basically the second largest wallet share category for roughly 100 million Indian households. And when we look at that, house help is just a single category within that, one of the larger ones. So we definitely think that with the advantage we have of having acquired these customers and gotten them used to high frequency services, a lot more potential beyond house help. Home cooks, for example, is the second category that we piloted with reasonable success and are now scaling it up in Bangalore. And as far as the experts are concerned, we think that we will continue to index heavily on women experts with the first two categories, but as we expand, we might foray into a hybrid fleet as well.
Okay. Ayush, you're targeting a $60 billion market that's still largely unorganized. What will it take to formalize and digitize this demand? And how aggressively will you expand into new cities versus deepening your presence in existing ones?
So we think that the $60 billion that we're talking about in terms of this category is actually $100 billion if you project it 5 years out. So obviously it will take massive execution from the team at Snapit to make sure that the category that we've created, we continue to do well in scaling this beyond just the initial traction that we've seen. And we're very, very, very excited about the journey in that respect.
All right. On that note, it's time for me to wrap up our conversation. Many thanks, Ayush, for joining us on Startup Street, and wish you the very best for all your aggressive growth plans.
Thank you so much. Thanks a lot.
And moving on, Stitch is stepping out of stealth with a bold bet on transforming one of fashion's most overlooked layers, fabric. The AI-native platform has raised $5.5 million from Omnivore and K Capital as it looks to sort of rewire how textiles are designed, developed and delivered at scale. At a time when global brands are under pressure to balance speed, cost and sustainability, Stitch is using AI to drive fabric innovation while optimizing manufacturing across Asia. With an order book already crossing $15 million and clients spanning the US, Europe and India, the company is positioning itself at the heart of the next wave of textile disruption. Joining me now to discuss this further is Narahari Payala, the co-founder and CEO of Stitch. Narahari, thank you so much for taking time out and being here with us on Startup Street. You know, you are sort of building in a part of the fashion value chain that's largely been ignored by tech, right? Which is fabric R&D and manufacturing. What did you sort of see broken in this back-end layer that made you believe that this is where AI can create the most value?
So if you see fabric, Arundhati, it's a sequence of what fiber you select and a bunch of mechanical and chemical treatments that you have to do on top of it. So there is thousands and thousands of line items of data that is already available with multiple mills across the country. And I come from a Zetwork background where I was heading a $500 million business in textiles. So we have seen and developed multiple new formulations and new recipes back then. Once we started Stitch, we wanted to kind of gather all the data and put AI, create a model, what we call as Fabric GPT, to understand the linkages between what is the process that would deliver a particular output attribute of a fabric. So fundamentally, fundamentally, fabric is the main ingredient. Basically, 70% of the cost of a garment is basically fabric, and sustainability is one larger problem. Basically, time to time, basically, we want to kind of create whatever is selling well in a global market, recreate a particular fabric here, and continuously increase the share of sustainable fiber into the fabric.
Absolutely. You know, you've raised this. We'll discuss the sustainable fabric and the manufacturing a little more in detail. But before that, you've raised this $5.5 million that you've got from Omnivore and K Capital, right? You've just come out of stealth. So what are the key milestones you're targeting over the next 12 to 18 months with this fundraise? Is it scaling, expansion, or building out your manufacturing network?
So three specific targets that we have. One is to build our AI architecture and gather a lot of data and build the Fabric GPT as a product. Number two is to set up a couple of R&D labs in India. And number three is we are currently active in UK and Europe, and we want to expand to US as well.
All right, active in UK and Europe, and you want to expand to the US. Your AI engine is currently working across both fabric innovation and supply chain optimization, right? For a global brand, what fundamentally changes when they work with Stitch, and how is this meaningfully different from traditional textile sourcing models?
So if you are a global brand, I'll come to you and say that, so there are two things. One is our AI agent, which scans through your category and tell you what designs are selling well and what fabrics are selling well. So I come to you by saying, okay, this is been selling well last month, and I have exact replica of the same fabric made out of India. And I would be presenting a bunch of fabrics to you every month. That way, first step is basically recreating a top performing fabric. Second step is basically to increase the share of sustainable fiber into that. By increasing the share of sustainable fiber, if you can get the same touch and feel and recreate the same fabric, that's like an upgrade to you're getting the same fabric, which is more sustainable. So if you go to any other manufacturer, you'll have to first work with mills and give a lot of inputs to create a fabric, and then go to factory and ask them to make garments. But here we are, who are coming to -1 step, where we are saying that what is selling well, what fabrics are selling well, and also showing you on day -1 itself that the replicas of those fabrics.
Sure. And, you've come out of stealth with an order book already exceeding $15 million and clients across, US, Europe and India, right? So what's driving this early traction, and how much of it is repeat demand versus new client acquisition?
100% of it is repeat, Arundhati. So we, as I told you, we were basically, both me and my co-founder Asim were heading a very large business, $500 million business in textiles in Zedwork, where we had customers across US, Europe, and UK, and suppliers across India and Bangladesh and China. So most of these relationships and network is already there. So that kind of worked in our favor to get a very large order book. There is a trust in terms of our capability and the past experience.
All right. And can you give us a sense of the type of clients that you're working with and how you plan to grow your client base even further?
Yeah, so we work with multiple global brands, including Shein, Roman, Dusk, and multiple Indian brands as well. And we fundamentally want to kind of increase the new fabric varieties that we offer to the market and just present it to more and more customers across. Across our network first, and get them on board first. That itself is a large list.
All right. And you were talking about sustainability, right? Sustainability mandates have tightened globally and supply chains are shifting towards Asia. So how big is the opportunity for an AI native textile-led platform like yours? And why is this sort of the right moment to build it out of India?
So very large market, right? Textile is a $900 billion market, growing at 8% year on year. And so using AI to create a textile scientist is something which can be done effectively or which comes naturally to an ecosystem like China and India, because this is where all the manufacturing happens. And entire market, if possible, if you see the fashion pyramid, everyone except the budget brand and probably fast fashion brand would want to become sustainable, right? If I can match the performance of a synthetic using more biodegradable agri-waste based fibers, then any brand would want to kind of use that.
Sure.
About more than half of that market of that $900 billion would want to become sustainable, given a chance, given the performance parameters are met.
All right. All right, Narahari, thank you so much for taking time out and being here with us on Startup Street. And we wish you all the best on this new journey going forward.
Thank you so much.
Well, with that, it's time for us to head into a short break. But coming up, MobiKwik gets approval from the Reserve Bank of India for an NBFC license. We speak to co-founder Upasna Taku on the other side. Stay tuned.
Well, fintech company One MobiKwik Systems has received the Reserve Bank of India's approval for an NBFC license. Now, this is going to allow MobiKwik to launch a new lending division, which they'll call MobiKwik Financial Services Private Limited, which will be a wholly owned subsidiary, and that will help expand their regulated lending capabilities. Now, the fintech also said this is going to enable it to launch new products with faster go-to-market offerings, both secured and unsecured, to consumers, MSMEs, and the core focus will remain on Tier 2 and Tier 3 cities. The NBFC is going to start operations once it gets the certificate of registration from the RBI. Joining me now is Upasana Thakur, Executive Director, Co-founder and CFO of MobiKwik, for more on this interesting development. Upasana, firstly, congratulations on getting this NBFC license. You say under 4 months. Start by telling us, one, what your aspiration for this NBFC arm is, and two, historically, we've seen fintechs prefer the asset-light lending partnership model over owning an NBFC because of capital efficiency. So what made you get this license and why now?
I think that first off, you're right. Most companies would like to be in an asset-light model, and I want to reiterate, we want to continue to operate in that manner. However, we do believe that in order to deepen our presence in offering financial products to our users, we kind of felt that we needed a vehicle which gave us credibility, gave us the opportunity to connect with more banks and NBFCs as partners to operate in a co-lending model, which is also fairly similar to the digital lending LSP model. And also allows us the capability to innovate on product and distribution directly as well. So I think the thesis was very simple. We were coming along in our journey of enabling digital payments and distribution of credit and investment products. But we did find some gaps. And to close those gaps, we thought that having an in-house NBFC would help us build.
Well, Upasana, briefly, you're still awaiting the final certificate of registration from RBI before you can start these NBFC operations. What are the conditions that are attached with this for you to fulfill? And what is the realistic timeline for the NBFC to go live?
See, it's but natural. As you know, MobiKwik already has the PPI wallet license, the Bharat Bill payment license, and the payment aggregator online, and the stockbroking license from SEBI. In all of the license processes, first you apply, then you get an application approved, and then you have to do certain amount of steps in order to operationalize the entity before you can go to any regulator and ask for the final certificate of registration. So for example, in this entity, which is MobiKwik Financial Services Private Limited, which is a wholly owned subsidiary in the MobiKwik group, where we had made the application is approved. Now we will have to do certain procedural things for which we have to seek board and shareholder resolutions. It is but natural that we have to infuse capital, we have to infuse resources and build the baseline, tech capabilities before we can go to the regulator and say that now we are ready and please grant us the final COR. That is typically how it works. And I can imagine that, it will take us a few months to get this done. Anywhere from 2 to 4 months, is my best estimate that we will be able to complete all of these steps and, seek for the final COR, and post which we will be able to start lending.
Okay, so 2 to 4 months is the realistic timeline. Now, let me ask you this. Over the short to medium term, how large a loan book do you want to build under this NBFC? And you said you will continue with your partnership for distribution as well. So what will be the share of lending through co-originated loans via what you'll do, on your balance sheet through this NBFC?
It is all very fresh for us. We have just received the application approval. So I'm not sure whether I can give you a definitive number. And one should also assume that in the first year of operations, any new entity that is getting started, and you want to set the foundation right in every way, from a tech perspective, from a procedure and systems processes and a people perspective. So, I will not set a very high benchmark in terms of what percentage of the business we would want to do via the NBFC. But yeah, over a 2-year, 3-year period, we can think of, a significant scale up. We don't have any such definitive numbers to give yet. Firstly, in order to do anything, first we need to infuse substantial, capital in the company and set the team in this company. And since we've literally gotten this today, it will take us some time to achieve that.
You've said in your statement that this new NBFC is going to allow you to launch new products with faster go-to-market. Could you at least tell us, when you start this NBFC in 2 to 4 months, what are the products or what are the segments you're going to focus on, and what will primarily be the focus area? I mean, in unsecured, are you going to look at vehicle? Are you going to look at housing? What are the segments?
See, we already have a very large user base in terms of more than 186 million customers and also merchants, about 5 million merchants. So our first go-to plan will be to serve them only. And to that extent, merchant loans and consumer loans is what we will, go into. When it comes to secured and unsecured, we are already distributing products like loan against mutual fund, in partnership with certain other players. So products, whether they are secured or unsecured, their first, the first customers we will target will be the customers who are already, MobiKwik customers and are looking for loan products on our platform, but we are not able to serve them. So that will be our first, go-to.
All right, Upasana, we leave it at that. Thank you very much for your time here on the show today. Always a pleasure having you, and congratulations again on getting that NBFC license. We look forward to tracking your journey.
Thank you, Ritu. Thanks so much for having me.
Hello and welcome to On the Record with me, Shriram Finance. It's been a big year for banking. We've seen a lot of deals take place, but it's also a difficult environment that the banking sector finds itself in as the war in West Asia continues to rage on. It is taking a toll and an impact on investment decisions. For HSBC in India, it has been a strong year. They've grown both as far as profits are concerned and, of course, improved on operational efficiency, and doing that all with great provisioning. Joining us now to talk about the road ahead is HSBC's Hitendra Dave. Hitendra, always a pleasure. Many thanks for joining us here on CNBC TV 18. Before I talk to you about all things HSBC, we've just seen the news coming in from the RBI, so let me address that. And for the benefit of our viewers who are just tuning in, this is what the RBI has done. It has withdrawn the circular that it had issued on the 1st of April, which was ostensibly to try and stabilize the depreciation of the rupee. Now, what the RBI has done today is that corporates can now rebook cancelled hedge contracts. This had been disallowed in the April 1 circular. Banks can quote and offer corporate hedges in the offshore market. Of course, the overall cap of 100 million still remains. Let's start by what the impact and the implications will be of the relaxations that the RBI has now announced.
First of all, thank you, Shireen. Always good to be speaking to you. No, I think the governor said it in his post-policy press conference where he was asked about these measures, that unusual times, unusual volatility, the Indian rupee perhaps moving almost singularly. On days where the rest of the pack was weakening, we were weakening. On the days where the rest of the pack was not weakening, but we were still weakening. And their analysis, their data suggested that if they were to put some wedge between the onshore markets and the offshore markets, it could help, and the data would seem to suggest it has at least helped calm some nerves out there, because as we all know, currencies can be, you can just get into your own self-created spiral a little bit, and therefore if the market regulator feels that spiral needs to be broken, I think they've broken it. But I think they had clarified that it is to address an unusual circumstance, and today's withdrawal of the April 1 circular would seem to suggest that hopefully this is the first of the overall withdrawal that they will do, so that the market liquidity, the access of corporates, access of banks, and access of all stakeholders in India and outside India to a deeper and more liquid market goes back.
But do you believe that today's relaxations are on account of the fact that the rupee has stabilized somewhat, and that's given the RBI the comfort to take this decision, or do you believe that it is because of feedback coming in from stakeholders? And we've seen that many have been saying that this was perhaps a little too harsh, maybe almost sledgehammer-like. Which of the two do you believe could have been the reason behind today's move?
Well, I think it will be a mix of both. Yes, there was feedback. I think the central bank immediately after the circular and in the days that have followed has been in constant touch with the market. And I think even while wanting to achieve the regulatory objective of putting a curb on speculative positions or very large positions, in the process, when you come out with a circular like that, even bona fide transactions could also get curtailed. There were also a situation where a lot of us had deals out with our own counterparties.
So it was impacting you?
No, I think it was just making it more cumbersome to unwind those transactions, and which is what they have. So they have taken away some of those things which remove the cumberness, which remove the friction without adding to the demand for dollars just through this process, is my sense.
Okay.
So I think it will be a mix of both feedback as well as the desire to be a opening of the market slowly.
But, on the back of what we've already seen the RBI do and today's decision and the move that we've seen in the currency market, what's the outlook now as far as the currency is concerned?
Yes, I think remove these circulars and the last 2 weeks of because ultimately in the long run, any asset, any currency is a function of demand and supply. You can put a halt to temporary demand, which is what these measures did. You can add some supply through some other measures. We are reading about OMC's demand having been taken out of the market or whatever. But ultimately, I think the currency was weakening, not just in the month of March. March was accelerated, but through the last many months. And that I think most people think partly was caused by this persistent selling in the stock market by FPIs, which was almost on a good day, $100 million, on a good day, almost going up to $500, $600, $700 million. And it was almost daily, right? So, and that demand had to be met in the market. Usually you would meet that demand through either FDI coming in. Now we all know that the net FDI number is turning out to be relatively insignificant, while the gross numbers are relatively unchanged and healthy, but the outflow has taken away the impact from a currency perspective. And I think the third thing, which is more technical, is that because there was a like I said, currency was in a self-fulfilling cycle of expectations, which caused exporters to hold back dollar supplies and importers to accelerate dollar demand. So this combination has to be, one of the three of these has to break, or two of the three of these, or three of the three of these have to break for the currency to fundamentally change its direction. We are seeing early signs of FPI selling tapering off. I mean, just let's not make too much of 1 week, but it looks like at least, and you hear from experts that perhaps in any case we are coming towards the end of that because of valuations or whatever. So yes, you would expect currency to be more range bound than it was, but the bias for slow weakness will change only when either the FPIs come back or you have gross FDI, and the exporter-importer narrative will follow these two as opposed to lead these two.
So let's address both the FPI as well as the FDI issue. And, it could be a function of valuations. It could also be a function as far as the currency is concerned that FPIs will consider in the midst of a whole host of other factors. But do you believe that we could perhaps have seen the bottom, the worst as far as the FPI selling is concerned? What do you think could turn sentiment?
Well, the best way to turn sentiment is to report good growth in earnings, right? I mean, if you show good growth in earnings, the kind of earnings growth that historically India has delivered, mid-teens and above, why would people not come back? Because India offers one of the most broadest markets in the world, right? Domestic market economy, IT economy, consumer economy, a very thriving financial services sector, infrastructure sector, real estate sector. You don't get too many markets in emerging markets that have this broader range. And that's what has attracted FPIs over the years to India. So you really want this to change? I think track earnings. The moment you see earnings growth breaking out of the last 15, 18 months of, high single digit, low double digit kind of numbers, it'll come back. Or we need FDI. I think FDI, because it's much more stable, much more predictable. We need a couple of sectors here where global boards start feeling a FOMO. Right? We have to create a sense of FOMO about our market.
So which could those sectors be where between the government and all other stakeholders, in your words, we can create FOMO?
No, we've seen, like you mentioned in your opening comments, right? We've seen significant FDI in the broader financial services sector. We have seen significant money coming into NBFCs, significant money coming into banks, exactly. And it's not over yet, right? I mean, there are other banks which are still in the process of being identified for appropriate buyers or suitors. So in the financial services sector, yes. I think everyone thinks the next round of growth for India has to come from manufacturing, whether manufacturing for the domestic consumer base or manufacturing for the world, and especially with all these FTAs being signed with the UK, with EU. Let's see what happens with the US tariff agreement. So I think it's very difficult to say this sector will drive, but you can sense that last 15 to 18 months, both people in the policy making circles, people in the business circles, I think are looking for that one thing to create that sense of excitement for international investors.
But speaking of sentiment at this point in time, as I pointed out, the war in West Asia continues. We don't know how quickly this will be resolved or whether this is going to continue to be a protracted battle. How is this starting to impact boardroom decisions? Are people now saying, look, let's wait it out, let's wait to see how this settles and then make fresh moves? Or are they saying, let's get on with things because we don't know how this is going to end?
I think there'll be two types. One is if there are strategic markets, right? I mean, you will continue to invest in that strategic market and see through this war situation, because you don't go into a market, commit lots of money, and then because of this you withdraw or you stop investing. That's not how real money or serious money considers itself, right? If you haven't made that commitment, would you go a little slow? Yes, possibly yes. But my own sense is, and our own surveys seem to suggest that, over the last 7, 8, 9 years, the world has got so used to such unusual periods. COVID was perhaps even more unusual than what we are living through. Then we had the tariff-related uncertainty for most of last year. And then we have, the Iran-US conflict out there. I think most boardrooms have become a little tougher on that side, that if we stop at every news flow, at every event,
we're not going to get anything done.
We are not going to get anything done. So I think at least our surveys, our research, our conversations seem to suggest that the world is not going to put things on pause. They might look for higher returns, purely because some of the risks have now surfaced. And now that the risks have surfaced, you want that appropriately captured in the return metrics.
So how do you think India finds itself positioned at this point in time? If you look at what's happening in some of the other high growth markets or high growth regions, they have been very directly impacted by the West Asia conflict. So do you believe India stands at an advantage today on account of that? Or do you believe that, because of the supply chain disruptions, because of the uncertainty, etc., the risks, even for India, have gone up and will then be factored into these investments decisions?
So, Shireen, I think it's almost impossible to say risks have not gone up for any part of the world. I mean, there will be some countries here, there, which might even be beneficiaries of the development since the end of February or so. But overall, global risks have gone up, and that's what is reflected in so many measures of risk. That said, in the context of India, see, why do people come to India? That hasn't changed. Okay, they come to India because we have a large domestic market. They come to India because by and large law and order is a very acceptable compared to countries at our levels of income. They come to India because of the soft power that India wields in terms of the number of engineers we have, the number of doctors we have, the number of nurses we have, etc. They also come to India because of the talent in if I can call it modern economy like IT and potentially AI, etc. Right? So that hasn't changed. And I would say that at the margin, because it's impossible to recreate an economy with 1.4 billion people or to create all the other factors that I've listed, right? At the margin, you are slightly better off. You are worse off than where you were 6 months back or so. But at the